and gratitude when you're successful, and conversely prevents you from being totally down on yourself when things don't work out, because you know that it's not just about you, that there's an ecosystem around you that made you who you are.
Well, speaking of your roots, how often at tech conferences are you asked about Google Cloud?
Quite often.
Really?
And I would point out that the Google relationship started before my brother got there and will endure after me or he leaves our current roles.
But what is it like to have your twin doing exactly what you're doing in a different company? I mean, you know, it's probably, is there any other combination? I don't know of any.
I'm not sure. I think it's an honor to work in the roles that we have. And I think that, you know, there's a sort of a mirror transformation that we are dealing with. We are trying to take NetApp and make it a cloud and AI company. And Thomas is trying to take a cloud and AI company and make it an enterprise business. And so we share notes about what it's, you know, what's involved in allowing organizations and enabling them to make that cultural shift.
Yes, well, you know, it's been an absolute pleasure. Thank you so much for your time, and we look forward to seeing more of you in India, and wish you all the very best with NetApp and all that you've spoken to us about.
Born in Mumbai, Jitu Patel arrived in the United States as a 19-year-old with little money in his pocket, waiting tables at Sizzler for just $4 an hour. Today, he is one of the most influential Indian origin executives in global technology. After spending over 2 decades building and scaling enterprise software businesses, Patel was appointed President and Chief Product Officer at Cisco in 2025. Under his leadership, Cisco has accelerated its push into artificial intelligence, cybersecurity, and enterprise software, helping drive record-breaking growth in recurring software revenues and AI infrastructure demand. As businesses race to adopt AI, Patel's mandate is clear: transform Cisco from a networking giant into the software and security backbone of the AI era.
Hello and welcome to this edition of Young Turks. I'm Shireen Bhan. We're celebrating our 24th year at Young Turks and our 14th year of bringing you voices from the Valley. So it's our great pleasure to have with us on the program a man who's quite literally at the center of things here in the Valley related to all things AI and tech. The man leading products for Cisco, the CPO. Thank you very much. And President Jitu, it's great to have you here.
Welcome to Cisco.
Thank you very much for having us. And wow, I mean, this gives a seat at the table an entirely different meaning, doesn't it?
There's a lot of seats at this table.
There's a lot. But are there really that many seats at the AI table today?
We just actually had our Silicon meeting here with our entire Silicon leadership team, and every seat was filled. But it was a fun day. We spent 2 days over here.
But what about the AI table? Is the AI table shrinking, or is the AI table expanding?
Ever expanding.
Ever expanding.
Yeah.
What's the most exciting thing? I know you've been talking a lot about the fact that you believe we're in networking super cycle. And what does that mean exactly for all of us?
So as you and I have talked about before, we're moving from this world of chatbots to agents. And these agents tend to be far more consumptive in their network consumption patterns than humans are. So for example, we just did a study. An agent consumed about 450% more bandwidth than a human for the exact same.
Good morning. Midweek has arrived and you're watching Power Breakfast right here on CNBC TV 18 in the Mumbai News Center. I'm Hormas Fatakia. With me as always, Rachna Dhanrajani. Rachna, good morning to you.
Good morning, Hormas. Let's quickly go through the headlines for the day. Let's start with the Wall Street. Stocks on Wall Street closed Tuesday's trading session lower, weighed down by losses in Micron Technology and other chip makers due to mounting doubts about the sustainability of the AI-driven rally.
Markets in Asia mirror cues from Wall Street. The Nifty implied open is indicating a gap down start for Dalal Street.
The United States launches powerful strikes against Iran after attacks on 3 ships transiting the Strait of Hormuz, including Qatari and Saudi Arabian tankers. The attacks come after the US revoked a license allowing Iran to sell oil.
And as a result of these attacks, Brent crude prices have surged above the $76 a barrel mark, and after the waiver as well that allowed Iran to sell crude in the global market.
US President Donald Trump resurrects his push to acquire Greenland at the NATO summit in Ankara, warns US could pull its troops from Europe in response to the continued pushback on the issue. NATO countries announced defense deals worth at least $50 billion as lenders sought to demonstrate increased defense spending amid pressure from Trump. Now, first, let's take a look at the Asian markets. The Asian markets are trading under pressure this morning, and the epicenter is once again the chip trade. Samsung's blockbuster quarter guidance that we saw come in yesterday and day before also had an impact, and yet it fell short of the street's sky-high expectations. It's pretty much at a point that Samsung is crushing under its own expectations, and that disappointment has knocked Korean markets sharply lower, with the weakness spilling into Japanese and Taiwanese tech names as well. So the regional read right now is clear that after a stellar run, semiconductor stocks are seeing profit, taking on any hint that reality cannot keep up with the hype. And that mood carried through Wall Street overnight. US stocks fell after Samsung's results and also on reports that China's DeepSeek is developing its own AI chip has triggered renewed selling in semiconductors. We'll get you more on that when we get you the AI pulse. But adding to the caution, the crude prices have surged after Washington moved to revoke the license permitting Iranian oil sales. Now, this is something that could not be ignored by Indian markets as well. So to get you an update from what's happening back home here after a 4-day winning streak was snapped yesterday. Hormaz, what are you seeing in the setup today?
The setup does not look good, and understandably so, considering the overnight developments that you're watching. The implied open is now suggesting a 200-point gap down as we speak. The reason behind that possibly could be a rise in oil prices. It's not a significant rise, of course. It's from $70 we've gone to around 75, 76. The market is still not gone into panic mode, even though the situation in West Asia appears to be deteriorating, because the market somehow still continues to believe that sooner or later there will be an agreement or a settlement that will be reached. Even the Central Command has said that they have completed the round of retaliatory strikes against Iran. But still, oil prices are higher. The GIFT Nifty is indicating a gap down. Now, why did we fall yesterday? Well, we made an intraday high yesterday. We were closing in on that recent swing high of 24,600, but then we reversed course towards the close. Of course, that was also due to the weekly expiry factors. And as Sudarshan was also highlighting yesterday morning, that the put call ratio has gone up to elevated levels. And usually when the put call ratio goes up to 1.3, 1.4 odd, there is always generally there is a reversal that you see. And of course, as a result of which the index also reversed around about 180 points from the day's high. The Nifty Bank was the bigger underperformer. That reversed 380 points from the day's high, and that dragged the Nifty lower as well in yesterday's trading session. The concern though yesterday was the underperformance of the broader markets. The advanced decline was two stocks declining for every one that advanced. The mid-cap index, although it recovered from the lows of the day, was still an underperformer. Now then, despite the fact that we ended lower, the series of higher highs and higher lows continued on the Nifty for the 5th straight day. That, of course, will be put to test today, considering the fact that we are opening gap down. So it will be interesting to see the kind of moves that you see from lower levels, most predominantly around that 24,150 mark, that where we are likely to open today. The 24,500 level, although remains a key supply zone, we did cross it yesterday. We made an intraday high of 24,530, but could not sustain at those levels. So that is an important one. So that is the congestion zone that needs to be watched out for. The Nifty Bank again continues to find resistance at 58,500. That is the first level to cross before it goes to its recent swing high of 58,700 odd. So that is that. But the trend for the Nifty Bank remains positive until the recent lows are protected. The recent lows are anywhere between 57,500 to 57,700. So that needs to be watched as well. Now the chip stock sell-off last night, would that result in another positive day for IT ahead of results for TCS tomorrow? That remains to be a monitorable. Whether the broader market underperformance continues, that is going to be another monitorable today. And of course, the business updates that have come in have shown that even the slightest disappointments, as Rashna was also highlighting, the weight of expectations is punished. Trent being a case in point yesterday. So a lot to watch out for in today's session. It's a sandwich session between the two expiries. The implied open is suggesting a 200-point gap down. It remains to be seen whether there is some buying that comes in at lower levels.
All right, those are the key levels and the gap down session. But now over to Ananya, who will list out the stocks to watch out for in today's trade. Good morning, Ananya.
Good morning. So let me walk you through the stocks that should be on your radar today. Let me first start with Interglobe Aviation, that is Indigo. Now, this will be in focus after DGCA data showed Indigo retain its market leadership with a 64.9% domestic market share and the best on-time performance at 82.8%, supported by healthy growth in domestic passenger traffic. Now, moving on to Minda, also announced a major expansion into the four-wheeler passenger vehicle seating systems business with a 320 crore greenfield plant in Maharashtra. Now, the facility is expected to commence operations by Q4 FY28 and has already secured its first major OEM order. Now, in the technology space, IdeaForge has opened its QIP at a floor price of 835.86 per share, while Silver Technologies has secured an order from RITES to build an AI-native platform for infrastructure project appraisal. Now, among other stocks, EMS has emerged as the L1 bidder for a 158 crore Delhi Jal Board project. Now, MTA Technologies received an ICRA rating upgrade to A+, that is stable, while Cochin Shipyard will remain in focus after the government expanded its offer for sale to 5.04%. So watch out for these stocks in the trading session today.
Ananya, thank you for those updates there. And of course, the big developments that have happened in West Asia has had a direct impact on oil prices and a lot of other commodities as well. Manisha Gupta is here with all the latest updates. Manisha, good morning.
Morning, and thank you for that. Well, absolutely. 5% of gains in the overnight market for the crude futures is no small feat, and we've seen that kind of a gain come in after a very long time, many weeks actually. So with this, we are looking at the futures now trading above $75 a barrel. The U.S. military has carried out fresh airstrikes in Iran. There have been various statements from many authorities. CENTCOM, for one, has said that the U.S. strikes are in response to Iran's attacks on 3 commercial vessels that were transiting the Strait of Hormuz. And with this, Iran has demonstrated aggression that was unwarranted, dangerous, and a clear violation of ceasefire. But in addition of that, the U.S. Treasury Department also has revoked the general license authorizing the production, delivery, sale of all petrochemicals of Iran origin. Now, that really brings in the supply concerns back into the market. Remember, till yesterday, the street was, calculating the surplus that we perhaps might be looking at by the end of this year. But clearly, the U.S.-Iran conversation or the peace deal is not going to be as smooth as most markets believed it to be, and that exactly is what we've seen in case of prices. The strength in crude oil prices has led to a decline in metal prices. You have gold, which is just about holding that $4,100 an ounce mark. Silver fell 3% yesterday. Copper declined 1%. Gold was down 1.5% as well. So most of the metal prices yet again in the negative, again in Asia right now.
All right, thank you so much, Manisha. All that action in oil and OMCs to be in focus today. But for now, let's slip into a break. Up next, we get you all the cues from Wall Street. Welcome back. You're watching Power Breakfast on CNBC TV 18. Now, in the US market, stocks closed lower after chip sell-off drive major indices down. Nasdaq was down more than 1%. CNBC's Contessa Brewer gets us a wrap of all the action on Wall Street.
U.S. markets were down across the major indices in Tuesday trading as chip stocks fell and oil prices moved higher. The Dow fell 131 points, the S&P 500 was off by 34, and the tech-heavy Nasdaq lost 302 points. It was down more than 1%. Meta is facing a trial in California next month, accusing it of designing Facebook and Instagram to addict younger users. And the company just revealed in a court filing the states involved are seeking a combined $1.4 trillion in penalties. That's just shy of the company's total market value. According to the filing, the penalties were calculated based on laws in the 4 states involved: California, Colorado, Kentucky, and New Jersey. But Meta argues there's no evidence to support that amount and no analog in the history of consumer protection for a sanction of that size. And Nestle is tweaking some of its recipes to appeal to duller palates of people taking GLP-1 weight loss drugs. A recent study showed the perception of the 5 basic taste qualities, sweet, sour, salty, bitter, and umami, were depressed by the drugs. Nestle says its chefs will work with patients to get the right taste, which could include adding spices. It's also tweaking nutritional labels and some of its portion sizes. That's what's happening in the United States. I'll send it back to you in Mumbai.
Contessa Brewer, thank you for that update there from Wall Street. Let's also now listen in to Mohammad Al-Aran, the Chief Economic Advisor at Allianz, who says that the Fed will not either hike or cut rates for some time now. He adds that the worst of the inflation scenario is now behind. Listen to what he had to say.
First, I think the worst of inflation is behind us. I think we're going to have the peak of this cycle, either the June data or July. And what's left driving inflation comes mainly from the AI, and that has a positive supply side coming with it, as opposed to what we've left behind, which is oil and tariffs, which had a negative supply side aspect. So the Fed can live with that. Why not cut too early? Just wait and see how it evolves. And I think the economy is in a good place right now, and just let it run.
All right, let's slip into a break now. Up next, we get you the updates from the world of technology and artificial intelligence, so stay tuned. Welcome back. You're watching Power Breakfast on CNBC TV 18. Now, getting you the latest on Trump-related developments, we have Vinny joining us in our special segment, Trump Watch.
Hi, good morning. So first up, we get you updates from West Asia, where the ceasefire is under fresh strains now. The U.S. Central Command says its forces have begun a series of powerful strikes against Iran. This is in retaliation for the Iranian attacks on 3 commercial vessels transiting from the Strait of Hormuz. Now, furthermore, they also called Iran's actions unwarranted, dangerous, and a clear violation of the ceasefire. Now, this marks the first major U.S. strike on Iran since June 26th and comes days after Trump's 6th July warning that came in, where he said that we are either going to delay or we are going to finish the job. Moving on, additionally, the U.S. Treasury revoked the general license which had authorized production, delivery and sale of Iranian origin crude oil and petrochemical products. Now, this move, which is going to be coming in effect from 7th of July 2026, tied directly to the Strait of Hormuz tanker attacks that happened. And Iran's foreign ministry called the revocation a breach of Islamabad's MOU ending the war. Meanwhile, on the sidelines of the NATO summit in Turkey, President Trump signaled that the U.S. is ready to lift sanctions on Turkey. His words, standing next to the president of Turkey, he said that where it is time, we don't want to have sanctioned friends right now. He says that the Secretary of State Rubio, Treasury Secretary Bessent, as well as Defense Secretary Hegseth are now working on a mechanism to lift these sanctions and, deliver to Turkey as well in terms for the defense side. Furthermore, President Trump also wasted no time in reopening an old fight with Greenland, landing or for the NATO summit, he told reporters Greenland should be controlled by United States, not by Denmark. And President Trump did not stop there. He put new threats on the table, pulling U.S. troops out of Europe altogether. He named some names, saying Italy, Germany and France. I quote, he said that they were not there for us. So during the war of Iran, why should we be there? Listen to what he had to say.
Greenland doesn't help Denmark. Denmark doesn't spend money to really help Greenland, but it's an important part for the United States. And it's surrounded by China ships and Russian ships. And that's not going to happen. The ships it's not going to happen. It was Greenland that, and it continues to be, that should be controlled by the United States, not by Denmark. And when they wouldn't go along with it, and with all the money we spend to help them with Russia, and we don't have to spend any money, we could remove all of our soldiers out of Europe.
Donald Trump and the Greenland rhetoric returning. Vinny, thank you for that update as well. Moving on, here's Ajay Singh, the CEO of SpiceJet, on the challenges faced by the Indian aviation sector and the outlook for tourism as well.
Well, of course, it's been a terrifically challenging time. The last few years have seen unprecedented geopolitical issues, starting with the Russia-Ukraine war and then the Indo-Pak conflict that we saw, and of course the West Asia conflict recently. On top of that was the crash of the Air India aircraft. So sentiment has been very poor. Oil prices have generally been extremely high, and so it's been a huge challenge. I think aviation is one of the most important infrastructure, sectors for the country, and therefore I think we all need to work together to ensure that the sector is strengthened and that airlines can continue to exist and do well. I think that tourism is bound to increase as things start to stabilize. At this point of time, sentiment is a little dull, but there's no question that this is a process which will take a few months at best, and you will see tourism back to normal, healthy growth.
And now it's time for all the updates from the world of tech in our segment, the AI Pulse. Rachna has hopped over to the wall for the latest updates. Rachna.
Well, first up is the chip stock sell-off that happened again on Tuesday, and the trigger was a strong result. Samsung has posted preliminary second quarter operating profit of about $58 billion, which is a 19-fold jump. That beat estimates that we've been reporting for the last 2 days, but it has not been enough. Shares have fallen as much as 10%. On Wall Street, Intel and Applied Materials dropped around 10%, AMD fell 8%, and the Nasdaq closed down 1.2%. Feeding that same sell-off, a Reuters report that China's DeepSeek is developing its own AI chip. As per the report, it's built for inference and not training and aims to cut DeepSeek's reliance on NVIDIA and Huawei. The effort is early stage. DeepSeek has not commented yet, and NVIDIA itself closed higher on the day. Reuters also reports that Beijing is weighing curbs on overseas access to China's top AI models. As per the report, officials have met Alibaba, ByteDance and Z.ai, and any restrictions could extend to unreleased models yet. The talks are ongoing with no final decision yet. Remember, just yesterday we told you that how US companies are now flocking over to Chinese models to save money. But now that looks difficult. Then there's Ukraine, which has said that it will favor AI it can run only on its own servers, limiting provider-controlled models like those from Anthropic and OpenAI. Now, Kyiv says that stance hardened after Washington ordered Anthropic to cut access to its most powerful models. To the money funding all this then, Amazon is back in the bond market to raise at least $25 billion. As per reports, its 2026 capital spending is projected at $200 billion, up from $131 billion last year. On the other side of that spend, Microsoft is now using its own in-house models to answer a share of prompts in Word and Excel, cutting reliance on OpenAI and Anthropic. According to Bloomberg, NVIDIA is also pushing beyond AI chips. Perplexity has confirmed that it will use NVIDIA's new Vera CPU with OpenAI, Anthropic and Oracle also on board as NVIDIA takes on Intel and AMD. And finally, Meta has launched Muse Image, its first in-house image model from Super Intelligence Labs. It's live across Meta AI, Instagram and WhatsApp. One feature generating images from friends' public Instagram posts is on by default and has already drawn a lot of scrutiny. This is the second one to come in this year under the leadership of Alexander Wang, who is the AI head of Meta. That's all from the world of AI for now.
Rachna, thank you for that update there. Of course, a lot relying on the chip companies and the sell-off that they saw last night. Micron, Intel, all of them. Intel was down 10% in yesterday's trading, and that may or may not have had a bearing on how the Asian markets are faring right now. The Taiwanese index is down 0.7%. There is a bit of a rebound in the Hang Seng. The Hang Seng has been a big underperformer this year in comparison to a lot of its other Asian peers, be it the Kospi or the Nikkei. The Kospi at one point was down around 0.7%. That has now extended its losses down another 2% in today's session, and the Nikkei too trading with losses of around 0.8%. Just pull up oil as well to see whether there has been any further fluctuations in oil prices. At last count, Brent was around 75.87 when we last checked after the recent developments in West Asia. Well, they're back at 76 is Brent, so 2.5% higher on Brent, another 2.5% added to NYMEX as well, so that too is now back at the $73 a barrel mark. You're back above the pre-war levels on oil prices, and that has had a bearing on the GIFT Nifty as well. The GIFT Nifty was down around 200 points, continues to remain so. So we most probably open around the mark of below the mark of 24,200, beg your pardon, around about that 24,150 mark. So it remains to be seen whether there is some recovery that comes in from lower levels. Take a leave on this edition of Power Breakfast from Rachna and me. Thank you for watching. Bazar Morning Call on the other side.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazar Morning Call, coming to you live from the CNBC TV 18 Motilal Oswal studios. It's a Wednesday morning, and we are back full up on the team. I'm Prashant. With me, my colleagues Rima and Nigel, who's back from the land of the rising sun. Welcome back, Nigel.
Well, good to be back. Arigato gozaimasu, as they normally say. Thank you very much in Japan. Beautiful country. Lovely to see the way they have progressed and so well planned. But obviously, I'm happy to be back because I love India. So towards the end of the trip, I was longing to come back. But beautiful country. But I would just have one advice. Whoever is going there first time, a kid's first visit, if it's over there, then you set the standard over there. So everything else will be downward from there. Very, very well planned. I think something to learn from there. But Mera Desh is, I'm so happy to be back.
We're so happy you are back. So it's great to have you back. So two big headlines, right? Nigel is back and the other one is geopolitical. Geopolitics is back in focus and crude prices soaring.
It was a question of when, I guess, right? That something will flare up. It was not supposed to be so peaceful. I mean, it was never. If you remember, even on the day when the ceasefire was announced and everything was kind of all
fragile.
said. It was fragile. Something will happen. It'll be bumpy. And I think it's happened.
And I think if I have to throw in the third headline, I think 40 is, not so bad. Djokovic, Djokovic,
Messi?
super and Messi. In the last
fantastic night for sporting fans.
And I'm saying that 40 is the new 20, Prashant.
I'm way past 40. So I think...
No, I'm thinking hard for that.
Okay, let's just take it from the top then in terms of where we are at as we start this session. So oils, by the way, jumped 5% overnight, and we are back above $75 a barrel. Actually 76, actually past 76. So there's a bit of an up move this morning as well. So what's happened, right? I mean, you'd ask. Actually, let me just run through the price action. The U.S. equity slipped. NASDAQ was down about 1.16. The S&P was down 0.45. You look at the U.S. 10-year yield, bond yield, that's also jumped about 8 basis points, about 4.5% or so. You basically got a couple of things which have happened. U.S. struck Iran and essentially revoked the 21st of June waiver that authorized the production, delivery and sale of crude oil of Iranian origin. This was a key element of the Iran-U.S. MOU. Lots of reporting around it in terms of why this has happened. Now, we know it from the U.S. Central Command themselves. This they posted on the social media platform X. They said the U.S. powerful strikes on Iran were meant to impose heavy costs for targeting and attacking commercial shipping crude by innocent civilians in an international waterway. So that's essentially the tweet that I'm talking about, the post, the X post that I'm talking about. So there was basically a Qatari ship which was attacked, a Saudi ship which was attacked, and the U.S. essentially saying, well, this was the attacks on Iran were in response to it. Now, Iran's deputy foreign minister has essentially vowed decisive actions in response. Where have we heard this? Not too long back, right? I mean, the cycle of, the bigger threat, sometimes, of course, followed up by action, but which eventually kind of died down, wound down, and markets responded with an aggressive repricing lower on oil prices as well. The question is, will this actually have an impact, a lingering impact in terms of traffic, ship traffic through the Strait of Hormuz? Again, this is all, and this may change because this is a live situation, but over the last 12 hours from what I've read, it's not made too much of an impact in terms of the traffic. Reports suggest that Japanese Singapore flag tankers continue to sail through. And remember, before this latest round of escalation, data from Kepler showed that traffic through the Strait of Hormuz is back to about 2/3 of where it was before the 28th of February, before, of course, the Iran-US conflict started. So again, I think this has become a variable in play. And people, many have expressed and scoffed at this agreement, saying, well, it's untenable, basically deviates from the position that either sides have had, and that maybe the core of the agreement at some level will hold, but it'll be bumpy along the way. So is this just that one of those bumps, or perhaps this is, once again, we've got to start to track this in a more core kind of a way. But 76 on oil, so I guess it makes a difference to large oil importers, and maybe not immediately, but we'll be watching carefully. It's an important variable. And I mentioned bond yields, which jumped, right? 8 basis points higher. Amazon's new 25 billion bond offering last night, and this, I think, was one of the reasons, saw softer than expected demand. I mean, I think it got done fully and oversubscribed and all of that, but I mean, I think to begin with, it kind of saw a little softer demand. Elsewhere, I think that NATO conference is on. I think today is the last day. Trump essentially saying that he may reverse his own ban on Turkey buying F-35s from the US. I'm not going into details, but there's a backstory and what this may mean, but we'll see. I'll just leave you with levels, right? Over the last 1 month, the Nifty is up over 1,000 points, 1,000 points in less than 1 month. And this is what we started with yesterday morning. And we got a bit of a pullback. I mean, nothing to really worry about. But, 50, 60, 70 points, about 0.25%, about 0.5% across the Nifty Bank, mid-cap, small-cap indices. And that's where we left off. Mid and small-cap indices have done so well, and people have been waiting for the large-cap indices to do well in the second half and catch up with the broader market. So it's not been, actually, it's been a pretty good setup, all told. Yesterday's high was 24,530. So that kind of becomes the first level on the upside. Next target doesn't change, 24,770. And the 40-day becomes the support, the first support if you're trading. That's at about the 24,250 kind of levels. So will we see the 40-day before the market kind of bounces up once again? We'll see. But this morning, you've got a bit more in terms of profit booking. At least that's the indicative open, about 200 points lower. But remember, as I said, the context is over 1,000 points in less than a month or so. F&O positioning and the data, what does it tell you? Nigel has got that. Nigel.
Well, the Nifty ended a little bit lower yesterday. Maybe, in fact, it preempted some overnight scare, or maybe, in fact, it had the weekly expiry as well that played out. But if you pull up the intraday chart, you'll see that the Nifty ended lower. So some part of this morning's bad news, well, it could be a little bit in the price. And there are two big cues to track from the globe. One is the Middle East tensions that have flared up. The second factor is the markets awaiting the Fed minutes as well. That's going to be the big trigger. And that's why we'll have the dollar index that will continue to remain in focus. Remember, it strengthened to around 101 or thereabouts. The last time I was on television, well, it was holding around that 100 odd. So some bit of strength out there, and Brent crude prices as well have perked up. But Brent crude still far away from those scary levels that we talk about. Well, in terms of the flows have turned positive. The FI is bought for the third straight day. So the FI is bought while the DI as well, they sold. So they cancelled off each other. But good to see that the FIs, they were buyers yet again. In terms of the positioning on index futures, well, they covered some shots. They covered close on 2.4 thousand short contracts. And that was the fourth straight session that we saw that the shorts have got covered. Remember, they started the series itself very aggressive on the short side, but that's gradually been coming down. If you pull up another chart, that'll tell you they have covered close to around 20,000 short positions in the last few days, while the clients as well that were still aggressively net long, those long positions have got unwound to some extent. Moving to the options data, two strikes fairly active, 24,400 call. There was some writing out there. Premium at around that 130 to around 160 rupees. So there's clear signs of writing out there. While on the downside, the 24,000 put, that continues to get written. So just plugging in the options data and looking at the technical levels, I think support comes in at around this 23,800, 24,000 odd. You'll still have to bet on the market moving up because the 20, 50 and 100 DMA, that comes in that vicinity. While you have resistance going by the options data, first resistance level is obviously at around the 24,550 and then all eyes on the 200 DMA, which in fact, if we get past that. Nifty Bank, that's been the strong point for the markets for the last few trading sessions, and that's really been holding on to its own. The 20 and 200 DMA, that's close to around 700 points from current levels, and that one will have to hold on to those levels, for the markets to further trend up. So I think a bit of a pullback to start off, but the texture of the market is looking pretty good, going by the flows that we're seeing, the shots that are getting covered out as well. So let's see whether or not this dip gets bought into today.
Well, IT has also been a strong point. It hit its low on 1st of July, that's last week, and from that level, it's gained close to about 9%. But we've got Arvind Sanger here with us in the studio. Good to have you. What brings you to India? And you want to just quickly react to the flare-up that we're seeing in Middle East and what it means?
Sure. I flew through Qatar and I'm flying back through Qatar, so I'm hoping that the flare-up remains somewhat contained. But, I was actually supposed to be here on, I was supposed to leave the U.S. on February 28th night, and I canceled that trip.
Wow.
And so
it was a Friday, I remember, right? It was a Saturday.
Saturday night.
Saturday morning, yeah. Correct.
In New York,
Saturday morning,
it was Saturday. So, so that was an overdue trip, and this is a good chance to catch up with things. I have a personal reason my mom is here, but I think the thing that is very interesting is how quickly the dialogue changed from oil going to 150 to oil going to 50. And I think, I was also surprised that oil remained as well behaved as it did, given Trump's tweets and his clear intention not to let oil run up. But on the other hand, I think the rumors of a glut were highly exaggerated. All that you were seeing was the 100 million barrels of floating storage flowing out. And that floating storage flowing out created a short-term glut. But the reality is that oil flowing out of the Persian Gulf, even if you include the stuff that is coming out of the west coast of Saudi and coming out of Fujairah, is still not back to normal levels. So we've been helped by certain short-term factors, but I believe that this, quote-unquote peace is going to remain fragile. We don't believe that Iran is willing to give up their nukes. They have kind of hardened their stance on that after the U.S. attacks. And so we think that anything that comes out, there's some talk that Trump may try to make peace now and after the midterms come back to finish the job. So the Iranians are not stupid. This is not going to create a stable environment. So if you're India, or if you're Japan, or you're Korea, or you're Taiwan, or you're Southeast Asia, do you feel lucky? Or do you want to rebuild and extra build strategic petroleum reserves? And I believe that people are underestimating the demand that is coming from that, and the supply is still not back to normal. Yeah. So we believed, once the peace deal was signed, that we're in an $80 to $100 oil barrel. And I think don't pay attention to where the oil price is now. Focus on where it's going. And I think 80 to 100 is not terrible for the world, but it's not the panacea that $50, $60 oil would be.
By the way, for those of for our viewers who don't know, maybe some know, if you can give me Arvind on a 2-window. Let me reveal a little secret. It's not a secret. Those who know. But Arvind Sanger is the father of the founder of Cursor. And he's had a ringside view, and we've been asking you about IT stocks and what to do with all of that stuff here. And Arvind has been skeptical, but I think what has been done with Cursor and of course the sale to SpaceX for $60 billion, has just been outstanding. So hats off, Arvind. I don't know how much influence you had, but tell us a little bit about it. Well, you've had a ringside view to it.
Yeah, it's been an amazing journey. I mean, in the first few months of their startup, they were staying in our apartment and they would take their shoes off. And I don't know if you've read, Cursor is one of the companies that you take your shoes off when you go to the office. And that I think we can take a little credit for that from when they were our apartment in New York was a garage while we were living in Miami. We moved, part of the year in Miami. And so, but it's been, look, at the end of the day, it's a question of them having found the right thing at the right time. Yeah. And obviously hardworking, Aman was always a hardworking kid.
I interviewed Aman at IIT Bombay here, and I think you were there too. I mean, absolutely outstanding. I mean, of course, just incredible. And how does it feel to be the father of a billionaire? Well, a billionaire a few times over.
Yeah. Well, I used to be known for my own accomplishments, and I'm known as the father of Aman. So it's a very, as a father, it's enormous joy.
Did you get to meet Elon?
I haven't met him, but he meets him regularly. So he tells me about
all that is proceeding, right? I mean, the transaction, etc.
They're working on a new model that's going to come out soon, which is in conjunction with SpaceX XAI. So all of that is going well, and I'm hoping to get him to India again for a quick trip sometime.
I want to meet him when he's here. So. Oh, amazing. So just off that background, right? What is your sense about what's happening in this space? Because this has been the big driver for so much else around it, right? This AI capex story, and it's fueled markets as whole. I mean, Korea, for example, 2 companies. Taiwan. I mean, actually, for India, the issue has been that maybe those markets got too red hot, and India's in that sense been ignored. But the sustainability of it, I mean, the hyperscalers are writing the big checks and it's all flowing downstream. What's your sense?
I think there's, like any major technology, there is no straight line. And so there was a straight line assumption. There's a lot of money being spent, and now people are looking at cost benefit. And when they're looking at cost benefit, the reality is that you're going to have some digestion issues. And so I think that, from an India standpoint, India was the anti-AI trade, which has been helpful in the last few weeks as the AI thing has died down. But I would say this is a technology that is coming. It is not a straight line, but the impact it's going to have is meaningful. It is going to take, a couple of years to fully play out, and there'll be cost pressures, and there'll be, other things. We invest in companies that are in the energy and power space and enabling the AI data center build out. And we're looking at opportunities in India as we do in the US. And the reality is that demand is still going to be there, whether it's for inference or for training, and now it's going to be more inference. And I think the adoption curve is still very solid, whether you look at Anthropic's data or Cursor's data or anybody else's data. But, the Chinese models are giving them a run for their money in terms of low-cost options. So I think the US companies will have to figure out how to do both. But from an India standpoint, I think the challenges remain that India is not on the inside of this AI race. So how does it wend its way? Especially, not just the IT services companies, but these global GCCs are not immune to what's coming. So people are looking at this as a great growth story, but this has its own challenges as white-collar jobs get displaced.
Arvind, but are you seeing, keeping that in context, right? I'm just looking at the kind of volatility the Kospi has seen over the last few months. The average intraday volatility of the Korean index from Jan to now is 3.3%. And the only time we had a number, this is intraday volatility, was more than this was in the Asian financial crisis in 1998, when the intraday volatility was 3.5%. I mean, that makes it tough for incremental allocation when you're swinging 7% on either side every alternate day. And plus, we've seen foreign investors sell in Kospi for technical reasons. There's a forced rebalancing. So incremental money into Kospi Taiwan at this juncture, does it make sense? And are you seeing increased inquiries towards India?
Well, if you look at, let's start with the US, and then let's look at Taiwan and Korea. US market cap today is like, what, 2/3 of the world market cap? That is an unsustainably high level. Korea and Taiwan together now more than 50%, or they got, I don't know if today they are, but they were close to 50% of global emerging markets. That's unsustainable. So yes, we have valuations in the AI beneficiaries which have gone so far ahead of where they need to be long-term that you are going to see volatility. And for value investors like ourselves, we are looking at, at markets like India as presenting opportunities from a valuation standpoint, which finally starts to, on a relative basis. The problem with India has been that it is never really cheap, but no longer is it on a relative basis as expensive. So that makes it interesting. And that's what you're seeing with the FI flows as people realize that.
So there are increased inquiries towards India?
I think there is a recognition. Look, India is going to be a bottom-up story in my mind.
Yeah.
It is not a macro story that is going to blow your socks off. And you look at the nominal GDP growth numbers, and the nominal GDP growth numbers are multi-decade lows. Companies' revenue growth is driven by nominal, not by real. So that's the challenge.
Arvind, does Aman come to you, say, well, Dad, here's a couple of $1 billion to manage? Has he come to you? No?
He's right now trying to close that deal with SpaceX. We'll see where it goes.
Well, thank you so much for dropping by. Great conversation, and congratulations. Do pass on our regards, and congrats to Aman for that fantastic deal and all the achievements. Thank you very much.
Thank you.
Thank you.
Okay, well, that's the conversation with Arvind Sanger, markets, a bit of tech, and of course, a broader view on what's going on. Let me just quickly run you through the interactions which are lined up today. 8:35, GK Energy will discuss their recent order wins and the key revenue drivers. 9 o'clock, Praveen Sai of PL Capital on the consumer durable space. 9:20, Gautam Trivedi of Napian Capital. 9:35, GICRE on reinsurance. The IT sector in focus ahead of the first quarter numbers. Sumit Jain of CLSA, and towards the end of the program, Lata speaks with economists Santanu Sen-Gupta and Samiran Chakrabarti in today's Indianomics.
Well, time to slip into a short break. On the other side, we've got a lot of stock-specific action that we'll track for you. We get it done in just a bit in our special top 10 segment. For the time being, I'll run you through the list. Interglobe Aviation, Uno Minda, MTAR Tech, and EMS. They're stocks that are reacting to positive news flow, while on the other side, you have Idea Forge, Kochi Shipyard, City Gas Distributors, Gold Sensitives, and Hindustan Zinc that will be reacting to the moves in terms of material prices. While crude sensitives, well, they could be more or less mixed in today's trading session. Take that break, get into further detail on all of these names.
Welcome back. Let's talk stocks now. Our entire research team is standing by with CNBC TV 18's list of top stocks for the day. Let me go across to Vinny now for the latest on Interglobe Aviation and why it should be on your watch list. And good morning, both Vinny and Vivek.
Hi, good morning. So first up, in terms of Interglobe Aviation and the aviation industry as a whole, we have the data that's coming in for the air traffic for the month of May. Now, May saw 1.54 crore passengers, and that is up over 9.5% versus April. So month-on-month basis, we are seeing an increase coming in. Furthermore, the domestic aviation rebound in May comes in after the disruption that we saw for West Asia conflict. Indigo flew around 99.9 lakh passengers. That is up 11% as well. They maintained their market share at 64.9%. The 64-65% range is what the company has managed to maintain over the last few months, and last year itself also they managed to maintain that level. Now, apart from that, the data also indicates that the passenger load factor for Interglobe Aviation has improved to 86.4% versus 82.7% in April. This is, they've also had the highest on-time performance among major airlines at 82.8% with just 0.36% cancellation. So interesting data, good data at least coming in for Interglobe Aviation for the May traffic data point, and that is why green could be seen here.
Got it. All right, Vinny, thanks a lot for that. Well, let's hop across to Vivek. He's tracking a few companies, Idea Forge, Kochi Shipyard as well. Morning, Vivek.
Well, good morning. Well, looking at two companies, again, you're talking about fundraising over here. Idea Forge, remember, has gone ahead and launched a QIP for a fundraise. The company is looking to raise up to 500 crore, and the indicative issue price for this particular fundraise is at 795 rupees a share, which implies a little over 5% discount to the last close. The equity dilution pre-issuance of capital is almost 14.5%, so it's a large dilution coming across. Why is the company raising funds? Number one, for debt repayment. Number two, for funding working capital gaps. And also, the company will be investing in product development. Now, coming to Cochin Shipyard, remember the stock was in focus yesterday as the government went ahead and launched an OFS to raise or to sell up to 5.2% stake. The base size was 2.5%. So the government has decided to go ahead and exercise the green shoe option. And the clearing price for this particular retail bidding is 1415 rupees a share. So 1415 rupees a share is the bid at which retail can go ahead and exercise the right for this particular OFS. Now, when you're talking about the total discount that was given as far as the base size is concerned, almost a 7% discount to day before yesterday's closing. So again, this particular stock expected to be a little under pressure on account of the discount being given.
Thank you very much for that. Ria's also now joining in with the latest on Uno Minda, MTAR Tech, and a few other EMS companies that she's watching closely.
Well, good morning. Starting off with Uno Minda first, the company has entered the four-wheeler passenger vehicle seating systems segment. They have announced that the JV will be setting up a greenfield plant with a 320 crore rupee capex, and which is expected to commence operations by the fourth quarter of FY28. And also, they have further approved an equity investment of nearly 93 crores in the JV. So, a positive movement expected on Uno Minda today. MTAR Tech will also be in focus as ICRA has upgraded the stock's rating from A to A positive on facilities worth nearly 1470 crores. And lastly, EMS Limited will also be in focus as the company has bagged an order worth nearly 158 crore rupees from the Delhi Jal Board for sewage work, and this is to be executed over the next 15 months. So all these stocks expected to trade positively today.
Got it. Okay, all right. Thanks a lot for that, Ria. Well, let's go across to Manisha. She's here to tell us about the crude sensitives, the city gas distribution companies, as well as gold and silver sensitives. Morning, Manisha.
Morning, Nigel. Thank you for that. Well, I'll start with the crude oil prices because the futures are now trading above $75 a barrel. We've seen 5% of gains in the overnight market. This is as the U.S. military has carried out fresh retaliatory airstrikes in Iran. This is in return to Iran attacking vessels transiting Strait of Hormuz. The CENTCOM statement does say that Iran's demonstrated aggression was unwarranted, dangerous, and a clear violation of the ceasefire. And that's exactly what the markets are reacting to. In addition to that, the U.S. also has revoked the general license authorizing Iran to deliver, sell crude oil and petrochemicals to the world. So that tells you that all the supply situation calculation that the street was doing till yesterday, today perhaps would take a different turn. Kepler data does suggest that we have been looking at increase in Strait of Hormuz vessel traffic, but that perhaps could see a standstill in the markets today. So that's something that the street will watch out for. Iran, in any case, has said that all the transit of the strait should only use routes approved by Tehran and avoid any separate temporary shipping corridor established by Oman or the International Maritime Organization. And that is a premium that the crude prices are seriously working on with. But it's not just about the crude prices. It also is the kind of sell-off that we have seen in metal prices, more so in precious metals, where gold fell 1.5%, silver fell 3% in the overnight markets, now below $60 an ounce. And with this decline, we're looking at silver prices down by 55% from its highs in the month of January. It has to do with the strength in U.S. dollars, surge in crude oil prices, but all of these markets are now waiting for the Fed June meeting minutes. Will that come in today? Further direction would come in from that.
Okay, all right. Well, Manisha, thank you very much for that. So all eyes, of course, on oil. Our top stocks and the recap of what we've put out, right? Stuff with positive news flow: Interglobe Aviation, Uno Minda, MTAR Tech, EMS. Well, stocks on the negative side: Idea Forge, Cochin Shipyard, City Gas Distributors, Gold Sensitives, and Hindustan Zinc. Crude sensitives, of course, are likely to open mixed this morning. Take a quick commercial break. We're back with the marathon of GK Energy on the other side on the recent order wins and key revenue drivers.
Welcome back. A quick check on Asia before we proceed. The GIFT Nifty anyway is suggesting a downtick after the near 1,000-point rally that we've had on the Nifty in the last 1 month. So profit booking is visible on the GIFT Nifty, but you are seeing softness across most of the Asian market screen, barring a Hang Seng. The Korean markets are down nearly 2%. The high on Kospi was about 9,385, so nearly 9,400. Today, Kospi has dropped below 7,500. So from the top that it hit just, I think in the start of June, in the last 1 month, the Kospi index has fallen nearly 20%. The Japanese markets too are selling off. We've seen a flare up in Middle East. The Strait of Hormuz remains a watch point right now. Crude prices are also higher and very close to that $76 per barrel. So all that is weighing on sentiment when it comes to Asia. But for our own markets, one sector which has been doing very well has been IT. I mean, it's been doing well only for the last 4 or 5 trading sessions. From the start of the year, the Nifty IT index is still down 30%. But as we enter into the earnings season, with TCS tomorrow, we've been trying to get some opinion on where the sector is headed, and hear out an interesting opinion that we got from Sandeep Tandon of Quant Mutual Fund, and this is what he had to say.
IT sector, which we have been quite bearish for a while now, looks attractive. They are now in the neglected zone, which we typically look for a buying opportunity, and that's the reason we have started nibbling into it, but very selectively. But if you ask me, this is a time to go all in and this is a time to take very big contra and aggressive call in IT, then answer is big no. As far as FMCG is concerned, yes, they have also underperformed for last many quarters. I think something is changing out there. So I think FMCG of the companies also, these are more of a trading opportunity because they are still very expensive. So it's not like they're becoming suddenly very cheap. They're expensive. Maybe that's the way we can look for only from a trading opportunity. And I think infra as a theme, power as a theme, maybe some of the energy companies can come back from the current levels. So I think that's an area where we are looking for, where good amount of capex is going on. And this is the only area which we see large capex, both from the private sector as the public sector side. I think capex numbers are reasonably large.
Okay, that is one voice, Sandeep Tandon of Quant Mutual Fund. We also had Value Quest's Ravi Dharamsi yesterday, and this is his take on the areas of opportunity. We were just talking about the AI capex cycle with Arvind earlier, and while India may not have a frontier model, etc., there are enough, businesses 1 or 2 layers lower, which cater to the demand which AI will generate. So this was the focus of that conversation, excerpt from that chat. Listen in.
The broader themes are that we keep bumping into every now and then is defense, aerospace, nuclear, energy transition, which includes from renewables to battery storage systems, hydrogen. Then there are AI data center, power grid capex. Now, in the foundational layer of AI, India has no play. Like the memory chips, the servers, the GPUs, everything is probably based out of Korea or Taiwan. But what are the other bottlenecks? So we need we need connectivity to the grid. We need cooling system. We need a lot of power cables to be laid out. We need switch gears. But for these companies, AI is only one theme. Energy transition is the other theme. Even just the higher exposure to renewables requires that we have a far higher and better, bigger, modern grid, and which requires that you put in the money behind more transformers and cables and all those kind of things.
Okay, all right, let's get back to market starts then. Horma joins us to tell us about some big movers yesterday and some of them that were backed by delivery. Hey, Hormas, good morning.
Good morning, Nigel. Welcome back to you as well. And I
Thank
wanted
you.
to bow and give you the good morning. Take a look at the big movers from yesterday's trading session. Of course, the top 5 most traded ones on the Nifty 500. And yet again, for yet another day, HDFC Bank continues to remain the most traded stock on the Nifty 500. And yet another day, the delivery volumes are also significantly higher than their 20-day average as well. Now, for the other names, of course, Trent, Rights, ICICI Bank, most of them continue to see delivery volumes that were largely in line with their 20-day average. The one stock that did very well yesterday, though, was Info Edge. The biggest single-day gain and volumes for the stock since January of 2021. This 12% up move that they saw. The stock has gained in 4 out of the last 5 trading sessions. The 1200 call option yesterday saw its premiums go up by nearly 700% in yesterday's trading session. Close to 1.7 crore shares were traded, a 20-day average of 17 lakh shares, and a quarter of those were marked for delivery. So around 43 lakh shares for delivery. That too was 4x or almost 5x its 20-day average. And the stock, despite this, is down 22% from its 52-week high and still down around 13% for the year. A couple of capital market names that are continuing to see selling pressure: BSE and MCX. Now, the BSE over the last 10 sessions has declined in 8 of them, and MCX has declined in 7 out of the last 10 trading sessions. The premiums as well on the 3600 put for the BSE was up almost 60%. Premiums on the 2600 put for MCX was up 33% as well. And both of these names saw close to 60 lakh shares that were traded yesterday. The 20-day average was around about 33 lakh shares for both of them. And even on the delivery front, MCX had 51% of the total traded volumes marked for delivery. The 20-day average was around 45%. For BSE, it was 38%. The 20-day average was around 33%. And from their 52-week highs as well, BSE is down almost 20% now from the top, and MCX is down almost 25%. And another name that did well yesterday was RITES. It snapped a 3-day losing streak. It had a similar up move on the 1st of July as well, when the stock had gone up 13%. But the volumes yesterday were higher than the up move that you saw on the 1st of July. The volumes yesterday were the highest since the day of its listing, which was back in which was back in 2018, and 10 crore shares were traded on RITES yesterday. The 20-day average is only 5.7 lakh shares, and around about 36 lakh shares were marked for delivery. Intraday, the stock had briefly turned positive on a year-to-date basis before it cooled off yet again, but still down around 20% from its 52-week highs.
All right, Hormuz, grab a drink of water, and I look forward to having you back on the show. Thanks a lot for joining and giving us all those stats. Well, let's focus on the first management this morning. We have GK Energy. That's the company that we're focusing on. And to help us out with details of business, we are joined by Mr. Gopal Kabra, the CMD and CEO of the company. Hi, Gopal. Good morning. Good to see you. Well, before we get to talking to you, just highlighting a few factors that we're going to be looking at in this interview. The solar water pump, solar rooftop order wins that they have just won. What's the current order book? How much of it is from government schemes? And also the key revenue drivers over the next 3 years or so. Well, Gopal, thanks a lot and welcome to the show. Well, you've secured a lot of orders, in the recent past. I'm looking at the BSE and I can see those orders. Some of them should come up for our viewers on the screen. Could you tell us what is the updated order book and what is the execution timeline with regard to these orders?
On March end, we had a 710 crore rupees order, and further that close to 300 crore rupees order we have secured. It includes the solar agri pump as well as the solar rooftop. So right now, the more or less order book is close to 1,000 crore rupees. Just we have closed the Q1 right now.
Got it. Okay.
And Gopal, your guidance, I think, is 3,000 crore for FY27. Your order book is 1,000 crore rupees. So how do you expect to achieve your full year guidance, and what are the orders in the pipeline, the tenders that are going to come out from the various states?
Just Q1 is over and 1,000 crore. So 33% of the projection what we have given, it's already there. So it seems to be very clear. And now talking about the order book, we are not only concentrating on the government-based business model. We are diversified and activated the few retail market business as well. So it will be a mix of the both, and PM Kusum 2.0 we are expecting soon to be move ahead, as well as we are expecting some more order from the Magil Tala, and under PM Surya Ghar scheme we are going very fast track. So there would be very good retail order to us.
Yeah. Gopal, morning. There is the solar pumps business, and then there's the solar rooftop business, right? That's the commercial and the residential the segments. And the PM Kusum is solar pumps, PM Kusum 2, right?
Yes, you're perfectly right.
Right. And this is imminent now. It should happen any time. What will be the size of that? And what is that? Lots of solar pump companies, right, out there, and many more have come to the market listed, like yours. When that happens, when that comes, first of all, when do you expect that to be announced? And how will that flow through into business for companies like you?
We have given the indication that from Q3, it will be commercially utilized for our revenue side. Till that, it will be under the procedural part. And we are expecting to be multifold because it is a commercially win segment for all the stakeholder, implementer, government, beneficiary like our farmers, and looking towards the current geopolitical scenario where we want to reduce the diesel consumption, everything.
The logic we know, Gopal. I'm just trying to understand. The government will provide. There'll be this outlay.
Yeah.
And it'll just be used as a subsidy for farmers, right? That's how it'll happen.
Yeah, it is there, but we requested or we want that eventually the subsidy should be slowed down and should be move out, because the product itself is becoming viable in financial term. Because if you see to the price from the 2 lakh to it came to 1,50,000. So viability of the self-sustainable of the product is going in the market because of the volume. So eventually down to few years, it will be non-government led business. Right now it is there for the couple of years.
Which is the second edition of this PM Kusum scheme, right?
Yeah, PM Kusum 2.0 shall be with part of some subsidy.
Okay. And in your business is primarily solar pumps, right? How will that move between solar pumps and residential rooftop panels?
Rooftop would be around 33% for current financial year.
Okay, fair enough.
All right. Quick couple of questions then, Gopal. In terms of margin trajectory, it's been gradually improving. Now you're talking about 3,000 crores odd for this year in terms of revenue guidance, right?
Yeah.
So what will the margin band look like, if you could help us out there? And one niggling worry is with regard to the working capital days, even the debtor days. I recall us chatting even at the time of the IPO, and you said there'll be efforts to bring that down gradually. So what is the guidance on both these two?
Guidance we have already given in our FI call around should be 20% plus minus 10% is what we have said on the gross margin side. And the working capital, if you talk about, we have close to around 120, 130 days. This is what we are expecting will remain into solar pump. And because solar rooftop is getting added to our business, and that is a cash and carry business, so eventually the net working requirement would be going to be slowed down.
So what would it come down to? And you said the EBITDA margins is at 20% with 10% up and down. So 18 to 22% should be the broad range on margins, right?
This is what we have indicated in our last con call.
Working capital days as of last year, it was around 115 approximately. What does that come down to? As you said, because the mix is evolving, it will come down gradually. So what should it stabilize at?
But still, right now we would say around 120 to 140 only, because let's see how the thing goes. It will definitely come down eventually.
Okay. All right. Gopal, we'll leave it there. Thank you very much for joining us. Good speaking with you, and good luck as you continue to execute. That's GK Energy in terms of the business on the two segments. We'll take a quick commercial break. Devin Choksi of DR Choksi FinServ with some fundamental stock conversation on the other side. Stay tuned.
Welcome back. The Gift Nifty is currently down close to about 200 points. Yesterday, the Nifty closed just shy of the 24,400 as expiry-related selling took place in the last 30 minutes of trade. Otherwise, markets were largely flat through the course of the trading session. But then we had a bit of a leg down. And this morning, given the crude prices, and now they've crossed that 76 mark, 76.1, we are seeing a bit of a drop in the Nifty. So again, getting pegged back in the range, getting back pegged back into the trading range that markets have been holding on to. We were hopeful of a bit of a breakout after the rally from the last 4 or 5 trading sessions, but this morning things are a bit tense on the Middle East situation. But let's talk stocks. Sudarshan now joins in with the brokerage call of the day. Sudarshan.
So preview notes have started trickling in. So first one is on real estate. Citi has come out with a note. It believes that residential demand remained strong even in Q1 FY27, and the segments which have done well are mass luxury, ultra luxury segments, and that have helped or that have boosted the demand growth for the entire pack. It expects DLF, Prestige Estates, Oberoi Realty pre-sales to meet the guidance, and the regions that which are expected to do well are Hyderabad, MMR and Bengaluru. It believes that Phoenix Mills revenue growth is seen improving on higher occupancy across the segments. Yesterday, you remember Kalyan Jewellers had come out with a quarterly update and the stock had ended at day's low. Now, Citi maintains buy call. It believes that target price by Citi is rupees 750 per share. Q1 consolidated revenue growth company has reported of 38%. It was below Citi's expectations. India revenue growth has risen by 38%, which was driven by 28% same-store sales growth, and Candia revenue jumped 112% YY, and company also added 5 stores. It sees franchise expansion that will support growth going forward. CLSA has come out with a note on auto. It expects auto OEM margin to decline in Q1 FY27 on commodity cost inflation, and it expects 19% revenue growth and 15% EBITDA growth for the auto sector in Q1 FY27. And margin recovery, it believes that will start in H2 FY27 as commodity prices ease and premium OEMs likely to outperform mass market peers in Q1 FY27. It prefers Mahindra & Mahindra, Tata Motors, Special Vehicles, Samvardhana Motherson, TVS Motor and Ather Energy.
Okay, thank you very much for that. Deven Choksi now is joining in on the show. Deven, thank you very much for joining in. If there is a gap down opening today, which it seems like, would you be looking out to buy anything, any stocks on your watch list?
Yeah, good morning, Bima. Yes, certainly. I think the market giving corrections in individual stocks is a good opportunity for us to, I think, consider some of the good quality stocks, particularly in the power ancillary sector, where the market has corrected in last 2-3 days, and that is giving a good opportunity to buy into. Some of the companies which are there in the NBFC space, particularly, I think, where they are showing relatively high amount of credit growth in the last reported numbers, they remain relatively stronger companies from the buying point of view because the tailwind remains extraordinarily strong for them in the business environment. Also, some of the private sector banks in particular, where they are getting benefit out of the FCNRB deposit rate, capital build up in their portfolio, in their balance sheet, likely to possibly accelerate the loan book expansion in the subsequent quarters. So again, I think the downside risk is minimum, and maybe heading around 8-10% kind of upside is distinctly possible in some of these banks. So one can again probably look into some of these companies. So yes, I think selectively across the sectors, I think you may find few companies which probably are worth looking at in the corrective market at this point of time.
Just yesterday, we were chatting with the MK strategist, Seshadri Sen, and his call is that they have zero exposure to large cap private sector banks and PSU banks. He acknowledges that FY27 will be a year of recovery because NIMs are bottoming out, the credit cycle has recovered. But he said, given the recent rally, now the price to book for many of these large cap private banks have crossed 2. We're between 2 to 2.5 times price to book after the recent rally. And that he doesn't see as fair value. Fair value for him would be sub 2, say 1.7 times. So therefore, he expects some, time-wise correction and completely exited all the strategy note says that they've completely exited all private sector investments, including an HDFC bank. They're still playing the financial theme via AMCs, etc., but at least nothing on PSUs.
Interesting. That'll be interesting to see their outlook on the market.
Call is just competition, right? I think that what even Sridhar Sivaram was saying, they're just losing market share.
It'll be interesting then because, how does the market move up if the private sector banks don't participate since they have such a large weightage on the Nifty itself? Hi, Deven. Good morning. Welcome to the show and good to speak to you after a while. Deven, what about Trent? It gave some kind of hope. The stock did see a good rally, but their quarterly update was far from what the street was anticipating. And that's why the stock pulled back more than 10% in yesterday's trade.
It's a sub 3,000 rupees stock, which was more than 8,000 rupees, I think just around 18 to 25 months ago. What's your view at these levels?
Good morning, Nigel. I think the rationality has started now coming into the fore, and probably many of these companies, retail franchises, which probably I think took a very strong tailwind at some point of time and created a crazy valuation, they have now started coming to reality terms. The rate of growth, I think, for most of these retailers, they cannot be extraordinary. I think if the economy on a nominal growth basis at growing at 10, 11%, some of these companies on a longer span basis, I think could possibly grow at least, I think, 20, 30% premium to the economic rate of growth. And that's why it is fair to assume that 15 to 17% kind of a maximum growth that one can possibly expect out of this company on a sustainable basis. Maybe 1 quarter, 2 quarter up and down, that's a different issue. So given that situation, any valuation that you give far ahead of time would deserve to get corrected, and that is what is exactly been happening in some of these counters. I'm not completely surprised though. Maybe I think the corrective downside, if it is time correction here for a little period of time, then it could become a buy opportunity at some point of time.
You said you're watching the power ancillary names post the correction. Which are the names? Can you help us with some ideas?
Yes, I think so. The meaningful corrections have happened, and I think some part of recovery also has happened in last 2 days. I think they include the likes of Siemens Energy, they include likes of Hitachi Energy, or even for that matter Siemens as a whole, even companies like Suzlon. I believe that I think some of these companies are definitely corrected meaningfully in last few days because of whatever the Chinese news related outcome. In my viewpoint, I think this is probably, I think, a buy opportunity because most of these companies are having a good amount of business visibility for at least next 3 to 4 years, wherein I think their order books are suggesting that they're going to grow at least double from here onwards, I think, in their size. Second aspect about it is that tailwind remains strong because the government spending on the power infrastructure continues to remain on a higher scale. And that's where possibly we are likely to see the continued thrust on the larger order book. So I think these companies are looking good. Maybe some part of, I think, profit could get little suppressed because of, I think, the higher raw material cost in a given quarter. But I think this kind of corrections, they mean opportunity for buying into the portfolio if you have a 3-year horizon.
And NBFCs? You said NBFCs where we've seen high growth.
I see both Bajaj means the Bajaj Finance and Bajaj Housing Finance. Both of them in the respective category of business have actually shown remarkably high amount of disbursals in this first quarter. And if the particularly when I think we are looking at the real estate segment showing up and growing faster going forward, given the size of economy and given the size of disposable income in the hands of people, I think the real estate particularly is likely to show up very well. And that's where probably I think the housing finance companies, which is a distinct model in form of Bajaj Housing Finance, with about 4 different verticals operating in one company, I believe that I think this company would continue to grow at a rate I think which is faster than the normal growth rate of other housing finance companies. So we remain distinctly confident about the possibilities in these two companies in the NBFC space.
Okay, all right. Wanted to ask you about some of these metal stocks. Then Devin, you have silver prices that have cooled off. So Hindustan Zinc will be a stock in focus. And aluminium prices that less than, I think, 35, 40 days ago have moved from $3,800 per ton all the way to $3,100 per ton. The stocks as well have pulled back a goodish deal, whether you look at Nalco or even Vedanta Aluminium from where it's listed, even Hindalco. Are you interested in any of these, the aluminium plays or the lone silver play out here, which is Hindustan Zinc?
So frankly, I think within the metal basket, I think when we look at the businesses, I think we always look at the delta. Delta between the energy cost and the price at which the metal commodity is sold. Yes, do agree that I think in an immediate period when the market falls, the price falls sharply in the commodity, that part of mark to market or maybe I think some part of the price disadvantage would be in the respective quarter. But beyond that, I think the next quarter the price adjusts itself because of this delta factor that plays a role. Fortunately, most of the Indian metal commodity companies have backward integrated into the renewable energy, and that's where probably they're saving significantly on the energy costs. And that delta stands improved, if not otherwise. So from that perspective, any price correction in these stocks, I think they would mean a close look, and that probably I think would mean that some level at some point of time, I think there would be a buy opportunity in the portfolio.
Okay, all right. We'll take a quick commercial break here. We'll come back. By the way, some news on South Indian Bank. They've got the RBI not to appoint the Mahesh Muralidhar Pai as the managing director and CEO. So that's the news which is coming through. For those who are tracking it in terms of this approval coming through, waiting for this approval to come through, maybe important. We'll take a break. We're back with the pre-open rates. Praveen Sahai of PL Capital with us to focus on the consumer durable space. Stay tuned. Coming up. Welcome back. Devin Chokshi is with us. There's about 6 minutes to go for the pre-open session. Devin, yesterday, if you can pull up 2 or 3 names, right? HDFC Life, SBI Life. Actually, those two more than anything else. LIC has done well from the lows as well. So this is the time around which we get the monthly numbers for life insurance companies, general insurance companies, and you see a bit of a move. We've not got it yet. I'm not sure the market's got a whiff, but stocks moved, and they were up 2.5%. In a market which actually was lower. So I don't know if you have any thoughts here, Devin. The sector, of course, is waiting for those distribution reforms, that paper, and it's going to be consultation paper. I must clarify. It's not, it's not going to be put out and notified. It's going to be consultation paper. It'll take time, but important nevertheless. Devin.
Yeah, Prashant. So structurally, I think we remain quite confident about the new business premium increasing in the life insurance businesses. And that is going to be seen very gradually going up because of, I think, higher amount of disposable income staying in the hands of individuals. So if you are looking at next 3 to 5 years, I think gradually, I think like you saw in case of mutual fund SIP, you are likely to see the similar kind of a trend emerging for the new business premium in the life insurance companies. Now, some of these companies have been languishing for last 3 to 5 years, I think around the same price. I think they have not done anything as far as the stock price is concerned. And that's where I like them because I think most of it was in price with a higher amount of embedded value to EBITDA. Today, I think that has rationalized over a period of time. It's the time correction and I think the steady growth in the business. So from that perspective, I think, yes, I think the downside risk in the stocks remains limited. Maybe, as I was making a point earlier in different contexts, you have 10-11% kind of normal GDP growth. Life insurance new business premium growth could be in the vicinity of around 15 to 17% for some of these companies with a good size distribution model that they created. I think they deserve to be included in the portfolio in the corrected price at some point of time, though I think it has started coming near to that level as I can see right now.
Deven, Swiggy was in focus yesterday, and the company had announced that the foreign shareholding in the company has fallen below 50%. Now, this is important because it can allow the company to once again pursue the resolution to change the classification and become an Indian-owned and controlled company, IOCC. Now, this matters because once you get that IOCC status, the quick commerce business can potentially move from a marketplace model to an inventory model. An inventory model, as you know, would give greater control over procurement, warehousing, fulfillment. Therefore, it translates into better supply chain efficiencies and potentially higher adjusted EBITDA margin. When Blinkit got that change in status to an IOCC, it pursued an inventory model, and that gave it some competitive advantage over Blinkit, over other competitors like a Swiggy, Flipkart, Amazon, etc. Now Swiggy has got the foreign shareholding below that 50%. So the street got very excited. Stock was up 7.5%. If that comes through, do you see it closing the gap, Deven, versus peers like a Blinkit?
Yes, Rima, reasonable to expect that for a reason that obviously I think this particular inventory back model is a model wherein possibly you not only have the higher amount of ability to supply to the end customer, but at the same time, I think the size can possibly grow with higher amount of capital infusion. Though in the near term, that's negative because I think higher amount of capital infusion would mean that I think further waiting period for the return on capital employed ratios, etc., to come for this kind of companies, even though they get into some profits. So from that perspective, though on one side for business side, I think this is a good development which may happen. But on the other side, for the stock price, I think it will still require a significantly large amount of contribution into the profit to justify the capital employed in the business. So we remain watchful, but not immediately gung-ho about buying into the portfolio.
Okay, got it. Deven, any view on, on InfoEdge? There's an update that's come about. I was just reading a sales note when they're talking about the JobSpeak numbers, in fact, looking quite good. And they're saying, that the quarterly tailwinds are very evident. It's been highlighted by the 6% increase in the Naukri JobSpeak index, which has been fueled by 25% surge in AI ML hiring and also 16% uptick in the insurance sector. This is the stock actually that's been holding strong. What's your view on the name?
Yeah, incrementally, I see this is a positive thing happening for the entire property segment that this company is carrying in different verticals. So from that perspective, yes, I see it. But how much it gets quantified into the top line and the numbers, the profit numbers, not done enough calculation on that. So I think we want to wait for it before I come in with a view on the subject.
All right, Deven, before we let you go, a quick view with regard to your stance currently on tech. I'm looking at some of these global players, whether it's Accenture, Cognizant, both of them, they have rallied by close to 15%. The valuations had come down, but the street is very, very concerned on these companies. And there's been a reason why they've been such underperformers. But just in the last few sessions, I think you've got 15% apiece on both these two names. What's your view on tech? Rima was just mentioning earlier that our tech index as well, that's the Nifty IT index, has seen a bit of a bounce. What do you like from the tech space?
So most of it, Nigel, I think as far as the large cap companies are concerned within the Indian IT service basket, most of them is, I think, in price. That means I think market has possibly discounted some of the high conviction valuation in this particular business to a significantly lower levels at this point of time. In my viewpoint, I think given the fact that likes of TCS, likes of even HCL Tech with the recent order win of Mercedes-Benz, I think they are actually shifting their business model systematically and gradually into the AI-led development as an AI-led deployments and the maintenance. So given that kind of a transition which they are into, in my viewpoint, I think the most of the negatives or the overreaction of the market is in price. Maybe if one wants to justify where the market stands today, probably I think they want to shift the portfolio from Indian IT company to some of the AI-based companies in the global markets. And that's where probably I think this victimization has happened for these companies. I think gradually some of these companies are likely to show up better numbers. 6 to 8 quarters is a period in which I think you should be seeing the transition into the new revenue model, which is from time and effort basis to going into the outcome-based revenue model, which these companies are likely to come up with. So we remain selectively bullish about the prospects going forward. Though fully agree that I think they may not give a very high jump. Maybe I think 15% odd kind of an upside from current level is distinctly possible in some of the bigger names like TCS.
Okay, all right. Devin, we'll leave it there. Thank you very much for joining us. Good speaking with you here on CNBC TV 18. Appreciate your time. I think look at the rupee. It's, I think, about a 20 paisa move on the downside. This is just almost a mechanical reaction to the oil price jump which we've seen. And 95.17, 94.97 from yesterday. Sudarshan and Mitesh are with us with what they'd want you to do as far as trades go. Gentlemen, good morning. Good to have you both here as always. So I guess for global reasons, it's a bit of a risk off on the screen across. Sudarshan, what would you recommend?
Yeah, good morning. I would recommend go and take the risk. So we have been waiting for 2 days saying that, okay, let the market correct a little. We are in an uptrend. A small correction would be a buying opportunity. That small correction is coming today. See, Prashant, these ups and downs are going to continue. They won't stop, not for the next 2.5 years. So we have to accept that this is a dip in an ongoing uptrend, a very decent correction. The correct way to approach and trade this is to buy call options rather than buy the futures directly. The call option, value of the call option is also your stop loss. Hold on to it. You will see volatility. But by the end of the month, and even in the next few days, we should see higher levels.
Which call are you recommending? Which call? Which strike?
Oh, I'm assuming we'll open somewhere around 24,200. So buy the 24,200 strike for July expiry, not the weekly expiry.
Okay, all right. And 2.5 years kind of gets us to the end of the presidency, the current presidency in the US version, I'm assuming. That was the idea there. Mitesh, you were saying yesterday, 24,250 around is a zone to buy. I don't know, I think we'll get it today. So, I mean, action those longs?
Yeah, very clearly. I think the support level does come in around this 24,250, 200. There's a gap. And today we might open the gap down around that previous gap area. So the idea should be to first wait for the next 15, 30 minutes, see if there's follow through. If we start breaking below levels of 24,180, 175, then I wouldn't be long. I would be, in fact, cutting down my long stock exposure as well. But in case we don't see a follow through beyond 24,250, 200 zones, I think then, yes, it will be a good chance to go long with a 70, 80 point kind of a stop loss. The direction of the indicators, the short-term averages are all on the upside. So the bias doesn't turn negative. But yeah, in case we don't respect the support level, then I think it's beyond a point to fight the market, which is slightly on the dicey kind of affair.
Okay, got that. Let's get to individual stocks then. Mitesh, you go first.
Good morning, Nigel. I have a mix of buys and sells. On the buying side is Swiggy. I think had a big price and volume breakout yesterday. Around 263, 262 half. If you get it, buy with the stop at 256. Look for a target of 275. Dalmia Bharat Cement has been a recommendation earlier as well. Now it's a buy around 1780 with a stop at 1755 for targets of 1830. And on the selling side is Biocon with a stop at 414 for a target of 390. And CAMS is a sell as well. Keep a stop above 790. Look for a target of 750.
Got it. All right. So, Darshan, what about you? What are your picks?
It's almost the same as Mitesh. I also have Swiggy as a buy. My original stop was 260, but with the gap down, you have to adjust the stops. Again, I have Biocon as a sell with a stop above 415. Adjust the stops. Coforge is a buying opportunity. IT is doing well, and any dip is a buy. So buy with an initial stop in mind at 1480, and REC is a sell with a stop above 365. So Coforge and Swiggy are for buying, and Biocon and REC are for selling.
Okay. All right. Got that, gentlemen. Thanks a lot for joining in and giving us those calls. We'll come back to you all for your updated 9-10 call of the day. Let's go across to Praveen Sahai, though, the lead research analyst, consumer durables, building materials, as well as EMS at PL Capital Group. Hi, Praveen. Good morning. Always good to see you in. Well, let's focus on Dixon first. The Vivo JV approval, well, that's expected anytime soon. I think earlier you had mentioned to us in an interaction that you indicated that the volume growth is likely to be offset by, likely to be set off for margin pressure going forward. So given that Dixon is a stock that's corrected a good deal from the top, it's still not cheap,
But if they're going to get back to their growing ways, then the market may be pretty okay with giving it the multiple that it's giving it right now. What's your view? And particularly with regard to this, JV, which we've been waiting for long, what can it add to the company?
Yeah, hi, Nigel, and thank you for having me. So on Dixon, definitely this quarter is expected to be a volume to be a bit strong, even excluding not without the JV of Vivo. So that's the one thing. Now, if that Vivo JV will go through and what industry participants are indicating about, if that is so, definitely that's Vivo is one of the largest markets here in the India mobile market. So nearly around 20% of that, and that will definitely a good amount of volume going to get added to the Dixon. So that's a very positive, and we all know that volume kick will in the Dixon will come from the JV first. However, about excluding that also, they are doing very well in that. However, on the margin pressure side, definitely that's the RM pressure, which is already there. Second is the PLI, which benefit they were absorbing to some extent is also going to go away. So the margin pressure, I believe, to continue. Having said that, we don't have a coverage on Dixon, so we don't have a rating on that.
Got it. Okay. All right. What did you make of Amber's foray though into the smartphone foray that they have recently announced? The street was quite excited initially.
Yeah, you are right. Again, like Oppo India, which is three brands, even in the premium and the mass segments, they have a presence altogether around 27-28% of a market share in Indian market. And this is a very asset-light JV. So already Oppo has a manufacturing facility and they are going to run that on the sublease basis. So I think, and they don't require any approval from the government as well. So for them, it's a good, like for next year onwards, 28 onwards, we will start seeing a material contribution in their top line from the Oppo JV, Oppo, mobile segment. And one important thing for Amber is always concern for the return profile because of the nature of the business, seasonal business, they are more in, and also in the PCBA, there is a low return profile they used to carry. That is going to, they rectify or improve with this, the mobile business.
And because of this Oppo, the deal that they've done with Oppo, you're expecting the EPS estimates. You have tweaked it by 10%, right, for FY28?
Yes. Yeah, right. Correct.
That's for Amber.
That's for Amber, yeah.
Let's turn our attention into the RAC players. I think Blue Star is a company that you like. What do you make of Voltas? They as well clocked at 1 million units, faster than what they did in the previous year. What is your preference out here? And, who are best placed from here on?
So in the all white good space, whether it's Blue Star, LG or Voltas, all are expected a very good set of numbers in the Q1 because of a volume largely. So say example, Voltas, as you mentioned, 1 million unit, they had already reported. That gives me around 30% of a growth in the volume. Blue Star is also 20 to 25% of a volume growth. The only challenge for these two players is the price pass on, because there is a market share, competitive intensity in the gain of the market share has been quite a high in this quarter. The price hikes, whatever they announced in the April, has not been absorbed. So the margin would be under pressure for them. Whereas on the LG, they had already taken the price hike nearly around 14%. So there the volume growth is lower, while the realization improvement is quite higher. So on the preference side, definitely still I prefer LG, then Blue Star, and then Voltas. While because of a valuation one, being a diversified player, LG, even the 41 times, looking, the some around 10-12% of upside over here. Whereas Blue Star, which is trading at nearly around 36 times, so there is a good upside of nearly around 15-16%, and Voltas, which is trading at 41 times. So I think the very seasonal and also the project business, which is quite fluctuating. There, I think there is some restriction on the valuation. So even though their number is quite a good in the probability and the volume side, but they are trading at 41 times. So that is what restricting me over here for them.
Praveen, just wrap it up with just your top ideas right now in terms of absolute returns and in your coverage universe.
Yeah, so the entire coverage universe, if I look at, in the consumer durable space, I like LG because LG is quite diversified across the product line. They had already taken the price hike, whether it's a ref and the WAS are nearly around 6-7% of price hike, 14% in the RAC, 10% in the TV. So these price hikes will reflect in the next 9 months as well. So I believe their growth trajectory of a 12-13% in top line with a margin improvement in the EBITDA, nearly around 20% of growth in the EBITDA to continue. So we are liking the LG right now. Another is Amber, because Amber, the entire consolidation of the electronics division going to get reflected in 27. And that's where the growth would be in the range of around 35-36% in their numbers, top line with the margin improvement, because whatever the entities they had acquired, that is a nearly around 15-17% of margin profile. And also the diversification towards mobile, we are quite positive on that. So 36 times of Amber, looking a good opportunity over here in the EMS space.
Praveen, thanks very much for that good sort of getting those ideas from you. Well, I think 2 minutes to go for market open, so let's just squeeze in a couple of stocks. Idea Forge is what we want to focus on. Vivek has got details here. Vivek.
Well, good morning. It's a QIP. The company is raising close to 500 crores, 5.5% discount to yesterday's close. So the issue price is at 795 rupees a share. A large equity dilution, which is almost 14.5%. Why does the company need money? For debt repayment, funding working capital gap, as well as for investing into product development. Expecting a bit of a downtick as far as Idea Forge is concerned, but we'll keep an eye out on who are the investors in this particular QIP, given the fact that the company has seen a couple of upgrades post the last couple of quarters.
All right. Thanks very much, Vivek, for that. Just opening up with the trade today, and let's just quickly run you through some of the stocks we've covered since the morning, and they're all up on your screen. Interglobe is down 2.5%. Uno Minda is down 0.5%. MTAR is down 0.8%. There's, EMS Limited 3% higher. Idea Forge, which Vivek just mentioned, is down about 1%. Actually, there's nothing large, but there will be a few names which will come up when the market opens, and we will point them out for you. But for now, in the pre-open, Cochin is down about 2%. Hindustan Zinc is down about 1.6-1.7%. Kalyan sold off, heavily yesterday, 1.5% higher. Senco, Titan are some of the other names which come up on your screen. HP, BP, IOC, as oils jump, these stocks have taken a bit of a dive. Nothing large, but they are lower at this stage. We've got a couple of seconds to go for market open. So we will just look at rates as they start, and then we'll go into individual broader market names as well. What do we have? 24,250, exactly in the zone which is the first support as we put out in the morning. 24,255. I think it's a 40-day, and are we able to bounce on those levels? We'll see. We'll find out. But that's a first support zone. So 0.5% cut. Nifty Bank is down 0.5%. So 57,900. Nifty Mid Cap Index is down 0.5%. So uniform 0.5% cut. And I think the small cap index is down a little bit more, 0.75% lower. But it's also, of course, just over the last 7-8 days done so much better than even the mid cap index for that matter. It's 3:1 in terms of what's down to up. But this is just, early start right out of the gate. So we will give it some time before we make any conclusion from it. ONGC, it's easy to count what's up. ONGC, Dr. Reddy's, Infosys, TCS on one side, and there's Shriram Finance, Indigo, Bajaj Finance, iShares on the other side. So it's interesting. IT, like yesterday, is bouncing. IT index was the top gainer yesterday, about 2.5%. And it's had if you just look at the last 7-8 trading sessions, it's been more up than down as far as IT stocks are concerned. Rima.
Well, you can see a bit of a defensive tilt in the buying today, or the rotation taking place. So it's pharma and IT, as Prashant pointed out. Dr. Reddy's, Cipla are the gainers. ONGC benefiting from the rise in crude prices on the way down. You've got Interglobe Aviation, Asian Paints selling off. On Interglobe Aviation, the cut is nearly 2%. On Asian Paints, almost there, 1.75%. Again, reacting adversely to the rise in crude prices. L&T too gets close to about 40% of its order book comes in from Middle East. So the flare-up there is hurting sentiment on L&T, and that stock has taken a bit of a knock. NBFCs are under pressure. So the top loser today is Shriram Finance. Along with that, Bajaj Finance is weak in trade. Reliance Industries is the heavyweight, which is weak in trade. Banking names, the Nifty Bank itself is down close to about 250 points. So we should pull up some of these large banks. HDFC Bank has started soft, 3/4 of a percentage point down. ICICI Bank is on the flattish side. Kotak Mahindra Bank mildly lower, 0.3% down. And Axis Bank is under pressure. So the drags are actually HDFC Bank and Axis Bank. But these are the two banks which had outperformed from last week. Following strong Q1 quarterly updates, and that's where you are seeing a bit of a sell-off. 0.5% gone on the Nifty and the Sensex. The problem is the advanced decline ratio standing at 2:5.
Well, that's right, Rima. Just pull up a few companies. Orchid Pharma, the stock is now up close to 11%. So that's one of the big movers actually in today's trading session. Up and about in today's session. Big, decent volumes as well. 2 lakh shares traded in the first few minutes itself. What else is moving well? EMS, that's up close to 5%. They bagged 158 crore order from the Delhi Jal board for sewage work. So that's why that stock, in fact, is up and about. You have Equitas Chemicals as well. That one's moving higher on decent volumes. 3,500 rupees stock, up close to around 5% as we speak. And Beer Corp, I recall in early morning trade, just pre-market opening actually, there was a large trade that got cleared out there. So that one, in fact, is up and about in today's trade. Oil prices have moved up, so the obvious beneficiaries would be ONGC as well as Oil India. Both of them are up. Vedanta Oil and Gas as well as up close to 6%. They'd come out with their operational update, and that stock has moved up. Kalyan Jewellers, post the operational update, that stock as well is doing pretty well. On the flip side, Vedanta Iron and Steel, the stock that I think from the listing price, it went up close to around 70-80% odd. Last few trading sessions has actually been moving down, circuit to circuit on the downside. And the ones that get hit when crude oil prices spike, the OMCs, they in fact are the top losers today. For the time being, down 120 points. Tell you what, in comparison to what the other Asian markets are doing, they're still relative outperformers after doing a relative outperformance in the month of June as well.
All right. Well, I think let's look at the Nifty for a quick bit. 24,275. So there is a 100-point cut coming through right now. I think we have Gautam Trivedi, who's with us, co-founder of Nepean Capital. Gautam, good morning. Great to have you back on the program. Thanks for joining in. So let me just start with IT, right? It's a space I think you've avoided. Too much going on, too tough to comprehend, figure out where this is going to land. A bit of a bounce, and you often see it. It's not the first because they've fallen so much. You get these bounces, but every so often, once in a while, you got to sort of ask yourself, because these are large, well-run companies, strong cash flow still. Growth's, of course, a problem. Whether they've fallen enough, and they really become good bets that you can buy and hold. Your thoughts, Gautam?
I think you make all the right points. A lot of these companies tick all the boxes. There's no corporate governance issue, not at least since Satyam. Great companies, no debt, and again, very smart management. But I think the evidence to prove that AI is not going to impact their business, or if it impacts positively, we haven't seen evidence of that. That's the single biggest problem I have of putting money to work in the IT sector, even though the valuations, as you said rightly, have corrected significantly from like 24, in some cases 27 times 1 year forward to now 16, 17 times. So really big correction valuation-wise as well. But if you look at it, last 5 years, 3 years, 1 year, year to date, you've not really actually lost money, or gained money rather by staying away from them. So I still am not convinced. Would love to hear the commentary starting next week on what they're seeing with respect to their results, guidance, etc. But not yet, unfortunately.
When someone wrote on Twitter, when I posted something on IT, he's like, watch for IT. And the line that he's reminded of is the one from Dhurandhar. He said, "Main ghayal hu, isliye main ghatak hu." So he's like, watch for, the Indian IT space, and let's see whether they can do any wonders. Of course, it's not going to happen in a quarter, but it's a long-term bet. Gautam, so I remember when we last spoke, you were back from your trips in the US and you were a little disappointed that made in India textiles were not available at Costco when you had from Vietnam, Bangladesh. Any more observations that you'd like to share with us in the last 2 or 3 months?
Yeah, so I think I've spoken to a bunch of exporters here. In fact, we bought one of them as well, in the hope that the FTA with the US and the EU gets signed, and not just signed, but there's an implementation timetable that's announced to the world, so that we know when and how the impact's going to come positively on Indian exporters. I believe that we're not too far away from a bottom for a lot of these companies. I don't want to start naming them necessarily, but I think it's a matter of time before you will see a significant positive impact on their revenues, EBITDA, etc. Because the fact is, if you're looking at smaller countries like even Jordan, Peru, I even said Pakistan's doing a great job. We're talking about Dhurandhar, so let me throw in Pakistan. But even Pakistan's doing a great job. You see a lot of made in Pakistan clothes on sale across the United States. I don't see that much of India, and it's, as an Indian, it obviously I'm disappointed.
But you're saying that we're close to a bottom in textiles.
Looks like it. I think again, subject to raw material and cotton prices, that's a separate discussion. But the fact is, I think from a revenue perspective and the ability to do more in terms of exports to the United States in particular, because it's the biggest consumer market and we're the world's second largest cotton producer. So there's definitely a mismatch as to why are we not more prominent in the US.
All right. Hi, Gautam. Good morning. Good to see you in as always. Tell us about some new names you'll have added or deleted from the list. I recall the last time around, we also spoke about Varun Beverages, the stock that got hit because of the competitive intensity, and it pulled back a little bit. I think that's the name they all were looking at. And TD Power Systems, I think you'll be interested out there as well. What a beautiful move we've seen on that stock over the last few years.
Yeah, that stock's done extremely well. Very, very down-to-earth promoter. I think it's a lot of these companies, you have to go find them. And, we do very well in the mid and small cap space. In fact, a lot more in terms of finding these small caps. And of course, it's a very long-term bets that you have to make. Sometimes these stocks outperform faster than you would think, like in the case of TD Power. But I think the opportunity set still remains very strong within the overall data center, AI, semiconductor, and of course, power, which has to power all of this. So without electricity, none of this is going to work. I think the overall ecosystem of all of these is massive. I'm not just talking of power producers or the IPP companies. Those are actually the least interesting. The most action and the most interest really is where the gigantic capex that's actually taking place in the power space, which is in transmission. So a lot of companies that make ancillary products like bushings. Again, a lot of these companies are small cap, so you need to have the ability to actually sit on that small cap for the next 2 to 3 years and ride out some of the volatility that you will see in a lot of these names.
Yeah, absolutely. Look at Info Edge. It's up another 5% after yesterday's 10-11% kind of a move. Actually, by the way, it's also it's got huge volumes, coming up with huge volumes. Hiring's up 14%. The hiring side of the business is up 14%. That is, pretty substantial given all of the worries around the IT hiring segment, which of course is still the large part of it. So while IT hiring is not increasing, Info Edge, and I hope we get the opportunity to speak with the management and ask them what's happened. But that is actually, I guess, the stock of the morning once again, like it was yesterday, actually. So no two ways about it.
Said in the Naukri Job Speak Index, and this data came out just 2-3 days back for the month of June. Insurance hiring is strong at 16%. FMCG is 7%. Telecom is 6%. Real estate up 5%. IT is down 3%. So that point is taken. But in IT, AI ML hiring is close to about 16%. But I guess that's still a very small subset. But insurance was the key driver in the month gone by. And the overall numbers, they're saying it's a pickup compared to what we've seen in the prior few quarters.
Absolutely. Just market breadth is slipped. I mean, 1,600 lower and about 960 odd stocks, which are higher right now. Now, this entire power capex, I mean, that theme, Gautam, what is your sense? I mean, you got to go. It's not as if it's a well-discovered theme, right? And prices have been. I mean, stocks are routinely up 100% in just 6 months this year in this space. So, what do you do? I mean, you got to just believe and be ready. Do you judge? I mean, I spoke with Ravi Dharamsi yesterday, who said, well, if you look at PE multiples here, you know, you'd constantly not be able to buy anything in this space. But then, you know, you got to look at other things, ordering and where you are in the ordering cycle, and you know, competitive intensity, or they being able to hold pricing, etc., etc., etc. But just talk to us about where you see opportunities in this space.
Yeah, so Prashant, you're absolutely right, and as is Ravi, about with respect to valuations in the power sector, and for that matter, valuations in India across the board, right? It's not limited only to power, but power has been on fire and will be for the next at least 5 to 10 years, given the absolute amount of capex that's going in. It's like companies, if you can find that are making ancillary products, and we have one of them into data centers. I mean, just think of the absolute capex that's coming into that space. I mean, there's an interview today's ET with Thomas Kurian, who's the head of president of Google Cloud. And honestly, it's an amazing interview, and I recommend you guys read it. But point I'm trying to make is that you have to follow the capex trail and figure out where is it that the capex is happening on a large scale, and which of these companies are going to benefit. I mean, we are seeing companies top line of 500 crores going to 2,000 crores in the next 2.5 years. And that's only because they're at the right place at the right time. Now, valuations are going to be obviously challenged from a domestic and an external. I mean, forget external FI investors looking at investing in these companies, which are trading at 65 times, 75 times, 1 year forward earnings. But let's look at some of the HVDC companies. The CMD of Power Grid Corporation, for example, earlier this year, at their annual analyst meet in Mumbai, announced that they will be placing orders over the next 12 to 18 months for 2 HVDC lines, which will be approximately about 35 to 40,000 crores. There are 3 companies in India that can deliver that. I mean, think about it, right? So a lot of this is what the market is expecting will happen. And, that capex is furiously happening, and we can't do without it. You can't cut down on that capex, given the amount of. Here's the thing. Think about it this way. If you don't have transmission from Khavda to the rest of India, what's the point of building the biggest solar plant in the country, sitting in the middle of nowhere, which is in Kutch, okay? But you can't evacuate the power. I mean, people talk about having power plants in Ladakh. Yeah. Great idea. A lot of sunlight. But how do you get the power to the end consumer?
So again, yeah. No, I completely take all those points. The only thing is that the names hit. I mean, I think the bidding for that HVDC order is happening as we speak, and we'll hear something about it. The management of KEC International told us that. So, and then that Hitachi and the GE Vernovas of the world, perhaps 2 or 3 companies were in it for the larger portion of that order, but there are others as well. If you own these companies, great, but for others at some level, you got to just throw your hands up and say, well, I missed that one. I'll look for the. It's just pretty tough to be an incremental new buyer in some of these names. But so that's my question. Do you go to layer 2, layer 3? I mean, look for companies which are into, because it's not just going to be those companies are going to order out, right? We had the management of transformers and rectifiers yesterday, and they told us that actually the Chinese news, where 4 Chinese companies have been given exemption, it actually perhaps is at a net level positive for us, because we were facing a huge shortage as far as bushings go, all kinds of bushings.
Yeah.
And 3 of these 4 companies actually make these bushings. So do you look for niche plays now instead of just the headline big operators?
Yeah, you make a good point, Prashant. The fact is, think about it. If the government has allowed 4 Chinese companies, there were 4 German companies or 4, French companies, that would be a different matter. But 4 Chinese companies, if they're being allowed to start selling in India, what does that tell you? It tells you that the demand is so strong that the Indian companies themselves don't have the capability to provide and to manufacture in time some of these products, right? So that just tells you the extent of the demand and just sort of adds more steam to what I've been saying. But yes, there are companies out there. I mean, frankly, if you're an investor, I would urge you or anybody out there who's on this list, watching this show, to go to Baroda. There are like 10 companies in Baroda alone. I mean, that's such a gigantic hub for the power sector. And there's so many companies to be found there that are making niche products. So yes, like I said, but you've got to go out in the field. You can't sit in an air-conditioned office in Nariman Point and find these companies.
That sounds like a jive with me and all of us.
I'll take you along the next time. If you want to come, do join us.
You want to name some of these smaller companies? Bush. You met Bushings a couple of times. Yash High Voltage is a company that makes it. I'm not sure whether that's a name you're interested in, because I recall Hitachi making a big announcement. And then from, some funds, they were calling up and saying, Hitachi made the announcement, where are they getting the bushings from? So,
It's done, Nigel, is doubled in the last, I think, 6 months.
It's doubled.
It's doubled. Yeah. So that's the thing, right? The markets, it's collective wisdom. So people, it's so fast and furious, and people like Gautam were in the trenches, although he's wearing a suit today, who are finding these.
If I'm on CNBC, Prashant, I have to wear a suit. I don't wear a tie, but I do wear a suit.
So I mean, just for educational purposes, give us an idea, give us a name if you can, Gautam, which investors, viewers can go and.
You guys just named Yash High Voltage. We do own Yash High Voltage. We didn't catch it, and we're not up 100%, but we think there's a lot of steam still left in this company, and then exactly in the right place at the right time.
Is there a lot of this work also happening in the private space, Gautam? Actually, public market investors, those who can do it, have become pretty agnostic between do public but do private as well. Because there's a lot of companies, right? Actually, there's a transformer company which is now IPOing. Almost, I think we'll see it in the next few weeks. So that is also happening, right?
Yeah, there is. I mean, see, here's the thing. In the higher KV, there are only a few companies. But in the lower KVA, there are, literally 10 companies. So, and as you said rightly, there are more that will IPO soon. But that space, I think, is multi-decade in terms of growth. And, it's like the data center business. And data center business and the power sector are joined at the hip. So you can't separate them.
Yeah. I was just thinking, we spoke to KEC International. Let's put the stock up. They're into EPC for these, the towers, essentially. Again, stocks come off sharply. Of course, there's been an earnings hit as well. But I think it's it's half to 1/3. Valuations are about 20 times. So all kinds of things happening. There are some big, some small, as Gautam said, some in the lower KVA, they are not, lots of them in these hubs like Baroda, etc. And some of them are making it to the market. Got it. Gautam, good chat. Thank you very much. And take us along next time you're on your way. Give us a call.
Will do, for sure.
Thank you. Thanks very much. I think, Rima, we have the management of GICRE.
Yes, indeed. Hitesh Joshi, Chairman, Managing Director of GICRE, is now here with us on the show. Congratulations, Hitesh, for the appointment as the CMD. We look forward to more interactions, starting with this one. Thank you.
Thank you so much. Thank you.
Mr. Doshi, let's just begin with your overall view on growth now, because when I look at GICRE, growth for you last year was about 6% of gross written premium, 8% at a net level. But generally, the health, life insurance, all that is growing at a much faster rate, at least double. So what explains the gap between the overall insurance industries and yours? Why is it widening? And what should we expect in terms of growth under you in FY27? And if you have a 3-year or 5-year goalpost in terms of growth for GICRE?
First things first, I think it would not be proper to compare the growth in the insurance market vis-a-vis the growth in the reinsurance market, or say entity like GICRE, because there are very many dynamics, very many factors which are at play. Say, for example, whether the class requires a lot of reinsurance, whether that, say, for example, a class like health may require very little reinsurance, a class like property and casualty, which might require a very substantial amount of reinsurance. What is the pricing level? What are the loss trends? How the buyers consider the pricing level, and whether they are increasing or decreasing their purchase of reinsurance. So to directly link GICRE's growth vis-a-vis the Indian insurance market growth will not be a correct way of looking at things. What may be compared appropriately would be GIC's growth versus the growth of the Indian reinsurance market. And to the extent GIC is a, say, regional or a global player, the growth in the global market. So this is how I think we would suggest that one needs to look at.
Okay, fair enough. That point is made. But what is your target in terms of growth for GIC RE? And the reason I ask, because one dynamic that's playing up is competition is also hotting up. You've got Alliance Geo Reinsurance, there's Fairfax backed, and all these companies are, they've set up now and they're going to try and gain market share. So what is your own growth estimate for this year and under your tenure in the next 3 or 5 years? And do you in any way see a price war taking place in reinsurance?
I think we will continue to grow in line with the market as far as the Indian domestic market is concerned. And we would certainly try to maintain our market share. As far as international markets are concerned, we need to realize that we have not yet completed 2 annual cycles from our rating upgrade to A- in October 24. So when you get your rating back, you kind of reclaim the business that you had lost and the opportunities that you had lost. So there is a lot of headroom there to grow in terms of the international market share. And that should also help us drive our growth overall.
Okay.
Coming to the competition that you mentioned, I would suggest, I would like to believe that competition is always welcome. And GIFT City is actually, in a way, emerging as a reinsurance hub. Competition has always been there. It is ultimately reinsurance has always been a global business, and particularly following the entry of alternative capital, markets have always been competitive. So we need to build this emerging capital market dynamics, alternative capital dynamics, and the climate crisis into our business model. There is no real reason for us to worry from the where we have come during last, say, as I mentioned, about our rating upgrade. The direction we have taken, the speed at which we are going, the way our underwriting performance is improving, that gives us a tremendous confidence in what we are doing, the way we are doing it, and the pace at which we are doing it.
Okay. So you said you will grow in line with the domestic reinsurance industry. What would that number be for this year?
That number will be, say, something like 8 to 10%. It can be overall.
8 to 10%. This is for the domestic market, not international, where there is headroom to grow.
Yes.
Okay. That point about competition is because you are a government-owned entity, you have that privilege, right? Every Indian insurer hands you about 4% of their business, what you call as obligatory cession, and that's guaranteed revenue for you, 4%. But now with competition coming in, is there a risk to 4%? And if yes, can it happen as soon as FY28?
I think you are probably hinting at something like obligatory getting shared with, say, private players.
Exactly. So obligatory getting shared.
I think it is best left to the regulator and the policymakers in the ministry to comment on this. But GIC has traveled from, say, obligatory of 20%, say, 2 decades back to today 4%. And while losing all this kind of, if you use the word guaranteed revenue or top line, GIC has grown from strength to strength, and I am fairly optimistic, rather confident, that there is no reason to feel any diffidence on this count. We will continue to go from strength to strength, and our rating upgrade will help us grow internationally.
All right. Hi, Mr. Joshi. Good morning. Good to see you in. This is Nigel on this side, and all the best, in the years to come at GIC.
Thank you. Thank you so much.
Well, I want to focus on the underwriting losses, which saw a sharp reduction, I think around 20% in FY26. Would you largely attribute this to better underwriting, the price revisions, or expense control? And what about from here on? What kind of a reduction in underwriting losses could we look at in FY27?
So talking of the underwriting losses, it is not really one variable which drives the entire performance. Of course, I can say with confidence that, as I mentioned, that whatever lessons we learned during the 4 years and the way we have embraced the underwriting discipline, there is a fundamental improvement and continuous improvement over the last 4 or 5 years, and it will continue. going forward in terms of the risk portfolio quality. So the improvement in underwriting performance can definitely be attributed to the way we have managed our portfolio in terms of selection of the risk, pricing adequacy, portfolio rebalancing, retrocession optimization. And these are all tools which are usually available with our insurer, and we'll continue to tread this path further, leveraging the analytical capabilities that we are emphasizing more and more.
What is the combined ratio, sir, you're working with for FY27?
Sorry?
Combined ratio?
Whatever we were for, say, 2026, that we should further improve, barring some major or a series of catastrophes. So, as I said, the direction which we have taken and the pace at which we are going, that gives us a tremendous confidence that we will continue to improve our business model, our resilience in our balance sheet and our operations.
So last quarter you were at 103.4. So you're saying it should get better from here on?
Yes. Directionally, absolutely yes.
Okay. That's about that. You know, you all have done, sir, an offer for sale, you know, and it got very good reception. The government did an offer for sale, but the government still holds a 77% stake in the company. So that's still higher than the minimum requirement. You know, when should we expect the next offer for sale, and will there be a change in the government policy? In terms of dividend? In terms of dividend, sorry?
As far as dividend is concerned, it is the board-approved dividend policy which decides. And there are very many factors which we consider in terms of calibrating our dividend outgo as a percentage of our profit after tax. So it is subject to annual review, and we will consider all the factors that are at play in terms of servicing our shareholders, value creation, and sharing with the shareholders. So it is an ongoing process, and we do relook at it annually.
Got that. You know, sir, good morning and congratulations on taking over. I just had a question. You sit one layer above insurers, so you have a bird's eye view across segments. Could you give us a sense of, and we ask this when we speak to Life and General and other insurers all the time, but could you give us a sense of which segments within general insurance is most in need for a price increase, price hike?
I think it may not be all that correct to say that, okay, this particular segment is heavily underpriced, because ultimately it is a function of the demand and supply, and more importantly, the perception and assessment of an underwriter in terms of what are the emerging loss trends, whether it is, say, for life mortality or longevity, or even, say, climate change, or whether even a specialty classes like casualty. So it is a summation of various loss emerging trends alongside the capacity available and underwriters' perception of the price adequacy. So at one point in time, one might say that, okay, given the circumstances and given the capacity that is available for a given class and a given contract, this is the right pricing level. And one has to take given that this is a business, particularly from a reinsurer's angle, which is a business of trend and statistics, one has to take a longer term horizon. I mean, as an underwriter, a particular underwriter may not be happy with the pricing level of a particular class today, but then it has to be evaluated in the context of a horizon of a business cycle of a hard and soft market.
Let me come in there. I get your point. All points are fine. But there's also an element of regulation, isn't it? Auto third party, for example, is regulated. Industry has been waiting for a long time for a price increase, isn't it?
Yes, absolutely.
So while all your points are correct, there is also this element.
Yeah, so see, the point is that regulatory action and legislative actions may lead or lag. I mean, ultimately, we are not in a perfect world. So there can be some time difference. So it will happen. I think policyholders are seized of the matter, and we can expect that due action will be taken.
You're not telling me very much. But I understand. It's not for you to maybe comment. So you're holding back. But hopefully, I mean, the industry has been waiting for a while. The ministry's got to decide, and we'll see. Just on that obligatory premium, sir, you think it's still something which is debated, needs to be debated, or it's an issue which is settled? It comes up, and I've spoken with prior GIC-RE representatives earlier. But just your thoughts.
I think you are referring essentially to the maintenance of obligatory or
the
tweaking it going
4%
forward.
obligatory premium, yes.
I think it is a fact that there is a regulatory objective of optimizing retention within the country, and there is a regulatory objective, and that means there is a legislative and regulatory backing to this particular objective. At the same time, the emerging geopolitics requires, and the way the globalization has taken retraced steps backwards, there is absolutely merit in maintaining this, because it is
the question. The question which comes up, Mr. Joshi, is whether it should be maintained solely with GIC-RE, or should it be split? That is the question.
See, the thing is, as I said, it is for the policyholders and regulator to think. But at the same time, the GIC-RE has performed its role in very many capacities, and it has been the whenever there is a challenge before the industry, GIC has stepped in. So when you say that obligatory is given, it has to be weighed against the role it is played and it is expected to play. I believe that whenever any decision is taken, this thing would be taken care of.
Sure. Mr. Joshi, we'll leave it there. Thank you very much for joining us, and we wish you all the best of luck as you take charge. Thank you.
Thank you so very much. Thank you.
Thank you. Okay, we'll take a quick commercial break here, and on the other side, we'll talk about the quarter gone by for the IT services sector. IT, of course, we've discussed quite a bit, but we really come down to numbers from individual companies and what the street is expecting. Quarter se quarter tak. Rima will set this up, and Sumi Jain of CLSA will answer questions around what to expect and where there can be surprises. Stay tuned.
Welcome back. Well, it's time for our special segment then, Quarter se Quarter tak, where we bring you earnings expectations from each sector. And Rima today will tell us what are the expectations in quarter one for the IT pack. Rima, take over.
Thanks so much for that. Let's begin with what happened this quarter. The Nifty IT index extended its underperformance. The index is down nearly 30% from January to June, and the PE multiple continued to get derated. I'm going to show you a table, and this is what the market was willing to pay IT companies at the start of the year versus what they're willing to pay right now. And I've sourced the table from CLSA. Now, for example, for TCS, at the start of the year, the market was willing to pay about 22 times. That came down by 40% and now currently close to about 13.5 times. And it's the same for Infosys and HCL Tech. And now when I look at the preview notes, whether it's CLSA or JP Morgan, Nomura, many others have now slashed their target multiples. They've cut it sharply, aligning themselves to the market. And they've aligned themselves to the fact that growth will be low now for an extended period of time. Goldman Sachs is saying that aggregate organic growth for the companies in their coverage will stand at 2.4% in FY27, making it the fourth consecutive year of low growth. So this is a setup as we enter Q1. Expectations are low despite Q1 being seasonally strong. So this is the CNBC TV 18 poll for constant currency revenue growth on a quarter-on-quarter basis. Flat for TCS, for Infosys 1.7%, but organic revenue growth here will be only 0.8% and lower for HCL Tech and even for Wipro.
The reasons we know, right? Iran war is one. Accenture flagged off, remember, $100 million impact. Deal closures have been delayed. There is AI deflation. And this is also a part that I found interesting from the ICICI note, where they say that India's IT exports grew 12% in FY26, but top 5 Indian IT companies grew 3.6%. So basically, they're saying that large companies are losing market share to GCCs and other players in the ecosystems. So I think when we begin this earnings season, the question is there a further risk to FY27, or have growth estimates been brought down adequately? For Infosys, I think there is some on the street who still believe that there is a possibility that the current revenue growth, organic revenue growth, which stands at 1.5 to 3.5%, could be brought down. The overall growth number will be fine. It could be even higher given the 2 acquisitions that they've done. For HCL Tech, broadly the consensus is that revenue guidance will be maintained at 1 to 4%, and margin guidance for both the companies, TCS and HCL Tech, will remain unchanged given we have got the INR tailwind. Not to forget that in the current quarter, the rupee has depreciated by nearly 2.5% quarter on quarter, and year on year, it's a decline of about 9.7%. Now, quickly, what to watch? I think the most important is going to be the management commentary and how the AI cycle is playing out. Currently, the street is pricing in AI deflation of 2 to 4%. Is there a risk on an annual basis? Is there a risk that this is going to be higher? When will the new work from AI offset the loss in work due to AI? When does recovery really take place? Because JP Morgan is now saying that, the near-term growth curve is going to look more L, which basically means recovery takes place only FY29, FY30 onwards. But companies are going to try and build the narrative around their AI mode, talk about acquisitions, investments, and building capabilities. Now let's come to the valuations, right? 13 to 15 times currently FY28 PE. Historically, large companies would have traded at 15, 22 times. Now the bears are arguing that this is still at a premium to what global companies are trading in, Accenture, Cognizant at 8 to 9 times. But bulls are saying, well, valuations are now closer to trough valuations of 11 to 13 times. The mid-cap story is where it's more interesting, right? They are trading, despite the correction, at a significant premium to large caps. They're averaging 20, 22, 25 times, much higher than historical levels because growth rate has been higher. Will the mid-cap valuation multiple sustain? Will we have accidents like we had in the case of KPIT Tech? Kotak says the setup is interesting. Valuations limit the downside, but re-rating from here on requires growth to accelerate. And as of now, at least, that is not visible. Well, that's the IT setup as we enter Q1. Let me welcome on the show Sumit Jain, Senior Research Analyst at CLSA India. Sumit, let me begin not with the numbers, but more your call on the sector, because you believe the Indian IT sectors and the individual stocks are trading below their intrinsic value. So explain that to us.
Yeah, surely, Rima. Thanks for having me on your show. So clearly, I think the AI deflation narrative has picked up more than the volume opportunity in the last 3 to 4 months. But I think the valuations have corrected even at a faster pace. And now if you look at the reverse DCF calculation for the frontline stocks like TCS and Infosys, at 12, 13 times, they are implying a 4% terminal growth, where if you build in a 2-3% INR depreciation each year, in dollar terms, you are talking about 1 to 2% increase each year for the next several years. Whereas if you look at the last 2 decades, the IT services spend growth has been around 4%. Of course, I mean, IT services have got squeezed out against hardware and software over these last 2 decades. And I guess the expectations are that will continue. But I guess these stocks have fallen more than what the potential for growth is going to be in the medium to long term. Of course, I mean, in the near term, we do believe that the deflation argument or the narrative will be stronger than the volume opportunity. We had these Gen AI Access Days where we hosted 14 experts across tech stack. And I guess compared to our last year Gen AI Access Days, it was very visible that deflation will be the primary narrative for at least next few quarters. And I think McKinsey made an interesting comment that in 18 to 24 months, you will see the volume opportunity from AI overtaking the deflation. Of course, I think Infosys has been flagging that by 2029 or 2030, the deflation might be more than the volume. So it remains a complicated market out there, but also to flag, it's a huge vendor consolidation activity going around, where the mid-tier operators like Persistent, Coforge continue to do well. And of course, we have seen a large deal won by HCL the last week. So yeah, I think there will be a wider band of valuations between winners and losers going forward.
Sumit, you make a couple of interesting points. Morning, you say that the current valuations are implying 1% dollar growth, whereas historically growth has been about 4%, right?
Yes,
and second, what you said, the contrast between what McKinsey is saying, which you said, well, they think that volume growth will outpace deflation, but Infosys is saying, well, is Infosys saying the same thing, or they're saying that deflation will be greater, the rate of deflation?
So Infosys expects that the deflation will be higher than volume till 2029 or 2030.
Okay, and then maybe things start to look different. So in a way, they are kind of sort of both making the same point, right? Both McKinsey and the first point, though, is the gap too small? I mean, it's not as if there's one implied growth is 1 and historical growth is 10, right? I mean, this seems too close to a gap to take comfort from, to be able to sort of bet on these names. I don't know if that's the correct way to look at it, which is that 1% implied growth compared to 4% historical growth.
So Prashant, we are still not getting any valid data points which flag that IT service budgets are shrinking with the Fortune 500 or G2000 enterprises. Yes, the deflation to the base business of IT companies will hit for the next 2 to 3 years as and when the large deals come up for renewal. But mind you, in every deal, the scope of volumes are also increasing. So I failed to mention, but TCS and Tech Mahindra continue to maintain the stance that the volume opportunity is higher than deflation in the AI world. So it's a pretty mixed commentary from IT companies out there. But just to flag, the order book of these companies remain robust, but your base business keeps coming up for renewal once every 3 to 5 years, and when that gets renewed, there is almost on average 5 to 15% kind of a deflation. So that is why I think the pressure on the revenue growth is slightly higher than the volume opportunity in the medium term.
Sumit, all this is about the medium term. Let's talk about the near term. When you did your channel checks prior to the quarter, you spoke to the companies, industry analysts, etc., experts. What were the key highlights about the current quarter and what we should expect in FY27?
Surely, Rima, see, I think this quarter is going to be weak. Accenture laid out the lay of the land by cutting down their guidance by 50 bips. And in this currently negative narrative for IT services sector globally, any guidance cut will further fuel the narrative of deflation being very strong. So I guess this quarter, TCS flagged it will be a flattish growth sequentially. Infosys, it's a stronger quarter than March, but they also did flag that the discretionary demand has not picked up the way it typically picks up in June quarter every year. And that's primarily because of the Middle East war and the crude oil prices increasing globally. Wipro again has been crying out for a weak demand in the June quarter, and maybe the September quarter strong seasonality may not work out this year. I guess Tech Mahindra stands out clearly in the large cap IT space, where they have two large telecom deals which will ramp up, one in this quarter and one in next quarter. And that's why we see Tech Mahindra's growth to be relatively higher than rest of the large cap names. And also to flag on HCL, they are entering into a seasonally strong quarterly period of September and December. And of course, they are one of the winners of vendor consolidation activity out there, where we saw a $1.1 billion deal for them from a European auto customer. And other than that, the mid-tier IT companies continues to do well. I think this is something I have flagged on CNBC multiple times, that whenever a technology disruption happens, the mid-tier operators are always a bigger beneficiary, because they can disrupt their business model much more easily and shift towards the new age solutions. And that's what we are seeing with both Coforge and Persistent, where Coforge this quarter organically will be flattish because of certain public contract coming down. But going forward, the growth will be strong. And in case of Persistent, expect a similar quarter as they have been delivering for the last 6-7 years. So yeah, not much change in the thought process on the mid-tier caps as far as the earnings growth trajectory is concerned.
On Persistent and Coforge, which are both your high conviction outperform, while the growth story is intact, but is there a mismatch in market expectations and the current valuation? If I buy today, will I make money? or is it all priced in? Because it's a well-documented story that these two companies are doing better than the rest.
Yeah, Rima. So I think the valuations for these companies are a bit depressed because of the broader negative narrative of the sector and the deflation being more than volume. But if you look at the valuation range for these companies, particularly the mid-tier operators, the PEG multiple has typically been in the range of 1.5 to 2.5 times PEG. So these companies have reported a stable to expanding margins in the last few years, and the organic dollar revenue growth for Coforge has been mid-teens, whereas it's around mid to high teens for Persistent. So in that lens, a 22 to 23 times PE multiple for Coforge is at the bottom end of that 1.5 to 2.5 time PEG multiple. And that's why we believe that there is a scope for valuations to also re-rate in case of Coforge, as and when they show the revenue and cost synergies around Encora integration. And of course, there will be a mid-teens kind of organic dollar revenue growth. In case of Persistent, of course, I mean, they announced a big acquisition of Nagarro last week. They were with us in Singapore earlier this week. And I think a lot of positive rationale they gave around this acquisition. So I guess in the near term, you will see potential earnings upgrade for Persistent as well, because of the large deal they won and the ramp up in this quarter expected. But probably, what numbers came for Nagarro over the next 2-3 quarters, given they have a high exposure to European auto space, which is actually not doing well, the warning we have seen from KPIT. So yeah, I think Persistent will be a tricky narrative out there where Indian Persistent EPS will get upgraded, but Nagarro may see some pressure in the near term. But yeah, we see a lot of positive rationale around the acquisition of Nagarro.
Just one quick last word, Sumit. The HCL Tech won that order, right? $1 billion Europe order from a Fortune 50 company there. And the stock was up sharply that day. Was that a Infosys order prior, right? Which they kind of, I was told that this was something which Infosys was doing, and then they gave up, and they were making hardly any margin for it. And I don't know if you have any feedback on it.
So Prashant, I mean, I will just go with the broader news articles out there. Yeah, I think at least the news articles are flagging it has taken over from Infosys. And if you remember, Infosys in 2020 won almost a $3 billion deal from Daimler. And a part of that has actually gone to Cognizant and part maybe to HCL. But maybe I will not comment further into it, given these companies do not get into client-wise disclosures, given the NDA they have with them.
I was just checking because, I mean, maybe is that if it is true, is it a broader signal? I mean, how desperate the situation is. But I think you already said that maybe, deal flow, etc. is not you're not seeing that impact on the base business. Maybe there is some deflation. So point taken, but interesting conversation, Sumit. Thank you very much for joining us. Good speaking with you here on CNBC TV 18 as always. Well, we're just going to talk about the comments coming in from Nitin Gadkari. This is the Road Transport and Highways Minister. He spoke on reports claiming the E20 petrol vehicles damaged, they're causing damage to petrol vehicles, and basically saying, well, these claims are fake. Listen in.
इस प्रकार की झूठी बातें, और इसलिए मैं आप एक ही बात बता रहा हूँ, आपके मार्फत मैं देश के तमाम लोगों को यह आह्वान करता हूँ कि कोई भी स्कूटर, मोटरसाइकिल और कार जो पेट्रोल की है, जिसमें इथेनॉल डाला जाता है, अगर खराब हुई है तो तुरंत डीलर के पास जाइए, तकरार करिए और एक कॉपी मेरे पास भेजिए। ऐसी एक भी कार और स्कूटर का नाम चमनके जी अगर आप बता पाएंगे तो मुझे बताइए। बिल्कुल, हमने भी कोई आया ना मेरे सामने।
Okay, let's welcome back on the show our technical expert Vinay Rajani, the Senior Technical Research Analyst at HDFC Securities. Hi Vinay, good morning. It's a bit of a tricky day of trade for equity markets on the whole, but the Indian markets are down 150 points. Actually, we're outperforming what our Asian peers are doing. What's your view at current reckoning, and would you go in and look to buy the Nifty?
Yeah, good morning. So yes, definitely till yesterday, trend of the Nifty was clearly bullish because of the we have opened lower, and till now it is up by down by 60 points. Not a big deal. Still, the trend is positive. 20, 50, 200 days, not, but at least up to 100 days it is trading. So it is a good sign. Positional trend is up. And on 3rd July, Nifty made a gap between 24,200 to 24,250. So today's low has filled that gap partially. We believe that for 100 to 200 is a very strong support for the Nifty, and it might happen that assume after first half of profit booking, or one can say selling pressure. But yes, the price remains up. We are of the opinion that at lower level Nifty should find support. 24,200 is a nice level to take a fresh entry, and any case for traders, the 24 would remain as a stop loss in long position. On the upside, the recent swing high of 530 would remain as a hurdle. But yes, stock specific action will be there. Some sectors defensive space will come and operate in the market. So we are not expecting broad-based selling in the market. 24,000 should be the stop loss in trade Nifty.
Yeah. Got that. Your stocks, Vinay?
Yeah. So some of the defense stocks are looking strong. Some engineering stocks like Azad Engineering is one of the continue to be recommended to our clients previously a few days back, and still it is looking good. So Azad Engineering around 23 go long. 2250 should be trading stop loss. On the upside, I'm expecting a target of 2400. The second stock is from the pharma and care space, that is RPG Life Science. So this stock has been resilient and quite strong, and now today it has given a fresh breakout on the long-term chart. Seems that your participation phase and the sector is also performing very well. So 2515 is the entry level, 2050 trading stop loss. On the upside, we are expecting an immediate target at 2650.
Okay, thank you, Vinay, for joining in. Let's go across. Okay, just one quick alert. Kospi has now entered the bear market, 20% down from the all-time level that it hit in June, which was nearly 9,400. The index today is sub 7,500. Manglam is now joining in to get us to check on the Sensex derivatives at this hour. Manglam.
Well, it's Wednesday, so that means tomorrow we have the Sensex weekly options expiry, and that's exactly what we're tracking this morning. The Sensex is actually opened about 500 points lower, so we have the BSE Oil and Gas Index, which is dragging it down by about 0.3% on the BSE Oil and Gas Index, and the Sensex itself down about 0.2%. But, you know, at 77,681, it's also fairly close to its 100-day moving average, is about 300 points from where we are, which is 77,324. So to that extent, this decline that we've seen, you know, it has some support at lower levels, and that's what the street is betting on as well. For options that expire tomorrow, the 78,000 call obviously has seen a fair amount of writing, telling you upwards of 78,000. Even if the market were to bounce back, we would see some sort of supply coming in. But if you look at the 77,500 put, those writers are playing for a premium of almost 200 rupees, telling you again that, you know, there is support at 77,300, which is very close to the 100-day moving average. And then below that, 77,000 put has the maximum open interest, telling you that the Sensex is unlikely in the very near term to break that 77,000 mark, even if it were to go below the 77,500 mark. Right now, 77,665 is where we are. Expiry is tomorrow.
Thank you for that. Get into a break. Manisha Gupta will join in to talk commodities. Stay tuned.
Okay, welcome back. I think let's just take a quick look at the listing this morning. NAC Packaging, a company called NAC Packaging, has made it to the market. I think stocks opened sharply higher, so 10% higher on top of the issue price. 187 is where that is trading at right now. So I think about a 20. This is a small company, relatively, and market cap of about 2,000 odd crores or so. But day one, decent listing. Okay, let's just look at commodities and what's top of mind there. Manisha is here with what else but oil. We're back to talking about Middle East and Iran and all of that stuff. Manisha, take it away.
Oh, absolutely. It doesn't seem to be going away in a hurry. And a lot of people that I'm talking to, including Citi and Bank of America, tell me that another 6 to 9 to 12 months is something that they see this basically continuing, and the crude oil price is being volatile as well. Having said that, we are back above $76 a barrel. We did see prices go decline to 70.5 in previous week therein. So from those kind of levels, it's a very smart jump that we have seen come in. 5% overnight. We are 6.5% on the higher side for this week already in sense of crude oil prices. Well, the U.S. military has carried some fresh retaliatory airstrikes in Iran. This is after Iran attacked 3 new vessels overnight which were transiting in and around Strait of Hormuz. One from Qatar, which is an LNG carrier, and the second one was from Saudi oil tanker. And both of these countries clearly have come out with comments regretting this as well. There also has been an important statement that has come in from CENTCOM saying that the U.S. strikes are in response to Iran attacks on 3 commercial vessels in Strait of Hormuz. It also continues to say that this is demonstrating an aggressive stance from Iran, which is unwarranted, dangerous, and a clear violation of the ceasefire, more importantly. There also is U.S. Treasury Department's Office of Foreign Asset Control suggesting that they have revoked now general license for Iran origin oil trade. All exports with immediate effect have been stopped. This includes basically crude oil, petrochemical products of all Iranian origin, by the way. Iran has already been saying for last few times, every time there has been a conversation between the two countries and mediators as well, that all vessels that cross Strait of Hormuz must be Tehran-approved routes only. Any going above and beyond Oman or as per international maritime times is something that Iran will not recognize. And that is exactly what they have done perhaps in the last couple of days as well. In total, 5 vessels till time have been attacked by Iran therein. If you look at the overall renewed conflict that has led to interim US-Iran peace agreement in a bit of a jitteriness there at risk as well, and that has raised prospects of perhaps fresh disruptions in the global energy supplies. Till yesterday, a lot of global banks and brokerages were talking about on how there could be a surplus. There were calculations on what we could be looking at by the 4th quarter and the 1st quarter of 2027. Well, that seems slightly destabilized right now. Also, reversal from earlier expectations of supply glut seems to be going away into the markets, with most banks now saying that it would be between 65 to 85, even 90 on the higher side as a range for rest of 2026 for crude prices.
All right. Manisha, thanks very much for it. There's commodities and oil specifically in focus. We take a break. Lata speaks with economists Santanu Sengupta and Samiran Chakrabarti in today's Indianomics. That conversation follows after a quick break.
Welcome to Indianomics. The big question I'm asking today on the show is, do economists and RBI need to seriously upgrade their India GDP growth forecast for this year? Right now, RBI is at 6.7% and economists on the street are between 6.3 and 6.9%. But just look at the recent data. Credit growth in May and June was over 17%, actually at 17.7%, highest in 2 years. Exports in April and May grew by 16% versus 4% in Jan-Feb March. And auto sales for June alone are at 21% for two-wheelers and 29% for cars. So if India grew by 7.8% in Jan-March quarter, how can we dip below 7% in the April-June quarter? Joining me to discuss the India growth picture are two top economists, Samiran Chakrabarti of Citi and Shantanu Sengupta of Goldman Sachs. Of course, since we have these two top economists, we are also going to discuss FCNR deposits, balance of payments, direction of rates and rupee. But first, the growth question. Samiran, to you, exactly what I said. If Jan-March was 7.8, and if April, May, June has seen 17% credit growth, 16% export growth for April, May at least, and fiery auto sales, should we be prepared for a 7% plus GDP for this quarter and for the year?
So, Lata, thanks for having me. Our own number for the quarter is 7% plus. So I think the high frequency indicators that we have got, they're tracking that around 7% GDP growth number. But as you know, large part of the GDP comes out of the corporate earnings. We are yet to find out that how those corporate earnings numbers will look like for the quarter. Based on that, we might have to tweak the numbers a little bit up and down. But for now, I think 7% is a real possibility. And there is a good reason behind it also. We would have to go back and see that 2025 was the year of stimulus for India. And that stimulus effect gave the economy a certain kind of momentum, which probably was able to counter the headwinds coming from the Middle Eastern conflict situation. And even from the conflict, I've always maintained that two things worked in India's favor. India does not produce power out of natural gas, and India had enough diesel and petrol stock because it's a refining economy. And because of these two things, power and transport, two of the most important things in growth, was not affected. So with that stimulus and these two supporting factors, I think the economy did pretty well even through the April-June period. Now, whether there is any lingering effect from this shock that still will pass on into the rest of the year, whether the shock can re-emerge or not, these are still open questions. But for now, whatever macro high-frequency data we are tracking seems to suggest that things have held up better than what probably people would have feared.
Would you say that there is an upside bias to your 6.9%? The reason why I called Shantanu and Samiran, both of you are at the higher end of the GDP forecast. Shantanu is at 6.8 and you are at 6.9. But will you say there is an upside bias now to the 6.9 going by the April, May, June data?
So, I mean, we have to be honest in admitting that these decimal place forecasts are not easy, and we should not put too much emphasis on this, the decimal number after the 6% or 7%. So, but given still, I think one of the things that we are still yet to figure out fully is the El Nino effect.
Yeah.
So maybe that's why we have taken about a 20 basis point odd lower number on our forecast, thinking that that's the kind of El Nino growth effect that we have to factor in for. If monsoon turns out to be better than what feared, then maybe there is some upside to our GDP growth forecast as well, based on the fact that we have already taken that 20 basis point downside in our forecast.
Okay. I just have this doubt that, this hunch that economists, all of us, were very bearish in April and May when the way the rupee was behaving and crude was behaving. But now that things have subsided on that front, two dramatic changes, crude from above 100 to around 70, 75, and this FCNR gush. maybe we need to change the numbers. Shantanu, therefore to you, would you say that given the recent data, there can be an upside bias to your 6.8%?
I would just say, thanks for having me in the first place, Radha, but I would just say that there are two parts. One is the economy has been more resilient through the crisis, but that's not true for only India. That's pretty much true for many other emerging markets that we have seen. Inventory draws have been quite stark across the world. Two, refinery runs have also been quite high for the refineries that worked. And that is what has cushioned most economies, and that was a learning for us as well, that you're able to withstand these kind of shocks better. The second thing, apart from the power point, which Samiran rightly pointed out in our view, is that you're able to switch to other forms of fuel very quickly. So the renewables surge has also been quite stark for India over the last several years. This had nothing to do with the Middle East conflict, but over the last several years, post-pandemic, you've been shifting, and therefore you did not quite feel the kind of shortages where other countries were dependent on fossil fuels. With regards to the current growth trajectory and going forward, what we think, I would say a slight upside risk to our fiscal year numbers, mainly from where the conflict is right now and the fact that oil prices are in the low 70s or the mid 70s, although it's ironic that we are talking on the day when, again, it's $75 a barrel. But I'll just point out that, remember, the consumer was completely insulated through the crisis until about mid-May. So June is the first month where you saw the impact of higher prices on the consumer. And this quarter will be the first quarter where the consumer will feel that price effect for the first time. Having said that, as you pointed out, credit growth is doing better. Monetary policy stimulus is working through. So I would say a slight upside risk to the numbers with the current state of affairs.
And your first quarter number?
So we have a 6.8, and I would say an upside bias to that.
Okay. Shantanu, you were saying that it's not just India. A lot of countries exhibited this resilience. And I was looking at the export growth of many countries. I don't know what their historical trend is, but many of them were at double digits. And ours is clearly an outperformance in April and May. And I'm only taking goods. I'm not even looking at services exports. Goods exports was up 13.5% in April and 18% in May. So there seems to be a global engine that's working favorably. Would that be a reason to upgrade Indian forecasts as well?
I would just say that even there, we should be careful about looking at the kind of goods during that period that countries are demanding. So, for instance, our exports to the Middle East shrank in the month of March and has rebounded very, very quickly thereafter. So if you look at the charts, it'll look like a sharp dip and then a very, very sharp rebound. And you are also supplying refined products to the rest of the region. You are able to refine and supply, especially to Southeast Asia. Singapore was a big importer of products. And hence, that's the kind of goods trade that went on during that period. But overall on growth, I would say the points that you made earlier during the conversation, which is credit and the general broad basing of credit. I mean, industrial credit growing at 15% is a very, very positive number for and probably merits thinking about whether there are upside risks to growth.
Fair enough. And you're giving me that handover very nicely, because that was my next question to both of you. Samiran, this FCNR money, first of all, how much are you all anticipating now that we are a few weeks into the scheme? If it is $50 billion or thereabouts, that's whatever, 5 lakh crore more of money which banks will have. So first of all, how much? And will that also have a positive impact on growth?
So, Lata, it's a difficult thing to estimate right now that how much money will come in. If I just extrapolate from the FX reserves data that RBI is publishing every week, it doesn't look like as yet too much of money flow has happened. So our estimate is all the three schemes combined, we will get something around $55-60 billion additional coming in. Yes, it clearly increases the availability of resources with the financial system to lend, or in other words, part of this can go into retiring the high cost debt that the system has got, and the rest can be on lent for credit. Now, obviously, this is the lean period for credit. So immediately it might not go into credit, but might go into some investments into bond as well. But the bigger question really is that this credit growth is now very, very strong. In fact, not just the banking system credit. Yesterday, RBI has published the NBFC monthly credit data also, and it shows that the retail credit growth, X of housing, is growing close to 25%. Credit growth to consumer durables is 42%. Gold loan growth is close to 70%. So clearly there is a huge momentum of credit growth that is there. And this in turn is probably supporting the consumption activity as well. So and once this consumption recovery takes shape, then it can feed into a proper investment recovery as well. So this is something that we have to very closely observe, that to what extent this additional liquidity that is coming in can get absorbed in the higher credit growth versus how much RBI will have to mop up from the system through its sterilization measures.
Fair point. So there is this positive Indian engine in terms of liquidity. Shantanu, similar question to you. My sense is that there is also a global engine in terms of capex, which is happening in power, data centers, etc. A wealth effect. Even if Korea is now in correction territory or bear territory, Korea is 70% up in terms of the market itself. That is also a wealth effect in Far East, in China, in the US in particular. So I'm just saying that both the global engine and the Indian liquidity engine is pointing to higher growth. Would you therefore say that what is your FCNR number? What is the growth impact?
On the FCNR, we are, again, putting all the three schemes together. So that's the FCNR, the ECB, as well as the bond inflows. We would think it will be about $80 billion. Again, the question really on the FCNR is the amount of leverage that foreign banks or domestic banks are able to take. If that is indeed very large, this number could be materially higher than what our estimates are. The liquidity impact, again, I would agree. We don't think even $80 billion will be easy for the RBI to manage if it comes in a very short period of time. That is in the next 6 to 9 months, and therefore we'll have to look at the sterilization tools. Of course, many at their disposal, but I think that question will come up. What that does is it keeps financial conditions in general benign in terms of liquidity. What happens to rates eventually going into next year if growth is indeed this strong is another question. But it keeps overall financial conditions quite benign, and it solves the liability overhang that the banking system has had over the last couple of years or so. And that should essentially make sure that the credit growth cycle extends. Remember also, right now you're only looking at the domestic credit growth. It is happening at a time when ECBs had come down. So if you look at the overall system, so apart from the NBFC credit that Samiran mentioned, I would just say that you'll also find ECB-induced lending also coming into the real system. So the total private credit is going to look quite strong over the next year or so in our view.
Okay, I still have questions on rates and rupee, but before I take the break, just a word, a yes or a no. Would you say there is a very good chance of a 7% plus GDP growth this year, Samiran?
It's possible.
Shantanu?
Yes, I would say upside risks to our numbers.
Thank you very much for that. A break, and thereafter the more important questions on where rates are headed, where the cost of capital and yields are headed, all those questions, very important questions for the market. Bazaar viewers, for you it's Chartbusters, but you will get to hear this very important answers from our economists after market hours.
The market opens with a gap down as the United States strikes targets in Iran in retaliation to attacks on commercial shipping, sending crude prices higher and spooking uncertainty over the durability of the ceasefire. The Nifty opens below 24,300, currently around 24,250. The mid-caps fares slightly better. Pharma is the sole sectoral gainer.
Stocks of oil marketing companies under pressure as crude oil prices spike and Brent crude prices jumps over $76 a barrel mark on fresh hostilities between the United States and Iran.
Paint stocks are another casualty of the surge in crude prices. Asian Paints is the top loser on the Nifty, down about 3%, though off lows now. Berger Paints, Kansai, Nerolac, all of them under pressure.
Interglobe Aviation reports 11% month-on-month growth in passenger traffic in May as the disruption from West Asia crisis eases, but higher crude prices and a threat of renewed conflict between the United States and Iran weigh on the stock.
South Indian Bank slips 7%, its biggest decline in 3 months, even as the RBI approves the appointment of the new MD and CEO Mahesh Pai for a 3-year term.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam, and the market's a little under pressure, but that's more or less the trend that we're seeing in all of the Asian markets. Hey, Mangalam.
Hi, Nigel. Welcome back. Good to do Chartbusters together after a while. Hope your holiday was a great one. Well, let's see whether the market does a lot better now from here on or not. The last 4 or 5 sessions have been fairly good, but let's see where it goes from here. And for that exact reason, we do have Ajit Mishra who joins in. Ajit, would you just call it, a dip after a big rally that we've seen, and maybe the uptrend is intact, or has something shifted?
Yeah, good morning, Mangalam. Good morning, Nigel. So, Mangalam, as you have rightly pointed out during the show, that it's a breather, basically, that 1,500 points kind of a rebound that the market has experienced, Nifty has experienced from 23,000 to 24,500. In that, we have reclaimed the major averages. Means a couple of days ago, we in fact reclaimed the 200 days of exponential moving average, but we couldn't sustain. So basically, that coincides with a couple of major hurdles. So that's one is long-term average, the other is the previous swing high close to around 24,600. So maybe market was trying to find a reason that to take a breather around that area before we make any meaningful up move, towards 25,000 mark or maybe higher. So as of now, the trend looks intact. 24,150, 24,000 is the area basically where we have multiple supports, both in terms of price action as well as the moving averages. And if you see that, in fact, the rate sensitives are also not very down and out in today's session also. So it means banking, after the initial downtick, we are seeing recovery. And the other sectors are also contributing on the rotational basis. So broadly, the trend still looks up, especially banking, as long as we are hold above 57,300, 57,500 mark. We anticipate this consolidation first after this recent up move, and then eventually up move up to 24,600 marks. So broadly, the texture looks positive. It's still a buy on dip until we decisively close below 24,000 mark.
Okay, so trend more or less positive. Got that. Ajay, I want to ask you about the metal index as well. That went through a bit of a correction. And when we woke up this morning, you have silver prices that were down, aluminum prices as well, a little bit softer. The dollar index, by the way, has seen a bit of a strength, which has, upset sentiment a little bit out here. However, from the day's low, the metal index actually has spiked up quite a bit. Stocks like Hindustan Zinc have seen a good recovery. Any view with regard to the trends on this one and levels you're looking at on the metal index?
So Nigel, in fact, if you see that metal was among the top performers, in the recent past, it's just that after the cool off in this US-Iran crisis, we were seeing that softening of the metal prices, and which was reflecting in the stock prices as well. And the move was almost vertical in some of the names. So basically, we are seeing more of price-wise correction and in some of the case time-wise correction. But broadly, the trend is still up. When it comes to the metal index also. Currently, the Nifty Metal Index is currently quoting around 12,600 mark, while holding above its 100 EMA mark. So the texture looks sideways to us, but broadly the trend is up, and about 12,800 mark, the 20 EMA zone. We may again see a recovery or rebound attempts, which could help the index to inch toward 13,200, 400 levels. So in this, National Aluminium, General Steel, JSW Steel, these are some of the counters which are relatively better and can witness fresh momentum in case it manages to cross 12,800 mark in the Nifty metals.
All right, take that point. Thanks a lot for joining in, Ajit, and giving us your calls. Just a two-word answer on your stock picks.
Yeah, so basically, considering the market tone, buy and sell approach is something that you should maintain. So Sun Pharma from the pharma basket, wherein we look positive, 2040 is what we are eyeing as target, 1830 should be a stop. ITC, it's a fresh breakdown, so where we anticipate a dip towards 268 mark. With stop at 288, one can go short in ITC.
All right, take that point. Thank you so much for joining in and giving us your calls. We'll just slip into a short break. On the other side, primary market action. The management of synthetic fabric manufacturer Kusumgar as the company's IPO opens. Stay with us. Welcome back. You're watching us here on Chartbusters. Let's shift focus to the primary market action then. Kusumgar, the IPO opens today. It's an engineered fabrics maker, operates across aerospace, defense, automotive and industrial segments. And the IPO is a pure OFS, 650 crores worth offer for sale coming in from promoters. Ankur Kothari, who's the CEO of the company, joins us. Thanks a lot, Ankur, for joining in. You know, the first obvious question is, why an OFS when you already have 300 crore of debt on your books? You could have done a fresh issue, repaid the debt of the company, and then, let some money come into the company as against just going to shareholders.
That's right. But a few reasons for this. One is that we essentially need no further funds for further capex. We did a pretty large capex in the last couple of years, and that should serve us well for the next 3 years or thereabouts. So that's one. Second is, I think the debt that you see on the books, which is a mix of long-term loans, comes with riders of subsidies that we get. These are excellent subsidies that we get from the Gujarat government. And, for this project that we put up, we take this debt and we have to take this debt to be able to avail subsidies. Effectively, the cost of debt for this term loan is between 4 and 5%. So that's the thing. I think we have had a strong Q4, and that has led into it seemingly looking like a large debt position. But in the normal course of business, as you see, this should normalize.
All right. Hi, Ankur. Good morning and welcome to the show and all the best to the IPO. This is Nigel on this side. Ankur, I wanted to understand that aspect that you made, the point you made with regard to the large capex that you'll undertake. At optimum levels with the current gross block, what kind of revenue potential does the company have?
So I think if you were to track, what we have done over the last few years and sort of the product mix, the direction in which we are headed, I think asset turns of 4 to 5 are reasonable to expect.
Okay.
So to give you a sense of where we could get to, essentially for the next 2 to 3 years, 3 years at least, we don't think we'll be needing any meaningful capex. Obviously, there'll be some maintenance, some debottlenecking capex going in.
All right. So you're doing around 700 crores as of the last year. What is the optimal levels of revenue? Could you double your revenues? Yes. Can you do around 1,400 crores without putting too much capex on?
Significantly more than that.
So could you give us the number? It's revenue potential, so it's in line with the guidelines. Your bankers will be keeping an eye out on what you have to say till you list. So we got that. We don't want anyone to get into trouble. What is the revenue potential? That's a number you can give us.
I think north of 2,000 crores, we should be able to do without significant capex, right? I mean, you always have some debottlenecking capex and some maintenance capex, and there could be new projects which are completely greenfield that we could be getting into. But for this current set of products, the current set of assets that we have, we should be able to go to north of 2,000 crores.
Okay. And what about how does your revenue mix move from year on? I'm seeing aero and defense. That revenue actually has not ballooned up, but I see outdoor as well as lifestyle. That's become one of the fastest growing verticals. So what is the ideal revenue mix that you would like to maintain from year on?
Great question. I think ideally we would want a mix, frankly, between sort of the aerospace and defense bit, which has a fabrics element and a finished products element. Then we have the automotive industrial bit, and then the active wear bit, right? Ideally, we would seek something to between 60 to 70% of aerospace and defense, with a healthy split between exports and domestic there. Then obviously between the 1/3 of the business that's left, between half each of active wear and industrial. We want to be fairly well diversified, both in terms of geographies as well as end markets, just ensures resilience in the business.
No, we understand that. And since you said it was about 4 to 5 times asset turnover, I was looking at your gross block. It stands at around 300 crores. So I was just looking at, that a back of the envelope calculation does suggest 1,500 crores worth revenue. I suppose some sort of value-added business and maintenance capex or capacity debottlenecking could take you to about 2,000 crores. The question is, by when do you intend to get there? And secondly, what are the current orders that you have on hand, Ankur?
I think a reasonable timeline to expect is 3 years plus. So FY30 is a good time frame for us to be targeting something like that. That is in line with how we have sort of grown over the last 6-7 years. So we are hopeful that we can maintain that thing. I missed the second question you asked.
The second part is, what are the current orders that you have on hand? How does this ordering activity work? Because obviously they can be lumpy, right?
Yeah. Well, an element of my business, I would say around 1/3 of my business is lumpy. Within the aerospace and defense space also, there are portions of our business that are frankly fairly linear and predictable. Right. So I think we are good for this year. Without indicating too much, I can say that for this year, we are looking to sort of resume the normal growth trajectory that we had earlier, since we had a blip in FY26. So back to normal, because Trump tariffs are done with, and there is renewed buying in aerospace and defense segment around the world.
Right. And what about margins? I look at your margins and then I look at some of the others. But others obviously have other parts of the business as well, which is why their margins are lower. The technical textile or the fibers business obviously has relatively higher margins. But in your case, a large part of your raw material is also crude linked. It's polyester, right? So what should one think of when it comes to margins? And what's the margin upside that you have from here on if you increase your operating leverage or increase your utilization?
It's a great question. Just to correct you on, I think polyester would be close to 30% of my sort of the input raw material value that I'm buying. I think having said that, most of our contracts are either back-to-back or directly linked to raw materials. And I would be able to say that comfortably, more than 2/3 of my business is oriented that way. So we do not really, there isn't a very large impact of changing raw material prices on our margins. Our gross margins, if you look at our numbers, are north of 50% anyway. So that's partly the thing. For our business, the focus is actually on value selling, creating customized solutions, niche products as per the customer's requirements. So I think that is going to be that will be the continued focus of the business, to try and do more and more high value products and be able to charge have a pricing premium because of the value that we are bringing. It's, the advantage of operating leverage or scale will kick in regardless. I think from management perspective, we end up focusing more on innovation and product pipeline and product development to boost our margins.
All right. Directionally, margins will improve from here. That's what you're trying to tell us.
I would actually, in my base case, I would imagine my EBITDA percentages to be in a similar range as today.
Similar range. Got that, Ankur. We're going to let you go at that. Thanks for giving us a brief insight into business. All the best with this IPO. And on listing, we re-invite you on the show, and then we push you a little bit more for the near-term guidance. All the best.
Thank you so much. My pleasure.
Well, time to slip into a short break. On the other side, we'll continue to focus on markets and stocks moving around.
Welcome back. We have some updates coming in from Tilak Nagar. It's the June month update where they saw the highest ever monthly sales, combined business volume at around 3.5 million cases as well. So good going for Alcobev. But let's talk about a bunch of other stocks. Kalyan Jewellers, that's one that was underperforming in yesterday's trading session. And we had made a point that, the numbers aren't bad. They're just weak in comparison to Titan, and which is why there was a sharp sell-off that we saw on Kalyan Jewellers, even as Titan hit a record high. And today as well, the stocks bounced back. So it's a 5% up move that we're seeing. And we have a note coming in from Citi as well. They have a buy call. Their target price is at 750 rupees. They're saying that India revenue rising 38%, driven by 28% SSSG. While it's below estimates, it's strong, and they do see franchise expansion supporting growth and ROCE improvement. So all those factors leading the stock to move higher from here on. With that, let's move on, and let's also get you some more updates. Ideas for profit coming in from our colleagues at Money Control Pro, and today we have Anubhav Sahu who joins in.
We're talking about Acutaas Chemicals, which posted a strong stock run-up in recent months on the back of sequential jump in Q4 numbers and the expectation that new businesses would show traction in fiscal 27. Now, company is largely led by CDMO offtake for the intermediates required for the blockbuster oncology drug called darolutamide. Now, this drug is marketed as Nubeqa by Bayer, which reported 57% revenue growth in last quarter and is expected to do well in near future given patent exclusivity in key markets. Secondly, new growth drivers in the areas of semiconductors and battery chemicals are emerging. With respect to chemicals used for semiconductors, company's subsidiary, Baba Fine Chemicals, posted a strong recovery in Q4 after initial teething difficulties. Then initial capex for battery chemicals is also done with, and two key electrolyte additive molecules are likely to commercialize from current fiscal. Overall, we expect company to deliver ahead of 25% top-line growth guidance in near term. However, margin profile will remain a function of successful execution of new businesses. Now, stock is trading at a premium valuation of 40 times EV by EBITDA of fiscal 28. We believe current valuation factors in near-term growth momentum, and so it is prudent to partially book profit at this level. Note that stock has climbed 3 times in the last 1 year.
Thanks a lot for that, Anubhav. Well, on that note, though, we'll wrap up on this session of Chartbusters. You stay with us. The team of Trading Hour comes up next.
Well, good morning. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu, with me Hormaz Fatakia. The Nifty down about 100 points, though from the lows we've seen some recovery. So suffice to say we're down, but not necessarily out. The mid-caps are doing a shade better, but more importantly, the real estate space, that is on fire this morning. We have the Realty Index, which this month itself is up nearly 9%. And if you look at some of the stocks which are surging out here, you have Lodha Developers, which is up 3.5%. We have DLF, which is up nearly 2%. And then from the broader markets, we have Anant Raj as well, and Godrej Properties up anywhere between 2 to 4%. So across the board, there have been gains. It's the Nifty Bank, which is currently under pressure by about 0.4%. But no real worries. The decline has been across the board, and we are seeing some recovery from the lows. Hormaz joins in, and he's moved across to put the spotlight on the top movers this hour. Hormaz.
There is some recovery from lower levels, and as you mentioned, you may be down but not necessarily out, because we are still managing to protect the important levels on the downside. Yet again, we managed to protect 24,200 on the lower end, at least as of now. We are almost 70-80 points off the lows of the day, so there is some buying interest that's coming in at lower levels. So good going for the index, at least from the initial fall that we have had, closing in on the 24,300 mark. Now take a look at the oil prices as well. The oil prices, even after the deterioration in the situation, are slowly extending their gains. Yes, but they haven't seen that hyper 8%, 10%, 12% up move. Brent is up 3.5%, still below the $80 a barrel mark, and a similar quantum seen for NYMEX as well. But the rise in oil prices has not had a very positive impact on the oil marketing companies. But before we get to that, you take a look at the stocks that are dragging the Nifty lower, and it is the FMCG names, ITC and HUL, that are dragging, and of course there is Reliance Industries, which is the top contributor to the Nifty downside in today's session. Now take a look at the impact of the higher crude oil prices. The oil marketing companies, HPBP, IOC, all down, but IOC has recovered from the lows of the day, as has BPCL, although HPCL is still down 3.5%, and Asian Paints too is seeing some recovery from the day's low. Look at the newsmakers today. Orchid Pharma, after that Russia tie-up, is up 10%. Inox India has won an order, and South Indian Bank, after the announcement of its new CEO, has declined as much as 9%, although now down around 7.5%. Now, you mentioned the FMCG stocks. They're taking a bit of a breather right now. Jubilant Foods is now down 4.5%. ITC, Dabur, United Spirits, all of them seeing losses of anywhere between 1.5% to 3%. A couple of positive brokerage notes that came in earlier in the day. Kalyan Jewelers, you heard Mangalam talk about it just a few minutes ago, 4.5% higher on the stock. Citi has projected an upside of as high as 97% from yesterday's close. And Info Edge, after yesterday's very strong up move, is extending its gains. Another double upgrade coming in from Citi for Info Edge today, so another 3% higher on this one as well. And lastly, stocks at 52-week highs in today's session. Pharma names continue to dominate this list yet again. Spark is up 2.5%, Senor's Pharma is up 5.5%. The Thangamal Jewelry is doing well today, 7% higher, and Adani Energy Solutions as well, one of the names that are at a 52-week high, Mangalam.
Yes, indeed. A lot of them are, doing extremely well. But all eyes this week at least, and as we move towards the quarterly earnings, will be the quarter tak, IT earnings that will come by. And this is our special segment. We bring you earnings expectations from each sector, and to open the batting every time, we have the IT pack. And as always, Rima joins in to tell us what the first quarter of FY27 will be for the IT sector, and more importantly, what the outlook is likely to be.
Let's begin with what happened this quarter. The Nifty IT index extended its underperformance. The index is down nearly 30% from January to June, and the PE multiple continued to get derated. I'm going to show you a table, and this is what the market was willing to pay IT companies at the start of the year versus what they're willing to pay right now. And I've sourced the table from CLSA. Now, for example, for TCS, at the start of the year, the market was willing to pay about 22 times. That came down by 40% and now currently close to about 13.5 times. And it's the same for Infosys and HCL Tech. And now when I look at the preview notes, whether it's CLSA or JP Morgan, Nomura, many others have now slashed their target multiples. They've cut it sharply, aligning themselves to the market. And they've aligned themselves to the fact that growth will be low now for an extended period of time. Goldman Sachs is saying that aggregate organic growth for the companies in their coverage will stand at 2.4% in FY27, making it the fourth consecutive consecutive year of low growth. So this is a setup as we enter Q1. Expectations are low despite Q1 being seasonally strong. So this is the CNBC TV 18 poll for constant currency revenue growth on a quarter-on-quarter basis. Flat for TCS, for Infosys 1.7%, but organic revenue growth here will be only 0.8% and lower for HCL Tech and even for Wipro. The reasons we know, right? Iran war is one. Accenture flagged off, remember, $100 million impact. Deal closures have been delayed. There is AI deflation. And this is also a part that I found interesting from the ICICI note, where they say that India's IT exports grew 12% in FY26, but top 5 Indian IT companies grew 3.6%. So basically, they're saying that large companies are losing market share to GCCs and other players in the ecosystems. So I think when we begin this earnings season, the question is there a further risk to FY27 or have growth estimates been brought down adequately? For Infosys, I think there is some on the street who still believe that there is a possibility that the current revenue growth, organic revenue growth, which stands at 1.5 to 3.5%, could be brought down. The overall growth number will be fine. It could be even higher given the 2 acquisitions that they've done. For HCL Tech, broadly, the consensus is that revenue guidance will be maintained at 1 to 4%, and margin guidance for both the companies, TCS and HCL Tech, will remain unchanged given we have got the INR tailwind. Not to forget that in the current quarter, the rupee has depreciated by nearly 2.5% quarter on quarter, and year on year, it's a decline of about 9.7%. Now, quickly, what to watch? I think the most important is going to be the management commentary on how the AI cycle is playing out. Currently, the street is pricing in AI deflation of 2 to 4%. Is there a risk on an annual basis? Is there a risk that this is going to be higher? When will the new work from AI offset the loss in work due to AI? When does recovery really take place? Because JP Morgan is now saying that, the near-term growth curve is going to look more L, which basically means recovery takes place only FY29, FY30 onwards. But companies are going to try and build the narrative around their AI moat, talk about acquisitions, investments, and building capabilities. Now let's come to the valuations, right? 13 to 15 times currently FY28 PE. Historically, large companies would have traded at 15, 22 times. Now the bears are arguing that this is still at a premium to what global companies are trading in, Accenture, Cognizant at 8 to 9 times. But bulls are saying, well, valuations are now closer to trough valuations of 11 to 13 times. The mid-cap story is where it's more interesting, right? They are trading, despite the correction, at a significant premium to large caps. They're averaging 20, 22, 25 times, much higher than historical levels because growth rate has been higher. Will the mid-cap valuation multiple sustain? Will we have accidents like we had in the case of KPIT Tech? Kotak says the setup is interesting. Valuations limit the downside, but re-rating from here on requires growth to accelerate. And as of now, at least, that is not visible.
Rima, thank you for summarizing that for us. The expectations from the IT sector, low expectations and even lower valuations. Now, earlier in the day, we spoke to CLSA Sumit Jain and discussed the IT budgets, the first quarter results, and whether the deflation concerns are warranted for the Indian IT services players. Here are his thoughts.
In the near term, we do believe that the deflation argument or the narrative will be stronger than the volume opportunity. We are still not getting any valid data points which flag that IT service budgets are shrinking with the Fortune 500 or G2000 enterprises. Yes, the deflation to the base business of IT companies will hit for the next 2 to 3 years as and when the large deals come up for renewal. But mind you, in every deal, the scope of volumes are also increasing. So I failed to mention, but TCS and Tech Mahindra continue to maintain the stance that the volume opportunity is higher than deflation in the AI world. I think this quarter is going to be weak. Accenture laid out the lay of the land by cutting down their guidance by 50 bips. And in this currently negative narrative for IT services sector globally, any guidance cut will further fuel the narrative of deflation being very strong. Tech Mahindra stands out clearly in the large cap IT space where they have 2 large telecom deals which will ramp up, one in this quarter and one in next quarter. And that's why we see Tech Mahindra's growth to be relatively higher than rest of the large cap names. Whenever a technology disruption happens, the mid-tier operators are always a bigger beneficiary because they can disrupt their business model much more easily and shift towards the new age solutions. And that's what we are seeing with both Coforge and Persistent.
All right, so that's about the IT space. We'll take a short break, come back, focus on the bond market with Manisha Gupta on the other side. Stay with us. Welcome back. The market's down about 105 points. Just look at Jubilant FoodWorks. Crude oil prices higher, brings back the uncertainty once again. And yesterday they reported their updates, 2.5% like-for-like growth. The stock was higher. Now it's giving up all of those gains, down about 4.5% at the low point. But the other one which is actually holding up is Honasa. Typically gives out its first quarter update anytime in between the 7th and the 8th day of the new quarter. That stock's holding up in the green. The street is expecting a good performance. The stock has seen a strong up move already ahead of that. But let's, as promised, shift focus to the bond market. Manisha Gupta joins in with all the details and updates from there.
Well, thank you so much for that. The story or the headline today clearly seems to be the crude oil prices, where we have seen 5% of gains in the overnight market. And with that, the crude futures are now trading above $76 a barrel. That has impacted the international money markets as well. So when you look at the Asia Pacific, the government bonds have seen a decline because of the higher crude oil prices. And actually, not just in Asia, whether you look at Japan, Europe, US, we have seen the bond yields kind of rise there. And that's exactly where the Indian market seems to be taking cues from as well. The US, by the way, has revoked the waiver for Iran oil sales following attacks on 3 vessels in the Strait of Hormuz. So the markets again are looking at some supply concerns, and is the reason that you've seen a 5% of a move come in the crude oil prices in the overnight market. It also is going to be about the India inflation data that comes in on Monday. And ahead of that, there is a bit of choppiness that we in any case have seen for the Indian markets, where the inflation data is expected to be on the higher side, given the fact that the crude prices are back up yet again. El Nino has led to lower sowing. So we are looking at agricultural inflation also coming back into the markets. Having said that, take a look at the private bond issuances that are happening in the market today. Yesterday was a great day, great numbers and big companies coming in. Today as well, you have SK Finance, which is looking to raise 2 billion, and they are doing it via issuances of 2-year bonds maturing in 2028. You also have Mass Financial Services. They are looking to raise 2.5 billion as well. They are doing it via floating bonds maturing in 2028 as well. PNB Housing Finance Limited also is in the market today. They're raising bids, looking to raise money at around 5 billion. They're doing it via issuing of bonds which are maturing in 2029. And then you have HDB Financial Services. They're looking to raise 7 billion. They're doing it via issuances of 2 bonds. That bidding is happening today as well. And then today itself, you have Shriram Finance Limited also in the market. They are looking to raise 20 billion, and they are doing it via issuances of 2 bonds. Bidding for that is also happening today.
Manisha, thank you for all of those updates there from the bond markets. But the big story that has been developing overnight has been the escalations of tensions yet again in West Asia and the subsequent rebound that you have seen in oil prices after they gave up every gain that they had seen post the start of the Iran war. Now Brent is back above the mark of 76.5. The NYMEX 2 is closing in on $73 a barrel. To take the conversation forward, Probal Sen, the senior research analyst, Indian oil and gas sector and the agrichem sector, institutional equities at ICICI Securities, along with Peter Maguire, the CEO at trading.com, are now joining in. Gentlemen, good morning. Thank you for taking out time. Probal, to you first. These daily fluctuations in oil prices may or may not have a significant bearing on the day-to-day operations of all of these companies. But do you believe that what is the level of oil prices that you believe that concerns will start to emerge again? Because during this period of ceasefire, whatever supply had to be procured would have been procured, at least for the near term, right?
So I think 2 parts to your question. First is, as far as crude availability is concerned, we have seen in the past as well that while imports are actually down about 10 to 15%, the residual imports of around 4.7 million barrels a day are sufficient to meet most of domestic requirements. Now, obviously, what it implies is that oil re-exports in the form of refined product have been cut down, and we believe that they will continue to remain subdued because obviously domestic consumption will be prioritized. But even in the worst of the crisis, I think imports did average close to about 4.5 to 4.6 million barrels of oil per day. So from an availability standpoint, that has not really been a concern, at least so far, in terms of published data that we've seen. The only small point of concern is in terms of LPG, which is a separate area where we are not really self-sufficient even in terms of refined product availability, and we have to import the finished product. And there, of course, we've had to scramble to get Indian refineries to produce more, scramble for imports from any destination that we could have. And there have, of course, been reduction in consumption or some demand destruction, specifically on the commercial side. So on both those fronts, any further flare up of the Gulf or any further, disruption in terms of flows to the Asian markets from the Gulf, from the SOH, will obviously have an impact. We'll have to again monitor and see. In terms of pricing levels, it's more important to really look at what product prices do. Crude prices, anyways, I think at this point of time remain, as you mentioned, below, the sort of break-even level, even in terms of retail margins, if I can, venture to say that. Once they again breach $85 is when you really start to worry about, significant subsidy losses. But as of now, I think we'll have to just wait and watch how this situation develops, if it leads to further escalation or this is just saber rattling in terms of negotiations.
What do you think, Prabal, happens to crude prices from here on, even if there is any escalation? Because the question this time around isn't as much about whether there is demand or not, or whether there is oil or not. There is a lot of oil which is being pumped, which is just stuck somewhere, right? And ever since the conversation around ceasefires and all of that began, oil prices have stopped reacting to the extent that they would in the earlier part of this skirmish. So do you ascribe a higher probability to oil prices actually crossing $85?
No, I wouldn't venture to, put a number to it at this point. I think what has happened is once the ceasefire agreement was reached, there was a lot of floating cargo, particularly from Iran's side, that got released in the market. And I think there was a lot of relief that inventories in the OECD countries would not get further depleted, which probably led to an unwinding of a lot of longs. And that is what has led to prices, frankly, being lower than what I had expected them to be. The flows from the Strait of Hormuz still remain extremely limited if you really compare to pre-conflict levels. Yes, alternate pipelines and the corridor alongside Oman may have helped reduce the shortfall. But the fact is, the IEA data in its latest outlook suggested that, and even EIA says that around 11.5 million barrels a day still remains constrained from that region. So while inventories, floating cargo, as you mentioned, may have helped the market continue to sort of offset, and more importantly, the Chinese demand reduction, a lot of that probably is more temporary. It was banking on the fact that this ceasefire would probably result in continued normalization of flows over the next couple of months. If something sets that back, you probably will see, frankly, it's very difficult to put a number of where oil could once again spike, because unlike the beginning of the conflict, you don't really have the kind of cushion you had in the form of strategic reserves and floating storage at this point of time to make up the difference.
Right. Let's also bring in Peter Maguire into this conversation. Peter, thank you for taking our time today. There are both sides of the conversation, right? There is one part which is saying that the market is still underpricing the risks or the supply side disruptions even after there is any potential ceasefire. There is also another camp which is saying that there is going to be a supply glut, which is also a lot of the oil watchdogs who are saying that there is going to be a supply glut in 2027. Is that the reason why you are not seeing any panic-led moves today, even after the latest developments that you have seen? Which side of the camp are you on?
Well, Hormaz, I think a couple of things. First off, and you've highlighted it, those two scenarios. The first point is it's up 3% today. Now, that's a positive move as far as price. You saw what Manisha said, up 5% in US trade. So the market is relatively taking this on board, and I think it's done what it needed to do as far as show the respect of the market. That's bid up. Let's see where the next 24 to 36 hours are. If there's any retaliatory action from Iran, what the big picture is. We know there's 63 million or approximate barrels floating out there of Iranian crude. And, the revoke of the 60-day waiver. Is this saber rattling? We understand the glut. I'm very conscious of that. I think Q4 is going to be, if from a geopolitical standpoint, if that was all stripped out, I think Q4 prices will be significantly lower than what they are at the moment. But we've got to get to Q4. And over that next matter of weeks, we could see, again, price volatility really engage the market if this was to be amplified.
Right. And would, again, the question, the sensitivity to the prices be higher or lower this time around? Because earlier, you did have obviously the worry of uncertainty and the benefit of strategic reserves. Now you have the worry of no strategic reserves, but you're still sure of the fact that, this is not going to escalate beyond a certain point because maybe the world has seen the worst of it.
Well, Mangalan, the uncertainty, and that's the great challenge that traders have. I look at it from a trading perspective and market sentiment. It's uncertain. So that uncertainty creates a degree of hesitation. Are we going long or are we going short? What's the news flow? What's happening? What's the theme of the market? The market at the moment, I'm saying, is probably more bullish than bearish in the short term. I'm saying 24 hours to 36. I want to see what the situation, how it unfolds. I want to see how New York takes all this on board tonight and the whole interaction as far as the market and if there's any further escalation. Is this a one shot as far as the states, or are they going to start really turning the heat up? So there's, again, a lot of segments that really need to be examined, pulled apart and really appreciated. It's what the market probably doesn't want, but that's the terms and conditions that we're dealt.
Good answer, Peter. What comes first, 85 or 65?
That's a good question, isn't it? Almost, I don't know. I don't think it's going to get to 85. I'll say maybe high 70s, and I'll revalue it then. But I think it's closer to 80 than it is to 70. I'll go that way.
And Probal, obvious question for you as well. Your pecking order in the oil and gas space, the oil marketing companies, the ONGCs or the oil Indias or the gas utility players?
I think, again, it boils down to what level of crude we actually settle at. If, as the other gentleman just mentioned, if the mood of the market remains in its sense that this is a temporary setback, rather than any structural escalation, then obviously crude can probably settle maybe in the high 70s, mid 80s. In that situation, I don't think there's any change in terms of pecking order. We would continue to believe OMCs probably will do better than they have done in terms of earnings performance and stock performance over the next 6 months. And gas companies, given the kind of LNG supply glut that is coming in the next 6 to 9 months, irrespective of Qatar rejoining the markets, we continue to believe that margins and pricing competitiveness for gas consumers will probably improve over the next 9 to 12 months. So we would remain bullish on that space. Upstream is a bit tricky. I think the sentiment obviously changes a bit if crude is on a downward trajectory. But if you look at the current environment, even at realizations of anywhere between $75 to $80, the fact is that ONGC and Oil India's net oil realizations are still going to end up at a 7 to 8 year high for this financial year. I think the critical issue there is production performance has to be backed up. In terms of guidance being met or exceeded. I think that is where the stocks will rise up. But from a numbers perspective, I think all the subsegments should do better at this point of time and in this kind of crude range.
Take that point. We had S. Narain as well, fairly positive on the energy sector, and he said it was across the board. Thank you, Probal, for joining in. Peter, I can't let you go without speaking about the other skirmish between countries, and this was Egypt and Argentina. What do you make of the match yesterday? I mean, a lot of people said that, oh, what a great comeback by Argentina. And then a lot of people said, what a great comeback by FIFA or the referees. I mean, what camp are you in here?
Well, I thought that Australia would have beaten Egypt last Saturday, but we didn't get there. And so Egypt went into the game, I think, with a lot of promise. And for the first probably over an hour, as we know, about an hour and a half, they were extraordinary. I thought they were the team to beat. And then, boy, oh boy, Argentina came home. That was incredible. And that short window of time, they built their confidence. They just kept the momentum. And you know as well as I do, once you got momentum and you got dynamic players, anything's possible. And Mangalan, they produced.
And you don't have any bone to pick with the referees there, is it?
Yeah, well, I don't want to go out there and say that. Look, they're doing a job and it's all about interpretation. We all understand everyone's got a different view. And I'm going to sit on the sidelines on that one. I'm going to watch the next game.
All right. That was, in cricketing terms, well left. Thank you so much, Peter, for joining in and chiming in on the crude prices and also what took place in FIFA overnight. We'll take a short break, come back. Market Technicals, as always. Sachidanand Tekar joins in from Trade Bulls with his trading ideas.
Welcome back. Still around 24,280 on the index, down around 115, 120 points. So continuing to see some steadiness from lower levels for the markets. But the one stock that has done well today is Orchid Pharma, and that's because it has inked a supply and licensing pact with Russia's Pharma Synthes. Now Vinny is joining in with more details on this one. Vinny.
Hi, so yes, this is a licensing and supply agreement with Pharma Synthes to commercialize a drug which is mainly used for the treatment of urinary tract infection, hospital-acquired as well as ventilator-associated bacterial pneumonia. So this drug is an important one for Orchid Pharma. Now, what does this partnership mean? It represents a potential opportunity that comes in of around $178 million over the next 10 years. And Pharma Synthes is a company that has actually got a very good presence in Russian hospitals, and the deal is something that is still subject to Ministry of Health of Russian Federation. So the approval is still left on that front. Now, obviously, we have analysts from Bob Capital who are saying that this deal itself could convert into doubling the sales for the company over the next decade. Overall, they expect that the company had earlier commented, especially in terms of the patent life of this product as well, and that could be a potential reach of around $1 billion in terms of sales. So big opportunity there, and that is why Orchid Pharma is passing a trade.
Indeed, Vinny. Thanks a lot for that. So that's about Orchid Pharma up around 8%. Good time to get in the F&O update at this hour as well. The Nifty is down about 120 points. We have the Nifty Bank, which is lower by about 0.4% as well. The mid-caps are relatively outperforming in the sense that they are not falling as much. The important part is that today's move and yesterday's have given us a bit of a range to work with on the frontline index. Today's low of 24,207, yesterday's high of 24,531 are likely to be the near-term range for the frontline index, given the sort of rally that we've seen from the lows already, and now fresh volatility around oil as well. And that's where option writers, for the ones that expire next Tuesday on the Nifty, have been positioned. 24,300 call, premium of 117 rupees, and we have the 24,200 put, which has a premium of over 100 rupees, around 100 rupees out here as well. Both of them come up for you on the screen. We have 24,100 to 24,400 as the broad range that you're looking at on the frontline index, the ones who are selling that straddle. But amidst all of this, a lot of individual calls, individual stocks are finding buyers. We have Kalyan Jewellers up 8% after a 7% decline yesterday. Info Edge up 3% after a big gain in yesterday's trading session already. And Indus Towers seeing some long positions. Almost.
There are volumes as well on Indus Towers, right? 90 lakh shares have been traded so far. So gains coming in on strong volumes as well for a lot of these companies seeing fresh long positions. A good time to get in a quick chart check from Sachitanand Uttekar of Trade Bulls, who's joining in. Sachitanand, good morning. Thank you for joining in. Now that we managed to cross 24,500, could not sustain above it, but we are managing to defend lower levels at least. So does the trend remain positive for the Nifty, at least as of now? Your call on the index and your stock recommendations as well for the morning.
Good morning, Hormoz. Clearly the trend is positive. We don't see any major distortion when it comes to the sequence, which has been progressing well. Eventually, for this particular series, we are expecting that Nifty could scale higher towards 24,750, 24,900, that kind of a zone. But after a 5 days up move, what we are observed here is that the index was trending away from its 5-day exponential moving average support, and today we have seen that particular decline. It is trying to consolidate and probably form on a higher base, so we may see some consolidation here within this range of 24,200 on the lower side and 24,360 on the higher side. So we may see some kind of consolidation, which will be overall considered as a healthy move. Also today, what we have observed is that Friday's gap, which was unsettled, I think that particular gap area is also filled. So I think it's a good development on the price. We may see some sideways action during the day, but eventually we expect that the Nifty would scale towards 24,520. That particular breakout will be in place, and we may see the rally extending towards 24,900 during this series itself.
What about specific stocks then, Sachitanand?
Almost there's a good reset again. I think auto is something which is again getting on the positive side. What we have observed here is that the two-wheeler auto space has been doing better than the four-wheeler space. Here, I think Bajaj Auto has already given a breakout from a channel formation. We are expecting that this particular rally may extend towards 10,500 levels. From a trading momentum perspective, the initial target is placed at 10,320, and hence we are recommending building fresh long positions in Bajaj Auto. One can keep a stop loss at 10,080 on closing basis and deploy fresh longs here. The other space which was under pressure is the capital goods space. But here, I think the declines have been very gradual. And if you look at the data of L&T, there is a good sign that the 4,000 put writers are still very dominant, and we may see a base somewhere here. So we are expecting that there could be a reversal in place. We may see, or we may get a confirmation of the same in today's session itself. So we are anticipating that there could be a rebound in this particular counter, and hence we are recommending building fresh long positions in L&T. One can keep a stop loss at 39.30 on closing basis. A trading move can be expected towards 4080, but eventually we expect the rally to resume towards 4200.
Right, take that point, Sachi. Thank you so much for that. We'll take a short break, come back on the other side. We will discuss market fundamentals with Ashi Anand of IME Capital. Stay tuned for that. Welcome back. You're watching us here on Trading Hour. Ashi Anand from IME Capital now joins us to discuss fundamentals for the market and his top sectoral picks. Ashi, it so appears that maybe, just maybe, the worst is behind for us, and from here on, at least, earnings are beginning to look up, at least from the two large sectors that we got updates from. And, even the flows from between India and Korea, after Korea having corrected about 20% from the peak, notwithstanding the outperformance that we've seen, would you be in the camp that things are looking favorable for India right now?
Yeah, hi. Firstly, thanks for having me on the show. I would cautiously agree. And I'll give you the indication on why I'm using the word cautiously. A lot of this is going to be very dependent on what's happening with US-Iran. At least as of right now, our base case scenario is that there's not that much that Trump has to gain by actually extending the conflict. And I think most parties actually do want the conflict to end. Now, the reason this is incredibly important is that oil prices clearly have a very large impact on the Indian economy, be it on the current account deficit, inflation, interest rates, etc. In order for us to have a constructive kind of view on the Indian markets and the Indian economy, it is very important to have oil prices around 70 or below. Now, any re-escalation of the crisis, any delay in the ceasefire, where oil prices kind of move back up and actually start sustaining for slightly longer term at higher levels is a clear risk. But at least as of right now, our view is that most parties seem willing to kind of continue with the ceasefire. There are obviously going to be skirmishes. There was certain skirmishes that happened just over the last couple of days. But that is, I think, given the parties involved, that is expected. We don't see that as a risk to the larger ceasefire. As long as the ceasefire extends, oil prices remain down, the view on India starts becoming quite constructive. You do have a number of different parts of the economy where you are starting to see kind of come back in terms of earnings. Banking, which is a very large part, which was impacted by both asset quality and NIM pressures. Both of those pressures have bottomed out. There are multiple elements of the consumption story that are starting to kind of recover. This is aided by kind of GST cuts, income tax cuts, interest rates having come down. I think a very new interesting segment of the economy is the whole electricity supply chain, driven by kind of AI data center capex globally as well as in India. So there are a number of positive kind of drivers of growth. We've already seen positive sentiment over the last quarterly earnings season, where I think at least the broader market, BSE 500 earnings at mid to high teens, was quite kind of encouraging. We are entering the results season as long as you keep seeing those numbers and nothing adverse turns out around on US-Iran. I think we are quite constructive on the overall markets. You raised the second point about India versus Korea. That is a point which I don't think we necessarily fully agree with. AI and AI capex is something which is a really interesting investment theme globally. You've seen very strong optimism being built in. You are seeing a pullback. But from a 2 to 3 year perspective, does AI remain one of the more dominant themes, and therefore do markets like Korea and Taiwan become more important from an FI perspective as compared to India? I think that is something which is still not clear. But at least from our perspective, I think we are quite clear about the fact that for the last 4 years, you've seen sustained FI outflows and domestic flows have helped support the market. So we don't really need FI money to come in to kind of have a general upward and a constructive market environment.
You mentioned data centers, supply chain as well, Ashi. Have you put money to work within this theme? The GE Vernovas, the Hitachi Energies, a lot of positive notes were written about it just a few weeks back, and now there are concerns with regards to competition, pricing, and so on. Where are you placed here?
So we actually are probably in the bullish camp. We are quite optimistic about this theme, and yes, we have kind of identified ways to kind of play AI and AI data center capex. I think when you look at it from a global perspective, while Korea and Taiwan could give you better computing infra kind of players, and India may kind of lag behind in terms of LLMs, in terms of semiconductors, high bandwidth memory, etc. The one part which is clearly playable from India is this entire electricity supply chain. Now, be it globally as well as in India, you are seeing tremendous shortages of transformers, of kind of grid capacities, of generation capacities. The entire electricity value chain is significantly kind of constrained. And even if you kind of take more conservative assumptions of AI data center build out, you don't really need to have the bull case to become very bullish on the entire electricity value chain. So we have kind of identified specific companies that are direct kind of plays, which are part of the vendor ecosystems of some of the major global MNCs that are key parts of the electricity value chain globally. There are kind of 3 or 4 different companies we've identified, and we have built up a fairly reasonable position out here. And yes, we are quite positive on this from a longer term perspective.
Right, Ashi, out of time, not out of questions. We'll obviously continue this conversation on another occasion, and hopefully that time, there'll be more optimism than just caution as well. Take a short break, come back, more on the markets on the other side.
Welcome back. Some minor recovery that we had seen on the market is now getting sold into 140 points lower now on the index, back towards the 24,250 mark, still slightly above the day's low, which is close to 24,210. But the stock that we are talking about right now is Acres. It's a recent listing, and a couple of brokerage notes have come in very recently. Today too, the stock doing well for itself, 6.5% higher. Ria is joining in now with more details on that. Ria.
Well, yes, Acres is up nearly 6% today after a note from IIFL Capital. They have a buy call on the stock with a target price of rupees 320, which is a nearly 32% upside compared to yesterday's closing price. Now, they have mentioned that the company is India's only vertically integrated precision manufacturer of aerospace components, and they have further highlighted that the company is extending its high-mix, low-volume manufacturing playbook into a high-volume, high-mix consumer electronics business, which presents a huge opportunity opportunity for them, and they do expect the consolidated revenue and EBITDA to grow by 7 times and 17 times respectively by the end of FY31. And in fact, they also believe that scale and operating leverage for the company should lift their net margins to nearly 7.4% by the end of FY31. They have mentioned, though, that the current high valuations of the company are justified by its differentiated franchise, the deep competitive moats, as well as the long duration growth runway that the company has. And they can also see some expansion of the wallet share in its aerospace OEMs. Currently, remember, Airbus and its OEMs contribute to over 60% of the total sales of the company. And in terms of the consumer electronics segment, they do believe that the consumer segment TAM will grow by around 10x for the company to 130 billion US dollars. So there is a large significant opportunity for the company there. In terms of the valuations, it currently trades at a price to book of 12 times its FY28 earnings. But as we said earlier, the brokerage believes that these current valuations are justified due to the long growth runway. And in terms of how the stock has performed, today it is up 6% and it is up nearly 75% since its listing in December of 2025. And in fact, just in the last 3 months, the stock price has doubled.
All right, take that point, Ria. Thanks a lot for that. The other stock which is bouncing back today after a decline yesterday is Kalyan Jewellers. Remember yesterday when the company reported its first quarter update, we had pointed out that these are not bad numbers. They're just, weak as compared to Titan. So which is why the street took the pair trade in yesterday's trading session. Now we're obviously looking at Kalyan in isolation, a 38% growth. While it's slightly below estimates of Citi maintains its bullish stance. They're saying that 28% same-store sales growth led by overall 38% growth, a good growth in their Candere business as well. It's over 112%. And franchise-led business would mean that, even though reported margins would be slightly lower, you will obviously have better ROC, and that explains why the stock is bouncing back after a decline. Take a short break, come back, get you more.
150 points lower on the Nifty. The Nifty Bank too is now back towards the lower end of today's trading range. 350 points down on that one as well. So still holding on to those 24,250 levels as we speak. Aegis Logistics is one name that has taken a bit of a leg down in the last few minutes. 8.5% lower on that stock is at the lows of the day. And this is one stock that has been making is up around 70 odd % over the last 1 month. So some profit booking setting in at higher levels. Aegis Wopac 2 is down around 4% in today's trade. So these two are the top losers on the Nifty 500 in today's session. Some profit booking also coming in on RITES after yesterday's 12% up move that you saw on the stock. And of course, some of the mid-cap IT companies too are seeing some selling pressure today. Emphasis is down 3.5%, Coforge is down 3%, and so some pressure. Intellect Design Arena too down around 3% in today's trade. But as we take your leave on this edition of Trading Hour, let's also listen in to Gautam Trivedi of Nepean Capital, who shares his views on how AI is panning out for the Indian IT sector. He also says that he's seeing strong opportunities in the data center space. From Manglam and me, thank you for watching. Halftime report on the other side.
A lot of these companies tick all the boxes. There's no corporate governance issue, not at least since Satyam. Great companies, no debt, and again, very smart management. But I think the evidence or to prove that AI is not going to impact their business, or will, if it impacts positively, we haven't seen evidence of that. That's the single biggest problem I have of putting money to work in the IT sector. Would love to hear the commentary starting next week on what they're seeing with respect to their results, guidance, etc. But not yet, unfortunately. I think the opportunity set still remains very strong within the overall data center, AI, semiconductor, and of course, power, which has to power all of this. So without electricity, none of this is going to work. I think the overall ecosystem of all of these is massive.
Stocks slip following a fresh round of US-Iran strikes. Heavyweights are the big drags, even as mid-caps hold steady. FMCG and chemicals slide, while realty and metals eke out some gains.
Stocks of oil marketers fall after tensions rise in the Gulf, threatening closure of the Strait of Hormuz. The recent optimism over declining oil prices and a certain supply start to fade, but experts expect oil prices won't flare much further.
Select stocks see big moves. South Indian Bank slumps as the street reads the CEO change as a shift in focus. Orchid Pharma jumps on supply deal with Russia for a urinary tract infection drug, while Aquis Limited gets a boost from a brokerage upgrade.
Brent jumps to $75 per barrel after US forcefully retaliates to Iran strikes on 3 ships sailing through the Strait of Hormuz. A revocation of authorization for oil sales by Iran also adds to concerns on supply disruption. Hello and welcome to Halftime Report. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Winnie Motiwala. Winnie, good afternoon. Well, the war risk is back and that is what the market is factoring in. The Nifty down by 150 points. We are below the 24,300 mark as we speak. The Sensex seeing a cut of 500 points. Remember, tomorrow we do have the BSE weekly options expiry, so keep that in mind as well. Bank Nifty is falling in line with the benchmarks as we speak. Nifty Realty, which was the top loser yesterday, is the top gainer today. So the market continues to be very, very volatile in that sense. Metals Index did not do so well, so it is seeing some buying today. Pharma is the other one, a defensive space, which is at least in the green, defying what we are seeing at the benchmark level. Oil and gas under a lot of pressure because there are fears of supply concerns yet again. However, the conversation with experts suggests that maybe prices won't flare so much. An important level will be $75 per barrel on the crude going forward. FMCG under pressure, so largely everything is under pressure, barring some of them that I spoke about. And earnings from tomorrow will be the key focus.
Absolutely. Good afternoon, Sonal. Earnings are going to be the key focus from tomorrow. Today, like you mentioned, right, banks. So let's pull up the Nifty 50 pullers and draggers, right? What's contributing on the positive side and what's contributing on the negative side? You have Hindalco, Bajaj Auto, Infosys, DVs, as well as Wipro, which are supporting the market in terms for the Nifty, while what is dragging the market today is Reliance, ICICI Bank, Axis Bank, ITC. So heavyweights are not doing too well, right? And some of these names that are coming in are also from the FMCG side, and that is why that fall we're seeing coming in for the FMCG pack and the top sectoral loser there. Apart from that, a lot of individual names that are managing to see an up move, right? Today, Kalyan Jewellers, yesterday we saw a fall after its Q1 update. It's back and trading with gains of around 6 to 7%. You have Anant Raj, then you have Lodha Developers, which are managing to hold on to gains. On the flip side, you have Aegis Logistics, Aegis Vopak Terminals, HPCL Rights, which are seeing some bit of a pressure. But let's talk to you all about what's on the show for you all today. First up, we'll have Saturn Credit, who's reported a strong Q1 business update. So we'll talk to the management of the company, discuss all of this with HV Singh. Moving on, we'll have Vivek, who will take us through a whole host of stocks that are moving around in the trading session. We'll also be talking about gold prices, trajectory there with Derek of West Point Gold in our Commodities Corner segment. And we will also focus on cryptocurrencies as prices gain in July. Manisha will take us through the key trends in our Crypto Corner segment. That's about all the lineup for y'all and the whole lineup for y'all on the show today. But first up, let's get started with some of the stocks that are moving around in the trading session today. And one of the outliers today is Orchid Pharma, managing to hold on to very strong gains in the trading session. And the reason behind this is they have signed a supply as well as a licensing pact with Russia's Pharma Synthes. Now, what does this company do and what does it mean for Orchid Pharma? It's a positive sign that comes in for Orchid Pharma. Pharma Synthes, this deal is mainly for one of the drugs that is used for urinary tract infection, treatment for that. Then it's a treatment mainly for some of these other kind of pneumonia. So it's going to be mainly used for these treatments. What is the market size of this over a period of 10 years? $178 million is the opportunity that comes in for Orchid Pharma in terms of this. This is what they mentioned in their presentation as well. Apart from this, Pharma Synthes itself has a very good presence in Russia, and with Russian hospitals, they have very good tie-ups. So this is a positive sign for the Russian markets to expand their reach furthermore in the Russian markets. Now, what are analysts saying for this? That this deal itself could double sales for the company going forward. Company had also commented earlier that over the patent life of this drug and this product, the potential they believe that this drug could see is going to be around $1 billion. So an opportunity that comes in for Rocket Pharma. That's why holding on to gains of 11% in the trading session, Sonal.
Okay, that is about Rocket Pharma, but we are also watching out for Minda. That is the stock on our radar, and that is the one which is in focus because company has announced a capex. The capex is to set up a greenfield manufacturing facility. This is for expansion into four-wheeler passenger vehicle seating system space. The company says the total project cost is 320 crore rupees, and project will be executed under one of the arms, which is Minda S Seating, and it is a JV of Minda and Tachi S company in Japan. There is a note coming in from Elara as well, where they say that breaking into the passenger vehicle segment has been quite difficult. The content per vehicle for passenger vehicle seatings range from 20,000 to 25,000 to around 50,000 to 60,000 per seat. So that's the kind of range that we are looking at if the company forays into this particular segment. Assuming the average of 35,000 per vehicle in terms of content per vehicle, the total addressable market is 18,000 crore rupees. That is what the company will be tapping as well. With asset turn of around 2 to 2.5 times, the company can reach 700 crores in 2 to 3 years, considering that 320 crore rupees is the capex here. It will contribute 1 to 2% of FY30, FY31 estimated revenue, and it unlocks a decent market size for them, 18,000 crore rupees, as I mentioned earlier, but the top line addition will just be 1 to 2% by FY30. So the execution really matters here. But Elara continues to be positive on the stock.
Okay, that's a word on Minda. But okay, on that note, we are actually going to slip into a very actually Vivek. We have Vivek actually. I beg your pardon. Vivek is here to take us through more of the stocks that are moving around in the trading session. Vivek, over to you. Which are the stocks that you're watching out for?
Well, thank you so much for that. It's a very sharp recovery, especially as far as the broader end of the markets are concerned. Look at some of the names from the chemical pack. After a long time, you're seeing some of these amine stocks actually buzz quite significantly. Balaji Amines, Alkyl Amines, both of the stocks higher, high single-digit volume and good volumes as well today. Kalyan Jewellers, yesterday you saw very sharp sell-off post a slightly muted update, but today has recovered very sharply, almost 6.5% higher. The realty pack, some of these names have seen a bit of a bounce back. So names like Lodha up almost 4%, Anant Raj up 6.5%, Goddess Properties, all of them doing quite well in the session. You spoke about Rocket Pharma, but NAC Packaging is the other name making a strong debut. But on the other hand, quite a few laggards as well. Have a look at South Indian Bank. Now, this particular stock, actually, there has been a fresh managing director that's been appointed. It's a person coming in from the PSU space. The street, taking a little bit off as far as valuations are concerned, down almost 7.5% in the session. Aegis Logistics, it's been an outperformer, but seeing a bit of profit booking today, down over 8%. Jubilant Foodworks, yesterday, that particular stock post the quarterly update did move higher, has cooled off a little bit, almost 3% lower. And along expected lines, as crude prices have risen, OMCs today have seen a bit of correction. So all three of the OMCs down anywhere between 2 to 4%.
Okay, all right, Vivek, thank you so much for joining us. We'll discuss some of these individual stocks in greater detail as well. For now, we'll step into a short break. Up next, Sadin Credit Care Network will connect with us to discuss their Q1 FY27 business update. Stay tuned for that conversation. Welcome back. You're still tuned in to Halftime Report. Life insurance stocks, they are in spotlight. This is on the back of data for the month of June. Looks like Axis Max Life and SBI Life stole the show. This is on a high base last month, but Yash is joining us now with more details. Yash.
Well, that's correct. So in the month of June, the strongest performance coming from two companies, that is SBI Life Insurance and Axis Max Life Insurance. Both companies posting really strong growth. And what's even better is that this growth comes on a very high base, which the companies posted last year, same month. I'll speak about the specific numbers to speak about the two companies which outperformed, starting with Axis Max Life Insurance. New business premium that has seen a growth of 21%, annualized premium equivalent or APE growing again at 21%, retail APE seeing a growth of 15% in the month of June. To the next candidate which has outperformed the industry, SBI Life Insurance, new business premium growing at 22%, APE growing at 18%, retail APE growing at 18%. Of course, as I mentioned, both these companies growing and on a very strong base, which they had in the form of last year in the month of June. HDFC Life has been a muted growth over a favorable base, new business premium growing at 32%, but APE growing just at about 8%, retail APE being flat on a year-on-year basis. ICICI Prudential, strong growth, but on a favorable base. The new business premium has grown at 25%, APE has grown at 24%, retail APE has grown at 13% in the month of June. Canada HSBC Life Insurance, it's a small company but growing at a very strong pace. New business premium growing at 21%, APE growing at 20%, retail APE also growing at about 28%. LIC, the growth in the month of June has been strong, but the base was favorable to the company. New business premium growing at 1%, APE growing by 26%. Finally, retail APE also seeing a growth of about 21%.
Okay, Yash, thank you so much for the update there for life insurance, the June report card coming in here. Thank you so much for that. But let's focus and bring on board the management of Saturn Credit. It has achieved its strongest ever Q1 performance. We have the business update that's coming in. Credit costs has seen a decline as well. HP Singh, Chairman and MD at Saturn Credit Network, now joining us. Mr. Singh, good afternoon. Thank you so much for joining us on the show. Let's start by talking about the credit cost, right? Credit costs fell from 6% to 2.5% to 3% YOY in Q1 FY27. Talk to us overall about the guidance for this. You've given a guidance of 3 to 3.5. This quarter has been already below this. Would you look at maybe, revising this full year guidance? And what is the MFI stress portfolio? How is the cycle moving now?
So first of all, thank you for having me here. And see, we've given the first quarter is always a very weak quarter. So for us to perform that very well in the first quarter, I think, bodes very well for the entire whole year as such. So when we say how would our credit costs pan out to be, I think we've given a guidance of a 3 to 3.5 because, we are still waiting for the monsoon or the flooding to probably take place. If that happens across over there, we might see some uptick in the credit cost. But looking at July, the way it is panning out to be with uneven rainfall, I think for us, maybe the floods and everything seems a distant part. However, for us, the guidance remains the same. We are conservative in our guidance growth, but we will outperform the guidance. That is what we probably want to say. But having said that, still the credit cost as well as the growth guidance probably remains in the same zone as what we had said.
Okay, all right. So what you had indicated earlier, you have outperformed in quarter one, but you want to be conservative as you are stating. Mr. Singh, also on your disbursements has been very strong. Consolidated basis, 54% growth on a YOY basis, 45% growth on a standalone basis. And you're saying that this is coming at a time when quarter one is usually weak. What is the target for the entire year? What kind of growth will you see in disbursements and the AUM growth as well? It has been very strong. Do you expect that trend to continue?
See, for us, again, when we gave the guidance in the start of the year, for us, the first quarter was always a very weak quarter. But having outperformed the first quarter, the second quarter, again, I think, carries a baseline of the first quarter, basically, because of the everything. So for us, we feel our best quarters are yet to come, which is going to be the third and the fourth quarter. We've given a growth guidance of 15 to 20%, but internally we have a higher figure for us, but we don't want to. We want to be conservative for the entire world as such, So for us, we'll outperform. That is for sure. In fact, if you look at again,
the way we've been able to do the first quarter, I think, the quarters to watch are maybe the third and the fourth quarter, and that is what we want to look at. Yeah.
So 15 to 20% is AUM growth guidance. What about disbursements? Do you have the same guidance for that? And you've done it. Sorry. So no, I'm just saying that it is more than actually 20% for AUM that you've seen right now, more than 40% for disbursements. Are you still telling us that you're keeping the guidance at 15 to 20%? Is that being too conservative?
I can say conservative, not too conservative. For us, again, we had given our overall guidance, of reaching about 32,000 crore by 2030. For us, the main importance which is coming is not for microfinance, but we are looking at our non-MFI portfolio to probably grow up. And that is where we are looking at a significant, uptick. We've done 19% up till now. For us, that was what we had given, that, we'll do close to about 30% in terms of the overall AUM portfolio. But we want to beat that, so that is where it is, And we as an institution, we normally want to beat the guidance wherever we've given it. So I leave it open for everybody else to judge, where it would be probably at the end of the year.
So, I just want to focus a bit more on that non-MFI mix, right? You said it's moved up from 14% to 19%. You have plans to bring it to 30%. When is that target of 30% by? And specifically, which segments on the non-MFI side are you seeing a scale up in or a pick up in?
So as an MFI, or as an NBFC, we've diversified a lot, So we have both housing finance, we have MSME finance, we have green finance, That's the lending portfolio which we have, and that's getting pretty significant in terms of our growth. But having said that, also we have a non-lending business, which is we've got a technology company. We just acquired a quantum computing cybersecurity company, and that where we feel if we have the correct software which we are able to justify and which we are able to bring in, I think that's a white space which we are really looking at. That is one thing which is there. We've just had a license of AIF Cat 2 fund. We are probably right now looking at our first close, which is going to happen. That is again something which will add up to our non-MFI portfolio. So having all these companies put together, I think the diversification is pretty large and pretty huge for us to look at lending as well as non-lending business. So that is what we are looking at. In fact, all these companies are still very small in terms of their size, but we are looking at that. So 30% is what we said.
But when is that 30% that you're going to be focusing on by? When will it come up to 30%?
We said 2030, but I think we'll beat that also.
Okay.
Okay. In that non-MFI part of the business, how big is gold loan? Is that something you'll be very aggressive at as well?
No, so that is one product which we are not doing, So we're not doing gold loan because I think, we feel that, everybody else is doing gold loan. So we wanted to do something very different. That's why we did green finance, and that's the reason why we picked up sustainability finance. That's more important for us, right now.
Mr. Singh, generally, are the yields on sustainable finance higher?
They're not higher, but they're not too weak also. If you really look at it, I think we're still doing a range bound of about 17 to 18% of yields over there, and that we feel is pretty good for us, overall.
So, let's talk about Kerala also, recent entry that you all are making in that region, right, in June 2026. So, how are you seeing the growth across in terms of Kerala, incremental growth? Are you expecting that because of deeper penetration? And apart from that, any other new geographies that you're looking at to enter?
So Kerala was our last state, where we had not entered, So we've entered in June. Right now, we are pretty, we just started this thing, So, whatever incremental comes is going to be add on to our AUM growth, But what I can probably say is, I think, we've seen the entire MFI, institutions working across of there. So we are cherry picking up the areas where we really want to work, where we feel that I think there is a lot of growth potential as well as the credit quality will hold on across over there. But no other state which is there. We're already present in all the states, And wherever we are, I think, looking at Northeast as well as geographies of UP and Bihar, I think, we're looking at significant growth coming in from these sides.
You say significant, what kind of growth plans do you have for geographies other than your core geography for now?
Normally, as such, I can't probably, fathom a percentage onto that, But I think, wherever we are, besides our normal, the top 5 of our states, where we work in, we will probably see some growth coming in because of deeper geography penetrations.
Okay, all right. Mr. Singh, thank you so much for joining us with your insights and for your time today. That's the word coming in from Satin Credit Care. Quarter 1 has been very strong and they expect the momentum to continue going forward as well. It's time for a break now. Manish Hatirumani of Deen Dayal Investments will join in with some trading strategies on the other side.
Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty has given up a few points from when we started the show. So let's keep an eye out on that. It's trading at the day's lowest point, 24,200, around that level what the Nifty trades at, now down 185 points odd in the trading session. Bank Nifty also continues to see that bit of a pressure, down 0.7% in trade. But on that note, let's also bring on board Manish Hatirumani, proprietor as well as trader and technical analyst at Deen Dayal Investments. Manish, good afternoon. Thank you so much for joining us on the show. While obviously we saw a few days of gain coming in, but geopolitical uncertainty seems like that's a bit of a worry right now. 24,200 right now for the Nifty. What are the levels you're keeping an eye out on?
Good afternoon, Vinny. Thank you so much for having me on the show. Well, the last time when we had this discussion, I was talking about a target of 24,500 for the potential target for this market. We have not only achieved that, but we also resisted over there. And that's where this fall has come from. The trend continues to be up as far as I'm concerned, and I will not switch until we don't break 24,000 on a closing basis. Until such time, a buy on dip strategy can be adopted for a target of 24,600.
Okay, all right. So that's on the benchmark index. What about individual names, Manish? What's on your radar?
I'm working with two buy calls. My first one is on Bharti Airtel, which is for a target of 1980, stop loss of 1875. This is an example of a stock that has been arrested in a range for quite some time. and then we have broken out on the upside. If we can sustain above the levels of 1950 on a closing basis, the stock can go up to 2050 as well. The second one is on Bajaj Finserv for a target of 2000, stop loss of 1805. This too was in a range between 1650 to 1850. We have moved out of this range, that too with higher than average volumes.
Manish, can you look at the charts for Info Edge for us? It's picked up some bit of a pace and momentum, specifically in the last week itself. Updates came in yesterday as well. On the charts, how is Info Edge looking?
Ma'am, can you tell me what is the current price of the stock?
Naukri.com Info Edge. So currently trading at around 1,190. Around that mark is what Info Edge is trading at.
So we see a very sharp run-up that's happened from around 960 to closer to about 1200. I wouldn't really enter this stock right now because the supports are now lower at about 1000. I would wait and use a buy on dips approach.
Buy on dips is the approach for Info Edge. Manish, thank you so much for joining us as always and helping us with those technical levels on the Nifty and individual names as well. With that, let's move on and talk about what's happening in the F&O space. Mangalam is joining us with more on that. Mangalam.
Well, the markets are the low point of today's trading session so far. We have the Nifty Bank, which is lower. We have the Nifty as well. The mild recovery that we saw from lows earlier has now been sold into. The Nifty is down about 200 points. And the mid-cap index is the only outperformer in the sense that it's not falling as much. But amidst all of this, there still seems to be a sense of consolidation after the rally that we've seen over the last few trading sessions. And the street does believe that maybe this time around we would be in a bit of a range. As we move higher, obviously there would be supply coming in, so which is why the 24,300 call writers are extremely active. These are options that expire next Tuesday. And then you have the 24,200 put writers who are equally active as well. So the 24,200 put comes up for you a premium of almost 150 rupees, telling you around 24,050, which is closer to where the 100-day moving average on the Nifty is, will see some support for the frontline index. So between 24,000 to about 24,400 is the range after a big rally that we've seen from the lows on the frontline index. But amidst all of this, there are a lot of pockets which are seeing some purchase. Lodha developers, real estate actually has been a standout sector. From the start of this month, the index is up nearly 10%, and Lodha developers is seeing some long positions being added. Eternal is the other one, which has been a bit of an outperformer, seeing some long positions being added on that counter also.
Okay, Mangalam, thank you so much for the update in the world of F&O this afternoon. But on that note, we're going to step into a very short break. After the break, we'll have Manisha Gupta, who's going to be in conversation with the CEO of West Point Gold to talk about commodities. Stay tuned in.
Welcome back. Joining us on the show now is Derek McPherson from West Point Gold. Derek, hi. Thank you so much for joining in. First of all, what is your sense onto the gold prices? They have declined overnight as investors await U.S. Federal Reserve minutes. To discuss more, what's your sense? What is the macro that you're looking at?
Well, I think it's higher from here. I think that we got into a little bit of an overbought territory. I think it got a little overcooked, and then we've had a pullback from there with risk appetites changing a bit. But I think the underlying fundamentals that drove gold price higher in 2025 still exist in 2026. You have central banks buying, diversifying away from U.S. dollars. You have governments spending aggressively, so you have increased liquidity. And so I think all those things still apply. We just had a little bit of pause in the run higher.
When you say the gold prices are going higher from here, Derek, what is the price range that you're looking at?
Yeah, I mean, I think that 6,000 is entirely possible. I don't like putting a time frame on it though, and I think probably even higher is possible over the next couple of years. Simply because you've got your traditional bull markets in precious metals would point to something closer to $8,000 for the gold price peaking out at. Whether it comes to that or not, and exactly how long that takes to get there, but I definitely think that over sort of the medium to long term, there's much higher. The gold price could go much higher from here.
Derek, with the global macro shifts impacting precious metals, how would you look at the current interplay between central bank gold buying, interest rate trajectories, and how are they shaping out the miners' valuations?
Yeah, that's a good point. I think that the central bank buying is going to continue to push the underlying commodity up, which should be good for the valuations for miners. One thing that we saw though through 2025 and even into early 2026 is miners didn't really get expensive. While their cash flows expanded and their share prices expanded because of that, the multiples didn't really expand. And so there hasn't, we're still kind of ahead of the curve as far as kind of generalist demand into precious metals equities. And so I think that there's still room for those to run, particularly if you get any kind of multiple expansion. But as we look out, you look kind of global macro and how that all fits in. I think that part of what happened sort of in late February, early March was with the Strait of Hormuz was that you had a risk-off trade, and so equities are part of that risk basket, whether they're precious metals or otherwise. And we saw sort of a pullback and a reset of risk across the board. And I think that. And I think we saw something similar to gold price, somewhere where people had a lot of investors had profits, they were able to take profits there. And so I think with that sort of pullback and that risk reset behind us, I guess, for lack of a better description, I think the peace deal or the tentative or the tenuous peace deal that we have in the Strait of Hormuz right now has allowed a bit of a move for risk on, a little more risk on. And I think that's what's benefited sort of liquidity and then also the gold price.
All right, that point is well taken. I would also want to understand on what really are the exploration milestones that West Point Gold is putting out for itself right now.
Yeah, so for West Point Gold, we're in the process of defining our maiden resource. And so our objective is to put out a significant maiden resource in line with our exploration target. Our exploration target is about 20 to 30 million tons at 2 to 3 grams a ton gold. It's about 1 to 3 million ounces. And so our effort right now is on getting the last of our drill results in and then pushing those and compiling those into a maiden resource that we can put out to the market. And that will really allow investors to value the company appropriately.
Derek, we understand that the exploration and drilling are highly capital intensive. What would you say is your financial strategy weaving into this?
We were, that's a great point. We are a pre-revenue business. And so our one of the things that we did very wisely is that we raised money in January when the markets were a little more frothy and there was a lot, there was more capital available for exploration stage companies. And so we put ourselves in a really good financial position. So we're funded for the next 12 to 18 months. And so that has allowed us to sort of focus on the fundamentals of the company. our expectation is that the market will be there for us if we continue to have success with the drill bit. And so we think the company is fundable, particularly post-resource.
Gold has shown strong resilience amid geopolitical tensions. How is then West Point Gold positioning itself to capture this premium? And does the macro climate accelerate your development timeline?
Yeah, I think that, West Point is sort of the maybe I'll frame this answer another way. Where we are in the cycle is we're sort of still, sort of early in the cycle overall for gold companies. In reality, the majors just started to move, had really just started to move, and we just saw some developers move as well. The big gold companies all have significant cash balances. We've just started to see M&A pick up a little bit. And so I think we're early in the M&A cycle and early in the gold cycle overall. And so I think there's more acquisitions to take place. I think with West Point in particular, while we're probably not one of the first companies that gets taken out simply because we're a little bit less developed than some of the other companies that are out there, I think if we can get through the main resource and then potentially onto an economic study, I think that will change how other companies look at us. I think an important point for us and how we're sort of positioned to capture is that we have good fundamental catalysts. And so while the $4,000 gold price is just over $4,000 gold price is really good for us and where we think the economics of our project will eventually land. What we're not relying on the gold price move to actually to move the company ahead. We have because we're well funded, we're able to put out good, strong fundamental catalysts that advance the company and de-risk the project for our shareholders.
No, absolutely, Derek. You bet $4,000 an ounce is good for you because the cost of gold production is $1,200 to $1,500 an ounce. So $4,000 an ounce is pretty good, neat cash inflow for the miners there. But with the cost of gold where it is, would you say that the absolutely minimal hedging that the gold miners are doing right now?
Hedging is challenging, right? Because investors look for buy gold companies for leverage to the gold price, and so that's certainly something that is. When you're hedging, I think that if you're looking at hedging, the only time that you would hedge is if you have debt that you need to protect the downside on. And so I think that there are companies that are kind of late stage build that still have some hedges in place, or have just built and have some hedges in place. But generally speaking, I think the objective is generally to be unhedged.
Point taken. Derek, thank you so much for joining us here at CNBC TV 18. So the gold prices are going higher from here. And as far as M&A, gold cycle, hedging, all of that is concerned, well, all of that seems to be turning quite well for gold mining companies at least. But with that, let's go for a short break. Up next in our Crypto Corner segment, we will decode the key trends in cryptocurrencies after this break.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome to Crypto Corner, and let me tell you that Bitcoin kind of has held on its higher side, especially for the month of July, where we have seen neat 8% of gains come in for the Bitcoin itself. The Bitcoin or the cryptos also have gained in the month of July because the market sentiment has turned positive, especially after the softer US jobs data that the street was dealing with. Let me take you through the last 1 week on how most of these cryptocurrencies actually have performed. So you have Bitcoin, which is gained up by nearly 5%. It's a 9% of gain coming in for Ether, and Binance gained up by 4% as well. And then you have Cardano, which is a neat 11% on the higher side. Solana up 2.5%, and XRP's posted 5% of gains. There have been various supportive factors for the crypto markets in the month of July and even before that. Well, to begin with, it has been about stronger buying from institutions. But let me tell you, it is trading off the July highs that we've seen in case of Bitcoin. So the high point of July was 64,000. I mean, as you can see, there's a bit of a decline coming in for this one. And this has all happened because of the overnight retaliatory strike that US has done on Iran. This is after Iran attacked nearly 3 oil tankers in and around Strait of Hormuz. Overall, it is also about the 10-year Japan government bond yields, which have hit a 30-year highs at 2.85%. Some pressure in the very near term for crypto is also coming in from the fact that MicroStrategy, which was earlier known for only buying Bitcoin, in the recent few months has started to sell Bitcoin to increase their balance sheet. So the latest sales have been to the tune of $216 million, also weighing slightly onto the prices. But there are supportive factors as well. You have the weak yen driving corporates into Bitcoin. That has got to some buying coming in. There are some Ripple securing MiCA approval in Luxembourg, eyeing EU expansion. SEC also is likely to unveil crypto safe harbor framework in the month of July. The SEC framework will ease capital easing compliance for startups. And in the meanwhile, you also have SEC dropping MetaMask probe against Consensus with no fines, also in some sense something that the markets are taking in the positive. And then you have Kraken pursuing banking license in Europe. Vanguard, which is open search for digital assets leader, eyeing tokenization in secondary trading of tokenized private equities, which has hit record highs in pre-IPO retail volumes, are some of the reasons which are continuing to support the crypto markets therein.
Okay. Manisha, thank you so much for the update in the world of cryptos this afternoon. But on that note, we're going to sip into a very short break. After the break, we'll get you more in terms of markets, more on stock-specific action. Stay tuned in.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back. Well, the market continues to trend lower. We are at the day's low. There's a sharp fall in the bank Nifty, and that's leading to the fall that we are seeing in Nifty as well. ICICI Bank, for instance, is at the day's low. The other heavyweights like HDFC Bank and other names are also not doing so well. But we do have some stocks which are reacting to specific news pieces. For instance, South Indian Bank, where RBI has gone ahead and approved appointment of the next MD and CEO for the bank. Stock is under pressure. Ananya is joining us to tell us more on what this means for the bank. Ananya.
So, good leadership is often considered a catalyst for growth, but today a leadership announcement is the reason behind South Indian Bank's sharp decline. So, let us look at the whole story, what happened. Now, today the RBI has approved the appointment of Mahesh Muralidhar Pai as the next managing director and the CEO for a 3-year term, effective October 1st. Now, he will succeed PR Shashadri, whose tenure concludes on September 30th. Now, let us look at the background for Mr. Pai. Now, currently, he's serving as Chief General Manager at Canara Bank. Now, Mr. Pai brings nearly 3 decades of banking experience across strategy, governance, treasury, retail credit, and digital banking, including leadership in digital banking and innovation initiatives. However, the appointment was different from market expectations. Now, as investors were anticipating an internal succession plan. Now, the surprise leadership transition led to profit booking, with the stock touching an intraday low of around 43.23 after a strong rally of nearly 20% so far this year. Now, despite the market reaction, the bank's fundamental remains stable. In its Q1 FY27 provisional business update, gross advances grew 17% year-on-year, total deposits increased 11.4%, and the CASA ratio improved to 33%. Now, the coming quarters will decide how effectively this new management will build the confidence of investors.
Ananya, thank you so much for updating us with South Indian Bank's recent update in terms of the CEO change. As of now, the stock is down 7%. Let's move on and talk about NACPacking. NACPacking is listing on the exchanges at a premium to its issue price. Ria is joining us to talk to us more about the company and the latest update there. Ria, over to you.
Well, yes, NACPacking has listed on the exchanges today at a very strong premium. Now, this was an IPO worth 439 crores, which was a combination of a fresh issue as well as an OFS. The issue price was 170 rupees per share, and currently the stock is trading at a premium of roughly 10%. Now, let's first take a look at what the company does exactly. Now, NACPacking is an integrated export-oriented packaging solutions provider. They manufacture printed and laminated woven polypropylene bags, and they also serve as the key supplier for customized high-strength packaging solutions across various industries like food grains, sugar, pet food, agriculture, fertilizers, as well as specialty chemicals and construction materials as well. The current capacity of the company is nearly 43,300 MTPA, and the utilization is at nearly 82% as of the end of FY26. And the current IPO fundraise, most of these funds, nearly 320 crores of the IPO proceeds, will be used for capex for setting up a new manufacturing facility. So they will be undertaking a strong capacity expansion. In terms of the financials of the company, the revenue growth has been quite strong at nearly 12 to 13% in the last 2 years. EBITDA margins also hold strong at 18.5%, and net profit growth has also been quite strong in the last 3 years. And FY26, we saw a net profit margin of nearly 11% for the company. Now, the company also caters to a lot of marquee clientele. They do serve some leading Indian names like Baba Agro, KRBL, DCM, Shriram, and also some export companies including Cargill and Christo Foods. In terms of the export contribution, the exports contribute nearly 56% of the company's revenue as of FY26, and the US, Mexico, as well as South Africa account for nearly 35% of the exports. So that is a large contribution there. In terms of the risks for the company, there are 2 or 3 key risks for the company that exist. There is certain client concentration. As of FY26, the top 10 customers accounted for nearly 41% of the revenue. And apart from this, there is also strong dependence on export incentives as well as foreign exchange risk for the company. And also, the raw material cost of the company is quite high, and the raw material prices are subject to fluctuation. So that can be a key risk for the company going ahead. But as of now, the street is reacting well to the stock.
Okay, it is reacting well. The listing has been in focus, a fresh one at that. That's about NAP packaging. But Ria, you're also tracking Equus. It is in focus after there is a note coming in from IIFL Capital. Tell us more.
Well, yes, Equus has also been in focus today, up nearly 6 to 7% today. IIFL Capital has a buy rating on the stock with a target price of 320 rupees, which is nearly a 32% upside compared to yesterday's closing price. Now, Equus is India's only vertically integrated precision manufacturer of aerospace components, and IIFL has highlighted that the company is extending its high-mix, low-volume manufacturing playbook into a high-volume, high-mix consumer electronics segment, which presents a large opportunity pipeline for them. In fact, they do expect the revenue and the EBITDA of the company to grow at 7 times and 17 times respectively by FY31. And they also expect the scale and operating leverage for the company, which should lift their net margins to nearly 7.4% by the end of FY31. And the brokerage has also mentioned that the current high valuations of the company are justified by its differentiated franchise, as well as its deep competitive moats and long duration growth runway that it offers currently. And they have also highlighted that the company is expanding its wallet share with its aerospace OEMs. In fact, as of now, Airbus and its OEMs contribute to over 60% of the sales for the company. And the consumer electronics consumer segment is also set to see a TAM growth of nearly 10 times for the company to $130 billion US. So that is a significant opportunity for them. In terms of the valuations, it currently trades at a price to book value of nearly 12 times its FY28 earnings. But as we mentioned, the brokerage believes that this is justified given the current growth rate of the company. And in terms of the stock moves today, of course, it is seeing a big move. It is up nearly 75% since listing in December of 2025. And in fact, just in the last 3 months, the stock has doubled.
Okay. Ria, thank you so much for that. And that's the update coming in on Equus Limited. But with that, we're absolutely out of time on this edition of Halftime Report, leaving the Nifty back above the 24,200 levels as of now. But thank you so much for tuning in. Up next, your Business Punch.
Stocks slip following a fresh round of US-Iran strikes. Heavyweights are the big drag, even as mid-caps hold steady. FMCG and chemicals slide, while realty and metals eke out gains.
Stocks of oil marketing companies fall after tensions rise in the Gulf, threatening the closure of the Strait of Hormuz. The recent optimism over the declining oil prices on a surge in supply starts to fade, but experts expect oil prices will not flare up much further.
Select stocks see big moves. South Indian Bank slumps as the street reads the CEO change as a shift in focus. Orchid Pharma jumps on a supply deal in Russia for a urinary infection drug, while Aqueous gets a boost from a brokerage upgrade.
Brent jumps to $75 a barrel after US forcefully retaliates to Iran strikes on 3 ships sailing through the Strait of Hormuz. A revocation of authorization of oil sales by Iran also adds to concerns of supply disruption.
India's renewable share in electricity mix hit 50% on July 6th, but the fast solarification of the sector is stressing the grid and forcing thermal units to operate at levels that can affect power reliability and availability. Hello and welcome to Business Lunch live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan and with me is Hormaz Patakia. Hormaz, good afternoon. You know, the market's coming off the highs of the day, sharply lower in trade. And, you know, this is on account of what's happening in West Asia. We're seeing strikes again, oil prices going back up.
Not good signs with the oil prices going up, but the bulls are trying to defend that 24,200 level on the downside, even though every intraday recovery that you are seeing is getting sold into. The only positive, if you could call it that oil prices are up, yes, but they are not significantly higher. It's a 2.5% up move. Yes, you're back above $75 a barrel. But 125 and 75 are vastly different, and that too. But that is having an impact on these oil marketing companies as well. Yes, but they are off the lows of the day as well. Brent continuing to hover around $76 a barrel. For the index, though, there are a combination of multiple factors. The Nifty Bank not performing, the developments in West Asia, and of course the technical factors as well, considering we were up almost 700 points in 5 sessions. So there is some profits being taken off the table, especially because of the earnings that are starting tomorrow with TCS reporting numbers. But yet again, there is some recovery that is emerging from lower levels for the markets. It remains to be seen whether this one too gets sold into as the one that did in the morning.
Absolutely. So key to watch that 24,200 mark right now. But you know, the stocks that are doing well, we've got those realty names that are seeing some up move. That index doing all right, with the likes of Lodha, Anantraj up 4%. Godrej Properties is also seeing gains of about 0.5%. The other index that has some green in it is that metal pack, which is seeing a slight up move. We've got Hindalco, which is up 0.6%, Nalco up 2.5%, and Hinzinc up over 1% in trade. On the downside, we've got those realty names, which are the top losers as crude prices surge on renewed hostilities between the United States and Iran. BPCL, Hind Petro, and IOC, all of those stocks down over 2%, IOC down over 1% in trade. FMCG stocks also lower, with ITC, HUL, and Varun Beverages leading the down move. That's all of them down over 1%. Varun Beverages about 1% in the red. But let's begin the show by focusing on the latest updates on the West Asia conflict. The conflict between the United States and Iran has entered a dangerous new phase after Washington launched fresh military strikes on more than 80 targets across Iran. Iran's Revolutionary Guard said that they targeted U.S. military sites in Bahrain and Kuwait in response to the attacks. Take a look at this report.
We are an LNG vessel loaded with LNG dangerous cargo. We require your assistance.
That was the distress call from the Qatari tanker Al Rekayat after it was struck near the Strait of Hormuz on Tuesday. Qatar has blamed Iran for attacking vessels in the strait, including the Al Rekayat. Iran's foreign ministry said Qatar's accusations were perplexing and that Tehran was diligently fulfilling its commitments. At the same time, it asserted that commercial vessels faced risks when using routes not coordinated with Iran. In response, the United States launched a new round of strikes on Iran on Tuesday and revoked a license that had allowed Tehran to continue selling oil on international markets. Oil prices rose more than 3% after the U.S. announced the move. A U.S. official told Reuters the strikes targeted Iranian air defense systems, coastal surveillance systems, surface-to-air missiles, anti-ship cruise missiles, and drone launch sites. In this eyewitness video verified by Reuters, smoke can be seen rising from a fire in Bandar Abbas, Iran. The blaze in the port area was caused by an explosion from U.S. airstrikes. Iran's Revolutionary Guards on Wednesday said they targeted U.S. military sites in Bahrain and Kuwait in response to American strikes. Both sides are accusing each other of violating the ceasefire reached between Washington and Tehran just weeks ago. Analysts say Tehran uses attacks on shipping to underscore its leverage as it negotiates with Washington over a longer-term agreement. U.S. President Donald Trump said the United States still wants a deal with Iran, but warned military action remains an option.
Look, we're going to win one way or the other. We're either going to make a deal or we're going to finish the job, okay? And it won't be tough to finish the job. I'd rather make a deal because I don't want to affect 91 million people.
The confrontation comes as Iran mourns Supreme Leader Ayatollah Ali Khamenei. Hundreds of thousands gathered in the holy city of Qum on Tuesday for funeral ceremonies, with chants of defiance underscoring the public mood. For now, the Strait of Hormuz remains at the center of the standoff. It is unclear whether the attacks will lead to another full-scale interruption of shipping traffic through the strait, which before the conflict carried about 1/5 of the world's oil and gas supplies.
And as a result of these developments, oil prices have seen an up move as well. Manisha is here with more details on that. Manisha.
Well, after 6 weeks of decline, the overnight gains for the crude oil prices have been to the tune of 5%. We've come back not just above 75, but $76 a barrel as well. And with that, this week is looking at 6.5% of gains already into the market. Much of the gains come in because of what has happened overnight. You have the U.S. military carrying out retaliatory attacks on Iran. This is in response to Iran attacking 3 vessels which were transiting via Strait of Hormuz, one from Qatar, one from Saudi Arabia, and this is in addition to 2 that they had attacked on a couple of days ago as well. So this week itself has seen Iran attacking 5 vessels going via Strait of Hormuz. Well, there are comments also coming in from CENTCOM saying that this is 1, violation of ceasefire, and 2, the kind of aggression that Iran has shown is unwarranted, dangerous, and of course a clear violation. The U.S. Treasury Department's office at Foreign Asset Control also said that with this, there's a complete and immediate reward that they have done in sense of Iran oil that is passing via Strait of Hormuz. Well, since the time that we did see on 17th of June that there was a peace deal between US and Iran, nearly 45 million barrels of Iranian oil has passed via Strait of Hormuz, which is now immediately stopped as per US. Iran, in the meanwhile, has been saying constantly that whoever passes via Strait of Hormuz, the country or the vessel, has to do it via the route that has been set by Iran. Any route that is established by Oman or International Maritime Organization is something that the Iran will not acknowledge or observe. So that is where we are looking at a thin line between both of these countries in sense of all the resolution conversation that seems to be happening. Now, what the markets are looking at is that there is a broad range that crude is now established, 68 to 65 on the lower side to 80 to 85 on the higher side, with markets believing that a full-blown war perhaps is not going to happen. But if that does happen, then you're looking at much higher highs than we saw previously into the markets there.
All right, Manisha, many thanks for those details. Now, India's usage of clean energy is rising, having peaked on the 6th of July when over half of the country's electricity was supplied by green energy. However, there are some problems with the fast pace of adoption as the thermal plants struggle to cope with load flexibility. Vivek is here to tell us more on this. Vivek?
Well, that's right. You summed it up perfectly in terms of what exactly we are going to discuss, especially in terms of India's rising and fast pace of renewable adoption. In fact, a couple of very key policymakers have tweeted on the same as well. So Mr. Amitabh Kant has actually said that, remember, India's clean power just hit a new record. On July 6th, more than half of India's electricity came from clean energy sources, even as the system demand hit 221 gigawatt. Now, this is, even though it's a brief peak, this is a strong signal of where India's grid is headed. But on the other hand, this particular spike as far as power demand and power supply coming in from renewable energy, especially solar, is concerned, has also invited a certain amount of discussion in how exactly this will impact the grid. And India's, remember, India currently continues to be reliant as far as thermal power is concerned. So Mr. Sanjeev Sanyal has actually said the rising solar penetration is causing grid stress. He's saying that solar power meets more midday demand. However, a solar generational uptick actually forces conventional sources, especially thermal plants, to ramp up and then ramp down more sharply to meet the net load as far as demand is concerned. Now remember, these particular concerns have been highlighted even by companies themselves. NTPC chairman earlier, in fact, had gone ahead and flagged off concerns as far as the rising use of solar in the grid is concerned. Mr. Gurdeep Singh had actually said that instead of forcing existing plants to operate at flexible load, which they were not designed on, the focus should be on building new flexible power units. And in fact, he also cautioned, saying that clear signals are now operating at such reduced levels is beginning to impact thermal reliability as well as availability. It's not that policymakers aren't aware of the stress, and discussions currently are ongoing. A few issues were highlighted in the recent meeting between the central planning team, the CEA, the regulator, which is CERC, and the grid operator, which is Grid India. A Bernstein report states that one of the key highlighting points of this particular discussion was that coal plants can run at a minimum load of 55% and not 40%, and that is something that needs to be static as far as thermal plants are concerned. Now, system cannot absorb too many renewables. In fact, on 13th May, there was an incident as far as Khavda was concerned. A generational loss of close to 9 gigawatt was seen, the largest generational loss event in the Indian grid so far. And the key reason was that grid oscillations were observed at Khavda. Most likely, the extra high voltage lines tripped over an over voltage protection surge. Now, some of the companies, remember, that do have a key and a very high thermal portfolio include NTPC, Adani Power, Tata Power, and JSW Energy. All of these companies especially will be keeping a keen eye on how exactly solar goes ahead and is ramped up into the system.
Vivek, thank you for those updates there. Besides that, of course, even as the markets are nearing the lows of the day, there are plenty of stock-specific activity that is taking place in the broader markets. Ananya is here to summarize that entire news flow. Ananya.
Well, yes, let us look at some buzzing stock. Let me first start with Interglobe Aviation, that is Indigo. They remain in focus after DGCA's May data showed the airline continuing its strong leadership position in India's domestic aviation market. Now, if you see, Indigo maintained a 64.9% market share and reported the highest on-time performance among airlines at 82.8%. Domestic passenger traffic also increased to 9.5% month-on-month to 1.54 crore. Now, if you see, however, the stock is facing some pressure today as Brent crude prices moved back above the $76 per barrel mark compared to around $72 at the start of the week, raising concerns over fuel costs. Now, IdeaForge Technology is in focus as the company's QIP opens with the floor price set at 835.86 per share. Now, coming to Silver Touch Technologies, the stock is also surging today. If you see, they had gained attention after securing an order from RITES to develop Parak, an AI native detailed project report appraisal platform. Now, EMS Limited emerged as the lowest bidder for 158.3 crore Delhi Jal Board's project, which is expected to be executed over 15 months. Now, lastly, Equus Limited is in focus after IIFL Capital initiated coverage with a buy call and a target price of 320, indicating a potential 32% upside, if you see. Now, the company is expanding its manufacturing capabilities into high volume, high mix consumer electronics, a segment with a significantly large total addressable market of around $130 billion. So these are the stocks that are buzzing today.
All right, Ananya, many thanks for taking us through those details. But on that note, it is time for us to head into a short break. More news and updates on the other side. Stay tuned.
Welcome back. Now, the NATO summit is currently underway in Turkey. The meeting of the 32 member states comes at a crucial time for the alliance after tensions with the US over Iran and Greenland. CNBC's Steve Sedgwick is now joining in from Ankara with all the latest updates.
It was a very unconventional start to this two-day meeting in Ankara for NATO leaders as well. It actually resembled more of an arms fair rather than a leaders meeting. The real leaders meeting where the discussions get underway, perhaps taking place this evening on the first day, on the Tuesday, and on the full-day agenda on Wednesday, when we'll have the official arrivals of world leaders. Day one was dedicated to a defence industry forum with arms, manufacturers, industry, and world leaders convening just up the road here in Ankara to discuss the actual enactment of EU plans to spend more money on procurement, not only of European weaponry, but also US weaponry going forward, to move on those commitments made at The Hague last year, where Europe is committed to spend 5% of GDP, which is made up of 1.5% on infrastructure spend and 3.5% of real industry spend on defence as well. The mission from European leaders and from Secretary General Rutte especially is to persuade the United States that actually real change is happening and that Europe is spending more money, and get ahead of concerns that the Pentagon review will actually then start dissecting which countries will get US support going forward and which won't if they are not spending money quickly enough. Other issues of contention that have reared their head in the last year since that successful Hague meeting, of course, include concern over Greenland and indeed the Straits of Hormuz as well, and the war with Iran. On the first matter, very interesting that President Trump mentioned Greenland in his opening comments to the world press when he was sitting on a bilat with President Erdogan as well. And he said, look, once again, the US should control Greenland. That will send shudders through the state of Denmark and through other European allies, and once again threaten a split within NATO. And of course, the US has a bone of contention where it sees that actually the European NATO members did not support the US during the Iran conflict, and they will be looking to reassure the president that actually they have a role in reopening the Straits of Hormuz after the ceasefire period as well. All in all, one European diplomat put it to me and said, look, at least we are all here, and that is a positive start. And of course, other issues at this meeting include the fact that President Zelensky is here and will be looking to shore up support from Europe and the United States in their battle against Russia.
So that's the latest from the NATO summit. But it is time now for a quick roundup of all that's brewing in the tech space. OpenAI, Anthropic, Samsung, Meta are all in focus. Let's understand why and go across to Rachna Dhanrajani. Rachna?
That's right, all of them are in focus. Let's start with OpenAI, that's set to launch its most capable model yet, GPT 5.6, publicly on Thursday. Now, the company has confirmed the rollout across 3 tiers, the flagship Sol, the mid-range Terra, and the low-cost Luna. The wide release comes after the US Commerce Department cleared it following extended government testing as per Axios. It is the same oversight framework that recently paused and then restored Anthropic's own Fable and Mythos models. Speaking of Anthropic and Fable, Anthropic now has a fresh update on Fable 5. The company has told users it is extending the models in plan access, which was due to move to usage credits on July 8th. But now it will stay included in eligible subscription plans through July 12th. Now it will move out on July 13th. Users can draw on Fable 5 for up to 50% of their weekly plan limits at no extra cost, with all Fable 5 usage shifting to credits from July 13th. Turning to the chip race then, Chinese startup DeepSeek is developing its own AI chip, Reuters has reported, citing 3 sources familiar with that matter. Now, the company is building an inference chip to cut its reliance on NVIDIA and Huawei. The effort is still early, with talks underway with chip design, foundry and memory firms. NVIDIA slipped around 1.6% in US pre-market trade. DeepSeek has not yet commented on this development though. Over to consumer AI, and Meta has launched Muse Image, its first in-house image generator from Super Intelligence Labs. This is the second rollout under Alexander Wang. It's live in Meta AI and Instagram stories in the US and on WhatsApp in a handful of markets. Now, speaking of paid plans, this would not be a paid one, at least at the beginning. It would be start with paid plans for heavier use. One feature that builds image from other users' public Instagram photos that was rolled out is opt-out by default, and that has already drawn privacy concerns. Finally, 2 hardware event dates are now confirmed. Samsung has set its next Galaxy Unpacked for July 22 in London, where the Galaxy Z Fold 8 and Z Flip 8 are expected to headline, alongside a rumored Fold 8 Ultra. And Google has set its Made by Google event for August 12 in New York, teasing the next generation of Pixel, with the Pixel 11 line and Watch 5 widely expected. Both the launches land against an industry-wide memory shortage that is pushing device prices higher. So we'll have to see where the price band is set for all these new launches.
Rachna, thank you for that update there from the world of AI. Take a short break. More news and updates on the other side. Stay tuned. Welcome back. Now, the monsoon is having an impact on quick commerce gig workers and the companies themselves. Rachna is back with us to tell us more on that. Rachna.
Well, a week of heavy rain and repeated red alerts in Mumbai, and through all of it, quick commerce hasn't stopped working. Delivery partners are fewer on the roads, but the orders are going out. The 10-minute promise, or groceries in a few minutes promise, is still holding. The question is what it's costing to hold it and who's paying. Start with demand. Rain doesn't hurt this business. It, in fact, feeds it. Customers say stay in and order more, and the platforms respond with the surge. On Zepto, free delivery this week kicked in only above $2.99 or in some cases 399 rupees against 99 on a regular day. And for platforms that charge a platform fee already, the rain surcharge simply sat on top of it. So the customer pays more per order precisely when delivery is slowest. So that's not a glitch. That's precisely the model these companies are working with. Now, the companies are saying that there's no immediate hit to operations. Monsoon playbook, real-time rerouting, though on the ground, some dark stores did shut for a few hours in the worst hit pockets, and the playbook runs on incentives. Rain bonuses that pull delivery partners onto flooded roads when fleets are running thin. Last monsoon, one rider reportedly made 21,000 rupees in a single week of heavy rain against an average monthly take-home of around 28,000 rupees. Nearly a month's earnings in 7 days. The upside is real, but so is the risk, and it's entirely his at that point. Then the pressure point a consumer can never see is the dark store. Rent, staff, cold storage, these are fixed costs, billing all day, be it rain or shine. Rain lifts demand, but it also slows fulfillment at the same instant. Orders pile in faster than they can go out, and the margin absorbing all of this. Blinkit, the market leader in the space, earned 37 crore rupees last quarter on over 14,000 crore of goods sold. That's 0.3%. Swiggy's Instamart lost 858 crore in the same 3 months. 3 paise in the rupee, that's all the margin that the best player in the business has. So a wet week in Mumbai can severely impact that, and we're only in the first week of July. So does the cost of delivering groceries in minutes can come at the cost of margins? That's what this monsoon will tell us about quick commerce.
All right, Rachna, many thanks for taking us through those details. Now moving on, yesterday we almost said goodbye to another football giant on the world stage after the exits of Neymar and Ronaldo. But Argentina had other plans. The defending champions scripted a remarkable comeback, recovering from 2 goals down to beat Egypt 3-2. Goals from Christian Romero, Lionel Messi and a dramatic stoppage time winner from Enzo Fernandez completed one of the greatest turnarounds of the tournament. Messi, despite missing an earlier penalty, scored his 8th goal of the World Cup to strengthen his lead in the Golden Boot race. In the other round of 16 clash, Switzerland edged past Colombia 4-3 on penalties after a goalless draw to reach their first World Cup quarterfinal since 1954. It's time for a brief pause today, but the action from the quarterfinals resumes tomorrow night when Morocco takes on favourites France.
Well, another day and another turn of event that has upset Arundhati. Taking your leave on this edition of Business Lunch from the two of us. Thank you so much for watching. The market still trying to hold on to that 24,200 mark. Mid-cap radar on the other side.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. Vivek, good afternoon. Continues to be a down day. There's no recovery that we've seen so far. To the midcaps, they're outperforming the benchmark. A lot of pressure coming in from the banks. We do have the oil and gas space as well. FMCG, which was one of the big movers yesterday, has come in for some profit booking. And the war tensions are back in our focus now.
That's right. Crude prices have spiked overnight, leading to a bit of a downtick as far as OMCs are concerned. And as far as financials are concerned, remember, these were the sectors that saw significant underperformance once we did see those tensions escalate. But we have a lot lined up on the show, so let's start off with the top headlines. Stocks slip following a fresh round of US-Iran strikes. Heavyweights are the big drags, even as midcaps hold steady. FMCG, oil and gas, and chemicals slide, while realty ekes out gains.
Auto components major Minda gains after investing 320 crore rupees in new plant for four-wheeler passenger vehicle seating facility. Elara Securities believes this project will unlock a decent enough total addressable market of around 18,000 crore rupees.
South Indian Bank slips more than 6%, its biggest decline in 3 months, even as the RBI approves the appointment of new MD and CEO Mahesh Pai for a 3-year term.
NAC Packaging makes a strong debut today, listing at a premium of nearly 11% to its IPO price. Shares list at 188 rupees per share on the NSE.
Cochin Shipyard under pressure as the government's offer for sale opens for retail investors. Government is looking at divesting up to 5.04% stake.
Okay, those are the top headlines that we are tracking for now. The markets, as I said, continue to be lower. We do have a lot of contribution on the downside coming in from the banks. The consumption pack is not doing so well. The IT pack is also not doing so well. Realty, which was the top loser yesterday, has made a comeback. It is up 0.6% as we speak. In fact, this month it has been a good gainer at 8.5% on the Nifty Realty Index. Metals also are doing well, but they have come off from the highs of the day. So metals was also sulking in trade yesterday, but a comeback and has come off from the highs quite flat with some positive bias. Mid-caps continue to be on our radar. Mid-cap index is absolutely flat with some negative bias for now. There has been some recovery, but again, the advanced decline ratio in the favor of declines.
Advanced decline ratio, a bit of a bounce back, especially as far as the mid-cap index is concerned, as you can see on your screen. But, what particular pocket that's seen sudden sell-off, especially in the last hour or so, has actually been some of the hospital names. So names like Max Healthcare, Apollo Hospitals, seeing a bit of pressure. And in fact, Pharma, which was outperforming in the morning, has seen a bit of a cool-off as we start the second half of the trading session. But this is our special segment, Mid-Cap Movers. Upasana standing by the big wall with all the mid-caps that are moving around in the session.
Well, certainly the Nifty Mid-Cap Index has recovered a bit from its lows. But first, let us look at the top gainers in today's trading session. Now, topping the list is Balaji Amines. It is up more than about 10%, and it is one of the key volume buzzers for today, followed by Rishabh Instruments, which is up nearly 7%. And if we look at the 1 month move of the stock, it's up nearly 19%. Next up is Stovecraft, is up nearly about 3%, and one of the plays in terms of consumption that is playing out for the stock. Next up is HLE Glasscoat. Even this stock is in focus, up nearly about 5%, continuing its yesterday's rally. And lastly, coming to Premier Energies, up nearly about 3%. Now let us look at some of the stocks in the Realty Index. As highlighted earlier, Nifty Realty Index is up more than 0.5%. Now, Anantraj, Lodha Developers, Soba, all these are up in the green, seeing a sharp up move of nearly about 2 to 5%. Now, let us look at the stocks that have hit an all-time high today. Stocks such as Ather Energy, Schneider Electric and JNK Bank. All these are up in today's trading session, hitting a 52-week high. Now, on the flip side, let us look at some of the top losers. Topping the list is Aegis Logistics, which is down nearly about 8% as we speak. And even RITES, it is down nearly about 3%, followed by Cohance Life Sciences, down about 3%. Bank of India is also seeing a sharp cut of nearly about 3%. And lastly, Apar Industries also down nearly about 3%. So all in all, these are the stocks that we are tracking today in our today's mid-cap radar.
Okay, all right. Some interesting names like Balaji Amines. Since you spoke about Balaji Amines, Upasana, even Alkyl Amines is giving it some company. That stock is the other one, which is higher by 7% in a market which is looking very weak otherwise. We do have Kalyan Jewelers, which continues its up move. The Thangamayil Jewelers is the other one. Rishabh Instruments is one stock, which is higher by 7%. Of course, Upasana spoke about that as well. And a lot more stocks, which we'll discuss through the course of the show as well. But it's a good time to get a technical check on the markets. Jay Thakkar, Head Derivatives and Quant Research at ICICI Securities, is joining us now. Jay, good afternoon. Thank you for joining us. It's the Sensex or the BSE options expiry tomorrow. We are seeing some declines there. 600 points almost lower on the Sensex. What are the next important levels on the Nifty and the Bank Nifty as well, apart from Sensex, that you're watching out for?
Hi, very good afternoon to you, Sonal. Sonal, as far as the indices levels are concerned, I think that on Nifty 24,000 is the very critical support. As far as this weekly expiry or this monthly expiry also goes forward, because that is where we see a highest build up on the put side, and on the upside 24,500. I mean, where on the weekly expiry Nifty attempted to climb above it and sustain, but could not eventually, and then closed below, well below, in fact, 24,500. So I would say that this 500 points range could continue for another couple of trading sessions. Likewise, Bank Nifty could be trading within that range of say 58,000. 500, 700 on the upside, the recent high which we have seen a week back, until 57,000. So that is also likely to consolidate. And Sensex, I think, Sonal, could consolidate within this band of say 76,000, 76,500 on the lower side to 78, 70 and a half on the upside. So more or less, looking at all of these indices, looking at the India VIX, which seems to have short-term got into an uptrend. I think that the markets would consolidate or take a pause after almost a good amount of run up which we have seen recently from 23,800 till 24,500. So a consolidation between this range of 24,500 to 24,000 could not be ruled out, and eventually post that, once this consolidation is over, I think it would again continue on the upside, which would get our targets of 24,800 to 25,000. But then, the stock specific momentum would continue. And hence, I think that, both long and short side positions in the short term could be helpful.
Okay, thank you so much, Jay, for your views as far as the markets are concerned. But Jay, give us some trading ideas for today. What are your top picks? Is mostly buy, or do you even have a sell?
I do have a sell. I've got a sell recommendation on State Bank of India now. So we have seen a good recovery in SBI from today's low, and it's trading around the levels of 1,033. We have seen the max pain level of 1,050 is trading below that. From the derivative perspective, we have seen the call base at 1,050. So a stop loss above 1,050 and a target of say 1,000 to 985. One can go short on SBI. From the short-term point of view, just from the risk-reward point of view, I would say that looks better. And as a disclaimer, we have a buy recommendation on this, for sure, I would like to say. But then we think that Havens from these levels can be looked at from the long side, is trading around the levels of 1,225, 26 right now. It had gone up with a very strong volumes yesterday. We have seen a good short covering happening there. Two oversold, and a bounce back cannot be ruled out there. So the upside, we believe that 1,260 to 1,275, these are the levels one can watch out or look out for in Havens, placing a stop loss of 1,195 on a closing basis. So one long and one short idea, Vivek.
Okay, one long and one short idea. Thank you so much for joining us with all those picks. Important comments coming in. Donald Trump is saying that they attacked very powerfully last night, and that is with respect to Iran. We wasted a lot of time with Iran, and then some more comments coming in with respect to what Donald Trump is saying. They are saying, and they are reiterating, they will not allow Iran to possess nuclear weapons, and this is something that US has been saying for a long time. In fact, we can cut across to that particular speech that's being made.
An ocean, but it's been a long-term thing, and they haven't treated us right. And Mark understands it. He understands that, and we're going to work something out, I think, one way or the other. But we've been treated unfairly. We pay disproportionately. We had a time when we were paying 100%. We were paying 100% of NATO, and yet a lot of the countries weren't paying anything. But there was, of calls made a few weeks ago. I spoke with UK, and the Prime Minister said, well, we don't want to help you now, but we'll help you when the war's over. I said, that's not good. And likewise, I spoke to Germany. They didn't want to help. Spoke to France. They didn't want to help. Nobody wanted to help. Some of the very small countries wanted to help because they're the most vulnerable. I mean, that's the only reason they wanted to help. So I appreciate you being here. We're going to be going back together, many of us together. And again, I want to say, despite the fact that I'm very upset with NATO, that we pay far, far too much, billions and billions of dollars too much, because it's unfair, because we're protecting them. So we protect them, but they're not there for us. Think of it. It doesn't work. But I want to have him.
Well, that was US President Donald Trump. And once again, what we're looking at is an escalation of tensions as far as US and Iran are concerned, and also threatening to pull out of the NATO, unhappy with the response he got from Europe leaders, especially when it came to attacking Iran and the support that he expected from Europe. Well, we'll now slip into a short break. We'll get him on the markets, and we will focus on NAC Packaging, South Indian Bank and Equus, which are all reacting to news flow. Welcome back to Midcap Radar. Well, one particular stock that's listed on the exchanges even on a day where we're seeing very volatile moves is NAC Packaging, and it's done quite well. It's managed to list at a premium, over a 10% premium to its issue price. Ria now joins in with more details on the company and the kind of valuations it trades at.
Well, yes, NAC Packaging has listed on the exchanges today and it is trading at a premium of nearly 10%. The issue price was around 170 rupees for the company. This was a 439 crore rupee IPO with a combination of a fresh issue as well as an OFS. So let's first take a look at what the company does exactly. It is an integrated export-oriented packaging solutions provider, and it manufactures printed and laminated woven polypropylene bags, and also it serves as a key supplier of customized high-strength packaging solutions, which caters to end-use industries across food, grains, sugar, pet food, agriculture, fertilizers, as well as construction materials. The current capacity of the company is nearly 43,300 MTPA, with capacity utilization at nearly 82% in FY26. And of these IPO proceeds, the company is going to use nearly 320 crores of these proceeds for capex for setting up a new manufacturing facility. So they will be seeing a large capacity expansion as well. Now, in terms of the financials, the company has been performing quite well. They have a revenue growth run rate of nearly 12 to 13%, with strong EBITDA margins at 18.5%. Even the net profit growth has been quite strong, and net profit margins hold strong at 11% as of FY26. The company also caters to a lot of key clientele across domestic and export names. In fact, the export contribution of the company is quite high. Nearly 56% of the revenue in FY26 came from exports, and of this, the US, Mexico, as well as South Africa account for nearly 35% of the total exports of the company. So while all these are key strengths for the company, there are also some risks that exist for the business. The first one is client concentration. In FY26, the top 10 customers accounted for nearly 41% of the revenue of the company. So that is somewhat of a risk for the company. They are also quite dependent on export incentives, as well as there is also foreign exchange risk that exists for them. And the raw material cost of the company is also quite high at nearly 60% of the revenue in FY26, and this is subject to price volatility as well as supply chain disruptions. So those are some key risks that exist for the company. But today the stock is performing well, up nearly 10%.
Okay, all right. So that's about this new listing. By the way, the markets have slipped from the highs post that comment coming in, and closed the flashes at the bottom of your screen as well. So just keep an eye out on that one. While we are doing that, look at that. It is at the day's low, 260 points lower on the Nifty for now. Let's get and talk about more stocks now. RBI has gone ahead and approved appointment of the next MD and CEO for South Indian Bank for a 3-year term. However, the stock is reeling under pressure. Ananya is here to tell us more. Ananya?
Well, yes, a leadership announcement is the reason why the stock is under pressure today. Now, let us look at what happened. So, the RBI has cleared the appointment of Mr. Mahesh Muralidhar Pai as the Managing Director and CEO of South Indian Bank for a 3-year tenure starting October 1st, 2026. Now, he will take over from Mr. P.R. Sheshadri, whose term wraps up on September 30th. Now, bringing nearly 30 years of universal banking expertise, Mr. Pai currently served as Chief General Manager at Canara Bank, where he has been spearheading their digital banking and innovation strategies. Now, this brings us to the core reason behind today's market reaction. Now, investors had largely anticipated an internal promotion to this leadership position, because an external appointment went against general street expectations. It triggered immediate profit taking on a counter that had already run up roughly 20% so far this year, now causing the stock to hit an intraday low of around 43.23. Now, however, the matching this management shift against the bank's actual business performance, the provisional Q1 FY27 update shows the operations remain fundamentally steady. Gross advances grew 17% year-on-year and 4.1% sequentially. Now, the total deposit also climbed 11.4% year-on-year, while the low-cost liability franchise strengthened with the CASA ratio expanding to 87 basis point quarter-on-quarter to 33%. Now, the coming quarters will show whether the new leadership can strengthen the investor confidence going forward. Yeah.
Well, thank you so much, Ananya. Well, before we move on to the next stock, just if you could pull up the intraday chart of the Nifty. Nifty now nearing the day's lowest point, down over 1.1%. And this is on account of the escalating tensions, especially as far as US and Iran is concerned. Private financials taking it on the chin. SBI has cooled off quite significantly. Most of the stocks that we are discussing near the day's lowest point. But moving on, shares of Equus are in focus after IIFL Capital's bullish note. Ria joins in with more details.
Well, yes, Aegis has been in focus today, up nearly 6 to 7% after a note coming in from IIFL Capital. The brokerage has a buy call on the stock with a target price of rupees 320, which is a 32% upside compared to yesterday's closing price. Now, Aegis is India's only vertically integrated precision manufacturer of aerospace components, and the brokerage has highlighted that the company is now extending its high-mix, low-volume manufacturing playbook into a high-volume, high-mix consumer electronics space, and they do expect the consolidated revenue as well as the EBITDA of the company to grow by 7 times and 17 times respectively by the end of FY31. They also expect scale and operating leverage for the company to come in and lift their net margins to nearly 7.4% by the end of FY31. They do, however, believe that the valuations, the currently high valuations of the company are justified by its differentiated franchise, its deep competitive moats, as well as the long duration growth runway that the company currently sees. Now, currently the company is also expanding its wallet share with aerospace OEMs. Currently, Airbus and its OEMs contribute to over 60% of the sales for the company. And in fact, IIFL has also highlighted that the consumer electronics space, the consumer segment TAM can see a growth of nearly 10 times for the company to $130 billion US. And currently, in terms of the valuation, it trades at a price to book value of 12 times its FY28 earnings. But as I mentioned earlier, the brokerage believes that this is justified given the long growth runway of the company. In terms of the stock moves today, it is performing well. It is up nearly 75% since its listing in December 2025, and in fact just in the last 3 months the stock has doubled.
Okay, all right, Ria, thank you so much for joining us. The markets continue to fall. That stock, however, is higher in trade. We'll slip into a short break. When we come back, we'll get to more on the market moves and some of the stocks which are seeing big momentum on the downside. Stay tuned. Welcome back. Well, the market fall has aggravated. We are off 237 points from the highs of the day. Look at that fall. In last couple of minutes, there have been a steep fall on the back of comments coming in from US President Donald Trump, where he's spoken about the memorandum of understanding ending. Now, we need more clarification on that. What does he really mean by that? But he's been talking about how the conversations with Iran and the West Asia war crisis, that is something that could still continue. And we have the comments say, as far as Iran is concerned, he says that he's wasting time there. And on the back of these comments, there has been a sharp fall from the highs of the day. Look at that. If we talk about the mid-cap index, that's down 0.6%. When we started the show, it was absolutely flat with some negative bias. But the fall has been very sharp. We are 500 points off the highs of the day when it comes to the mid-cap index. The advanced decline ratio sharply in favor of declines. Those two lines should come up for you on the screen. And that is indicating that it is getting in favor of the bears as we speak. HCL Tech, you have Ultratech Cement, HDFC Bank, Sun Pharma, NTPC, TCS. All of these stocks are in the red as we speak. Even that the advanced decline ratio, if you look at that graph, if we can bring that up again, just look at that graph, because the fall has been so sharp that those two lines are moving exactly in the opposite direction. The comment is very important. I believe the MOU is over. I will let our negotiators keep talking if they want, but the market impact has been severe on our own markets because the uncertainty is back
again.
again.
A significant fall. Some names I'll keep on my radar. Keep an eye out on L&T, Larsen & Toubro, one of the biggest, 30% order book there. Some of the capital goods name, ABB, Cummins, Siemens, all of these names, and NBFC stocks, along with banks, names like Shriram Finance, names like PNB Housing Finance, all of these stocks have cooled off significantly from the day's highest point. But with that, it's all the time we have on this edition of Mid Cap Radar. Your stocks when we return.
Welcome to Your Stocks live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan, and with me as always is Vinny Motiwala. Vinny, hi, good afternoon. You know, a big sharp fall coming into the markets in the last 20 minutes, right? And this is on account of escalating tensions in West Asia, and Trump also making comments saying that, you know, the Iran is very dangerous people, and he's saying that the MOU is likely over. If you take the look at the Nifty and Sensex, both of them 1.6% lower. Nifty now below that 24,000 mark. The mid-cap index, which was flat just an hour ago, is 1% in the red, and the Nifty Bank falling in line with the blue chips, in fact, even more. If you bring up that advanced decline ratio and you take a look at it, we've got 2,227 stocks declining for 827 advancing, and both of them going in polar opposite directions as we speak right now. Every sectoral index is in the red. So let's hear out Trump's comments on Iran.
I think it's over. I don't want to deal with them anymore. They're scum. You know what scum is? They're scum. They're sick people. They're led by sick people. And they're vicious, violent people. And if they had a nuclear weapon, they'd use it. As far as I'm concerned, it's over. I'll speak to our negotiators. They want to negotiate. They're good people. Steve Witkoff, Jared Kushner. But they have to come back to me. As far as I'm concerned, it's just a waste of time dealing with them. They're liars. We make a deal. And if I make a deal with him, we have a deal, and he goes out, he talks. We make a deal. Everyone's agreed. No nuclear weapon. We make a deal. They go outside, talk to the press. They say, we never even talked about it. There's something wrong with them. They're cuckoo. As far as I'm concerned, it's over.
That's the update that's coming in on the global front, and a sharp fall in the markets. Obviously, we are now, trading at the day's lowest point. 23,000 now is what the Nifty is trading at, 23,900 levels. Watch out for that. That fall continues for the markets. But let's move on and bring on board our experts for today who will help solve all those stock-related queries that you all have sent us. First up, we have Asta Jain, research analyst at Hem Securities, as well as Somal Mehta, head of retail research at Mirae Asset Sher Khan, to answer all the stock-related queries. Let's move on and start with the query then. First query for today coming in from Jairam, who's writing to us from Mumbai. He says that he's holding some shares, that's 2,200 shares of Indian Overseas Bank. And this he's gotten it inherited from his father. So it's a long-term story. What is the view on this bank? Should they continue to hold the stock? Asta?
Hi, good afternoon to all of you. See, talking about Indian Overseas Bank, we all know that it was a good turnaround story because it was into the RBI prompt corrective actions few years back. And then afterwards, we have seen that has turned into the profitable, well-capitalized PSU bank. So I believe that this story is that one should believe on this story because of the strong revenue growth, which we have seen. Apart from that, the improving asset quality is also accompanying the revenue growth. So this is what we believe, that all these factors which are related to the financials of the bank, whether it is a healthy loan growth, improving asset quality, and a stronger revenue growth, I think these factors are pointing towards more upside for the counter. Hence, recommending hold on this counter with a price target of somewhere at around 38 rupees to 40 rupees, but these are the long-term price targets, so one should be patient enough to hold this stock at least for 6 months, and 38 to 40 can be assigned as a price target to IOB.
All right, Somal, coming to you, Indian Overseas Bank, what are the targets? He's inherited this from his father and he wants to know the outlook for the bank, but any key targets he should watch out for?
Yeah, at this point of time, the view is definitely negative. It's been struggling below 200 daily moving average since last probably 7-8 months now. And it's been in the downtrend on the monthly, weekly chart. So my view is negative. I'll be expecting the stock to go down till at least 29 or 30 levels. So that's my level to watch out for as a target on the downside. However, I think overall, if you see the structure on the monthly charts, the long-term perspectives still look good to me. Once it breaks out above 37 as the breakout level, if it goes about 37, I think that will be the right time to go ahead and buy the stock for a target of 42, probably 45 as well. So I'll wait for a breakout on the upside, but at this point of time, a little bit of pain till 30 or 29 levels.
All right. Okay. The next query is coming in from S. Jayakumar, who writes to us from Tamil Nadu. He wants to know, he holds 100 shares of John Cockrell at 9,293 rupees, and he wants to know if he should continue to hold or sell the stock. He is making a loss on it. The stock is currently at 8,445. Asta, what are the long-term prospects of the stock? Should he, sell right now, or should he continue to hold?
I think he should continue to hold, because there is one unique factor about the John Cockrell is that, it is among few of the companies which are into the hydrogen ready steel plant. So what we say is a unique green steel opportunity is what is there for this company. So I believe that is the main thing which this company can really ride upon. Apart from that, there are other factors which are also signaling towards the strength of the company, in which strong parentage is also one of the factor which we are seeing that this company is holding. And in fact, whatever order inflows they are receiving now, we have seen a very strong improvement in the order inflows, which in turn is leading to the strong profitability. So my idea here is that John Cockrell is one of the counter one should remain invested in for the price target of 9,000 to 9,200.
Somil, what's your view coming in on this one? Should the viewer continue to hold the stock or sell?
Absolutely hold the stock. If you're a long-term investor, definitely hold on to the stock. It may go down till 8,100 level, which is the 40 daily moving average. But I think hold on to the stock. Overall structure looks good to me. The next target on the upside would be 9,500. So buy on decline should be the strategy. But if you're an investor, and if you have this on your portfolio, hold on to it.
Okay. That's a view there. But, a quick check in terms of the markets, right? Look at the India VIX. It's up. Bank Nifty, a sharp fall that we're seeing, down more than 1,000 points, down 2% in the trading session as well. Nifty is down, more than 300 points as of now is what we're seeing. 400 points now is down for the Nifty 50 as well. So the day's lowest point, this is all coming in after we've seen that commentary coming in from President Trump at the NATO summit. And key to watch out for, Nifty mid-cap is down 795 points. All of them at the day's lowest point. We were flip-flopping between the red and the green. And now look at the steep fall that has just come in, right, in the 20 minutes. That is key to watch out for. And I would just like to pull up some of those Nifty names which are falling in the market as well, and which are seeing a bit of a drag. So let's pull up the Nifty 50. What is not doing well in terms of the Nifty 50? Reliance was already on the side, flip side, which was not managing to hold on to gains. And that is something that is dragging the market. We have ICICI Bank, L&T, Bharti Airtel among the names for the Nifty 50 that are seeing the sharp fall as well. So yes, that's the fall coming in the markets. There's no respite as of now, not much green that we're seeing. An advanced decline ratio clearly is seeing a very wide gap. But let's move on and keep it going with the stock related queries. The next query for today is coming in from Balampur Relic Rishna, who's writing to us from Erode, and he's saying that he's holding 1,198 shares of Ircon International. Price is 157 rupees per share. This is he holding it since the last 4 months. So short term, what level should he exit at? Should he continue to hold this stock or get out of the stock? Asta, your view on this one.
I recommend hold on this counter. The reason being the strong order book which the Ircon is having, around 24,984 crore of order book the company is having right now. So that really signals strong revenue visibility for the company going ahead. So my idea here is that on the basis of a strong order book this company is having, and we all know that the balance sheet is also in a very good state as we talk about the balance sheet also. So talking about all these factors, my idea here is to stay invested in this counter for the long-term purpose, because in the short term, definitely we can see some sort of a pressure in the stock price, but it is a good long-term bet to hold upon. So right now, just stay invested in the counter of Ircon International.
All right. And Somil, what's your view on Ircon?
Yeah, at this point of time, view is negative. I'll be expecting this downtrend to continue. It's been in the downtrend for a little while now. We've seen a bounce here and there, but I don't see any respite here. I'll be expecting the targets of around 115 to 110 levels for the stock. However, in the long run, I think that will be a very good buying opportunity around 110 or 115 levels. So if you're a long-term investor, hold on to it. You may see a little bit of pain in the short term, but overall structure is still positive.
All right. The next query is coming in from Santosh Vasisht, who writes to us from Bihar. He wants to know at what price can he invest in Paytm for the long term. Asta, if I can come to you, what's your view on Paytm? Should he invest in this stock or maybe look at something else?
So Paytm is like one of the fintech where we have seen a very strong growth now, and it has really seen, a strong growth in the profitability from last few results we can say. So yes, one of the fintech which I believe is a strong candidate right now in that space, and not only they have achieved the strong profitability. In fact, the kind of ecosystem they are working into it, that is the merchant ecosystem, that is also giving a major strength to the company. So I believe that on the basis of the asset light model, on the basis of the strong revenue as well as profitability, this is one of the fintech company which one should invest on. Now the question arises at this point of a time or maybe at a lower level. So my idea here is just wait for some fall to come in, or maybe we are into the result season right now. So just wait for the results to come in and then make any sort of entry into this counter. This is what I recommend. So buy on dips is a strategy which can be applied to Paytm, maybe at around 1150 odd levels.
Okay, buy on dip strategy. Somil, what is your suggestion as well right now for Paytm for the long term?
See, Paytm long term, definitely hold on to it. I'm positive on the stock. It's been in the uptrend on the monthly and quarterly chart, so I'll hold on to it. Crucial supports around 1000 is the support, and another support is around 920. These are long term supports, but I'll hold on to this stock, and I'll be expecting a targets of above probably 1400 levels for Paytm.
Okay, we'll keep an eye out on those levels for Paytm. Let's move on and talk about the next query for today. This is coming in from Visakhapatnam from ESR. He's holding 300 shares of TCS. This is at a price of 1,900 rupees per share. They're holding it since COVID. Now, he couldn't sell it when it was at those 4,500 levels. Wants to know whether should continue to hold or sell. But before we go to TCS now, we're seeing that the Nifty is down 500 points. So just the 23,900 also is broken at one point of time. So watch out for that in the trading session. Bank Nifty also continues to see that decline. IT pack also is down in trade. Bank Nifty is down now 1,300 points approximately in the trading session. So the 23,900 seems like we're breaching that level for the Nifty as well. Mid cap, small cap, all of that also seeing a sharp fall post the commentary from Trump. But talking about the IT pack, which is down 1.3%, and in that we have TCS. What's the view coming in on this one, Asta? They're holding it since COVID. Should they continue to hold it or sell the stock now, given this volatility, given the concerns coming in around the IT pack as well? And obviously you have the earnings now for TCS, which will be coming out.
Yes, so I think TCS is one of the stock in the IT space where one should remain invested in, although we really need to see how the results going to be. But what we have seen in the prior result is that first of all, now their AI generated revenues start exceeding US dollar 2.3 billion. So that is one of the factor. In fact, this is one of the company which has shown very strong growth in their revenue and the profitability. And we all know due to low capex, these IT industries are still on a very strong side of their balance sheet because of the no debt, etc., and continuously dividend paying as well as share buyback. So I know that right now the environment for IT industry is not very optimistic at this moment of the time, but getting out from the stock at this moment of time does not make any sense. So at least wait for the results to come in, or just invest or remain invested in this counter.
Remain investors is what you're saying. Somil, what's your view? I mean, concerns around the AI play, volatility has been big in the IT pack. Do you think he should stay invested in TCS at the rate that he bought it at, which was 1,900 rupees?
Yeah, I've been negative on IT for a little while now, I'm still negative in the short term, medium term, long term, all three time frames. But TCS has already had a very sharp correction since the highs were around 4,500 levels, and now it is 2,000. So almost 60% retracement is already done. So I don't think so this is the right time to sell now. You hold on to it. I'll be expecting a very good bounce from here very soon. Probably around 1940 is the target I'm expecting on the downside in the short to medium term. That will be a very crucial support for the TCS. So I'll hold on to the stock. or probably you can, exit probably after a bounce.
Okay. That's a view coming in there for TCS. But on that note, we're going to slip into a very short break. After the break, we'll come back with more of your stock-related queries, more on the markets. Stay tuned in. Welcome back to your stocks on CNBC TV 18. A quick check in terms of the markets again. We're seeing a smidge of a recovery coming in, but still from the day's highest point, we're down 385 points for the markets. That's for the Nifty and even for the Sensex. We are sharply lower in trade markets trying to make that bit of a comeback, but it's just barely any few points, 1,200 points down for the Sensex. Brent crude, that has jumped up sharply as well. 78.44 is what the Brent crude oil prices are currently at, given the commentary that's come in and obviously the uncertainty now that comes in over the Strait of Hormuz. We already saw overnight also a lot of issues and actions happening over there, and that is a concern that comes in, and Brent crude oil prices also have jumped up. Nifty near the day's lowest point still. But let's keep it going with all your stock-related queries. We still have with us Asta Jain as well as Somal Mehta. And moving on to the next query for today, we have Ashish Kotian, who is calling us on the phone line. He's calling from Ahmedabad, and his question is on Quality Power. Ashish, good afternoon. Thank you so much for calling us on CNBC TV 18. Please take us through your query.
So good afternoon, everybody. I've got 40 shares of Quality Power equipment I got 2 months ago for 1,250 rupees. So my holding period is about, I would say, 6 months to a year. Okay. So I want to know, should I add or hold or sell?
Okay, point taken there, Ashish. Quality Power Equipment's one of those cap good side companies that come in here. Asta, Ashish has bought this 2 months back at around 1,250. Currently, they're making a loss on this one. The holding time period is also 6 to 1 year, right? So it's just a short term type of a query. What is your view on this one? Can they add at these levels more? Should they look at averaging it right now?
So Quality Power, basically, they are like, they are not EPC contractors. And we should say like it is not into pure cable manufacturing because they manufacture high voltage power equipment. So I should say it is basically a very technology intensive business which this company is running into. And that makes it a niche business as well. So I believe that first of all, the main factor behind a hold for this counter is that first of all, they are into the niche business. Secondly, what I believe, the kind of macro environment we are into, and the push of the Indian government for the power sector definitely make it a very strong beneficiary. And in fact, they export also, and they have got a very strong export business along with the kind of product portfolio which this company is enjoying, as I've already told you. So I believe that this is one of the counter we should recommend a hold, and I recommend hold for this counter, and one should remain invested in this counter for the short term horizon as well. So right now, just continue with your holding for this counter in the short term.
All right, continue holding in the short term is what you're saying. Somil, Quality Power Equipments, do you think he should continue to hold? What's your view on the stock? Any targets to watch out for?
If you're targeting only short term, then I would definitely book some profits or exit at this point of time, because it's in a downtrend in the very short term. Long term, yes, it is still in the structure is all right. But in the very short term, I'll be expecting the stock to go down till at least 950. So that would be my target. So you can book some profits or you just exit the stock.
All right. Somil and Astha, thank you so much for taking time out and being here with us on your stocks and answering all of our viewer queries. And the markets continue to fall. The Nifty now below 23,900 as we speak. The Nifty Bank also 2.3% in the red. And the mid-cap index also 1.6% in the red. But with that, it's a wrap on this edition of Your Stocks. But do remember to email us your queries and we will address them with our experts. But stay tuned for Closing Bell to take you through the last hour of trade.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The Asian markets are trading under pressure this morning, and the epicenter is once again the chip trade.
Have begun a series of powerful strikes against Iran.
Oils, by the way, jumped 5% overnight.
India is not on the inside of this AI race.
Which is the first support, as we put out in the morning, 24,255.
The power has been on fire and will be for the next at least 5 to 10 years.
The Nifty IT index extended its underperformance.
We are back above $76 a barrel.
The Nifty down about 100 points, though from the lows we've seen some recovery.
This is a licensing and supply agreement with Pharma
announced a capex. The capex is to set up a greenfield manufacturing facility.
Target price of 320 rupees, which is nearly a 32% upside.
Well, continues to be a down day. There's no recovery that we've seen so far.
Well, that is the day so far. It's all flipped. It's all changed, especially in the last 1 hour or so since the headlines from President Trump came. There was, of course, fighting, but to a limited degree. Markets were down 150 odd points. But look at the Nifty now. I think it's a 500-point decline, which is coming through. And I think we should be at the day's lowest point. 23,000, under 23,900 is where we are at on your screen. VIX has jumped, of course. Oil's at 78. This morning we woke up to 76. It's moved up $2.50 from there. And, dollar rupee is moved up about, from the opening levels, dollar rupee is up another 40 odd paise or so. So lots to discuss here. We're coming to you from the CNBC TV 18 Motilal Oswal studios. With me, my colleagues Rima and Nigel. Guys, hi.
Hi, and just for those who missed it, the big headline coming in from Donald Trump is the memorandum of understanding with Iran is over. He says, I don't want to deal with Iran. He said the MOU is dead. And that's the reason why even crude prices have surged quite a bit. Yesterday, we were at 72, almost 72. This morning, when we woke up, we were hovering close to 76, and now it's 78.5. So that flare up in crude prices continues, and that's what's hurting. And the sell-off has been so rapid. How quickly things change, right? It was only on the 22nd of June that the MOU had signed, and things were going fine. Even for our own markets, there was a recovery in the last 1 week or so, and that's turned on a dime.
Will it turn again later this evening?
That's the thing, right? It's if you remember, we were all 2 steps forward, 1 step back, then 3 steps forward, 2 steps back. But it's always been, even in the worst of times, maybe in the early days of early March and middle of March, etc., when it looked absolutely uncertain. But when you got to a bit of a standoffish phase, which is both sides knew what the stakes were, but nobody could pull back. And then we finally got this MOU and both sides kind of accommodated each other a little bit more. Unless this entire thing blows up once again, I think, it's kind of hard to sort of throw this piece away in that sense. So, President Trump speaks every day, pretty much every day, right? So is it possible he says something different later today? It's possible. This was, of course, a speech, and we'll play out. Why don't we play out, actually, President Trump's comments first, and then we'll discuss more.
I think it's over. I don't want to deal with them anymore. They're scum. You know what scum is? They're scum. They're sick people. They're led by sick people. And they're vicious, violent people. And if they had a nuclear weapon, they'd use it. As far as I'm concerned, it's over. I'll speak to our negotiators. They want to negotiate. They're good people. Steve Witkoff, Jared Kushner, but they have to come back to me. As far as I'm concerned, it's just a waste of time dealing with them. They're liars. We make a deal, and if I make a deal with him, we have a deal, and he goes out, he talks. We make a deal. Everyone's agreed. No nuclear weapon. We make a deal. They go outside, talk to the press. They say, we never even talked about it. There's something wrong with them. They're cuckoo. As far as I'm concerned, it's over. I don't care. They can talk. But I think they're wasting their time. They're a bunch of lying guys. I do my whole life. That's all I do is deals.
Well, that is, President Trump in his inimitable style, basically saying, well, it's over. Pramit Pal Chaudhary is with us. He's India Practice Head, Eurasia Group. Okay, I think Pramit should be with us in just a quick bit, but maybe just get the technicals out of the way. Mitesh is with us. Mitesh, is just turned just like that, 500 down. What do you do?
Morning, Prashant. Good afternoon. If in the morning somebody would have told me to be 500 down, I would have definitely bet against it because I was not hoping the market will break down this strongly. But any which way, I think getting below 24 to 5200 zone was itself a negative marker, and we did significantly reduce our long exposure while built up some on the short side. I think the next level which the Nifty should look at is around 23 800 750 zone, and then 23 650 is the final support. So I think these are the two levels which the market can go up to. But the bigger worry is that the fall today is slightly on the severe side, which has kind of plunged most of the 2-hour, 3-hour, 4-hour charts on the negative side, which means that we are quite likely to head towards 23 650, and therefore there might be some more pain left. In case we start breaking below 23 650, then I think we'll look at even further lower targets. But that's the time for that. That's the target which I'm looking at for the time being. And on the stock side, I have two sell calls. HPCL is a sell with a stop at 392.5 for a target of 373. And KFIT Tech is a sell with a stop at 861 for targets of 800.
And for the Nifty, you're saying 23,800 is it's acted as a support many times in the past. You're saying that's important.
That's right.
Yeah. Okay, I got it. I think Mitesh, we'll come back to you. Let's just get just some perspective around this latest escalation. Pramit Pal Chaudhary of Eurasia Group is now with us. We can go across to him. Pramit, good to have you with us here. What do you make of the comments from President Trump?
Well, look, you had an MOU, Memorandum of Understanding, which was the basis of the last ceasefire, which was extraordinarily, should we say, vague about a lot of the details. I mean, compared to normal international diplomacy, it was really sort of a throw-together piece. And what you're now going to be seeing, or you have been seeing, is in effect both sides trying to say that this is what this paragraph of vaguely worded statement means. And if we are ready, we're prepared to fight over this. So you can see one precipitating point immediately was South Lebanon, because it was not very clear in that MOU as to what was the link between what Israel did in Lebanon and what was happening in the Gulf. But we're also seeing Iran, I think, push the envelope as hard as they can, that when it comes to the Straits of Hormuz, there will be nobody except Iran in power. And I think they've been emboldened by the fact that a lot of the Arab states in that region have kind of come to the same point of view. So a clash at some point, I think, was going to be inevitable on a number of points. The nature of those this clash or others was harder to predict. But I'm not at all surprised that, if you wish, the negotiated settlement that should have been done by diplomats is effectively now being done through military means.
We discussed this, that this is going to stay, not stay, and it perhaps will not be a clear road. There will be bumps. And is this a bump, you think, or this is over now? This is a collapse? How do you read it? Because your earlier view was that the core of it perhaps will stay, the core of the agreement, the MOU.
Yeah, I think that still is the case. I think while Trump has declared this agreement dead on arrival about 20 times, even during negotiations, and then next day said, "Oh, I'm back into the picture." So I think we'll see Qatar in particular get back into the negotiating stance and say, "Look, where do you want to go with this?" Because fundamentally, yes, the core of the agreement remains the same, which is that America is not prepared to wield its military power to force the Hormuz to stay open. It is not prepared. On the other hand, Iran has to start to recognize there's a limit to how far they can expect anything to happen. Israel will not listen to anybody on what happens in Lebanon. So therefore, at some point, you're going to see negotiations begin again. But in each case, I think the overall trend will be Iran getting more and more powerful in terms of its influence over the Hormuz. But I'm not too sure there's going to be any shift on Israel's policy in Lebanon.
So you're saying the core position of the US remains the same, that it's not prepared to use military force to reopen the Strait of Hormuz, right?
Correct. I mean, it's not prepared to sit down and force to have the Carter Doctrine enforced, which would mean that, yes, the Straits of Hormuz and the Persian Gulf would effectively once more become an American lake. America's simply not prepared to do that kind of work.
Yeah. What led to the? Why were the? I think there was a grace period, right? I mean, we don't. There are different versions of it. Apparently, the Strait of Hormuz was under Iranian control, but I think the ships could pass without any fee, toll, whatever you want to call it, for a period, and then perhaps they would start. From what I remember, is that correct, Pramit? So are we?
Yeah, there was a 30-day. There were a couple of different grace periods: 30-day, 60-day. But what Iran did is that certain countries, 6 friendly countries, including India, would be exempted altogether from paying dues, could go back and forth, which was why we got a lot of shipments through. But I think importantly for Iran is that they got a lot of their shipments through. Almost all the Iranian floating reserve passed through Hormuz. However, at this point, they discovered that nobody was prepared to buy it, because America had not lifted the sanctions on those purchases. Not even China was prepared to buy. So they saw that as an act of bad faith. And then we started to see the shift, the Oman route opening up. And then you had the problem in Lebanon. So when you started to combine this together, I think Iran at this point said, okay, we're going to have to go back to the hard negotiating table, which means we've got to start shooting at some ships.
Pramit, sorry, I thought US was to lift.
Sorry, go ahead.
No, I thought US was to lift the sanctions on Iranian exports of, Iranian oil sales. This was agreed. This was a part of, I think, 21st of June or 22nd of June. You're saying that didn't take place. And that is what triggered the attack by the Iranians on the 3 commercial ships yesterday?
I'd say it's a combination of factors, but one of them was this, that, look, wait a minute, we've just got our ships through and nothing has happened. I mean, nothing has changed on the outside. People are not buying our oil. It's just floating around there because everybody is trying to get a definite clearance from the U.S. Treasury. Can we buy this oil? And the U.S. Treasury simply wasn't giving that. It may partly because of internal confusion in the United States itself. Many years ago, I was talking to a senior American diplomat who used to handle sanctions in North Korea. And he told me, he said, imposing sanctions is easy. Unimposing sanctions is incredibly difficult. So I think there may be a bit of that as well. But I would say the path from here is, again, a set of negotiations with Iran saying, look, you've got to unsanction our oil immediately. Maybe some minor concessions by the Israelis, at least a pause on their attacks for a while, after which then perhaps you can go back to another kind of a ceasefire. But as I said, a lot of this, in my view, is fundamentally a consequence of the fact that the heavy lifting of really detailed negotiation was never done. I mean, this is why diplomats exist, and this is why diplomats spend so much time sitting there at a table going through, it's literally like a lawyer, going through all the possible options and saying, are you okay with this? Then we're okay with this, and let's put it down in writing.
Yeah. Got it. There was Kepler data, shipping data, which showed that as of this, before all of this started, ship traffic through the Strait of Hormuz was back to about 75% of pre-war levels.
Correct.
Right. So ships were passing through, right? I mean,
Yes. But a lot of them were Iranian ships or carrying Iranian cargoes. But yes, Qatar, you notice Qatar, Kuwait, everybody began loading ships and beginning production under the belief that this was now good. And also empty ships are going in the other direction, so you could refill the cargoes. But then the Iranians went through and they said, hey, nobody's buying our oil. This indicates to us this deal is not done. Then you're still having fighting in Lebanon. Combine that with, should we say, the emotional charge of Ayatollah Khamenei's funeral, where the anti-American sentiment really boils over. You end up with a situation where Iran says, okay, we're going to go back. We're going to go back and start playing dirty again.
Okay. I see. So you're saying that the Iranian ships were passing through the strait, but there was no buyer on the other end. That was essentially a problem. So in a way, Iran felt betrayed.
Because the sanctions had not been, sanctions had not been lifted. I mean, what is the point of the Hormuz being open if I can't sell anything on the other side?
And you're saying it might well be a technicality.
It could be technicality. What tends to happen, and I've actually been at a table watching American diplomats trying to undo a sanction, is that you end up there's a network of banks, corresponding banks, insurance companies, shipping companies involved in every single shipment that goes through. Each of them have a lawyer, legal department, or compliance department that wants to get a assurance from the U.S. Treasury or at a very high level in the US system, that if we are involved in buying this oil, we will not be sanctioned, because that would be extraordinarily destructive to the company involved. And then you have to go piecemeal by piecemeal, keep sending these assurances. So the North Korean case that I was mentioning, a bank in Macau had handled North Korean money, got sanctioned when the North Koreans and the Americans negotiated a deal which was going to be unsanctioned. Not just the Bank of Macau, banks in Hong Kong, shipping companies banks. I remember one point, even the central bank governor of Russia ringing up US Treasury and saying, am I allowed to give me a personal assurance that this is all right? And they said, well, we've already issued a public statement, it's lifted. He says, no, we want a specific letter to the Central Bank of Russia saying that the sanction has been lifted and we will have no legal problem. So each and every step of the way, you end up with a personal time. So it wouldn't surprise me to find out that that's also a problem, especially given how chaotic the Trump administration is about these type of things.
Do you see this getting resolved? That the sanctions are actually being lifted, not just on paper, as you said, right? Every country wanted that assurance. They went to the Treasury Department in the US. They wanted that letter to show that they're actually allowed to pass through. Specific companies were. Do you see this problem getting resolved? Or, I mean, how does this play out from here on?
I think for the original, America is not prepared to use its military power, even though it is powerful enough to do so, to reestablish its dominance of the Straits of Hormuz. The Iranians see themselves in a position of victory. They don't want to lose what they've accomplished so far. The Arab states in the Gulf have effectively acceded that Iran will be the dominant power. Reports are clear that they're starting to pay, if you wish, protection money to the Iranians. And Trump really wants to get out of this war. This is not a war that's gone well for him. He doesn't want higher pump prices in the United States as he's heading into a very difficult midterm election. So the basic drivers and motives that brought the original ceasefire together remain in place. However, the details, which were never worked out, are now going to have to be worked out on the run, on the fly, if you wish, with intermittent bursts of fighting, because that seems to be the only way to get your case through.
Pramit, so you're saying the ships which passed through the Strait of Hormuz since the fragile ceasefire has been in place were mostly Iranian ships floating around in the water, some friendly nations like India. Is there any data to show, to tell, or even otherwise to spell that there weren't, I mean, what about the ships from other countries, right? The neutral countries, not so friendly. Were there some?
Yeah. Saudi Arabia, I think, got quite a few ships through. I think Qatar even got some early on, got some LNG ships through. So there were a fair number of countries that did get their ships through. But the bulk of them, if I remember correctly, were carrying Iranian cargoes.
Well, it's a fast-changing situation. But how do you expect, I don't know if you have a view, financial markets to respond? But when this was going on, it would be one thing, markets would sell off, and then they would rally ferociously back up only to sell off again. We went back and forth multiple times over. You think it's that kind of a state back once again?
I think I don't really have a view on this, but I think my instinct would be that the markets will take a slightly long-term view, which is that there seems to be a lot of oil in the world. You can see oil prices were heading for really low points. We were seeing a lot of countries, including Saudi Arabia, saying we're going to start to produce like crazy to get back our money, and say that this is just a blip. And given Trump's record, taco or otherwise, of pulling back from his original threats really reasonably quickly, and as I said, a sense most partners that this is none of the players here really want to get into a fight. I would see oil prices rising a little bit, but not very much, not as much as you would expect if everybody was expecting or believes that there's a complete breakdown of the ceasefire.
Yeah, Pramit, great perspective and very useful contextually. Thank you very much for joining us on short notice. Appreciate your time here on CNBC TV 18. Okay, well, that's the view from an expert, and his view is that markets may take, and he's not a market expert, he's a geopolitical expert. His view is there's enough, which everyone knows, there's enough oil in the world. Existing producers want to pump a lot more to make up for all the lost profits on oil they couldn't sell because they couldn't get through the oil through the Strait of Hormuz. So maybe today's sharp rally aside, markets may decide to take that view that there's a lot of oil, and unless this completely blows up and there's actual blockade and such, this is a blip more than like a complete collapse of all of it. Well, that's the view. 78.5 right now, 79. Almost, I think we hit 79. We're about 78, 78 at this point in time. We'll take a quick commercial break here. We'll come back and we'll focus on markets on the other side. Stay tuned.
Welcome back. US President's Iran warning has spurred a steep impact across asset classes. Hormus is here joining in to put the declines into perspective. Hormus.
You know how things change in a matter of minutes, right? We were lower today, yes, but the recovery was the dips were being bought into. But then comes one statement from Donald Trump, and this is the impact that you see. 600 points down on the index, on the Sensex, almost 1800 points on the Sensex, 600 on the Nifty. And this one line from Donald Trump is what triggered this. I think the MOU with Iran is over. Of course, he said a lot of other things, but this is the one that the market is reacting to the most. And look at, in just a matter of minutes, 10 lakh crore worth of investor wealth has been wiped out in today's trading session. From a 100-odd point fall on the Nifty, we are now down 600 points. And the broader markets too, which were recovering from the lows of the day, are now back to the lows of the day as well. And the next slide will tell you why. There's 47 stocks on the Nifty trading with losses. 96 stocks on the small cap index are trading with losses, with 86 on the mid cap index and 460 of them on the Nifty 500 trading with losses as we speak. 3 indices where every single constituent is also trading with losses. The Nifty Bank, the Nifty FMCG index and the PSU Bank index. 14 on the Nifty Bank, 15 on the FMCG index and 12 on the PSU Bank index. All of them trading with losses. And for most of the other indices as well, you would only find a gainer or two, not more. And look at the India VIX as well. This 30% jump in the India VIX, all of which has come around about close to 2 p.m. and thereafter. Back above the levels of 15 is India VIX, 30% higher, the biggest single day jump since April, when the VIX had gone up over 60%. Not only India, the impact has been felt across the globe. The Dow futures are now down 700 points as we speak. The S&P 500, the Nasdaq futures as well. Look at the oil prices. They were slightly higher this morning, 2.5%, but after those remarks, a 6% up move on Brent. Similar quantum on the NYMEX, nearing 75. Brent is nearing 80. The dollar index, which was already stronger, continues to remain so. Above the levels of 101 is where the dollar index is. No significant move so far, but the currency has moved to the lows of the day. The rupee, in comparison to the dollar, 95.60 now is where the currency stands. And the move has had an impact on other asset classes as well. Silver, gold, platinum, all of these prices too, where seeing some recovery in the initial days of the month, are now back down to the losing end.
Okay, all right. Thanks a lot, Hormus, for that. Well, let's do a quick check on the F&O market then, because a lot has changed in a matter of the last 60 minutes or so. I think we should just get a split screen up for our viewers on the screen. You'll see the way the VIX spiked up, as Mr. Trump said that the talks are off. And you have the Nifty that's moved to the low point of the day. So that split screen comes up for you on the screen. That really tells you the story of the day. The Nifty was doing pretty okay. Fell off the cliff. India VIX Volatility Index spikes up close to around 30%. I'll tell you what, at around 15 odd, it's still digestible from a bullish perspective, though the fall has been very, very sharp. You don't want it to move up above the 20 odd mark. The other trigger you'll be looking at is the PCR, because the PCR, remember, now you have the call writers that have come back into play. And in a matter of minutes, the PCR fell from around 1.1 to around 0.8. Actually, in the last few minutes, it's moved even a little bit lower than that. It's moved to around 0.77. The screens tell you 0.79, but the call writers basically are back in the game. The 24,200 call, pull up that strike out there. Premium down to around 70 bucks, 65 rupees now. It started the day at around 255 rupees. The 23,300 call, the premium is down sub 50 rupees approximately. I think we need to refresh that plate. That's come down drastically. At the start of the day, it was close to around 187 or thereabouts. And on the put side, the 23,600 put. Just take a look at that. Those put buyers are having a blast. Yesterday, maybe some out of the money put buying, in case things go wrong, you're buying some protection on the downside. Yesterday, the premium was 5 bucks. Now it is 100 rupees. So that's a 20x return you're making. If you had some out of the money put buying, if you fear that something was going to go wrong, then you've been dancing away to the bank. So those put buyers will be very, very happy. Just pull up the 50 DMA, because in this fall, we have taken out very, very close averages. Now, whether you're looking at the 20 DMA, that's got taken out a little bit, but now we're at a crucial juncture, because that's where the 50 DMA is at. And you don't want this vicinity of from 23,750 to 23,800 to break on the downside. It's going to be important whether we have heard the last of Mr. Trump just for the day, or whether we see some kind of post later in the evening. That's going to be what the bulls will hope for, some kind of clarification that things are not as bad as it seems as of now. For the time being, one set of traders, they're going in there and just selling out, and that's why we're seeing this drop. Take a look at a few stocks. Jio Financial, we are seeing some fresh shorting out there. but there could be potential beneficiaries as well. If there is an escalation of tensions, then aluminium sector, you have seen it do pretty well. Nalco's seen a bit of a short covering bounce in today's trading session, though overnight aluminium prices were weak. So keep an eye out on that. There were a lot of shorts that got into the system from 450 to 350. There's a bit of a covering that we're seeing out there. And Premier Energies is another one as well that we're seeing some kind of short covering in today's trading sessions. The short point is we're very, very close to the support levels. The bulls will at least want to end a little above these levels, because at around the 50 DMA, you don't want to break that decisively. Well, I think we have Mitesh Thakur who's back with us. Mitesh, want to fill us in with a couple of calls? The last time we spoke, the markets actually have trended a little bit lower. So crucial support zone both on the Nifty as well as the Nifty Bank. Fresh trade on those indices and individual stock calls.
I think, as I said, the biggest damage was seen on the 3-4 hour chart, and there were breakdowns, and we are now at 23,800, 750, the next support area. There's a good chance that we might even head towards 23,650. There's a scenario when, news flow will definitely rule the short-term movement. It's difficult to guess which way it will go. But as I said, looking at the intraday chart, I think the chances of us possibly heading towards 23,650 are strong. And if we break that, then even lower levels can be tested.
Stocks, Mitesh?
On the stock side, a couple of sell calls can be possibly added, and ABB is one of them. It's breaking below its short-term 10-20 day averages. So keep a stop above 6,800. Look for targets of around 6,650. And the other one is IT is holding out well, but I'm not sure whether I want to take a buy. But if somebody wants to take a buy, I think Infosys is something which could be slightly better. Keep a stop below 1,042, 43 here, and for a target of 1,100.
Thank you very much for that. We will slip into a break. On the other side, Rahul Singh of Tata Asset Management will join in.
Okay, it's a 500-point cut, although, you've gotten close to it being a 600-point cut, and then there's been a bit of a bounce, which has appeared, but, it's pretty stark. Starting at about 147, essentially, is when the market just started falling one way. We were at 24,200 at 1:47 p.m. So 24,200, and we're at about 23,900 now. So it's a 300-point sell-off from that level. Rahul Singh is CIO Equities at Tata Asset Management. He's with us. Rahul, we stopped talking about this Iran-US thing some time back, and thankfully so. Oil prices sold off aggressively in response to it, to the MOU, and now there's a bit of a jitter here. We spoke with somebody from Eurasia Group, and they're experts at this, and the person we spoke to, his view, Pramit Pal Chaudhary, his view was there's enough oil in the world. Nobody's got the stomach to get into a fight once again, so should settle down. I'm paraphrasing him. That seems to be the view. For markets, Rahul, we're also speaking after a while. What's your perspective?
Yes, I think it's difficult to predict what's the end game in all this. But what I think we have learned over the last 3 odd months is that we are better served holding our nerves rather than reacting to every news. We know that by now, and that's what I think the investors should be doing. My sense of the markets, otherwise, irrespective of this, is that we are looking at some kind of a pickup in credit growth. We are seeing activity on certain parts of the investment cycle quite robust. We are seeing the commodity cycle after having come down a little bit from the peaks, still holding strong. We are seeing some pockets of consumption showing real signs of recovery. Monsoons remain a watch point, but I think overall we have a low base in consumption, so that kind of will help support some of the consumption growth next year. So all in all, if you put all these things together and look at the earnings growth rate, we may not get to 17-18% kind of earnings growth rate for Nifty 50 this year, fiscal year, but 15% kind of looks within reach. And I think that's how the markets will get dictated. The other point which I think is relevant for India relative to other markets is that this year, I think the growth differential between India, even though India might grow at 12-15% in terms of earnings, the growth differential between Indian earnings growth rate and what we are seeing in the other emerging markets is still high. And I think that will get narrowed down, or that growth differential with other emerging markets, India will be able to narrow only next year. So till that time, I think it will be a kind of a grinding upwards kind of a market till we form a proper base and start looking more attractive compared to the other markets.
All right. Hi, Rahul. Good afternoon. Good to see you in. So are you constructive at this point of time on the markets? Or do you believe, as you're saying, earnings growth is going to be a little bit lower? We're still in the dark with regard to what's going on in the geopolitical issue. And we've got this monsoon headwind as well. So what would your view at current reckoning?
Yeah, I mean, instead of a one-word answer whether we are constructive or not, I think the way to manage this situation is to have a healthy, balanced portfolio. So look at the areas where we are seeing earnings revival or potential triggers for earnings revival, which could be BFSI, but also balance it because there are cyclical risks in sectors like BFSI. A lot of things are linked to the economy. You balance it with sectors which are more secular or less influenced by these external factors like crude prices or geopolitics like healthcare. In addition to that, we have to keep an eye on the long-term emerging themes of manufacturing, defense, and energy security, which I think will be, when the dust settles down, these are the 2-3 themes which are going to be very, very extremely important, and therefore keep some space in the portfolios for these 2 or 3 emerging kind of themes which could last for next 3 to 5 years. So I think that's the way to be constructive on the markets, rather than making a generic statement on whether we are constructive or not. I think we have to balance the risks. We have to manage in the situation we are given in. We have to, and therefore that can only be managed by building this kind of portfolio which I just mentioned.
Okay, got it. Talking about making space, we have got some juicy IPOs that are lined up in the second half of this calendar year. You have SBI Fund that will be coming off, in the next couple of days or so. The issue should open in the next few days. Then you have Jio, which the street has been waiting for, and NSE as well. So there'll be some kind of this liquidity that's available with domestic participants that gets sucked out. Or do you believe there'll be enough appetite even from the FIs that actually that doesn't happen? How would you view this, a bit of an overhang with regard to the upcoming IPOs?
Well, I think as long as the IPOs are of good quality, large cap companies, marquee names, we should welcome them. We should not worry about them sucking out liquidity. I would look at it the other way, that instead of that liquidity creating excess in terms of valuation in certain pockets, which already is not very cheap, although not as expensive as it was in 2024, but instead of creating those excesses, it is better that this liquidity goes to some of these high quality companies, IPOs or placements, whatever you want to call it. And that, I think, is a further stabilizer to the valuations and to the ultimate recovery in the markets in the next 2 to 3 years.
Rahul, it's a interesting time, and hopefully, this is a blip with regards to these headlines, etc. And markets have also wisened up, as you said, over the last 3 months, 4 months when this was going on, and this doesn't derail. Because we started this year in a way where saying things were all falling into place. I remember credit growth was picking up, and then of course, late Feb, all this happened. Now, as we start the second half of this calendar year, the expectation has been that mid and small caps have done so well. Now, large caps perhaps should start to, participate. That's the situation. Thank you very much for joining in. Good speaking with you, and it's always a pleasure getting that perspective from you. Well, let's just look at what foreigners have been doing, right? And we are, by the way, they have been buying, and it's a marked change compared to. And I think we are putting this data out because of the quantum of selling that we saw, because it's such a huge number, and then of course to go the other way, I think it's deserving of just sort of some spotlighting here. Yusuf has got the data. Yusuf, take it away.
After offloading 12 billion worth of financial stocks between January and May, foreign portfolio investors have turned net buyers in the second half of June, purchasing about 1.5 billion worth of financial shares, signaling a shift in sentiment. Financials remains FPI's largest sectoral exposure, accounting for more than 30% of their Indian equity holding. Capital goods and healthcare together make up another 15% of foreign investors' portfolio. Besides financials, FPIs also bought 300 to 400 million worth of shares in constructions and consumer services during the second half of June. On the other hand, they sold 460 million worth of metals and minings and around 400 million worth of power shares during the second half of June. Interestingly, while the late month buying spree helped narrow overall outflows, it was not enough to offset heavy selling earlier in the month. Unlike February, when they bought 900 million worth of financial stocks, turned overall monthly flows into positive, June still ended with FPIs remaining a net sellers of 5.2 billion worth of shares. At the end of June, FPIs held around 726 billion worth of Indian equities, accounting for nearly 14% of India's equity market.
Okay, thank you very much for that. It just takes me back to the conversation that we have with Timothy Moore of Goldman Sachs. And he actually highlighted that in the first half of the year, the Korean markets have seen $100 billion of FIs selling in June alone. I think the number was close to about $30 billion. It's not because brokerages or market has a negative view on Kospi per se. He was just saying it was forced rebalancing because the weight of Kospi on account of it having gone up so much exceeded the risk weightage. So therefore, there was forced selling. But, there is that market which has seen so much of FI selling, $100 billion, but yet, even after the volatility, it's still up 70-80% on a year-to-date basis. And then there is India on the other hand. But today, by the way, Europe across the board is down quite a bit. So India is falling in tandem with the cuts, the risk-off seen across the global markets. Frontline European indices are down close to about 2%. And even the Dow futures or the S&P futures, the last time I checked, were down nearly 1% or more. Dow down close to about 650 points. We can get that if we could. But let's talk about IT because TCS reports numbers tomorrow market hours. We had a chat with Sumit Jain of CLSA, and his basic call on the sector is that stocks are trading below their intrinsic value. So over the medium term, he does see the situation improve for the sector. Listen in.
In the near term, we do believe that the deflation argument or the narrative will be stronger than the volume opportunity. We are still not getting any valid data points which flag that IT service budgets are shrinking with the Fortune 500 or G2000 enterprises. Yes, the deflation to the base business of IT companies will hit for the next 2 to 3 years as and when the large deals come up for renewal. But mind you, in every deal, the scope of volumes are also increasing. So I failed to mention, but TCS and Tech Mahindra continue to maintain the stance that the volume opportunity is higher than deflation in the AI world. I think this quarter is going to be weak. Accenture laid out the lay of the land by cutting down their guidance by 50 bips. And in this currently negative narrative for IT services sector globally, any guidance cut will further fuel the narrative of deflation being very strong. Tech Mahindra stands out clearly in the large cap IT space where they have two large telecom deals which will ramp up, one in this quarter and one in next quarter. And that's why we see Tech Mahindra's growth to be relatively higher than rest of the large cap names. Whenever a technology disruption happens, the mid-tier operators are always a bigger beneficiary because they can disrupt their business model much more easily and shift towards the new age solutions. And that's what we are seeing with both Coforge and Persistent.
Okay, interesting call there on on tech. Sumit sounding a little bit optimistic actually on prospects with his top picks. By the way, from the broader markets, it seems Cupid has suddenly lost its protection a little bit. The stock I think was at around 215, 220, and suddenly there seems there's a bit of a slip out there. So we'll keep an eye out on that one, falling on rather large volumes, 220 rupees to around 185 rupees. Sharp downtick on that one. Protection getting broken out there. So just keep an eye out on that particular stock. Just spotted it from the broader markets. Sudeep Bandyopadhyay though joins us to talk about what he likes in this sort of a market. Hi Sudeep, unfortunately Mr. Trump has derailed the plans. It seemed the Nifty was chugging on quite well, but I think what some of the bulls will be hoping is there is some clarification that comes in. It's not as bad as what he said, say 2 hours ago. And that's why we've seen a bit of a recovery from the day's low. But the fall is very, very sharp. These falls sometimes give some opportunities. What would you look to buy if you had to give us two ideas?
Good afternoon, Nigel. I think you're absolutely right. I won't be surprised before the end of the day, Mr. Trump comes with some other statement which kind of reassures the market that the deal is on. I mean, we have been now used to this kind of flip-flops from the current US administration. Mr. Trump doesn't have too much of choice but to kind of forge some kind of a deal before the midterms. So I would bet on the side of things settling down sooner than later. And as far as the opportunity is concerned, I definitely consider these good buying opportunities. Of course, don't rush into buying whenever there's a dip. But these kind of dips definitely gives some opportunity for buying into quality stocks where the depreciation because of these kind of statements has been sharp.
Okay. Hi, Sudeep. You want to tell us any stock ideas that you would have bought today because of the correction seen, or any stocks on your watch list?
Well, I've been buying, recommending buying Larsen Toubro since the West Asia crisis started. And I think, every dip L&T should be accumulated. I now do like ICICI Bank as well. And I think, every dip, again, is a good opportunity for accumulating ICICI Bank. Definitely, there is a, valuation comfort in ICICI Bank. And the chance of it going up is significantly higher than it coming down. If I have to expand the universe, probably I will look at some of the defense names where, again, I think valuation has started becoming a little bit more reasonable compared to what it was earlier. So a BEL may be worth buying, taking the benefit of this correction.
Okay, ICICI Bank and BEL, these are some stocks that he's looking at in the correction.
Got it. Sudeep, you'll be looking for opportunities, in this sort of market when you see stocks that fall off and some of them fall very, very sharply. We have seen that kitchen appliances suddenly is getting a lot of focus. And there is a report that suggests that I think the demand this year will be up by more than 50% in comparison to last year. And this is not just the induction cooktops. What is your view on this space? I think we've discussed this in the past, TTK Prestige, Stovecraft, Hawkins as well. I think Butterfly, Gandhimati as well, it's still listed. What is your pick from the pack?
Well, I think we did discuss this, and I mentioned Stovecraft has been our pick for some time. It hasn't really rewarded the shareholders for quite some time, but I think the time for Stovecraft has come. Induction cooked up a sudden surge in demand was the inflection point, and I think things have started moving in the right direction. Amongst the 4-5 listed peers, Stovecraft does look good to me. If I have to pick something else, I will probably go back to the TTK tried and tested one. And I think if I'm buying TTK at current level, it has to be for long term.
Sudeep, stay on. We need to slip into a very short break. As we do that, let's hear our opinion that we got from Gautam Trivedi of Nepean Capital, who says that he's seeing opportunity in data centers, textiles, and the power sector.
I think the opportunity set still remains very strong within the overall data center, AI, semiconductor, and of course, power, which has to power all of this. So without electricity, none of this is going to work. I think the overall ecosystem of all of these is massive. I've spoken to a bunch of exporters here. In fact, we bought one of them as well, in the hope that the FTA with the US and the EU gets signed. And not just signed, but there's an implementation timetable that's announced to the world so that we know when and how the impact's going to come positively on Indian exporters. I believe that we're not too far away from a bottom for a lot of these companies. I don't want to start naming them necessarily, but I think it's a matter of time before you'll see a significant positive impact on their revenues, EBITDA, etc. We are seeing companies top line of 500 crores going to 2,000 crores in the next 2.5 years. And that's only because they're at the right place at the right time. Now, valuations are going to be obviously challenged from a domestic and an external. I mean, forget external FI investors looking at investing in these companies, which are trading at 65 times, 75 times, 1 year forward earnings. If the government has allowed for Chinese companies, there were for German companies or for French companies, that would be a different matter. But for Chinese companies, if they're being allowed to start selling in India, what does that tell you? It tells you that the demand is so strong that the Indian companies themselves don't have the capability to provide and to manufacture in time some of these products.
Welcome back. 7 minutes to go. There has been a smidge of a recovery. The Nifty's climbed back above the 23,900 mark, having dipped below from 3 o'clock. But look at the advanced decline ratio. We've got one stock advancing for 5 stocks declining. More than 2,600 stocks currently in the red. And when I look at the Nifty 50, we've got only 4. 46 of the Nifty 50 stocks are currently in the red. ONGC, Bajaj Auto, Hindalco, Coal India, with ONGC being the only Nifty stock with a gain of more than 1%. It's been a broad-based sell-off across the board. Banks are under pressure. IT is seeing some profit booking. Interglobe Aviation, auto names like Maruti under pressure, along with that Tata Motors, passenger vehicles. FMCG is not spared. ITC has a cut of 2.5%, and Reliance Industries too has been a bit of a drag today. In conversation with Sudeep, any idea on Info Edge? Just in the last couple of days, stocks gotten re-rated. The street liked the job speak index data, then the Q1 business update, 20% up this month.
Well, it's definitely a pleasant surprise. The business update was kind of not on the expected lines, much better than that. There was always a fear that the slowdown in IT will impact InfoEdge's Naukri.com. But I think, other recruitments, particularly in the GCCs and the AI space, is compensating, actually more than compensating for the slowdown, a bit of a slowdown in the IT recruitments. And that was very apparent, and that was a pleasant surprise. I think other verticals are not that big to make any significant difference, but the growth shown by them was really commendable. And that's why the market is excited about this stock.
Okay, look at that Info Edge and the spike in the last 2 or 3 days. Sudeep, what else? What are the conversations that you're having with investors, retail shareholders? When they come to you, what are the pockets of interest?
Well, I think, yesterday itself, we were recommending Kalyan Jewelers. I think it moved up today morning. Yesterday, everybody was comparing it with Titan's growth. And because the growth in Kalyan was a shade lower than Titan, it got punished yesterday in the market. But we are absolutely positive on Kalyan as well. Of course, Titan has been our favorite for quite some time, but Kalyan with its franchise model, which has a significant positive impact on the balance sheet, as well as its expansion into West Asia, as well as northern part of India, where the margins are much higher, is improving the overall margin profile of the business. We are positive. I think the lower end jewelry brand Candor needs to be expanded, and the scope for expansion there is significant. I think things will start looking completely different when the Candor expansion will be underway in a significant manner.
Got it. All right. Sudeep, what about the cement pack? I just resumed today, but from 5th, 6th, I was surprised to hear that the South-based producers, they're trying to push in some price increases. It may not actually be digested by the street, but that intent of even going ahead to push through means they're optimistic about demand, I think so. I was looking at a couple of smaller cement companies. Some of them have grown quite well on volumes. We'll have to see how it is, when finally the Q1 numbers come. But in June, actually, some of them delivered pretty good growth. What is your view on the cement pack?
Oh, absolutely. You're absolutely right. I think the demand has been quite robust and definitely better than expectation. That's what our channel checks tells us. Of course, now the monsoon has set in, so the demand slowdown will happen. And I'm not very sure about the prices going up at this stage. I think, post-monsoon only prices will go up. But demand has been robust, and that support or tailwind, whatever we want to call it, is definitely there. The other thing which has happened is, the costs had gone up. Cost of raw materials for the cement producers had gone up, but things have started coming down. I would hope that the war doesn't really, get ugly. And if that doesn't happen, I think the cost concerns also will be out of the way. So I'm looking at good first quarter numbers from the cement companies. And again, from third quarter onwards, cement companies will start showing good growth based on incremental volumes and improved margins.
Final word then, the EV two-wheeler pack, Ather Energy. That one's going boom, boom, boom. People talk about Ola Electric being a wealth destroyer. This one has actually been a wealth creator. And various investors have made this point that technologically, they are far more advanced, not in comparison with Ola, but in comparison to the industry on the whole. They're looking to raise some money as well. What's your view? Today as well, the stock is holding strong, 5% higher.
I think it's definitely they've done a much better job compared to many other players, and of course compared to Ola. But I think at this stage, I find the valuation a bit challenging. I would rather go and buy a Bajaj Auto, which also has a good two-wheeler EV business, and it's also growing. Bajaj is number 2 in the pecking order. TVS, of course, is number 1, and the entire company is definitely looking good for buying at current levels. So I would keep watching the space. Ether is definitely doing good, but the valuation is a bit rich as far as we are concerned.
Got it. Okay. All right. Thanks a lot, Sudeep, for joining in and giving us a view on all of those stocks. Well, let's wind down the markets. What started off as not such a bad day when we were down 100, 150, 200 points for most of the trading session. We fell off the cliff because Mr. Trump says that he doesn't want to interact with Iran, at least as of now. We'll have to wait by to hear whether or not he has something to say overnight. But the markets got spooked. Crude oil prices spiked up. The markets came down. Nifty was down. Nifty Bank was down. The small and the mid-cap indices were down. And the breadth of the market turned inversely in favor of the number of stocks that were declining. Close to 4 stocks declining for 1 stock that was advancing. From the frontline names, this war is going to restart and this Middle East tension is going to be back on the table. Then you'll have crude oil prices that will move up, which will pull up fuel cost even for, the aviation sector. And tourism obviously takes a hit. So Interglobe Aviation was the top loser, down 5%. Bond yields as well could spike up if, in fact, inflation, fears come back on the table. So you had a couple of those NBFCs. Shriram Finance was down close to around 5%. HUL came in for profit taking, that was 3.5%. And also you had Maruti Suzuki that was down close to 4%. What did well then? Oil producer will do well, right, in this sort of environment. So you had ONGC that was the top gainer, that was up close to around 1%. And we have seen that when this war tension comes back on the table, then you have, the aluminium premium that comes back. And that's where you have a few stocks that actually did well. Hindalco was higher in trade today. Nalco was higher in today's trading session. And Vedanta Aluminium as well did pop up. From the other stocks that in the broader markets, you had Kalyan Jewellers. That stock was very, very strong, was up close to around 5% after seeing a sharp decline. Jindal Drilling was up close to around 10%. Equis, IFL had come out with a note on the company. That stock as well did well. Net, it goes down as a poor trading session. The bulls will want to hear something overnight. Whether it comes or not, well, we'll have to wait by. For the time being, we wrap up at closing bell. The team of Markets Forward is waiting for you on the other side.
Sell-off on Dalal Street after tensions flare up in West Asia. Trump says the ceasefire with Iran is over. Nifty plunges 500 points to end below 23,900. All sectoral indices end lower. Volatility index surges 26%.
Crude oil prices rise with Brent hovering near $80 a barrel. US also revokes the authorization for Iran to sell its oil. Stocks of oil marketeers fall.
Select stocks see big moves. South Indian Bank slumps as the street reads the CEO change as a shift in focus. Orchid Pharma jumps on a supply deal in Russia for a urinary tract infection drug, while Aquis gets a boost from a brokerage upgrade.
Good evening. You're watching us here on Markets Forward. This is your show where we aim to get you all the key data points to get up for the next trading day. But before that, we have to recap today's session as well. I'm Mangalam Malu. With me, Vivek Iyer. A comment from Trump and nearly 700 points off the Nifty in the last session and a half. And within an hour, nearly 15 lakh crores shaved off the Bombay Stock Exchange total market cap. So there has been a lot of sell-off pressure. All of that has been reflected in the way, the stock market has moved. The advanced decline chart actually tells you the story of the day. We were okay till midpoint, and then we got that comment from Donald Trump saying, they wasted a lot of time on Iran, basically increasing geopolitical uncertainty. We went into trade with oil at around 76 as against 72, and we are ending trade with oil closer to 79. Financials across the board, there was selling. There was no one sector that was spared. Vivek.
That's right. Good afternoon. Not a single sector managed to end the day with gains. During mid-session, we started off, mid-cap rate at around 130, 145 is when, the comments started coming in. Post which, the sell-off that we've seen was pretty brutal. The Sensex shaving off over 1,670 points in a single trading session, and the volatility index was up 26% on the back of that brutal sell-off. But we've got you covered for the next 20 minutes with all the big news and key developments on Dalal Street, top corporate voices, as well as events to track ahead. So let's kick off the day's market action. First up, we will start with the top movers and shakers of the day with Hormaz Fatakia. We'll decode what the rising tensions in West Asia mean for crude prices. We'll also tell you why Orchid Pharma and Aquis rallied in trade, and then put the spotlight on South Indian Bank's new leadership appointment. Last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. But now on to our first segment of the day. Hormaz joins us from the big wall with all the top movers and shakers.
The last couple of hours just dwindled everything in terms of news flow for the markets, especially considering the fact that we are heading into earnings season starting tomorrow. But the 500-point sell-off on the Nifty today comes from all of the index heavyweights: HDFC Bank, ICICI Bank, Reliance Industries. Reliance Industries was the stock that I wanted to mention, not Industrial Infra. L&T, Bharti Airtel, all of them contributing to the losses in today's trading session. The others that did not do well in today's trade were a lot of these FMCG companies also that were bearing the brunt, but the rising crude oil prices had an impact on the oil marketing companies. Of course, the HPBP, IOC ending anywhere between 3 to 5% lower, and Indigo as well ending with losses of close to 5%. Take a look at the FMCG companies that took a bit of a pause in today's session. They were doing well, had done well, but Dabur was down 4%. Tata Consumer was the stock that I wanted to talk about, not TCPL Packaging, but HUL and Colgate too, not having a very good day at the office in today's trading session. Multiple stocks that fell to a 52-week low in today's session. Birlasoft was down 4. IRFC is now sub 100, continuing to extend its losses. Brainbees Solutions, Mrs. Bector's Foods too at 52-week lows in today's session. But there were some names that managed to buck the trend in today's trade. There was still some signs of green in today's session. Vivek just spoke about Orchid Pharma. That was one name that did well. But other than that, there were some names like Kalyan Jewelers and some of the others that managed to end the day with green. MCX, after a 4-day losing streak, managed a 4% advance, and Unichem Laboratories ended at a 20% circuit. Back to you guys.
All right, take that point, Hormaz. Thanks a lot for that. About 500 stocks which were managing to hold on into the green, as against 2,600 which were in the red. So for every stock that we saw which ended in the green, we had 5 which ended in the red, and that's the kind of decline that we've seen across the board today as well. But a large part of that can be attributed to oil. We'll obviously speak to Manisha about that in just a bit. Sudeep Bandyopadhyay from IndiTrade Capital and Shrikant Chauhan from Kotak Securities have joined us as well. Let's go across to Shrikant first. Shrikant, with the kind of fall that we've seen today, technically, do you think something has changed? Because we've broken below the 100-day moving average, the 50-day moving average, and the 20-day moving average. These three levels took almost a month to conquer.
Mangalam. The way today the market has broken all these important levels, one thing is very clear that there is good amount of fear in the market. And in case if there is any rebound, because right now the markets are completely oversold on intraday charts. So close to 23,800, the market has spent a lot of time when the market has started rallying from the lower levels. So 23,800 is definitely going to act as major support for the market. And in case if we see the market is closing below these levels in next 1 or 2 days of time, then we may even see the levels of 23,500 or maybe 23,300. But today's sell-off clearly indicates that even if there is any bounce back, then close to 23,100, 24,100, around those levels, we can see some, again, resistance and selling pressure in the market. So in case if there is any rebound, which is more likely, then we should look for reducing some long position at resistance level.
Okay, Srikanth, thank you so much for your view as far as the technical aspects of the market are concerned. But as tensions in West Asia flare, prices of crude oil have now climbed above $78 a barrel mark. Manisha now joins in to give us more details on the oil market.
Vivek, thank you so much for that. Well, yes, the crude oil prices have gained up by more than 6% today, and we're looking at nearly 11% of gains coming in for the crude oil prices for this week itself. Monday was trading at $71 a barrel. We've seen 79 plus kind of levels come in today itself. Well, this is, and with this, it brings the crude oil prices back in case of backwardation here. It had just about turned into contango in a couple of last weeks there. Well, the exchange of fire between US and Iran has complicated the peace talks, which in any case were very fragile, as the markets have been telling us. The US president, in the meanwhile, has said that Iran's ceasefire is over, I think, and that led to a lot of buying coming in for the crude prices there. There have been concerns about supply and shipping via Strait of Hormuz, and that clearly is the major reason there. The managed money, the gross shorts on crude near record levels has been yet another reason. They are vulnerable to short covering, and if that happens, you could be looking at further higher in case of the crude oil prices there, with $80 and $85 a barrel is what the markets are putting the crude prices in case of Brent in the coming few days there. Well, the US also has revoked the Iran oil export waiver there. Nearly 58 million barrels of Iran crude and condensation has been on the oil, on the waters as on 1st of July, is the view coming in from Vortex. There also is a report from Kepler which says that the Iran oil on Asian waters has gained up by 18% on a week-on-week basis, even as Iran has been exporting off all of that oil via Strait of Hormuz. The big buyers clearly have stayed away from the markets, wanting to understand the clarity and sense of US sanctions on Iran. So Iran hasn't really been able to sell a lot of oil there. Also, when you look at the China run rates, well, they have been at a 9-year lows as well. So not too much of a buying coming in from China too. But the markets do believe that this is going to be a volatile time going forward for the crude prices, with most Wall Street banks and brokerages telling us that 80, 85 is a possibility, while a very strong support at $70 a barrel is what the Brent could be following in days to come.
First is, as far as crude availability is concerned, we have seen in the past as well that while imports are actually down about 10 to 15%, the residual imports of around 4.6, 4.7 million barrels a day are sufficient to meet most of domestic requirements. Now, obviously, what it implies is that oil re-exports in the form of refined product have been cut down, and we believe that they will continue to remain subdued because obviously domestic consumption will be prioritized. But even in the worst of the crisis, I think imports did average close to about 4.5 to 4.6 million barrels of oil per day. So from an availability standpoint, that has not really been a concern, at least so far, in terms of published data that we've seen. The only small point of concern is in terms of LPG, which is a separate area where we are not really self-sufficient even in terms of refined product availability, and we have to import the finished product.
First off, and you've highlighted it, those two scenarios. The first point is it's up 3% today. Now, that's a positive move as far as price. You saw what Manisha said, up 5% in US trade. So the market is relatively taking this on board, and I think it's done what it needed to do as far as show the respect of the market. That's bid up. Let's see where the next 24 to 36 hours are. If there's any retaliatory action from Iran, what the big picture is. We know there's 63 million or approximate barrels floating out there of Iranian crude. And, the revoke of the 60-day waiver. Is this saber rattling? We understand the glut. I'm very conscious of that. I think Q4 is going to be, if from a geopolitical standpoint, if that was all stripped out, I think Q4 prices will be significantly lower than what they are at the moment. But we've got to get to Q4, and over that next matter of weeks, we could see again price volatility really engage the market if this was to be amplified.
Well, the word coming in as far as the oil markets are concerned. Well, Sudeep, let me come across to you first. Oil marketing companies, they just started recovering a certain proportion of their marketing margins that have seen a significant downtick. Do you now feel that recovery is further delayed? And oil sensitives, especially names like aviation and consumer names, will you now be a little wary or start booking out in case you're dipped in?
Well, I think definitely I'll be wary. Obviously, the oil prices going up hurts them. And oil marketing companies, you're absolutely right. They were recovering quite a bit during the past few weeks when oil prices came down. I think things are looking, kind of jittery once again. As far as Interglobe Aviation and other aviation companies are concerned, again, ATF prices going up directly affects their profitability. So it's a matter of worry for them. Whether this is going to continue or not is extremely difficult to predict, because we know the current US administration and the president is used to changing stance very, very rapidly. So I won't be surprised if by end of the day, some more statements come, which puts back the peace talks on track. So I would take the entire thing with a pinch of salt and keep a very kind of a cautious stance on the market and the developments.
All right, we take that point. Thanks a lot for that. Let's talk about some of the stocks that gained in today's trading session. And Orchid Pharma was one of the few, as it's inked a supply licensing pact with Russia's pharmaceutical company, Syntez. Vinny Motiwala joins in as, the stock ended about 8% higher in an otherwise very wobbly market.
Hi, thanks so much for that. So absolutely right. Today, managing to close in gains of 9%. So very good news. That is actually, we could say that it's penciled in for Orchid Pharma. They've signed this licensing agreement with and supply agreement with Pharma Syntez. This is mainly to commercialize Exblifep, which is a drug mainly used for treatment of complicated urinary tract infection and hospital-acquired as well as ventilator-associated bacterial pneumonia. Now, this drug is going to be for commercialization in Russia. Now, Pharma Syntez, when you look at it as a company, what is it? It is actually has a very good presence in Russia and with Russian hospitals. So the deal is still subject to Ministry of Health of Russian Federation, the approval for that. But apart from that, they have the US FDA approval, they have the EU approvals that have come in for the drug for Orchid Pharma. Now, what does it mean in terms of the partnership and a potential opportunity? The potential opportunity that it would turn out to be could be $178 million over the first 10 years of this. Currently, the drug has a patent that will be going on as well. So they do have that benefit that comes in. And Bob Capital says that the deal itself could double the sales if you look at it currently and convert it into the USD, from USD to rupees, could double the sales of Orchid Pharma over this time period as well. Now, obviously, do not forget the company has earlier commented that, over the patent life of this product, the potential sales could actually reach $1 billion in terms of sales. So it's a very big opportunity that comes in for the market. Russia market also is important for them and they are expanding their presence there. That is why the stock is passing in trade.
Well, thank you so much, Vinny, for joining us and giving us all of the details as far as the developments regarding Orchid Pharma is concerned. Well, another stock that did very well in the session was Aquis. It gained over 5% after IIFL Capital has started betting big on the stock. Ria joins in with more details.
Well, yes, Aquis has been in focus today, up nearly 6 to 7% after a note coming in from IIFL Capital. The brokerage has a buy call on the stock with a target price of rupees 320, which is a 32% upside compared to yesterday's closing price. Now, Aquis is India's only vertically integrated precision manufacturer of aerospace components, and the brokerage has highlighted that the company is now extending its high-mix, low-volume manufacturing playbook into a high-volume, high-mix consumer electronics space, and they do expect the consolidated revenue as well as the EBITDA of the company to grow by 7 times and 17 times respectively by the end of FY31. They also expect scale and operating leverage for the company to come in and lift their net margins to nearly 7.4% by the end of FY31. They do, however, believe that the valuations, the currently high valuations of the company are justified by its differentiated franchise, its deep competitive moats, as well as the long duration growth runway that the company currently sees. Now, currently Currently, the company is also expanding its wallet share with aerospace OEMs. Currently, Airbus and its OEMs contribute to over 60% of the sales for the company. And in fact, IIFL has also highlighted that the consumer electronics space, the consumer segment TAM can see a growth of nearly 10 times for the company to 130 billion US dollars. And currently, in terms of the valuation, it trades at a price to book value of 12 times its FY28 earnings. But as I mentioned earlier, the brokerage believes that this is justified given the long growth runway of the company. In terms of the stock moves today, it is performing well. It is up nearly 75% since its listing in December 2025. And in fact, just in the last 3 months, the stock has doubled.
All right, let's move on and talk about another stock which is on our radar today. The RBI approved the appointment of Mahesh Muralidhar Pai as the next MD and CEO of South Indian Bank for a three-year term. The stock tanked nearly 9% despite that. Why is it? Ananya Singh joins in with the details. Ananya.
Well, yes, a leadership announcement is the reason why the stock is under pressure today. Now, let us look at what happened. So, the RBI has cleared the appointment of Mr. Mahesh Muralidhar Pai as the Managing Director and CEO of South Indian Bank for a 3-year tenure starting October 1st, 2026. Now, he will take over from Mr. P.R. Sheshadri, whose term wraps up on September 30th. Now, bringing nearly 30 years of universal banking expertise, Mr. Pai currently served as Chief General Manager at Canara Bank, where he has been spearheading their digital banking and innovation strategies. Now, this brings us to the core reason behind today's market reaction. Now, investors had largely anticipated an internal promotion to this leadership position because an external appointment went against General Street expectations. It triggered immediate profit taking on a counter that had already run up roughly 20% so far this year, now causing the stock to hit an intraday low of around 43.23. Now, however, the matching this management shift against the bank's actual business performance, the provisional Q1 FY27 update shows the operations remain fundamentally steady. Gross advances grew 17% year-on-year and 4.1% sequentially. Now, the total deposit also climbed 11.4% year-on-year, while the low-cost liability franchise strengthened with the CASA ratio expanding to 87 basis point quarter-on-quarter to 33%. Now, the coming quarters will show whether the new leadership can strengthen the investor confidence going forward. Yeah.
Well, thank you so much, Ananya, for breaking down all of the developments as far as the leadership changes at South India Bank is concerned. Well, Shrikant, let me come across to you first. I know why we did hear Ananya speak about South Indian Bank. As far as the Nifty Bank is concerned today, it was a free fall, especially, some of the PSU names as well as the private banks. Now, within this fall, in case there is some stability, which are the names that you will be bullish towards?
Yeah, absolutely. I think what you're saying is right, because if there is any rebound in the market or pullback, then that we can expect out of private banks as compared to PSU banks. There we are seeing good amount of relative outperformance, and specifically we like HDFC Bank as well as ICICI Bank. I think both these stocks, they are still into uptrend, and also they participated very clearly when there was like a clearly uptrend in the bank Nifty as well as in the market. So at current levels, ICICI Bank, which is around 1375, 1360, here the stock is having very good support. Between 1370, 1360, the stock is having support. Again, the stock can move towards 1430, 1440. That's my view. So on dips or even at current level, it's a buy. For HDFC Bank, there also we saw smart rally up to 830, 835. From there, now again the stock is available at its psychological level of 800, and eventually we are expecting stock to move towards the levels of 900. So at this level, or maybe if there is any correction, then close to 790. Between these levels, we should look for adding HDFC Bank as well as ICICI Bank.
All right, just a final question to Sudeep. Sudeep, if there was one stock that you would want to buy currently, what would that be?
Well, I would probably go and buy ICICI Bank, just to echo what Shrikant was just mentioning. I think the valuation definitely looks interesting. And post this correction, it has become more interesting. There is definitely more chances of significant upside compared to the downside risk.
That point. Thanks a lot, gentlemen, for joining in and giving us your stock and sector calls, market insight on a day like this. What we'll do is take a short break, come back, get you all the key corporate conversations that we had during the day on the channel, and more importantly, tell you the key market events to watch out for ahead of trade tomorrow.
Welcome back to Markets Forward. Well, it's now time to take stock of all of the corporate voices of the day. GK Energy CMD and CEO Gopal Kabra told CNBC TV18 that the company's order book has grown to around 1,000 crore rupees at the end of Q1, up from 710 crore rupees at the end of Q4, that is the end of FY26. He said that the company is diversifying its order mix by expanding into the retail market, with solar rooftop projects expected to contribute around 30% of FY27 revenue. Kabra also said EBITDA margins are expected to remain in the 18 to 20% range, while a greater focus on the solar rooftop business is likely to improve working capital efficiency over time.
Right, and the other corporate that we had today was Kusumgar. Director Ankur Kothari told CNBC TV18 that the company is targeting over 2,000 crore rupees of revenue by FY30, which is actually achievable. The revenue expected to more than double over the medium term. Said that FY27 growth is likely to normalize as tariff-related headwinds have eased, while margins are expected to remain stable in the 26 to 28% band. He also added that the company has no major capex plans over the next 4 to 5 years beyond maintenance capex and will focus on diversifying across geographies and business lines to drive growth.
And before we wrap, we bring you the key market events to watch out for in tomorrow's trading session. Upasna Bhatt is standing by the big wall with all the key events to watch out for tomorrow.
Well, tomorrow onwards, we officially kick off the earnings season with TCS reporting its numbers. Certainly, IT sector will be in focus tomorrow, but also there are few small companies such as Anand Rathi Wealth and GM Breweries, which will be reporting their Q1 FY27 numbers. Now, let us look at some of the stocks will be in focus on the back of corporate action. Premier Explosive will be in focus as the board will consider on the business and operations of the company. Hence, the board meeting is scheduled for tomorrow. Nestle India and Mphasis will also trade ex-dividend tomorrow onwards. So something to keep an eye out on. Now, let us place focus on some of the global cues for tomorrow. US will be reporting its initial jobless claims data, China CPI and PPI data for the month of July, and ECB to publish minutes of the latest policy meet is something we'll be keeping a track also. Now, coming to the Apple supplier, that is Luxshare's $5.6 billion IPO to list in the Hong Kong exchanges is one of the largest IPO of the year. So certainly we'll keeping a track on that as well. And lastly, Eurozone finance minister will gather in Brussels for a meeting to review the macroeconomic stability. So all in all, these are the key events for tomorrow. Certainly looks like an eventful day.
All right, Upasna, thanks a lot for that. That's quite a list. We will monitor everything along with the Truth Social posts that Donald Trump puts out as well, because that will have some market impact as well. We wrap up on this edition of Markets Forward. Thank you so much. We'll be back with more news and updates. Thank you.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening.
Over. I don't want to deal with them anymore. They're scum. You know what scum is? They're scum. They're sick people. They're led by sick people.
President Trump pulls the plug on the ceasefire agreement with Iran as both nations resume hostilities. Iran targets American military installations in the Gulf hours after the U.S. carried out airstrikes. NATO rallies behind Trump, calls the U.S. attacks absolutely necessary. Crude oil prices flare up with Brent hovering near $80 a barrel. U.S. also revokes the authorization for Iran to sell its oil. Shipping traffic grinds to a halt at the Strait of Hormuz. Deep cuts on Dalal Street. The Sensex loses nearly 1,700 points. The Nifty drops below 23,900. All sectoral indices close in the red. The rupee weakens by over 50 paise against the dollar. Foreign portfolio investment into Indian bonds hits a record high in June as inflows cross 41,700 crore rupees. Removal of capital gains tax, withholding tax and expansion of the fully accessible route boosts investments. The Union Transport Minister Nitin Gadkari dares critics to identify a single car that faced problems due to E20 fuel. Defends the ethanol blending policy despite widespread fears over fuel efficiency and engine safety. India's clean energy push hits a new milestone. More than 50% of the electricity supplied on the 6th of July came from clean energy sources, but the solar penetration is also causing stress to the grid. Outrage in Maharashtra after a Shiv Sena corporator and his supporters attack a doctor and medical staff in Mumbai. Doctors across the state threaten to go on strike from tomorrow. The U.S. Justice Department indicts a Punjab police officer along with gangster Lawrence Bishnoi and 35 others, accused them of a wide range of crimes, including targeted killings, extortion, racketeering, among others. Messi magic breaks the Egyptian spell as Argentina overcome a 2-goal deficit in stoppage time to reach the quarterfinals. Switzerland edge out Colombia on penalties to reach the World Cup quarterfinals for the first time in 72 years. 39-year-old Novak Djokovic survives a 5-hour set marathon to enter the Wimbledon semi-final, beats Felix Auger after 5 hours and 15 minutes in what was Djokovic's longest match at Wimbledon. Well, let's go straight to the top story this evening. Now, President Trump has declared that the ceasefire MOU with Iran is quote-unquote over. This comes after Washington and Tehran exchanged strikes overnight. Now, let's break down the latest developments for you. Speaking on the sidelines of the NATO summit, President Trump said, and I quote, Iran is led by sick and violent people, and if they had a nuclear weapon, they would use it, end of quote. He added he doesn't want to deal with Iran anymore. Trump said the U.S. negotiating team could continue talks, but in his words, they're wasting their time. Now, let's understand the chain of events that have led to Trump's remarks. The U.S. claimed that Iran attacked 3 vessels near the Strait of Hormuz. On Tuesday, a Qatari-flagged LNG tanker was among those hit. However, Iran neither denied nor confirmed the allegations. Then, in the early hours of Wednesday, the U.S. military said it hit over 80 targets in response to Tehran's alleged attacks. As per the military, the strikes hit Iranian air defense systems, control centers, and over 60 small boats of the Iranian Revolutionary Guards in and near the Strait of Hormuz. The U.S. also revoked temporary sanctions waiver for Tehran to export oil. Now, NATO's chief, Mark Rutte, defended the U.S. strikes, and I quote, is absolutely necessary. Meanwhile, Iran's top negotiator, Mohammad Ghalibaf, accused the U.S. of violating terms of the MOU. In a social media post, Ghalibaf said, and I quote, the era of bullying and extortion is over. It leads nowhere. Ghalibaf warned that Iran does not fold, and then Gulf nations felt the heat of the escalation. Tehran retaliated against America's strikes by attacking Bahrain and Kuwait. The Kuwaiti army said it intercepted 2 ballistic missiles and 13 drones, and no material damage or human injuries were reported. Now, in the oil markets, Brent crude prices surging after President Trump pulled the plug on the ceasefire. According to ship tracking firm Marine Traffic, vessel movement in the Strait of Hormuz is resilient despite the strikes. Now, here's what President Trump said on Iran. Listen in for yourself.
To me, I think it's over. I don't want to deal with them anymore. They're scum. You know what scum is? They're scum. They're sick people. They're led by sick people. And they're vicious, violent people. And if they had a nuclear weapon, they'd use it. As far as I'm concerned, it's over. I'll speak to our negotiators. They want to negotiate. They're good people. Steve Witkoff, Jared Kushner. but they have to come back to me. As far as I'm concerned, it's just a waste of time dealing with them. They're liars. We make a deal, and if I make a deal with him, we have a deal, and he goes out, he talks. We make a deal. Everyone's agreed. No nuclear weapon. We make a deal. They go outside, talk to the press. They say, we never even talked about it. There's something wrong with them. They're cuckoo. As far as I'm concerned, it's over.
Well, that is President Trump saying, as far as he's concerned, it's over. Now, pulling the plug on the Iran ceasefire wasn't the only curveball that Donald Trump threw in Ankara. He renewed his criticism of NATO, voicing frustration over what he described as Europe's lack of support during the Iran conflict. Now, remember, this has long been a major flashpoint between Washington and the alliance. The Trump administration has repeatedly accused European NATO members of failing to shoulder their fair share of the security burden. Steve Sedgwick reports from Ankara on the points of friction between Washington and Brussels. Steve.
The president is really irked about the lack of perceived support from NATO members for Operation Epic Fury, the fact that they didn't overtly support and get involved in the military action, and in some cases refused American base usage for offensive actions against Iran. For defensive actions, that was allowed from some of these nations as well.
Not happy with NATO because of what they did with Greenland, and I'm not happy with NATO because of the fact that they didn't want to help us with the #1 state sponsor of terror, that's Iran. They were unwilling to help us. Now, in all fairness, I didn't speak to Mark about it. I think if I did, it might have been different, but we didn't need help.
Very interesting. I haven't spoken to one leader here yet who is willing to acquiesce to Donald Trump's demands and actually, or hopes previously, that they get more actively involved. And he says, look, I'm done with NATO. I'm fed up with it. They weren't there when we needed them. NATO would probably argue that the only time that Article 5 has been enacted, this mutual defense pact, was obviously after 9/11. The president also, in the sound that we've been listening to this morning, talked about the $1 trillion that the US has spent on NATO. I think perhaps maybe that's a conflagration of two different issues. As we all know and our viewers know, the Pentagon budget for defense is circa $1 trillion. I think the last figure I saw was $980 billion. But the US hasn't spent $1 trillion on NATO per se. In fact, its dues for the NATO infrastructure is in the low single-digit billions as well, although, as we all know, and it is unequivocally the case, the US has been the major supplier of the burden supporting European nations in the post-World War way. And, of course, his great problem was that Europe wasn't doing enough. Europe listened, it's spending a lot more money, it is getting towards that 5% target, but it's trying to get there by 2035. But the problem is the Pentagon is conducting a review, which will be for 6 months from June 18th onwards, and actually some nations who don't seem to be spending enough money may lose some support from the United States.
Steve Sedgwick there reporting on the flashpoints between President Trump and NATO at the NATO summit in Ankara. Now, President Trump has also renewed his call for the U.S. to take control of Greenland. Trump said Greenland should be controlled by the U.S. and not by Denmark. He also threatened to pull U.S. troops out of Europe over the continent's pushback. So, reiteration of old positions.
Greenland doesn't help Denmark. Denmark doesn't spend money to really help Greenland. But it's an important part for the United States. And it's surrounded by China ships and Russian ships. And that's not going to happen. The ships it's not going to happen. It was Greenland that, and it continues to be, that should be controlled by the United States, not by Denmark. And when they wouldn't go along with it, and with all the money we spend to help them with Russia, and we don't have to spend any money, we could remove all of our soldiers out of Europe.
Well, Trump reiterating old threats. Now, Russian forces have attacked Ukraine with drones and missiles targeting Kyiv for the third time in less than a week. Ukraine's defenses claim to have intercepted 80% of 169 drones used in the overnight attacks. Meanwhile, Ukraine struck 9 more Russian Shadow Fleet tankers in the Sea of Azov overnight. The latest strikes take the total number of Russian vessels hit over the past 3 days to 21. Ukrainian forces also targeted military sites in occupied Crimea, with 6 more power substations hit under Operation Crimean Switch. And the fresh flare-up in West Asia led to a sell-off across stock markets worldwide. The Sensex lost nearly 1,700 points, and Nifty dropping below 23,900 after a sharp sell-off. And no sector was spared as all sectoral indices ended in the red. The volatility index surging nearly 25%. The Nifty Bank down almost 3%. Nifty PSU Bank Index down almost 3% as well, and 2% lower for both the Sensex and the Nifty. Prashant standing by now with the market wrap. Prashant, markets clearly on the edge on the back of all the comments coming in there from President Trump.
If you look at the Nifty, from about 150 in the afternoon, we lost another 250 to 300 points or so. So 2% cut on the Nifty, all told by 3:30. The Nifty Bank lost 2%. The small cap index lost about 2%. The mid cap index did a little better, but not by much. India Wix jumped some 24-25%. We're back at the 14-ish, 15-ish kind of level. So volatility index spiking there. And banks really is where this showed up, right? So you look at the PSU bank index, the private bank index, and of course, as I said, the 2% cut on the Nifty Bank itself. Now, I'll just come to the large cap losers. Jio Finance, Indigo, Shriram Finance, Maruti, HUL, Kotak Bank, Mahindra and Mahindra were essentially the big losers which came through. And actually, by the end of it, only one name with over a 1% pop. And guess what? That's ONGC, as oil moved up substantially in the last 24-hour period or so. The advance decline was deeply negative today. So some 2,700 stocks down, some 600 stocks higher. So pretty one way. And Coforge was down 4.5% today. It's the best performing IT stock, by some standards. AG's Logistics has had a one-way move higher, 10% lower. Chola Finance was down 4.5%. 361 down 5%. Force Motors down 4.5%. CDSL, Viatec Vabag, Apar Industries, HDFC, AMC, Emphasis, SRF, and so many others which were under pressure. But, enough and more volume on the other side as well. So BSC, which basically had lost about 3-4% yesterday, was up 2% today. MCX, similar case, down yesterday, back up 4%. So just flipping on the other side. Naukri was a big mover yesterday. It was a big mover for quite a while today, but of course, came off the highs, 1.5 higher there. Aether was a big mover, 5.5% gains coming through. Balaji Amines and Alkyl Amines were the other two big movers. I think about 10% respectively. And Orchid Pharma also stood out with about 7.5 odd % kind of gain. So that's the picture. The headlines doing the damage, but markets, of course, on wait and watch mode because, this is known to be a pretty volatile set of headlines which tend to move around and then markets have to respond and adjust on the other side. Back to you.
Yes, we will have to keep tracking those headlines coming in from President Trump. Prashant, many thanks for joining us. In the money market, the rupee weakened by over 50 paise against the dollar. The currency breaching the 95 mark once again. 10-year bond prices also declined in trade with the yield spiking above 6.7%. But staying with the bond market action, foreign portfolio investors are flocking to Indian bonds once again. FPI investments crossed 41,700 crore rupees in the month of June, hitting a record high. Ritu's here with more on what's driving the foreign inflows. Ritu.
Well, yes, foreign investors are making a strong comeback to India's government bond market following the series of measures that were undertaken by the government and the RBI to make these investments more attractive. And the result is record investments into Indian government bonds under RBI's fully accessible route for the month of June. If you look at the CCIL data, foreign portfolio investors made a record net investment of 41,773 crore rupees in these securities just in the month of June. And that is a sharp turnaround from March when they were net sellers and a huge jump from the inflows of just about 5 to 5,500 crores each that we saw in April and May. Now, the buying has also taken the total FPI holdings in these securities to 3.73 lakh crore rupees, and foreign investors now own about 7.12% of all the bonds that are available under the fully accessible route. Now, their participation is also becoming broader. So you have 11 government securities that now have foreign ownership of more than 10%. For instance, the highest foreign holding is 21.5% in the 7.38% government security maturing in 2027. Now, the reason behind the surge is obvious. The government has removed that 12.5% capital gains tax and the 20% withholding tax on interest for eligible government securities that are bought by foreign investors, which makes these attractive attractive. We also saw RBI expanding the list of bonds that are available for investment under this fully accessible route. And then to that, you add the fact that there's growing expectations of India's inclusion in the global aggregate bond index. And on the back of that, you have overseas investors that are increasing their exposure to Indian government bonds. Now, let me finish by saying while foreign investors have been pouring money into the bond market, the contrast with equities has been quite striking, where FPI inflows are only just starting to pick up since the second half of June.
All right, Ritu, many thanks for joining us. Now, the Q2 earnings season kicks off tomorrow with TCS expected to report muted revenue growth. Rima is here to wrap up what we can expect. Rima, quick curtain raiser on what we should expect.
Expect a muted quarter from TCS, revenues seen flat in constant currency. The broad range from analysts was minus 0.1% going up to plus 0.4%. Margins will take a hit, down 120 basis points on a sequential basis to 24.1% because of a wage hike. Now, wage hike typically shaves off 150 to 200 basis points in the margin, but there was a sharp currency depreciation. The rupee fell by 2.5% quarter on quarter, and that will provide some currency tailwind, and therefore net-net on the margins, the CNBC TV 18 poll is for a drop of 110-120 basis points, and bottom line profits will also decline partially. There could be a one-time legal expense, according to analysts, as the companies settle the case. Now, TCS share price has gotten hit. Year to date, it's down more than 35%. Valuation multiples at one point of time, peak value, it always commanded premium valuation multiples, 22, 24 times, and now it's down to 13, 14 times. Remember, the company's ambition is to be the world's largest AI-led services. The stock has gotten battered, as has the entire IT sector. Expectations are low. What can the companies say to reverse the narrative? We'll wait back to see.
Yes, we will be tracking the TCS numbers. Rima, many thanks. Packaging Solutions provider NAC Packaging made a strong debut on the Lal Street shares, listing at 188 rupees a piece, a premium of 11% to its issue price of 170. IPO received strong interest and was subscribed over 83 times. The company currently has an installed manufacturing capacity of 43,300 metric tons per annum and plans to utilize 320 crore rupees from the IPO proceeds to set up a new manufacturing facility. Kusumgar's 650 crore rupee IPO was fully subscribed within the first few hours of bidding on the first day. As of 4 p.m., the issue has been subscribed over 3 times. Demand was led by non-institutional and retail investors. Retail portion subscribed by over 3 times, and the non-institutional investor portion subscribed 6 times. Kusumgar manufactures advanced technical textiles and engineered fabrics. Shares of South Indian Bank down in trade today, even as the RBI approved the appointment of its next MD and CEO, Mahesh Muralidhar Pai, will take charge as the bank's MD and CEO for a 3-year term beginning the 1st of October. His appointment will be placed before the bank's board next week. Pai currently serves as the Chief General Manager heading Digital Banking and Innovation at Canara Bank. Pai will succeed PR Shishadri, who stepped down in January of this year. Time for us to head into a break, but up next, Union Road Transport Minister Nitin Gadkari dares critics to identify a single car that faces problems due to E20 fuel. That and more when we return. Union Road Transport Minister Nitin Gadkari has challenged critics of the E20 fuel to identify a single car, in his words, that's been affected. Gadkari's response while speaking at a Sudarshan TV event comes amidst allegations that the use of blended petrol is impacting car engines and reducing mileage. Now, last Saturday, in a rare show of unity, 3 of India's leading automakers addressed a government-hosted press conference to defend the centre's ethanol fuel mandate. Take a look.
इस प्रकार की झूठी बातें, और इसलिए मैं आप एक ही बात बताता हूँ, आपके मार्फत मैं देश के तमाम लोगों को आह्वान करता हूँ कि कोई भी स्कूटर, मोटरसाइकिल और कार जो पेट्रोल की है, जिसमें इथेनॉल डाला जाता, अगर खराब हुई है तो तुरंत डीलर के पास जाइए, तकरार करिए और एक कॉपी मेरे पास भेजिए। ऐसी एक भी कार और स्कूटर का नाम चवनके जी अगर आप बता पाएंगे तो मुझे बताइए।
बिल्कुल, हमने भी
कोई आया ना मेरे सामने।
Well, the gut-curry challenge there. And staying with the E20 fuel controversy, Santosh Iyer, the CEO of Mercedes-Benz India, says customers should have the freedom to choose the fuel that they want to use. Speaking to CNBC TV 18, Iyer also said that Mercedes-Benz customers don't have anything to worry about. He flagged adulteration in fuel as a bigger concern than the E20 petrol. Take a look.
Cars which we have sold from 2020 are anyways certified materially compliant. Even 23, 24 onwards, they are also even emission and range compliant. So I think customers don't have to worry anything about the older cars as well, which are manufactured and sold after this period. Even before this period, I think the cars will be able to run. There may be certain compromises, slight efficiency drop. But, you know, it's not that overnight the government has put 20% ethanol. These cars have been running on 15% ethanol any which ways. I think one of the bigger problems that emerged in this crisis, in this entire debate, is a lot of adulteration is still happening in fuel pumps, which also means it's not E20, maybe somebody is filling an E30 or something else, and in terms of the fuel mix, and that is maybe causing problems to one of the other consumers as such. But a good amount of education and also, as I said, you know, for us, we have already launched the E25 car. We introduced a new S-Class plug-in hybrid in Mumbai last 2 weeks back, and that's already E25 compliant. So we are always ahead of the curve, and our customers need not worry on this topic.
Well, that's Mercedes-Benz India saying that they are E20 compliant, but fuel adulteration is a bigger concern today. A Pakistani cargo plane operated by K2 Airways has gone missing over the Arabian Sea. The Boeing 737 carrying 5 crew members vanished from the radar around 155 nautical miles west of Karachi after reportedly suffering a navigation failure. Pakistan Civil Aviation Authority says search and rescue operations are underway. The cause of the disappearance has not been confirmed as of now. The rape and murder of a 12-year-old girl in Buripur has sent shockwaves across West Bengal. One of the main accused in the case is now dead. Prabhas Mandal was shot dead during a crime scene reconstruction exercise early this morning. Police say he allegedly grabbed a firearm, fired around and tried to escape, prompting retaliatory fire. Mandal was arrested after CCTV footage allegedly showed him walking with the 12-year-old victim before she went missing. 3 other accused in the case remain in police custody. Now, the U.S. Justice Department has indicted a Punjab police officer along with gangster Lawrence Bishnoi and 35 others. Authorities accuse them of a wide range of crimes, including targeted killings, extortion, racketeering, among others. Archana is standing by with the details. Archana, take us through the indictment that has come in from the U.S.
Right. So in a stunning international crackdown, Shireen, the U.S. Department of Justice has charged jailed Indian gangster Lawrence Bishnoi and his close aide Goldie Brar with orchestrating the high-profile 2023 assassination of Sikh separatist Hardeep Singh Nijjar in Canada. The charges are part of a massive global operation called Hardball. Now, FBI Director Kash Patel announced that agents working with partners in Canada, Europe and India have arrested 24 suspects across the U.S., Canada and Europe. A total of 37 individuals now face charges including racketeering, extortion, narcotics, trafficking, targeted killings, kidnappings and firearm offences. Now, at the center of the indictment is the Bishnoi crime syndicate. The 33-year-old Lawrence Bishnoi, this gangster who's currently lodged in Sabarmati jail in Ahmedabad, is accused of running his international criminal empire from behind bars using smuggled cell phones and encrypted communications. Remember, Nijjar's killing had triggered a diplomatic crisis after the then Canadian Prime Minister Justin Trudeau said months later that the authorities were actively pursuing credible allegations linking the Indian government agents to the murder. New Delhi, of course, rejected the claim as absurd. However, in the latest US indictment charging Bishnoi and Goldie Brar, there is no allegation against any Indian government official in this killing. Nijjar, who was a Canadian citizen, had campaigned for the creation of Khalistan, which is an independent Sikh homeland carved out of India, and had been designated a terrorist by New Delhi. Now, also charged in this case are Bishnoi's associate Goldie Brar, a Punjab police officer named Gurinder Jeet Singh. The government has taken note of that. The Punjab government has taken note of this development. And of course, rival gangster Jaggu Bhagwanpuria, who runs his own criminal network in Punjab. Now, the latest is that the US is actively hunting 10 more fugitives. 7 are believed to be in the US, 2 are in India, and 1 is in Europe. The FBI has offered a reward of up to $50,000 for information leading to the arrest of Goldie Brar, also known as Satyendra Singh. Back to you.
Archana, many thanks for joining us. The big sporting story is Lionel Messi powered Argentina into the quarterfinals of the World Cup. A heartbreak for Egypt, who were leading by 2 goals with just 12 minutes left to play. In the other game, Switzerland beat Colombia in a penalty shootout to reach the quarterfinals for the first time in 72 years. And from football to tennis, where Novak Djokovic booked his place in the Wimbledon semi-final, the 39-year-old survived a 5-hour marathon against Felix Auger Aliassime, which lasted 5 hours and 15 minutes. This was Djokovic's longest match at Wimbledon.
Like Messi, 39 years, one scores goals. You win after 5 hours and 15 minutes.
It would be nice to play 90 minutes like him. But.
Okay.
Well, that is Djokovic there, 5 hours and 15 minutes. I mean, endurance takes on a whole different meaning. They're the longest Wimbledon match that Djokovic has ever played and the longest quarterfinal ever witnessed on a court at Wimbledon. With that, it is time for us to wrap up this edition of Business 360. Do stay tuned to CNBC TV 18. We've got plenty more coming up for you right after this short break.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, you would have noticed that there have been several headlines about some important changes in the Employee Provident Fund scheme. In fact, we have a new scheme, EPF Scheme 2026. Now, there are certain important changes that these new rules and regulations have brought forth. Changes with respect to, how we are looking at our PF, how much is mandatory to put in the Employee Provident Fund? How can we withdraw that corpus? And what are the rules and regulations which will determine when we can withdraw it and how much of that PF contribution we can withdraw? This is always a very, very important subject when it comes to our retirement security. This is a large net and probably the only safety net, from a very disciplined standpoint that a lot of Indians still have when it comes to retirement savings. So this is what we're going to discuss on the show and simplify all of the changes that have been announced. So I have with me today Puneet Gupta, partner of People Advisory Services Tax at EY India, and Parizad Sirwala, partner and head of tax and global mobility services at KPMG in India. Thank you so much, Parizad, for joining in, and thanks very much to be here with us, Puneet. To you as well. Puneet's joining us from Delhi, I think. Parizad is here with us from Mumbai. Now, I really want to start at the headline level itself. The EPF scheme 2026. Does a lot change? Parizad, let me open with you.
So I would say, Surbhi, first of all, thank you for having me here. It's not really a random or a radical policy change that we've sort of been reading as a headline sort of item. It was very much expected as a part of the implementation with the Code on Social Security that was anyways unveiled in November 2025 by the government. So while it's been really described as a major sort of, change, it's important to understand that this is a step in the government's journey towards this entire operationalization of labor laws in India. And, that's my headline. So yes, certain things have changed and we can discuss and deep dive, but a lot of provisions and a lot of things have remained the same that was there even in the erstwhile, provident fund schemes.
Okay, absolutely. And we'll dive right into some of those big changes. And Puneet, I think the one piece that caught the maximum amount of press, and rightfully so, is the fact that 12% of basic wage, that almost, rule cast in stone that I as an employee will contribute 12% of my basic, the employer will match it, contribute 12% of basic. That may no longer be mandatory, not to the same extent, not the same value. So let's start right there and explain that to our viewers. What has happened?
Yeah. So there are multiple provisions in the labor codes on that. The base provision is that employer and employee both contribute 12% of wages, and wages here is as defined under the new labor codes. But there's also a very specific provision, which in fact was there in the earlier scheme also, that if an employee has wages exceeding the wage ceiling, then both employee and employer contribute on wages up to the wage ceiling. And while the new wage ceiling for contributions have not been announced, we still follow the old ceiling of 15,000 rupees. Simply said, if someone is earning wages more than 15,000 rupees, then employer and employee on a mandatory basis are only required to contribute on 15,000 rupees. Then they're talking about voluntary PF contribution, that an employee can contribute on wages exceeding the wage ceiling or at a rate higher than the statutory 12% rate. An employer, while under no obligation, employer can always match additional contribution. The main, and all of it to large extent was there under the earlier scheme also. What is very specific in the new scheme, which was not as specific in the old scheme, is the flexibility given to both employer and employee to either reduce or stop additional contributions at any point of time. This provision, which followed from multiple Supreme Court and other cases in the past, is now kind of black and white in the scheme, which is where the whole flexibility is coming.
Yeah, absolutely. And that's an important point. It has both pros and cons, and we'll discuss that. Parizad, because earlier it was almost a given, right? Whether, whatever organization you're in, if the organization is part of the EPFO, then 12% by default would go towards your PF contribution from an employee's perspective. How are companies looking at this change now? And, will it intrinsically become that, okay, we're only putting in the bare minimum, and in any case, if your wage is above, 15,000 rupees, then will only 1,800 be contributed? I mean, how are employers thinking about it? Though it's early days, but what should we expect?
Yeah. So as Puneet has already mentioned, the wage ceiling continues at 15,000 per month. The rate of contribution continues at 12% per month. Sorry, 12%. There's really no change. Okay. Even earlier, if the employee chose to, there would be a joint declaration that would be filed between the employer and the employee. And for those employees, salaried employees earning above the wage threshold of 15,000, they could become members of the Provident Fund and contribute. And if, say, let's say, depending on my financial circumstances or life events, if I want to go beyond the 12% rate also, that was possible as a voluntary Provident Fund contribution. But that does not really oblige or mandate my employer to contribute beyond that. If it's at my option, the voluntary to go beyond. So because there will be other admin charges also that the employer has to pay. As far as the employer is concerned, the obligation stops at that 12%. That provision was there even earlier. But if I want to, build up my retirement nest and corpus, I can go beyond, is exactly what Puneet also mentioned.
But now, if you are earning more than 15,000, there is no obligation, right? So from an employer perspective, I mean, just let's take the example of someone. I think, Puneet, that will help if we take the example of someone who is, say, earning 1 lakh rupees, or you can take any sum that's easy to work with, and how things change. Because again, for the employer, it's no longer mandatory to match 12% with 12%. So the entire manner in which I'm looking at my salary structure, how much is going towards PF, that whole thing is up for discussion now, isn't it?
Yeah. So it'll be very simple example. Let's say someone with a gross CTC of 2 lakh rupees per month, wages under labor codes is 1 lakh rupees per month, which is broadly 50% of gross salary. Let's say basic salary was 60,000 rupees per month, and wage ceiling, of course, is 15,000 now. Generally, you're right, employer would normally have 12% of 60,000 rupees, which is the basic salary as part of compensation structure. So this example, employer will contribute 7,200 rupees and employer will deduct 7,200 rupees from employee salary, 12% of 60,000 rupees, and contribute that to EPF. That's how generally PF contributions work. That same provision or that same base can continue under the new scheme also, because the employer and employee have an option to go beyond basis a joint declaration. But one flexibility, if they want to agree on a new terms of employment, or say for new employees, the other option is for both employer and employee to do a mandatory contribution of only 1,800 rupees per month, and the balance, which is 7,200 earlier and now 1,800, 5,400 rupees per month, can be contributed on a voluntary basis by both employer and employee. So you can still contribute 7,200, but that can be split 1,800 as statutory contribution and the balance 5,400 as voluntary contribution. And this voluntary contribution, like we discussed, can be reduced or stopped at any point of time, both by employer and or employee.
Absolutely. That's a great example and it really helps. And Parisa, that's the point. Flexibility is fantastic, but if it is used with responsibility, right? And now maybe I also sound a little bit like a grandmother, but someone who's been sort of hosting personal finance conversations for so long. The whole idea of the EPFO was a retirement safety net. So this was default deduction. It didn't allow you to think. The money would just go and sit in your PF account, right? And it would keep accumulating over the years, and then the power of compounding kicks in. What would you say to employees now as they have these new conversations with employers? Does it still make sense to continue with the earlier structures? Does it make sense to add to the voluntary PF? Also tell us, what is the voluntary maximum contribution that one can make? Or, is there a merit in actually opting out of all this as well now?
So, Subhi, I think as a function of this absolute transformative labor codes in India, anyways, I think, from 2025, late November, organizations have looked at rehaul of salary structures, because the very essence of the definition of wages has, completely changed for the purpose of all your retirals as far as India's labor codes are concerned. Okay. So, of course, it's, each component of your salary structure or CTC has to be seen. As far as PF is concerned, a lot of things, which we discussed, it's the only retirement savings. I would say, each one's lives and individual circumstances are different. I would continue as a salaried employee because there's no major change. In fact, with EPFO 3.0 and digital upgrades, even your online processing and claims are going to be easier. Even the tax treatment continues to be the same. The interest framework, which is a good healthy rate of 8% plus, continues to be the same. If you're a employee above the wage ceiling of 15,000, and if the employer decides to restrict the contributions to 15,000, as we discussed a while ago, then maybe your monthly net take home can also increase. So while it's very individual specific, there is really no need, even if I'm a new employee, I would still continue with the Provident Fund. It's my only retirement safety net. But overall, it's a function of, the wage definition has changed for all retires, but that's a larger sort of exercise or issue from a labor code perspective.
Yeah. No, absolutely. I take your point. It depends on the individual that you are. If you're going to take that additional money, which it doesn't go to your PF, it comes to you. If you go and invest it wisely in a different instrument, great. But if you're going to blow that up in the next holiday or in the next mobile phone you want to buy, then maybe that's not the best course, right? But then I think this is three old people talking. Our job is to, I think, put it out on the table to make people think. But Puneet, on that, before we move to the next leg of the conversation, in your early conversations with employers, I mean, the way corporates are thinking about this, like Parizad mentioned, salary structures are changing, these conversations are on. How are employers or most corporate organizations likely to react? Because it's no longer mandatory for them to match whatever the employee is putting in the PF account. Would they rather want to opt out, give that as some other component of CTC, or are companies showing the willingness to constantly contribute? What are we likely to expect in the newer format salary structures as they evolve, perhaps over the course of this year?
Right. So I think there can be all three models, and I'll lay down three models. One option is when a new employee joins EPF, a new employee joins employment for the first time, there's always an option of opting out of PF. So some organizations do provide that option for employees to completely opt out of PF, provided the person was not a PF member in any prior employment. And in that case, there will be no PF and pension contribution made for that person. That's one option. The second option is the age-old option, which can very well continue even now, where both employee and employer contribute 12% of full basic salary for an employee. That is agreed terms of employment and standard contribution that can still continue. Or a third option now that also has to be agreed with employees and has to form part of terms of employment with the employee. But the third option, like we're discussing, is for both employer and employee to contribute at 1,800 rupees per month. And if the employer is willing to contribute extra, that is as voluntary contribution from employer's side. And similarly, if an employee wants to contribute extra, it can be a voluntary contribution from employee side. So all three systems, all three options can continue, depends on the terms of employment with employee.
And Parizad, one last point on this, on the voluntary contribution, like Puneet explained, that if you really want to invest the maximum amount of your salary, he mentioned that, you can even invest up to 100% of your wages in the Provident Fund. But then people do that to get the best of the tax benefits. But those benefits were pruned and they were capped a couple of years ago, right? So if you could just go over the voluntary Provident Fund framework, up till what point can I invest? What kind of tax incentives do I still get, if any?
So there is no change to any tax treatment. So, employer contributions, this is for, higher income earners or higher balances. So contributions above a particular threshold, which is around 7.5 lakhs, are taxable. Below that, it's not. And only if you withdraw the balance under 5 years, it's taxable. Otherwise, it's not. And generally, the Provident Fund is for your retirement, nest. So you will withdraw it only for your retirement. So even the accumulated balance as and when withdrawn is generally, tax-free. So largely it's an exempt model, except where for people who are, having the higher amounts going in for higher income earners, if the contributions are above a particular threshold, those remain
Will be
taxable. But for a large portion of the salaried, I mean, look, the EPFO, as I understand from data, is managing 7 crore plus subscribers. So it's really which income bracket you're falling in and the amount of your, contributions in your corpus.
Sure, but yeah, up till 7.5 lakhs, even the contribution is tax-free. So it continues to be perhaps one of the most tax-efficient vehicles for long-term savings and investments. All right, we have to take a very quick break. But on the other side, we're going to talk about the changes in the PF withdrawal rules. Some important ones that we should be aware of.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week we are simplifying all the changes that have come about with respect to Provident Fund rules, where it's no longer mandatory. If you're earning more than 15,000 rupees, then it's no longer mandatory to put 12% of your wages in the Employee Provident Fund. Neither mandatory for you nor mandatory for your employer. So that part we've now understood. Important to also take note of certain changes with respect to PF withdrawal rules. Let me go back to our experts. And Puneet, here I want to start with the change that's happened when you're no longer employed. Earlier, when you quit your job or you resigned, or if you were terminated, if you were unemployed for a period of 2 months, you had access to your PF funds. But now that has changed to a whole 1 year. You have to be unemployed for 1 full year, right? To get access to your PF money. Now, some will find this a little tough and onerous, because what if I don't get an immediate job, or I've taken a break for family reasons or whatever? I don't have access to the PF funds then.
Yeah. So be again, like we can split the withdrawal part contribute provisions into 3 key buckets. One is if your person is leaving employment on account of retirement after 55 years of age, or there is retrenchment of employment, or person has taken a voluntary retirement, fallen under a voluntary retirement scheme. In that case, you can take full withdrawal, 100%, no limitation period, no waiting period for 12 months. But if you leave employment earlier, before 55 years of age, then yes, we have to now wait for at least 12 months to be able to make a full withdrawal. And the reason the government or the authorities probably would have done that is, let's say someone has left employment and then joined back another new employment in 7 months, 9 months, to just ensure that there is continuity of Provident Fund benefit and you have enough corpus, that change in rule has been done. But at the same time, what they've also done is allowed partial withdrawals. And there is one specific category called special circumstance, where a person can withdraw at any point of time 75% of the entire corpus without assigning or giving any reasons to EPFO. So yes, if you leave employment before 55, then you'll have to wait for 12 months to make a full withdrawal, but you can still do a 75% withdrawal at any point of time from EPFO.
Okay, all right. Parizad, you want to add into this the flexibility bit, because even the partial withdrawals that are allowed, there are some very specific stringent conditions, right? For what purpose are you withdrawing? How many times you can withdraw? So if you could just go over those regulations as well, please.
Yes, Urbi. So as Puneet mentioned, one is on the eligibility part and on the process for withdrawal. So clearly with the whole digitization trust, the process is definitely far, far easier. In fact, they have talked about ATM linked, UPI, Aadhaar linked facilities. So that clearly is far more flexible and easier. On the eligibility part, Puneet has already mentioned about full withdrawal at the time of final settlement. There are certain categories mentioned. For partial withdrawals, in fact, earlier in the erstwhile EPF 1952 scheme, there were various multiple categories. Now, effectively, they make 13 categories. One of them, as Puneet discussed, is the special circumstance. But over and above that, there are certain, again, linked to certain life events like essential needs like illness of self and family. Again, you have to be, a member for 12 months, then, education for self and family, and the number of times you can withdraw. So it's specified, like for education, it's 10 times, for marriage, it's 5 times withdrawal, so on and so forth. Then there is a housing category. So for partial withdrawals, it's now basically bucketized into 3 main broad features. And while you are still employed, you must maintain 25% of your eligible PF balance. You can't, withdraw the full amount till you are employed. But up to 75% of the corpus you can technically withdraw. So that's as far as the withdrawal provisions are concerned. The categories have basically been simplified, and the process is far more easier with, the whole thing being towards the electronic mode.
Okay, quick final question to both of you now. We're coming to final thoughts, and, I only have a minute left on the show. And here I'm, making things quite simple. Now, for someone who really needs all the money in their hand immediately, I'm sure they can go up to their payroll team and their employer and say that, hey, just, leave me out of the EPF. I'm above the wage threshold. Just, allow me to get the maximum salary in hand right now today. So let's leave out those category of employees. But for others, for whom long-term savings, retirement security, and creating that, long-term nest is really important, for such employees, what should they ask their employers? What kind of a salary structure would be most conducive to them in this new EPF regime, in this new labor code regime? So that's what I want to understand from both of you. What should we as employees go and tell our employers? Puneet, if you could take that up first.
Yeah, so it'll be very simple, no change. You either continue to contribute 12% of full basic salary, or in fact, if you can go one step ahead and contribute 12% of wages as defined under labor codes, because wages have to be minimum 50% of gross salary. So if someone wants to build that long-term corpus, long-term retirement kitty that we've been talking about, then simply both employer and employee can contribute 12% of wages on a monthly basis, and that can build up the long-term social security.
Okay. And Parizad, so from my perspective, the employee's perspective, I can take a pledge to keep, giving my contributions, but my employer is no longer obligated to match my contribution. The employer might choose to make changes in the CTC structure and add that income somewhere else. So then what should I be cognizant of? Again, what is the conversation I need to have with my HR and payroll team to ensure that the employer contribution, if it's not going in PF, then where else will it make best sense for me as the employee?
I think, Surpi, that's a larger compensation structuring and an HR and a payroll question. It's got nothing to do with Provident Fund, as Puneet has already mentioned. Then you're getting into what the cost to the company is. And it's also going to be interlinked to your tax compensation structuring aspect. A typical compensation structure in India is still going to be broken up into fixed and flexible basket, and that continues based on my experience and seeing the industry trends. It's a combination of your basic, your allowances. Also, it depends on where you are under the old tax regime or the new tax regime. But I would just, very generalistically and simplistically say it's always going to be a combination of your basic salary, your fixed components, your allowances, and your reimbursements and your perquisites, and of course your retired kitty. It's very difficult to sort of, pinpoint and say what an ideal structure is. Yeah.
I think the takeaway is that all of us salaried employees, a trip to the payroll office or the HR office is definitely in order as these new structures roll forward. But thank you very much. You've left us far more enlightened. I think we are armed with the right set of questions and the right information to have those conversations in a meaningful way. So Parizad and Puneet, thank you very much. Very, very helpful and very, very timely conversation today. Glad you could be with us on the show.
Thank you so much.
Thank you for having us. Yeah.
All right. Well, with that, it's a wrap on this edition of Let's Talk Money. Hope you found this conversation useful. Please go ahead, discuss those salary structures with your payroll team. As always, we're going to be here next week with another theme, another topic, and more ways in which you can handle your money better. See you again next week.
Let's Talk Money.
Hello and welcome to this special show on West Asia tensions. I am Ashmit Kumar. Now, Brent crude prices surged after US President Donald Trump declared that the ceasefire MOU with Iran is over. This comes after Washington and Tehran exchanged strikes overnight. Here are the latest developments. Now, speaking on the sidelines of the NATO summit, President said, and I quote, Iran is led by sick and violent people, and if they had a nuclear weapon, they would use it, end of quote. He added that he doesn't want to deal with Iran anymore. Trump said that the U.S. negotiating team could continue talks, but in his words, they're wasting their time. Now, let's understand the chain of events that led to Trump's remarks. The U.S. claimed that Iran attacked 3 vessels near the Strait of Hormuz on Tuesday. A Qatari-flagged LNG tanker was among those hit. However, Iran neither denied nor confirmed these allegations. Then, in the early hours of Wednesday, the U.S. military said that it hit over 80 targets in response to Tehran's alleged attacks. As per the military, the strikes hit Iranian air defense systems, control centers, and over 60 small boats of Iranian Revolutionary Guard in and near the Strait of Hormuz. The U.S. also revoked a temporary sanction waiver for Tehran to export oil. Now, NATO chief defended the U.S. strikes as absolutely necessary. Iran's top negotiator, meanwhile, Mohammad Bagher Ghalibaf, accused the U.S. of violating terms of the MOU. In a social media post, Ghalibaf said, and I quote, "The era of bullying and extortion is over. It leads nowhere," end of quote. Ghalibaf warned that Iran does not fold, and then the Gulf nations felt the heat of this escalation. Tehran retaliated against American strikes by attacking Bahrain and Kuwait. The Kuwaiti army said that it intercepted 2 ballistic missiles and 13 drones, and no material damage or human injuries were reported. Here's what Donald Trump said with respect to Iran.
To me, I think it's over. I don't want to deal with them anymore. They're scum. You know what scum is? They're scum. They're sick people. They're led by sick people. And they're vicious, violent people. And if they had a nuclear weapon, they'd use it. As far as I'm concerned, it's over. I'll speak to our negotiators. They want to negotiate. They're good people. Steve Witkoff, Jared Kushner. But they have to come back to me. As far as I'm concerned, it's just a waste of time dealing with them. They're liars. We make a deal. And if I make a deal with him, we have a deal. And he goes out, he talks. We make a deal. Everyone's agreed. No nuclear weapon. We make a deal. They go outside, talk to the press. They say, we never even talked about it. There's something wrong with them. They're cuckoo. As far as I'm concerned, it's over.
Well, sharp comments, those coming in from President of the United States, Donald Trump, to help us decode some of these comments and what that translates into. Joining us in a bit will be Meera Shankar, former Indian ambassador to the United States. We also have with us Deep Pal, Director of Geopolitics at the Coan Advisory Group. As well, we have with us geopolitical researcher Vivek Kelkar. To all of our panelists, thank you so much for joining us. Mr. Pal, let me come to you first. Again, we're seeing these sharp comments coming out of Ankara on the sidelines of that NATO summit. Tell us, what is your reading of these comments? Is the ceasefire MOU well and truly over? Or is this a case of traditional Trumpian maximalism which needs to be taken with a pinch of salt?
Right. Thank you, Ashmit, for having me. I think we are going to see the agreement basically stalled for now. We saw Vice President Vance cancelling one of his visits to Switzerland over the last weekend. So that is definitely something that's not going to happen, given the way things are unfolding as they are right now. But I think diplomacy will continue through intermediaries such as Qatar and Pakistan. However, those conversations in which they will be taking information back and forth between the two sides, indirectly communicating between the two sides, they will largely be about stabilizing the security situation. In fact, the negotiations on things such as sanctions relief or Iran's nuclear program, they, I think, will be on the back burner right now because, as we can understand for everyone, the focus still continues to be stabilizing movement of tankers and other kind of vessels through the Strait of Hormuz. As well as ensuring that the widening of the geography within which the conflict is now being played, as we have heard, Iranian strikes on US facilities in Bahrain and Kuwait and so on. Right, so the attempt on both sides will be now narrowing that down, bringing down the tensions, and ensuring that prices don't go up war levels once again. That's going to be, I think, the focus, and the conversations are going to continue indirectly as of now. That would be my reading.
Mr. Kelkar, I just want to get your thoughts. Even as Donald Trump has made these comments, what does that mean in the near term? We've seen over the last 24 hours military exchanges between the two sides. 80 targets hit inside Iran. Iran has responded by strikes on Kuwait and Bahrain. Should we come to expect more such strikes going further now that there's a breakdown, it seems, at least as far as on the face of it, in terms of talks between the two sides?
Thanks for having me, Ashmit. I never believed that the MOU would sustain. I never believed that either Iran or Trump would actually come down to a peace situation. And that's where we are, for two reasons. One, Iran cannot lose its leverage over the Strait of Hormuz, not in the middle term. So we've got to look at it from that perspective. Iran reacted, and while we're calling it an alleged reaction, yes, there is evidence that there was a hit on the ship. And that ship was going through the Omani route, which really makes it a little difficult for Iran not to react because it had to in that situation. And if that happened with the Iranian reaction, the US would react as well. So there's no question about that. And over the middle term, yes, for the moment, this MOU does look like it's over. Having said that, you have to note that Trump said that the negotiators would continue talking. He has said that the ball is in his court effectively, but we have to understand that Trump is being Trump at times, and so we have to understand that this will continue. The most important players in this are actually the GCC countries, and among them Qatar. Qatar's role is being grossly underestimated. Qatar shares the world's largest gas field with Iran in the Persian Gulf. So it had a crucial role to play in this negotiation, which happened in Switzerland, and it has a crucial role to play in any negotiation going forward. So we've got to watch.
Even in response to the strikes that we've seen over the last 24 hours, we saw Qatar playing a role where it was trying to, in fact, request both the sides to, in fact, rein in their forces, both Iran and the United States. Joining us now, also with us, is Ambassador Meera Shankar, former Indian ambassador to the United States. Ambassador, same question to you again. Very sharp comments coming in. The language that he's used, particularly calling Iranian leaders liars, scum, saying that they're vicious, saying if they had nuclear weapons, they would have used them. Does this use of language perhaps represent the traditional Trumpian maximalism, or do we truly believe that the MOU is dead in the water, that the talks, that the ceasefire is over?
No, there were many ambiguities and unresolved differences in the MOU, which were papered over. So the possibility of it slipping at any point was quite high. But at the same time, I would say that both sides have an interest in not extending active hostilities. Trump, because US weapons supplies, their stockpiles, have been gravely depleted during the conflict with Iran. And Iran, because they have really suffered, severe losses of leadership, of navy, of the economy has been badly hit. See, the US has again withdrawn the waiver for Iran to make global oil supplies, which was given as part of the MOU. So I think that Iran also will feel the heat. And President Trump faces elections, midterm elections to the House of Representatives in November, where if oil prices spike again, the answers will be seen in the voting in that election. So there are, while there are enough points at which the MOU could derail, and it's not a perfect instrument. At the same time, I would say there are also factors which rein in the two belligerents. And therefore, if you see, while Trump has said it's over, the ceasefire is dead, but the talks can continue, even though it's a waste of time. Now, that's typical Trump, leaving open both options. You know, if the talks lead again to some kind of understanding, fine. If not, then you go back to military action. So I would say that you might see talks being resumed, and let's hope that some kind of patchwork understanding, even if not a perfect understanding, can be reached. Because if you look at the language in the MOU, it basically says the US will remove its blockade of Iran within 30 days, and Iran will make its best efforts to demine the strait and restore shipping to previous level within 30 days. And then in the long run, it says that Iran will make arrangements for administration of shipping or something like that in the Gulf, in some way tacitly accepting Iran's management of the Strait of Hormuz. Now, if that was not the intention, the language is somewhat misleading. And Iran, on the other hand, had given a commitment that for 60 days, they will not charge any shipping fees, though they had left open the possibility that they may impose service charges or some fees later in discussion with Oman and the other the other countries which are, bordering the Strait of Hormuz, the littoral states. And that, this would be in conformity with international law and practice. So the point is that there was ambiguity in the language, which did not leave clear whether the US expectation was that ships would not have to coordinate with Iran before transiting the Strait of Hormuz. It appeared that they had agreed to that from
Ambassador, that ambiguity there coming in the way.
Yeah.
That ambiguity there coming in the way. Mr. Pal, let me come to you. Let me come to you for another perspective. Now, these strikes that have taken place, importantly, comes at a time when the former supreme leader is being laid to rest. Khamenei is being laid to rest. The funeral proceedings are currently underway. What do these strikes coming in the midst of that funeral do as far as Tehran and its geopolitical outlook is concerned? The reason I ask is that will this strengthen the hand even further of the hardline elements and therefore make any talks with Tehran that much harder?
Smith, I think the fact that these strikes are happening in the middle of, and we have all seen the pictures of people milling around the procession for Khamenei, and the processions continuing through for days, and people continuing to be with them. I think on one hand, what that does is it does give more credence to what the Iranian leadership has been saying about their stand, about the fact that they are victims, about the fact that they have been attacked when they were at no fault of their own. So that gives more credence to that. That gives more credence to the fact that the US and Israel have unfairly targeted them. At the same time, it makes it more difficult for the Iranian leadership to negotiate with the US or with other parties in this, because there is a possibility that the hardening elements within the Iranian establishment are going to ask for a far stricter or stronger approach, which leaves very little left for negotiating, which leaves very little opportunity to find a middle path, which both sides would want to have, given there is very little appetite for active combat or active kinetic action moving forward that we have seen continuing for the last few months.
Sure. Mr. Kelkar, I just want to get your thoughts with respect to what we've seen over the 48 hours period. We've seen sharp exchanges between the two sides. We've seen hits on 3 tankers. What then in the near term do you anticipate as far as the flow of energy through the Strait of Hormuz is concerned? So far, the movement had been there, but now we're seeing sanctions being imposed once again on Iran. There are again military strikes. Tankers are being hit, including ships from Qatar. Does that then mean that in the near term, we could see perhaps going back to what we saw earlier in the month of March when there was complete choking of oil supply? Do you see that happening in the near term?
Not really. We have to wait and watch over what kind of escalation happens over the next 24 to 48 hours before we come to a conclusion on that. Having said that, the issue is if the tanker routes or if any shipping routes adhere to the norms Iranian norms where they traverse through the Larak Island route, there might not be these kind of problems. If, however, ships try and put their transponders off, which is what it's reported that this Qatari ship did, and try and go through the Omani route, then there will be problems going forward because Iran, and more particularly the IRGC, has little options but to talk about its leverage over the Strait of Hormuz. So let's be very clear about that. So this is a situation you have to watch out for, but most importantly, you will have to watch out for how the GCC countries, and among them, most importantly, Qatar, really react to the situation. That's the critical thing over the next 24 hours, and what kind of negotiations Qatar actually is initiating either through back channels or more directly with the Iranian regime to ensure that this situation does not escalate beyond this point. This is the critical thing because Qatar is the most important actor economically in this situation.
Sure. So GCC, again, their response will be crucial to watch. They've been hit as well, so it'll be important to watch how they respond over the next 24 hours. Ambassador Shankar, let me come back to the point that you were making, that is this all about essentially wresting control of the Strait of Hormuz? Of course, the chain of events is such that it led with Iran saying that, look, follow the routes that I'm prescribing, don't go close to the Omani coast. And then subsequently, of course, we saw the hit. So is this all about wresting control of the Strait of Hormuz, where Iran perhaps is preparing grounds for levying some kind of fee going forward, perhaps after the 60-day period?
Well, we have to wait and see, but clearly Iran sees this as a key factor which gives it strategic and economic leverage, not just vis-a-vis its neighboring countries in the Gulf, whose exports get impacted, but also vis-a-vis the US. And perhaps it is this leverage which might persuade it to give up its nuclear option. It would be a trade-off, as I see it, and because this is far more effective. But we have to wait and see. And the problem flows from ambiguities in the language of the MOU, under which Iran has been believes that its right to coordinate movement of shipping through the Straits of Hormuz without fees for 60 days, and thereafter, in terms of whatever administrative arrangements it puts in place, has been recognized in the MOU. I mean, my sense is that the trade-off, if really Iran is prepared to give up its nuclear option and to negotiate seriously there, it would be a trade-off between giving that up and having its control over the Strait of Hormuz accepted.
Well, that's an interesting perspective, that trade-off that Iran perhaps may be ready to make. But will that happen? Will the talks even proceed? Well, that's the bigger question that we'll at least find ourselves asking over the next 24 hours. Don't go anywhere. It's time now for slipping into a very short break, but we'll come back and we'll continue this conversation on the road ahead with respect to West Asia tensions on the other side. Welcome back. Still with us, our Ambassador Meera Shankar, former Indian Ambassador to the United States, Deep Pal, Director of Geopolitics at Coan Advisory Group, as well as geopolitical researcher Vivek Kelkar. Again, to all of our panelists, thank you so much for staying on with us. Mr. Pal, let me come to you. Again, there have been 3 occasions where in the course of cessation of hostilities, the US has attacked Iran as well as Iranian targets. We've seen, of course, then retaliatory responses from Tehran as well. What I want to ask is that, is this the new normal, that we will see exchanges between the two sides, verbal as well as perhaps kinetic operations, limited strikes? Is this the new normal that perhaps the markets, that geopoliticians will have to now adjust to?
I think what is very significant, Ashmit, in comparison to those hits, that those attacks that you talk about, where both sides traded attacks on each other, and this time is that every time that happened during the ceasefire or during in the run-up to the MOU being agreed upon and signed and all of that, every time that happened, we heard both sides come out and emphasize how these attacks were very limited responses, limited targets, and they did not violate the terms of the ceasefire or the MOU or what they were working towards. You have to remember that is not how it's been this time, right? Both sides have come out with very strong words. It's not just President Trump who we have heard talk about how he's done with this, which may be hyperbole, but it's not just him. Even from the Iranian side, we have had the speaker come out with very strongly worded statements. We have to wait, obviously, and see how this further proceeds as far as taking stands is concerned. However, I do think that both the Gulf states within the region, as well as a larger community of countries that depend on the region for their energy as well as other kind of needs, are trying to basically understand if this is how things are going to be. I mean, we have seen crude prices go up, and I believe the market is now pricing supply disruption risk rather than peace. Now, at the same time, what we will see happen, I think, in the coming days is the Gulf states strengthening their security around their critical energy infrastructure while seeking to avoid direct involvement in the conflict. We have heard about how some of these countries have already spoken with the Iranian leadership and tried to have some kind of security guarantees for them. They will try and ensure that they don't get pulled into this to the extent possible, but essentially accepting that a status quo ante from pre-28 February 2026 is very, very far away. The uncertainty will continue to be there for the near future.
Sure. Mr. Kelkar, again, I want to build on the point that Mr. Par had made with respect to energy supply. I want to get your thoughts. The oil markets are very jittery. On the back of the strikes against the oil tankers, we had seen Brent go up to 72. Now, with this latest comment coming in from Donald Trump, the Brent crude prices have gone up all the way to 78. It could go even higher if the uncertainty continues. I want to get your thoughts. All of this is happening at a time when even Russian refineries have been hit in the conflict with Ukraine. What does that do to the global oil supply? What does that do to net energy importers such as India in the near future?
You look at the futures prices, and they're still not up. The September futures, and they're still around 76 when I checked earlier in the day. That's the crucial one that you really got to watch out for. The intermediate prices at the moment, the way the prices have gone up, they have reacted to events. And prices have been reacting to events all this time. We have to look at 2 or 3 critical factors to understand what's going to happen over the medium term or over the next 3, 4, 5, 6 months to oil prices. One, there might be early signs of demand destruction globally. You look at why Saudi's actually reduced its oil price over the last, when was it, 24, 48 hours? And that's because China still hasn't picked up Saudi oil. So Saudi has worries over its market share. So because that was in anticipation of a glut coming in because some of the Iranian oil was coming back into the market. Having said that, what sort of demand is actually going to accrue? And a lot of that depends on China. There was talk of China pushing its jet fuel and other downstream petrochemical exports back into the market. In July, there was talk of 3 billion tons coming back into the market. How China will behave over the next few months is going to be critical for oil prices. And having the other demand is actually the EU. EU demand hasn't picked up. So we've got a whole lot of threads to watch out for. The Iranian oil is only one factor in this whole game. There are several other threads that are coming up that we really need to watch out for before we can anticipate what happens to oil prices. Knee-jerk reactions to events will happen.
Right, so knee-jerk reactions perhaps can be anticipated, can be expected. We're running out of time. One final question to Ambassador Shankar, who's still with us. Ambassador Shankar, I just want to go back to the issue that we had raised earlier when you had talked about how neither of the two sides have much of an appetite for continuation of conflict. What I want to ask is that in the statement that Donald Trump made sitting out of Ankara, twice he said negotiators are still free to proceed. They'll be wasting their time, but they're still free to negotiate. Does that then tell you that at least in the near future, there will be cessation of hostilities, at least some amount of respect for not exchanging kinetic operations, not exchanging missiles and drones? Do you see that at least some stability returning to the Strait of Hormuz?
I see that he's left open a door for resuming negotiations, which were going on in Qatar before this latest incident, and which were then suspended to allow time for the mourning and the funeral of Supreme Leader Khamenei, who was assassinated. And then this incident happened. So it's possible that there would be an effort to resume, and certainly from the neighboring countries like Qatar, there would be every incentive to ensure that circumstances are created where normal shipping can resume. Because right now, insurance premiums for the Strait of Hormuz are so high that most ships are preferring to take the route around the Cape of Good Hope from Europe. So that adds a lot of shipping time, but it's safer. So, there has to be some insurance that shipping in Hormuz will be secure, that military operations are not going to erupt again before actual normal shipping resumes. Right now, it's mainly the ships which have been stuck in the Straits of Hormuz, which are seeking to make their passage out.
Right, Ambassador Shankar. That'll be, of course, something we'll have to keep an eye on, the shipping movement through the Strait of Hormuz. But that, for now, is all the time that we have. I'd like to thank all of our guests, Ambassador Shankar, Mr. Pal, Mr. Kelkar, for joining us with your insight on the latest comments coming in from Donald Trump saying that the MOU is over. But with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
Welcome to Indianomics. The big question I'm asking today on the show is, do economists and RBI need to seriously upgrade their India GDP growth forecast for this year? Right now, RBI is at 6.7% and economists on the street are between 6.3 and 6.9%. But just look at the recent data. Credit growth in May and June was over 17%, actually at 17.7%, highest in 2 years. Exports in April and May grew by 16% versus 4% in Jan-Feb March. And auto sales for June alone are at 21% for two-wheelers and 29% for cars. So if India grew by 7.8% in Jan-March quarter, how can we dip below 7% in the April-June quarter? Joining me to discuss the India growth picture are two top economists, Samiran Chakrabarti of Citi and Shantanu Sengupta of Goldman Sachs. Of course, since we have these two top economists, we are also going to discuss FCNR deposits, balance of payments, direction of rates and rupee. But first, the growth question. Samiran, to you, exactly what I said. If Jan-March was 7.8, and if April, May, June has seen 17% credit growth, 16% export growth for April, May at least, and fiery auto sales, should we be prepared for a 7% plus GDP for this quarter and for the year?
So, Lata, thanks for having me. Our own number for the quarter is 7% plus. So I think the high frequency indicators that we have got, they're tracking that around 7% GDP growth number. But as you know, large part of the GDP comes out of the corporate earnings. We are yet to find out that how those corporate earnings numbers will look like for the quarter. Based on that, we might have to tweak the numbers a little bit up and down. But for now, I think 7% is a real possibility. And there is a good reason behind it also. We would have to go back and see that 2025 was a year of stimulus for India. And that stimulus effect gave the economy a certain kind of momentum, which probably was able to counter the headwinds coming from the Middle Eastern conflict situation. And even from the conflict, I've always maintained that two things worked in India's favor. India does not produce power out of natural gas, and India had enough diesel and petrol stock because it's a refining economy. And because of these two things, power and transport, two of the most important things in growth, was not affected. So with that stimulus and these two supporting factors, I think the economy did pretty well even through the April-June period. Now, whether there is any lingering effect from this shock that still will pass on into the rest of the year, whether the shock can re-emerge or not, these are still open questions. But for now, whatever macro high-frequency data we are tracking seems to suggest that things have held up better than what probably people would have feared.
Would you say that there is an upside bias to your 6.9%? The reason why I called Shantanu and Samiran, both of you are at the higher end of the GDP forecast. Shantanu is at 6.8 and you are at 6.9. But will you say there is an upside bias now to the 6.9 going by the April, May, June data?
So, I mean, we have to be honest in admitting that this decimal place forecasts are not easy, and we should not put too much emphasis on this, the decimal number after the 6% or 7%. So, but given still, I think one of the things that we are still yet to figure out fully is the El Nino effect.
Yeah.
So maybe that's why we have taken about a 20 basis point odd lower number on our forecast, thinking that that's the kind of El Nino growth effect that we have to factor in for. If monsoon turns out to be better than what feared, then maybe there is some upside to our GDP growth forecast as well, based on the fact that we have already taken that 20 basis point downside in our forecast.
Okay. I just have this doubt that, this hunch that economists, all of us, were very bearish in April and May when the way the rupee was behaving and crude was behaving. But now that things have subsided on that front, two dramatic changes, crude from above 100 to around 70, 75, and this FCNR gush, maybe we need to change the numbers. Shantanu, therefore to you, would you say that given the recent data, there can be an upside bias to your 6.8%?
I would just say, thanks for having me in the first place, Radha, but I would just say that there are two parts. One is the economy has been more resilient through the crisis, but that's not true for only India. That's pretty much true for many other emerging markets that we have seen. Inventory draws have been quite stark across the world. Two, refinery runs have also been quite high for the refineries that worked. And that is what has cushioned most economies, and that was a learning for us as well, that you're able to withstand these kind of shocks better. The second thing, apart from the power point, which Samiran rightly pointed out in our view, is that you're able to switch to other forms of fuel very quickly. So the renewables surge has also been quite stark for India over the last several years. This had nothing to do with the Middle East conflict, but over the last several years, post-pandemic, you've been shifting, and therefore you did not quite feel the kind of shortages where other countries were dependent on fossil fuels. With regards to the current growth trajectory and going forward, what we think, I would say a slight upside risk to our fiscal year numbers, mainly from where the conflict is right now and the fact that oil prices are in the low 70s or the mid 70s, although it's ironic that we are talking on the day when, again, it's $75 a barrel. But I'll just point out that, remember, the consumer was completely insulated through the crisis until about mid-May. So June is the first month where you saw the impact of higher prices on the consumer. And this quarter will be the first quarter where the consumer will feel that price effect for the first time. Having said that, as you pointed out, credit growth is doing better. Monetary policy stimulus is working through. So I would say a slight upside risk to the numbers with the current state of affairs.
And your first quarter number?
We have a 6.8, and I would say an upside bias to that.
Okay. Shantanu, you were saying that it's not just India. A lot of countries exhibited this resilience. And I was looking at the export growth of many countries. I don't know what their historical trend is, but many of them were at double digits. And ours is clearly an outperformance in April and May. And I'm only taking goods. I'm not even looking at services exports. Goods exports was up 13.5% in April and 18% in May. So there seems to be a global engine that's working favorably. Would that be a reason to upgrade Indian forecasts as well?
I would just say that even there, we should be careful about looking at the kind of goods during that period that countries were demanding. So, for instance, our exports to the Middle East shrank in the month of March and has rebounded very, very quickly thereafter. So if you look at the charts, it'll look like a sharp dip and then a very, very sharp rebound. And you are also supplying refined products to the rest of the region. You are able to refine and supply, especially to Southeast Asia. Singapore was a big importer of products. And hence, that's the kind of goods trade that went on during that period. But overall on growth, I would say the points that you made earlier during the conversation, which is credit and the general broad basing of credit. I mean, industrial credit growing at 15% is a very, very positive number for and probably merits thinking about whether there are upside risks to growth.
Fair enough. And you're giving me that handover very nicely, because that was my next question to both of you. Samiran, this FCNR money, first of all, how much are you all anticipating now that we are a few weeks into the scheme? If it is $50 billion or thereabouts, that's whatever, 5 lakh crore more of money which banks will have. So first of all, how much? And will that also have a positive impact on growth?
So, Lata, it's a difficult thing to estimate right now that how much money will come in. If I just extrapolate from the FX reserves data that RBI is publishing every week, it doesn't look like as yet too much of money flow has happened. So our estimate is all the three schemes combined, we will get something around $55-60 billion additional coming in. Yes, it clearly increases the availability of resources with the financial system to lend, or in other words, part of this can go into retiring the high-cost debt that the system has got, and the rest can be on lent for credit. And now, obviously, this is the lean period for credit, so immediately it might not go into credit, but might go into some investments into bond as well. But the bigger question really is that this credit growth is now very, very strong. In fact, not just the banking system credit. Yesterday, RBI has published the NBFC monthly credit data also, and it shows that the retail credit growth, X of housing, is growing close to 25%. Credit growth to consumer durables is 42%. Gold loan growth is close to 70%. So clearly there is a huge momentum of credit growth that is there. And this in turn is probably supporting the consumption activity as well. So once this consumption recovery takes shape, then it can feed into a proper investment recovery as well. So this is something that we have to very closely observe, that to what extent this additional liquidity that is coming in can get absorbed in the higher credit growth versus how much RBI will have to mop up from the system through its sterilization measures.
Fair point. So there is this positive Indian engine in terms of liquidity. Shantanu, similar question to you. Would you therefore say that what is your FCNR number? What is the growth impact?
On the FCNR, we are, again, putting all the three schemes together. So that's the FCNR, the ECB, as well as the bond inflows. We would think it will be about $80 billion. Again, the question really on the FCNR is the amount of leverage that foreign banks or domestic banks are able to take. If that is indeed very large, this number could be materially higher than what our estimates are. The liquidity impact, again, I would agree. We don't think even $80 billion will be easy for the RBI to manage if it comes in a very short period of time. That is in the next 6 to 9 months, and therefore we'll have to look at the sterilization tools. Of course, many at their disposal, but I think that question will come up. What that does is it keeps financial conditions in general benign in terms of liquidity. What happens to rates eventually going into next year if growth is indeed this strong is another question. But it keeps overall financial conditions quite benign, and it solves the liability overhang that the banking system has had over the last couple of years or so. And that should essentially make sure that the credit growth cycle extends. Remember also, right now you're only looking at the domestic credit growth. It is happening at a time when ECBs had come down. So if you look at the overall system, so apart from the NBFC credit that Samiran mentioned, I would just say that you'll also find ECB-induced lending also coming into the Indian system. So the total private credit is going to look quite strong over the next year or so in our view.
Okay. I still have questions on rates and rupee, but before I take the break, just a word, a yes or a no. Would you say there is a very good chance of a 7% plus GDP growth this year? Samiran?
It's possible.
Shantanu?
Yes, I would say upside risks to our numbers.
Oh, thanks, both of you, for endorsing my optimism on economic growth. Have to take a break, but thereafter, important questions on inflation, where interest rates are headed, and where rupee is. Welcome back to this important Indianomics edition. I've been speaking with Shantanu Sengupta of Goldman Sachs and Samiran Chakraborty of Citi India. There is this Bengali, control over Indian economic thinking, and that is reflected here in my guests. Okay, before the break, we were discussing the growth picture, but very importantly, inflation. We did see this one reading of 8% plus on WPI, but thereafter we've seen some of the fertilizers, etc., ease off. Samiran, what's the sense about inflation? Are we going to see it even go to the Reserve Bank's forecast of 5% plus? Even I think they're standing at 5.9 for the third quarter. Will we be pleasantly surprised?
Samantha, there are three parts to this inflation discussion. One is what you were referring to, which is the WPI part, and that's more connected to the input costs in some sense. In the Ukraine war period, we saw that whatever was the increase in WPI over the 4 months when the conflict was at its peak, that got completely reversed over the next 12 months. So do we see a similar pattern emerging in this conflict as well, that over the next few months, this whole input price shock dissipates in a very even way? So that's one part. The second part is obviously the impact that is coming from the El Nino shock. As yet, there is nothing visible except for some increase in rice prices, which is slightly unseasonal, and some increase in edible oil prices. We don't see any signs of price pressures even going on to vegetables, etc. So no second round effect also. We have built in about 40 to 50 basis point upside risk from the El Nino. So we'll have to observe that to what extent we are right on that forecast. And the third factor is what we were discussing before about this somewhat improved growth momentum, particularly coming from the credit side. Does it have any meaningful effect feeding through to core inflation numbers with a lag? So these are the three things that I will be watching very closely on the inflation front. Our current view is average CPI headline of about 4.7% for the full year, with core somewhere around 4.5%, which probably does not warrant too much monetary policy action, even if for one quarter the headline numbers are slightly higher because of base effect. I think RBI can see through that.
Okay. Shantanu, you have an even lower forecast for inflation, if I'm not mistaken, for the full year. Then why are you expecting rate hikes?
Oh, so we have a 4.9 for the year. We are at 4.1. We go to 4.7, and by Q3 we are at 5.5, which is still about 50 basis points below the RBI. Look, our point is that, again, very quickly on the El Nino, our sense is that this is more of a, this will be surprising, but it's more of a winter cycle shock than a summer shock, because we think that the inventories are pretty strong in India. So we should not really have a material impact on rice or other long cycle crop prices right now. If at all it impacts, if reservoir levels are lower, it impacts the winter crop more. So that's why we have a little more backloaded inflation. We still think that core goods inflation will be high. Once companies raise prices, they don't tend to bring it down quickly. And therefore, if growth is indeed this strong, then later this year or next year is when we think a very shallow hiking cycle is on the cards.
Okay, fair enough. Are you expecting, Shantanu, anything specific from RBI in terms of liquidity absorption? I mean, is there a temporary CRR hike or something? And separately, where do you see yields itself? Yields have fallen from, 7.1 to 6.7 for the 10-year. Does it go even lower?
Well, on the bond markets, we think we like the ultra long end tenor of the curve. We like the 30-year bond space. Yields there. The curve was very steep. Yields were quite elevated there, and therefore we like owning that part of the curve. Also because not just because of FII demand, but also because of insurance, pension, and more local demand. With respect to liquidity, I think it's going to be a tricky question. It's a tricky question because the quantum of the FCNR is really unknown. So you can think about unwinding some of the short forwards, but eventually if you end up with a large liquidity injection, our sense is that short-term reverse repos will not be very effective in a situation. So, maybe we haven't really thought about the CRR, but maybe something like a longer-term reverse repo. So the exact opposite of what you had during a TLTRO is what you might be ending up looking at, because there's no way in this cycle that the RBI can be selling bonds and be doing OMO sales. So we think that those are the couple of options on the table.
Oh, yes. Something like a TLTRRO is on the cards, is it? Samiran, what's your estimate of where bond yields are headed?
No, first on the liquidity thing, I think the very interesting difference between the 2013 FCNR period and now is that the 2000 FCNR announcement was in September, and most of the flows were coming in October, November, which happens to be the festive season where the currency in circulation increase is significantly higher. So almost 70-80% of the inflows at that time was absorbed through increase in currency in circulation. This time around, we have that sort of a 2-3 month gap to hit that festive season currency in circulation increase period. So there is some merit in considering that we do some liquidity sucking mechanisms which last for that 2-3 months and then hope that the currency in circulation increase takes care of the liquidity problem to some extent. Also in 2013, RBI had issued the cash management bills, the CMBs. So we can consider the CMBs. I think the CRR hike will be somewhat odd because on the one hand, we are giving CRR relaxations on the FCNR inflows, and then we are putting CRR back on the incremental deposits, so it will go in cross purposes. So I think we have to think of more a CMB / longer term VRRR to head into that October-November period and get the currency in circulation increase to take care of the rest of the issues. Yes, bond yields will keep on trying to push downwards till the point RBI signals that it's now starting its sterilization program. I think that will probably where the bond yields will hit the bottom. And obviously, we are going to track the global cues to see whether any Fed rate hike expectations, how it changes in the market, because that can also have a meaningful effect on this cycle.
I just want a quick last question to both of you. Samiran, even if the Bloomberg Barclays bond inclusion doesn't actually happen, it does look like it is around the corner. And we already have seen debt FPI flows fairly sticky, better than equity for sure. So what's your call on the rupee, Samiran, and then I come to Shantanu?
So one thing is already happening. Whether to some extent the front running of the index inclusion news is happening or not is hard to say. But because of the removal of the withholding tax and the capital gains tax on Indian government bonds, there was a certain section of FPI investment which was going towards the quasi-sovereigns issuances which do not have this capital gains tax earlier. Now, but those are illiquid markets. So now some of that investment is flowing back into Indian government bonds because they also now have the similar characteristics compared to those quasi-sovereigns. So our sense is that we're going to get, if you look at our BOP forecast itself, it has completely swung from a 50 billion deficit to a 45 billion surplus now. So almost 100 billion swing in just about a fortnight. So this creates the right backdrop for RBI to reset the USD INR levels to a much lower level. The governor himself has mentioned in media interviews before that the INR is undervalued. So this is probably a good time to get that undervaluation corrected and to go to a more fair value levels. But this process will probably start only after we see the inflows actually materializing. Today, it's too early for that.
Fair point. Shantanu, out of time, but what's your rupee range?
We're looking at 94, 96 as the range, 94 in the more short term, so a bit of appreciation from here. And then over a 12-month period, once all these flows are over, we think you trace back towards 96 odd. So you'll have a little bit of vol, but it's going to be very much anchored around where current spot levels are.
Okay, thank you very much, Shantanu and Samiran, for a 360-degree perspective of the economy and for endorsing my optimism that we are likely to head to a 7% plus growth, and that yields are still likely to be headed lower until the Reserve Bank shows its hand on sterilizing the liquidity. Thank you very much for joining me on this very interesting edition of Indianomics.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening.
It's over. I don't want to deal with them anymore. They're scum. You know what scum is? They're scum. They're sick people. They're led by sick people.
President Trump pulls the plug on the ceasefire agreement with Iran as both nations resume hostilities. Iran targets American military installations in the Gulf hours after the U.S. carried out airstrikes. NATO rallies behind Trump, calls the U.S. attacks absolutely necessary. Crude oil prices flare up with Brent hovering near $80 a barrel. U.S. also revokes the authorization for Iran to sell its oil. Shipping traffic grinds to a halt at the Strait of Hormuz. Deep cuts on Dalal Street. The Sensex loses nearly 1,700 points. The Nifty drops below 23,900. All sectoral indices close in the red. The rupee weakens by over 50 paise against the dollar. Foreign portfolio investment into Indian bonds hits a record high in June as inflows cross 41,700 crore rupees. Removal of capital gains tax, withholding tax, and expansion of the fully accessible route boosts investments. The Union Transport Minister Nitin Gadkari dares critics to identify a single car that faced problems due to E20 fuel. Defends the ethanol blending policy despite widespread fears over fuel efficiency and engine safety. India's clean energy push hits a new milestone. More than 50% of the electricity supplied on the 6th of July came from clean energy sources, but the solar penetration is also causing stress to the grid. Outrage in Maharashtra after a Shiv Sena corporator and his supporters attack a doctor and medical staff in Mumbai. Doctors across the state threaten to go on strike from tomorrow. The U.S. Justice Department indicts a Punjab police officer along with gangster Lawrence Bishnoi and 35 others, accused them of a wide range of crimes, including targeted killings, extortion, racketeering, among others. Messi magic breaks the Egyptian spell as Argentina overcome a 2-goal deficit in stoppage time to reach the quarterfinals. Switzerland edge out Colombia on penalties to reach the World Cup quarterfinals for the first time in 72 years. 39-year-old Novak Djokovic survives a 5-hour set marathon to enter the Wimbledon semi-final, beats Felix Auger after 5 hours and 15 minutes in what was Djokovic's longest match at Wimbledon. Well, let's go straight to the top story this evening. Now, President Trump has declared that the ceasefire MOU with Iran is quote-unquote over. This comes after Washington and Tehran exchanged strikes overnight. Now, let's break down the latest developments for you. Speaking on the sidelines of the NATO summit, President Trump said, and I quote, "Iran is led by sick and violent people, and if they had a nuclear weapon, they would use it," end of quote. He added he doesn't want to deal with Iran anymore. Trump said the U.S. negotiating team could continue talks, but in his words, they're wasting their time. Now, let's understand the chain of events that have led to Trump's remarks. The U.S. claimed that Iran attacked 3 vessels near the Strait of Hormuz on Tuesday. A Qatari-flagged LNG tanker was among those hit. However, Iran neither denied nor confirmed the allegations. Then, in the early hours of Wednesday, the U.S. military said it hit over 80 targets in response to Tehran's alleged attacks. As per the military, the strikes hit Iranian air defense systems, control centers, and over 60 small boats of the Iranian Revolutionary Guards in and near the Strait of Hormuz. The U.S. also revoked temporary sanctions waiver for Tehran to export oil. Now, NATO's chief, Mark Rutte, defended the U.S. strikes, and I quote, is absolutely necessary. Meanwhile, Iran's top negotiator, Mohammad Ghalibaf, accused the U.S. of violating terms of the MOU. In a social media post, Ghalibaf said, and I quote, "The era of bullying and extortion is over. It leads nowhere." Ghalibaf warned that Iran does not fold, and then Gulf nations felt the heat of the escalation. Tehran retaliated against America's strikes by attacking Bahrain and Kuwait. The Kuwaiti army said it intercepted 2 ballistic missiles and 13 drones, and no material damage or human injuries were reported. Now, in the oil markets, Brent crude prices surging after President Trump pulled the plug on the ceasefire. According to ship tracking firm Marine Traffic, vessel movement in the Strait of Hormuz is resilient despite the strikes. Now, here's what President Trump said on Iran. Listen in for yourself.
To me, I think it's over. I don't want to deal with them anymore. They're scum. You know what scum is? They're scum. They're sick people. They're led by sick people. And they're vicious, violent people. And if they had a nuclear weapon, they'd use it. As far as I'm concerned, it's over. I'll speak to our negotiators. They want to negotiate. They're good people. Steve Witkoff, Jared Kushner. But they have to come back to me. As far as I'm concerned, it's just a waste of time dealing with them. They're liars. We make a deal. And if I make a deal with him, we have a deal. And he goes out, he talks. We make a deal. Everyone's agreed. No nuclear weapon. We make a deal. They go outside, talk to the press. They say, we never even talked about it. There's something wrong with them. They're cuckoo. As far as I'm concerned, it's over.
Well, that is President Trump saying, as far as he's concerned, it's over. Now, pulling the plug on the Iran ceasefire wasn't the only curveball that Donald Trump threw in Ankara. He renewed his criticism of NATO, voicing frustration over what he described as Europe's lack of support during the Iran conflict. Now, remember, this has long been a major flashpoint between Washington and the alliance. The Trump administration has repeatedly accused European NATO members of failing to shoulder their fair share of the security burden. Steve Sedgwick reports from Ankara on the points of friction between Washington and Brussels. Steve.
The president is really irked about the lack of perceived support from NATO members for Operation Epic Fury, the fact that they didn't overtly support and get involved in the military action, and in some cases refused American base usage for offensive actions against Iran. For defensive actions, that was allowed from some of these nations as well.
Not happy with NATO because of what they did with Greenland, and I'm not happy with NATO because of the fact that They didn't want to help us with the #1 state sponsor of terror, that's Iran. They were unwilling to help us. Now, in all fairness, I didn't speak to Mark about it. I think if I did, it might have been different, but we didn't need help.
Very interesting. I haven't spoken to one leader here yet who is willing to acquiesce to Donald Trump's demands and actually, or hopes previously, that they get more actively involved. And he says, look, I'm done with NATO. I'm fed up with it. They weren't there when we needed them. NATO would probably argue that the only time that Article 5 has been enacted, this mutual defence pact, was obviously after 9/11. The president also, in the sound that we've been listening to this morning, talked about the $1 trillion that the US has spent on NATO. I think perhaps maybe that's a conflagration of two different issues. As we all know and our viewers know, the Pentagon budget for defence is circa $1 trillion. I think the last figure I saw was $980 billion. But the US hasn't spent $1 trillion on NATO per se. In fact, its dues for the NATO infrastructure is in the low single-digit billions as well, although, as we all know, and it is unequivocally the case, the US has been the major supplier of the burden supporting European nations in the post-World War way. And, of course, his great problem was that Europe wasn't doing enough. Europe listened, it's spending a lot more money, it is getting towards that 5% target, but it's trying to get there by 2035. But the problem is, the Pentagon is conducting a review, which will be for 6 months from June 18th onwards, and actually some nations who don't seem to be spending enough money may lose some support from the United States.
Steve Sedgwick there reporting on the flashpoints between President Trump and NATO at the NATO summit in Ankara. Now, President Trump has also renewed his call for the U.S. to take control of Greenland. Trump said Greenland should be controlled by the U.S. and not by Denmark. He also threatened to pull U.S. troops out of Europe over the continent's pushback. So, reiteration of old positions.
Greenland doesn't help Denmark. Denmark doesn't spend money to really help Greenland. But it's an important part for the United States. And it's surrounded by China ships and Russian ships. And that's not going to happen. The ships it's not going to happen. It was Greenland that, and it continues to be, that should be controlled by the United States, not by Denmark. And when they wouldn't go along with it, and with all the money we spend to help them with Russia, and we don't have to spend any money, we could remove all of our soldiers out of Europe.
Well, Trump reiterating old threats. Now, Russian forces have attacked Ukraine with drones and missiles targeting Kyiv for the third time in less than a week. Ukraine's defenses claim to have intercepted 80% of 169 drones used in the overnight attacks. Meanwhile, Ukraine struck 9 more Russian Shadow Fleet tankers in the Sea of Azov overnight. The latest strikes take the total number of Russian vessels hit over the past 3 days to 21. Ukrainian forces also targeted military sites in occupied Crimea, with 6 more power substations hit under Operation Crimean Switch. And the fresh flare-up in West Asia led to a sell-off across stock markets worldwide. The Sensex lost nearly 1,700 points, the Nifty dropping below 23,900 after a sharp sell-off. And no sector was spared as all sectoral indices ended in the red. The volatility index surging nearly 25%. The Nifty Bank down almost 3%. Nifty PSU Bank Index down almost 3% as well, and 2% lower for both the Sensex and the Nifty. Prashant standing by now with the market wrap. Prashant, markets clearly on the edge on the back of all the comments coming in there from President Trump.
If you look at the Nifty, from about 150 in the afternoon, we lost another, 250 to 300 points or so. So 2% cut on the Nifty, all told by 3:30. The Nifty Bank lost 2%. The small cap index lost about 2%. The mid cap index did a little better, but not by much. India Wix jumped some 24-25%. We're back at the 14-ish, 15-ish kind of level. So a volatility index spiking there. And banks really is where this showed up, right? So you look at the PSU Bank Index, the private bank index, and of course, as I said, the 2% cut on the Nifty Bank itself. Now I'll just come to the large cap losers. Jio Finance, Indigo, Shriram Finance, Maruti, HUL, Kotak Bank, Mahindra and Mahindra were essentially the big losers which came through. And actually, by the end of it, only one name with over a 1% pop. And guess what? That's ONGC, as oil moved up substantially in the last 24-hour period or so. The advance decline was deeply negative today. So some 2,700 stocks down, some 600 stocks higher. So pretty one way. And Coforge was down 4.5% today. It's the best performing IT stock by some standards. AG's Logistics has had a one-way move higher, 10% lower. Chola Finance was down 4.5%, 361 down 5%, Force Motors down 4.5%, CDSL, Viatec Vibhag, Apar Industries, HDFC, AMC, Emphasis, SRF, and so many others which, were under pressure. But, enough and more volume on the other side as well. So BSC, which basically had lost about 3-4% yesterday, was up 2% today. MCX, similar case, down yesterday, back up 4%. So just flipping on the other side, Naukri was a big mover yesterday, was a big mover for quite a while today, but of course came off the highs, 1.5 higher there. Aether was a big mover, 5.5% gains coming through. Balaji Amines and Alkyl Amines were the other two big movers, I think about 10% respectively. And Orchid Pharma also stood out with about 7.5 odd percent kind of gain. So that's the picture. The headlines doing the damage, but markets, of course, on wait and watch mode because, this is known to be a pretty volatile set of headlines which tend to move around and then markets have to respond and adjust on the other side. Back to you.
Yes, we will have to keep tracking those headlines coming in from President Trump. Prashant, many thanks for joining us. In the money market, the rupee weakened by over 50 paise against the dollar. The currency breaching the 95 mark once again. 10-year bond prices also declined in trade with the yield spiking above 6.7%. But staying with the bond market action, foreign portfolio investors are flocking to Indian bonds once again. FPI investments crossed 41,700 crore rupees in the month of June, hitting a record high. Ritu's here with more on what's driving the foreign inflows. Ritu.
Well, yes, foreign investors are making a strong comeback to India's government bond market following the series of measures that were undertaken by the government and the RBI to make these investments more attractive. And the result is record investments into Indian government bonds under RBI's fully accessible route for the month of June. If you look at the CCIL data, foreign portfolio investors made a record net investment of 41,773 crore rupees in these securities just in the month of June. And that is a sharp turnaround from March when they were net sellers and a huge jump from the inflows of just about 5 to 5,500 crores each that we saw in April and May. Now, the buying has also taken the total FPI holdings in these securities to 3.73 lakh crore rupees, and foreign investors now own about 7.12% of all the bonds that are available under the fully accessible route. Now, their participation is also becoming broader. So you have 11 government securities that now have foreign ownership of more than 10%. For instance, the highest foreign holding is 21.5% in the 7.38% government security maturing in 2027. Now, the reason behind the surge is obvious. The government has removed that 12.5% capital gains tax and the 20% withholding tax on interest for eligible government securities that are bought by foreign investors, which makes these attractive. We also saw RBI expanding the list of bonds that are available for investment under this fully accessible route. And then to that, you add the fact that there's growing expectations of India's inclusion in the global aggregate bond index. And on the back of that, you have overseas investors that are increasing their exposure to Indian government bonds. Now, let me finish by saying while foreign investors have been pouring money into the bond market, the contrast with equities has been quite striking, where FPI inflows are only just starting to pick up since the second half of June.
All right, Ritu, many thanks for joining us. Now, the Q2 earnings season kicks off tomorrow with TCS expected to report muted revenue growth. Rima is here to wrap up what we can expect. Rima, quick curtain raiser on what we should expect.
Expect a muted quarter from TCS. Revenue seen flat in constant currency. The broad range from analysts was minus 0.1% going up to plus 0.4%. Margins will take a hit, down 120 basis points on a sequential basis to 24.1% because of a wage hike. Now, wage hike typically shaves off 150 to 200 basis points in the margin, but there was a sharp currency depreciation. The rupee fell by 2.5% quarter on quarter, and that will provide some currency tailwind, and therefore net-net on the margins, the CNBC TV 18 poll is for a drop of 110-120 basis points, and bottom line profits will also decline partially. There could be a one-time legal expense, according to analysts, as the company settle the case. Now, TCS share price has gotten hit. Year to date, it's down more than 35%. Valuation multiples at one point of time, peak value, it will always command a premium valuation multiple, 22, 24 times, and now it's down to 13, 14 times. Remember, the company's ambition is to be the world's largest AI-led services. The stock stock has gotten battered, as has the entire IT sector. Expectations are low. What can the companies say to reverse the narrative? We'll wait back to see.
Yes, we will be tracking the TCS numbers. Rima, many thanks. Packaging Solutions provider NAC Packaging made a strong debut on the Lal Street shares, listing at 188 rupees a piece, a premium of 11% to its issue price of 170. IPO received strong interest and was subscribed over 83 times. The company currently has an installed manufacturing capacity of 43,300 metric tons per annum and plans to utilize 320 crore rupees from the IPO proceeds to set up a new manufacturing facility. Kusumgar's 650 crore rupee IPO was fully subscribed within the first few hours of bidding on the first day. As of 4 p.m., the issue has been subscribed over 3 times. Demand was led by non-institutional and retail investors. Retail portion subscribed by over 3 times and the non-institutional investor portion subscribed 6 times. Kusumgar manufactures advanced technical textiles and engineered fabrics. Shares of South Indian Bank down in trade today, even as the RBI approved the appointment of its next MD and CEO, Mahesh Muralidhar Pai, will take charge as the bank's MD and CEO for a 3-year term beginning the 1st of October. His appointment will be placed before the bank's board next week. Pai currently serves as the Chief General Manager heading Digital Banking and Innovation at Canara Bank. Pai will succeed PR Sheshadri, who stepped down in January of this year. Time for us to head into a break, but up next, Union Road Transport Minister Nitin Gadkari dares critics to identify a single car that faces problems due to E20 fuel. That and more when we return. Union Road Transport Minister Nitin Gadkari has challenged critics of the E20 fuel to identify a single car, in his words, that's been affected. Gadkari's response while speaking at a Sudarshan TV event comes amidst allegations that the use of blended petrol is impacting car engines and reducing mileage. Now, last Saturday, in a rare show of unity, 3 of India's leading automakers addressed a government-hosted press conference to defend the centre's ethanol fuel mandate. Take a look.
इस प्रकार की झूठी बातें, और इसलिए मैं आप एक ही बात बता रहा हूं, आपके मार्फत मैं देश के तमाम लोगों को यह आह्वान करता हूं कि कोई भी स्कूटर, मोटरसाइकिल और कार जो पेट्रोल की है, जिसमें इथेनॉल डाला जाता, अगर खराब हुई है तो तुरंत डीलर के पास जाइए, तकरार करिए और एक कॉपी मेरे पास भेजिए। ऐसी एक भी कार और स्कूटर का नाम चवन के जी अगर आप बता पाएंगे तो मुझे बताइए। बिल्कुल हमने भी कोई आया ना मेरे सामने.
Well, the Gadkari challenge there. And staying with the E20 fuel controversy, Santosh Iyer, the CEO of Mercedes-Benz India, says customers should have the freedom to choose the fuel that they want to use. Speaking to CNBC TV 18, Iyer also said that Mercedes-Benz customers don't have anything to worry about. He flagged adulteration in fuel as a bigger concern than the E20 petrol. Take a look.
Cars which we have sold from 2020 are anyways certified materially compliant. Even 23, 24 onwards, they are also even emission and range compliant. So I think customers don't have to worry anything about the older cars as well, which are manufactured and sold after this period. Even before this period, I think the cars will be able to run. There may be certain compromises, slight efficiency drop. But, you know, it's not that overnight the government has put 20% ethanol. These cars have been running on 15% ethanol any which ways. I think one of the bigger problems that emerged in this crisis, in this entire debate, is a lot of adulteration is still happening in fuel pumps, which also means it's not E20, maybe somebody's filling an E30 or something else, and in terms of the fuel mix, and that is maybe causing problems to one of the other consumers as such. But a good amount of education and also, as I said, you know, for us, we have already launched the E25 car. We introduced a new S-Class plug-in hybrid in Mumbai last 2 weeks back, and that's already E25 compliant. So we are always ahead of the curve, and our customers need not worry on this topic.
Well, that's Mercedes-Benz India saying that they are E20 compliant, but fuel adulteration is a bigger concern today. A Pakistani cargo plane operated by K2 Airways has gone missing over the Arabian Sea. The Boeing 737 carrying 5 crew members vanished from the radar around 155 nautical miles west of Karachi after reportedly suffering a navigation failure. Pakistan Civil Aviation Authority says search and rescue operations are underway. The cause of the disappearance has not been confirmed as of now. The rape and murder of a 12-year-old girl in Buripur has sent shockwaves across West Bengal. One of the main accused in the case is now dead. Prabhas Mandal was shot dead during a crime scene reconstruction exercise early this morning. Police say he allegedly grabbed a firearm, fired around and tried to escape, prompting retaliatory fire. Mandal was arrested after CCTV footage allegedly showed him walking with the 12-year-old victim before she went missing. 3 other accused in the case remain in police custody. Now, the U.S. Justice Department has indicted a Punjab police officer along with gangster Lawrence Bishnoi and 35 others. Authorities accuse them of a wide range of crimes, including targeted killings, extortion, racketeering, among others. Archana is standing by with the details. Archana, take us through the indictment that has come in from the U.S.
Right. So in a stunning international crackdown, Shireen, the U.S. Department of Justice has charged jailed Indian gangster Lawrence Bishnoi and his close aide Goldie Brar with orchestrating the high-profile 2023 assassination of Sikh separatist Hardeep Singh Nijjar in Canada. The charges are part of a massive global operation called Hardball. Now, FBI Director Kash Patel announced that agents working with partners in Canada, Europe and India have arrested 24 suspects across the U.S., Canada and Europe. A total of 37 individuals now face charges including racketeering, extortion, narcotics, trafficking, targeted killings, kidnappings and firearm offences. Now, at the centre of the indictment is the Bishnoi crime syndicate. The 33-year-old Lawrence Bishnoi, this gangster who's currently lodged in Sabarmati jail in Ahmedabad, is accused of running his international criminal empire from behind bars using smuggled cell phones and encrypted communications. Remember, Nijjar's killing had triggered a diplomatic crisis after the then Canadian Prime Minister Justin Trudeau said months later that the authorities were actively pursuing credible allegations linking the Indian government agents to the murder. New Delhi, of course, rejected the claim as absurd. However, in the latest US indictment charging Bishnoi and Goldie Brar, there is no allegation against any Indian government official in this killing. Nijjar, who was a Canadian citizen, had campaigned for the creation of Khalistan, which is an independent Sikh homeland carved out of India, and had been designated a terrorist by New Delhi. Now, also charged in this case are Bishnoi's associate Goldie Brar,
a Punjab police officer named Gurinderjeet Singh. The government has taken note of that. The Punjab government has taken note of this development. And of course, rival gangster Jaggu Bhagwanpuria, who runs his own criminal network in Punjab. Now, the latest is that the US is actively hunting 10 more fugitives. 7 are believed to be in the US, 2 are in India, and 1 is in Europe. The FBI has offered a reward of up to $50,000 for information leading to the arrest of Goldie Brar, also known as Satyendra Singh. Back to you.
Archana, many thanks for joining us. The big sporting story is Lionel Messi powered Argentina into the quarterfinals of the World Cup. A heartbreak for Egypt, who were leading by 2 goals with just 12 minutes left to play. In the other game, Switzerland beat Colombia in a penalty shootout to reach the quarterfinals for the first time in 72 years. And from football to tennis, where Novak Djokovic booked his place in the Wimbledon semi-final, the 39-year-old survived a 5-hour marathon against Felix Auger Aliassime, which lasted 5 hours and 15 minutes. This was Djokovic's longest match at Wimbledon.
Like Messi, 39 years, once scores goals. You win after 5 hours and 15 minutes.
It would be nice to play 90 minutes like him. But.
Okay.
Well, that is Djokovic there, 5 hours and 15 minutes. I mean, endurance takes on a whole different meaning. They're the longest Wimbledon match that Djokovic has ever played and the longest quarterfinal ever witnessed on a court at Wimbledon. With that, it is time for us to wrap up this edition of Business 360. Do stay tuned to CNBC TV 18. We've got plenty more coming up for you right after this short break.
Using that equipment. And Russia, you know, it's a big country, but it's a big force. Russia's always been a big fighting force. So, you know, it's, but I really believe it's ready. It's very interesting because you'd almost say it's worse than ever, and maybe it isn't. Sometimes with war, and you study war, and I've studied it so long, for years, long before I did this, sometimes it's when it gets the worst. And I don't know that it's the worst right now. It's consistently bad. They lost 25,000 people were lost, kids, young people, last month. And we had a month, 35 2 months ago. And I would say more Russians. And but it's just they're people. They're people. And there's actually very little difference between the people. I mean, you know, it's like the Russians and Ukrainian people. And they can get along, but it's a nasty war. Thousands and thousands, mostly soldiers, are being killed. The battlefields, I see pictures and it's horrible. He thinks it's horrible. We all think it's horrible. And the president wants to get it done, and I believe that President Putin wants to get it done, and that should be a good combination. Thank you.
Mr. President, what is your assessment on Ukraine's strike on Russian oil refineries and military factories?
Where are you from?
Ukraine.
Phrase the question differently, please.
Ukraine delivered strikes on Russian military factories and on oil refineries, and they ran out of gas.
Marco, why don't you answer that? Because you're right in the middle of it.
Yeah, no, I think what you're discussing is the ability of Ukraine to reach deep inside of Russia and conduct strikes. Sure. I think that's one of the dynamics that's changed in this war over the last few months, and that is that Russians are finding it more difficult to defend their own airspace. And what we hope that means is that it's going to create the space now to negotiate the end of this war.
It's an escalation, but it's also an escalation that can help lead to an end. And,
Mr. President,
That is the president at the NATO summit in Ankara, bilateral there with the Ukrainian president, Vladimir Zelensky, saying that they hit Iran hard last night and will probably hit Iran again hard tonight, registering his dissatisfaction with that ceasefire, which he earlier said is now over. Good Wednesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer, David Faber at Post 9 of the New York Stock Exchange. Pre-markets trying to burn off some of this early morning selling as the president...
AI may be grabbing the headlines, but data is powering the revolution. At the heart of that transformation is NetApp, a $30 billion intelligent data infrastructure leader, helping enterprises unlock the value of their data across cloud and AI. After a landmark year driven by record financial performance and growing enterprise AI demand, CEO George Kurian...
Headlines from the startup space. Industrial automation firm Adage Automation raises 230 crore rupees in a funding round led by Incred Alternative Investments, will use the capital to expand manufacturing capacity, strengthen its global footprint and pursue strategic acquisitions.
EdTech platform Elevate Education bags 170 crore rupees in a Series D funding round led by Westbridge Capital. The fresh capital will be deployed towards strengthening its AI capabilities, expand its partner institution network and target profitability in FY27.
Skincare startup Neothera bags 9 crore rupees in a pre-seed funding round led by Bloom Ventures. The science-led skin health brand will use the capital to accelerate product development, expand clinical research and strengthen its go-to-market strategy.
Google selects 20 AI-first startups for the latest cohort of its India Accelerator program from over 2,500 applicants. The startups span sectors from healthcare and climate tech to developer tools and agentic AI.
PhonePe has elevated long-time engineering leader Srijan Biswas as its new Chief Technology Officer. Biswas will now lead the fintech major's engineering organization, while co-founder Rahul Chari takes on the expanded role of Chief Product and Technology Officer. Well, those were the headlines we've been tracking for you this evening on What's Brewing Today. India's energy transition is creating a new financing opportunity as rooftop solar adoption accelerates across households and businesses. Access to fast and affordable credit is becoming just as important as access to solar panels. Green Finance NBFC Solfin Sustainable Finance recently raised 280 crore rupees, turned profitable within its first full year of operations and has now secured a CARE A- credit rating and is preparing to raise another 600 crore rupees in institutional debt to expand solar financing across India. Joining me now is Gautam Kaushik, the co-founder of Solfin Sustainable Finance. Gautam, welcome to Startup Street. First, tell us, what does the CARE A- rating practically change for Solfin? Does it lower your cost of funds, expand access to institutional lenders, or ultimately make solar loans cheaper for customers?
No, absolutely. First of all, a very good evening to you and to your viewers as well. And thanks for having me on the show. Gives me a great opportunity to talk about Solfin, but most importantly, talk about the energy transition that's happening around us. So you talked about the rating. Well, we are proud of getting the rating, especially we are still within the second year of our operations, right? So it is definitely a proud moment for us. Having said that, the credit rating is a barometer that is basically used by various lenders on how they perceive and price risk, right? So it creates the conditions for us to actually go for cheaper borrowing. Doesn't switch immediately. But what it does is it creates those conditions, right? An immediate fillip is that we clear the threshold for a lot of DFIs, for a lot of banks, because they look at a specific rating, typically a BBB or an A-. Beyond that, they can start lending, right, to institutions like ours. So yes, it broadens for us in terms of the lenders that we can talk to. It deepens the kind of discussions that we can have, not just on lending, but co-lending as well.
Okay, Gautam,
longer tenures as well.
Yes, you've built Solfin around a technology-led underwriting engine that claims to reduce loan approvals from weeks to days and in some commercial cases to single-digit turnaround times. Walk us through how that works. What data are you analyzing differently from a traditional lender?
Yeah, so I think it boils down to the fact that we are faster because not because of we are taking more risk. We are actually removing the friction in the process, right? We are also looking at the asset very differently. So the first point of call is the fact that we are trying to get all the information from the various sources directly through API. We leverage AI in terms of being able to assess that information, grade that information. So that a lot of manual intervention, which is involved in the initial stages of underwriting, is actually done away with. That's typically done with the help of AI. And then we also look at the underwriting differently, right? So we're not just depending on the bureau and the deadlines or the I would say the leverage that the customer carries. What we look at is the asset and the requirement of the customer, right? To what extent would the asset create the conditions for a customer where saving can pay for the loan itself, right? So what we look at is the asset, the economic profile of the customer. We look at all the data that has been collected.
Understood.
And the fact is that with every underwriting, with every sanctioning, right, we are getting more data, which actually helps us improve our underwriting models.
Okay. Gautam, you currently work with close to 1,400 partners, including EPCs, dealers and manufacturers like Vari. Is this ecosystem approach becoming your biggest competitive advantage, and how important are these partnerships in expanding into Tier 2 and Tier 3 markets?
No, absolutely. I think that would definitely be the biggest advantage that we have, and we plan on expanding and deepening this network that we have. Like if you look at India, it's a very complex country, right? You have a lot of population that still lives in Tier 2, Tier 3 towns, and it's practically impossible for a lender of our vintage and of our scale to reach those locations. Whereas what these partners do is it helps us create a quasi branch right at those locations, and these partners are reaching out to those customers on a daily basis. And we are there at the till when the customer is making that decision to go for solar. And we can provide financing to the customer. And typically, like if you look at a residential rooftop, which is typically the requirement at Tier 2, Tier 3 town, our sanctioning is less than an hour. Right? So the idea is that you work with a large set of EPCs who have gathered that trust with the customers, who are adept and very, very good at what they do. And then ride the network, ride the trust that they've built to also provide the financing rails to their customers.
All right.
So it's not just like something that is required. I think it's essential for us
Absolutely.
to ride on this partner network as we
Yes, Gautam. But Solfin also turned profitable within its first full year of operations. Like I mentioned earlier, you recently raised 280 crores, of which you plan to mobilize 250 crore rupees. What are the revenue and expansion targets going forward? And sources tell us that you're also looking to raise 600 crores in debt soon. Can you confirm this?
Yes, so I can definitely talk about the numbers, but I think what's really exciting is the space that we are operating in, right? If you look at the whole energy transition space, it's a several lakh crore opportunity. You have 3 lakh homes which are actually getting solarized every month, and the number is only going to go up, given the fact that we have less than 1% of the roofs in the country solarized. So the economics are definitely getting better by the day, and the customers are getting more aware. So if you look at the immense opportunity that we have in front of us and our aspiration to carve out a decent size share, any number that I quote is going to be like showing like a small lamp to the sun. Right? If you look at the equity that we have raised and the rating that we have, it positions us nicely, right? So if you look at a company of our size and scale and vintage, and if you look at a gearing ratio of around 2, given we have 380 crores of equity, we are looking at another 500 to 600 crores of debt, definitely. So that we get there and close out 1,000 crore of deployment on the asset very quickly.
Right? So Gautam, as you now look to mobilize more institutional debt, what's the next phase of growth? Are you expanding beyond solar financing into adjacent green asset categories like EVs, battery storage or energy efficiency? And looking ahead, do you see Solfin evolving into a broader green finance platform, or will your focus remain firmly on solar?
Well, we feel that the next phase for us is going to be all about depth and adjacency, right? So we've built a machine which looks at assets very differently. It is built a partner network. We will obviously build out a lender network, which is basically into green financing. So it's a machine that can definitely walk into adjacent territories. Having said that, when I look at it, I think we still see a significant opportunity within the solar ecosystem. right? You look at different customer segments which are evolving. We see BESS as a very big opportunity which is emerging and which has a very strong agency with solar. EVs on the horizon, but we have to prove ourselves within solar and BESS before we earn the right to also get into to get into EV. So while we are looking to move into these adjacent dimensions, solar is going to be the strong foundation that we build on.
Well, on that note, it's time for me to wrap up our conversation. Many thanks, Gautam, for joining us on Startup Street, and wish you the very best in all your growth plans.
Thanks, and wish you all the best as well. Thank you.
And moving on, as India accelerates its electric vehicle ambitions, the race isn't just about making more batteries, it's also about securing the critical minerals that power them. That's where battery recycling is emerging as a strategic opportunity. Batex Energies, one of India's leading battery recycling and critical mineral recovery startups, has just raised 105 crore rupees in a Series A funding round led by Ivy Cap Ventures. Now, the company plans to scale its recycling and refining capacity, deepen its tech stack, and help build a domestic supply chain for battery-grade materials. So can India reduce its dependence on imported critical minerals? And what role will startups like Batex play in that journey? Joining us now is Utkarsh Singh, the co-founder and CEO of Batex Energies. Utkarsh, welcome to Startup Street. Thank you so much for joining us here today. You know, when you started Batex, battery recycling wasn't exactly a mainstream conversion in India, right? What sort of convinced you that recovering critical minerals would become one of the country's biggest clean tech opportunities?
Right. Thank you, Anilti, for having us on the show. And it's a great question that, see, when we looked at the entire space of electric mobility, it was very clear that it is happening because of the green transition that is required. When everybody talked about, okay, we need to have more and more batteries, but nobody thought about that these batteries and these cells are not actually made in India. It is all imported from all over the world, specifically from various key countries, right? But as you bring in more and more of these cells and you deploy it after a certain age, it becomes a scrap. So therefore, what happens to this critical material has always kept us awake at night. And that is the problem that we are solving, that how we can create a domestic supply chain of these critical materials so that we can become Atmanirbhar Bharat and develop the cell manufacturing in India. So that is the mission that we are on.
All right, so that's the mission you're on. You know, you've raised this 105 crore rupees in a Series A round led by Ivy Cap Ventures, right? What's sort of the immediate priority for this capital? Is it like expanding recycling capacity, investing in tech, or building India's critical mineral supply chain? Where will the money go?
Yeah, I think this capital was very much crucial for us, led by Ivy Cap Ventures, and also our existing investors like Zephyr Peacock and Mankind Pharma Family Office have also pulled in and topped up in this round. So this capital will be specifically used for scaling up our operations. We are already commercial scale proven in these critical materials from the used lithium-ion batteries, and we're supplying the critical minerals like lithium, cobalt, nickel back into the market for various other applications. But with this particular capital, our idea is to triple our capacity. And with the triple capacity, we are on track to make India as one of the epicenters in the world for critical material refining and recycling. So I think that is what everybody around the world is looking at, to have China plus one strategy. And that is what we are creating in India.
Absolutely. And, you know, battery recycling is often seen as a capital-intensive business. Can you walk us through your business model today? Because essentially, you're making sustainability less expensive, right? So where do your revenues come from? What kind of capacity are you operating at? And when do you sort of expect the next phase of scale to kick in?
Right. So at the moment, as on date, we have already set up a commercial scale plant, which is in which we are already producing close to hundreds of tons of these critical materials, specifically cobalt and lithium at the moment. And then we are scaling up also for nickel. And trust me, all of these metals are not found in India. 100% of them are imported today as on date. So with this capital, we are going to increase the capacity, right? And because these materials are not only used for new lithium-ion battery recycling, but it is also used for different other applications, like in steel manufacturing. Cobalt is used in your aerospace, wherein lithium is used in pharmaceutical. So we are also looking at catering and creating niche products using these materials for various other applications. So that is what is the journey we are on.
Sure. And, India still imports a large share of the lithium, cobalt and nickel needed for EV batteries, right? How much of that dependence can companies like BATX realistically replace over the next 5 years? And what role do policy incentives play in this?
Oh, yes. I think so Ministry of Mines have come up with a critical mineral mission. That is the key flagship, campaign for solving this problem. Because see, as the utilization of more electronics is happening around the country, and there is always a threat of the supply chain because we are very much dependent for the 100% import of these materials. It is not only in critical minerals, but also in rare earth materials, right? So as a company, we also focus to use this capital for development of new technologies, which is into the rare earth magnets and extraction of rare earth materials. So we are looking at solving the entire, puzzle, wherein we are able to replace at least 30% of the complete import that is happening in country today. So I think with this, venture and many more like us, we will be able to together solve for India and make us self-reliant in this space.
And become self-reliant in this space. And, like you pointed out, everyone wants to build the urban mining story, right? You already have 4 granted patents and are now moving into cathode active materials. What gives BATX a technological edge, and how difficult is it for competitors to replicate what you've sort of built?
Exactly. So since inception, we have always been a technology-driven company. And I think for us in the market, technology speaks for itself. Because what we have been able to build is almost in 1/3 of the capital that anybody would build in India, and at least 1/10 of the capital that anybody would build in Europe or US. So I think it has only been able to happen because of the key technology team, and specifically our co-founder and CTO, Mr. Vikrant. So this is what has given us an edge to develop and have less and a quicker iterative cycles for the technology development. So I think we will continue to innovate and evolve, and now getting into the cathode active material. So we are now going to set up a pilot scale plant. We already have a patent granted for the production of cathode from the used lithium ion LFP batteries. So I think that is something that will give us an edge. And as a company, we'll continue to innovate.
Absolutely. And, before I let you go, you also have plans to go global, right, and move beyond India. Is the ambition to become a global critical minerals company? And could we eventually see BATX supplying battery materials directly to EV manufacturers?
Yes, I think that is the ambition, because if you look at the entire supply chain, it is all routed towards one country in the world, right? And when we visit Europe or we visit US, it is always that everybody is looking for what alternative we can create in the global south. And I think in India, we are very well positioned to become the center for refining in the world. And in all of the countries with the FTA with Europe and different MOUs with countries in the global south, I think India is very well suited. And as a company, we are going to capitalize on all of these opportunities. And I think we are well suited for this space.
All right, Utkarsh, thank you so much for taking time out and being here with us on Startup Street. We wish you all the best on this journey going forward.
Thank you, all the best. Thank you.
Well, on that note, it's time for us to head into a short break. But coming up next, can carbon capture finally make commercial sense? We speak to Ugreen Technologies founder and CEO Gaurav Dwivedi on turning industrial carbon dioxide into reusable fuel. Stay tuned. Welcome back to Startup Street. India has set its first binding emission targets for heavy industries, but can carbon capture become commercially viable? One startup believes it has the answer. Ugreen Technology says its solution can capture industrial CO2 at a fraction of global cost while converting emissions into reusable fuel. CNBC TV 18's Aishwarya Anand speaks to Gaurav Dwivedi, founder and CEO of Ugreen Technology, on the sidelines of the IVCA Clean Air Forum 2026.
India is the world's third largest emitter of CO2. So help me understand, how is Ugreen solving for that?
Everyone is just blaming the industries that you are emitting, you are doing this, you are doing that, but no one is actually giving them a solution. If they are giving steel at, let's say, X rate and decarbonized steel at, let's say, 10X rate, so would you be willing to buy that? No, obviously not. So that's where Ugreen Technology comes in. The core idea behind our whole company, that we want to make sustainability profitable. The CO2 capture device that we created, that captures your carbon dioxide at the very point source, and that's not just it. It converts that captured carbon dioxide into fuel that you could reutilize in your industry, hence cutting down your methane or your coal consumption. So that's a circular economy that we are creating for our consumers.
Can you give me a use case example of when people use your product? How does it actually work?
We have done a project where the inlet CO2 composition was 66%.
Okay.
So it was huge, it was very massive, and the outlet CO2 composition was 0.2%. So it was like greater than 99% of capture efficiency. And the cost that we are giving, it's 50-60% less than our counterparts in Europe or some of them who are working in India.
Which industries are you particularly catering to right now?
So at this particular stage, we are catering to the hard to abate sectors.
Okay.
The sectors who are difficult to decarbonize, like steel, power, cement, aluminum, all of these. So 9 sectors Government of India mandated to decarbonize. We are helping them out at this particular stage. Apart from it, we are also working with some biogas customers, we are working with natural gas customers.
Interestingly, you've also ran a pilot with Oil India,
Yes.
Which is India's first ever carbon capture project in oil and gas sector.
PNP of oil and gas.
Right. So what did that look like on the ground field?
So the location of our pilot was in just 10 kilometers or 9 kilometers from the border, from the Pakistan border. So the heat was around 55, which it was in a desert. So the heat was very high. And all of the scientists who are working in this CO2 capture field, they are very well aware that if the temperature goes up, the capturing goes down. But we were against that fact. कि यार करके तो देखते हैं, पेड़ भी तो कर ही लेता है ना capture. So when we implemented our machine, so the results were very beautiful. We were able to achieve more than 97% of capture efficiency.
What does then your business numbers look like? Because how are you monetizing? What does that look like? Give us a sense of that. Give us an in-depth analysis of it.
So after $500,000 spent and after half a decade of R&D, so we are here. So we recently started our commercialization like a quarter ago. This particular financial year, we started a commercialization in April 1st. And till this time, we have clocked in orders of more than $1 million.
The US has passed the Inflation Reduction Act, giving billions in subsidies for carbon capture.
Yes.
The EU has a carbon border tax coming in.
Yeah.
India has just notified its first binding emission targets. So does that change your business overnight, or is it compliance? Is it like compliance in India is still very easy to avoid?
These policies, yes, they help us a lot. They do help us, they do give us a room to even talk to our customers and everything. But at the end, nobody is scared about this because obviously you can never tell a steel manufacturer that stop producing steel because it is polluting the atmosphere. How would you make your homes? How would you make trains? How would you make cars? And anything. We are a developing country. We need everything, and we cannot put a cap over these people. You cannot decarbonize. We have to give them solutions. And they are willing. They are very, very willing to adapt to these solutions.
Between your tech and what China could provide, what is the difference in cost on that front?
So China's commercial things haven't yet touched India's market. So there is no commercial number that are available, but I know commercial numbers that are available with some of the companies who have done, directly not associated with China, but might be associated with China. So if they are giving you the cost of let's say $40 to $45 per ton of CO2 capture, we are giving you the cost of $19 to $20 per ton of CO2 capture at just 1 ton capacity machine. If we'll scale it up to 20 ton, let's say 100 ton or 200 ton, the cost will go to $8 to $10 per ton of CO2 capture. They are at 45, we are at 8 to 10.
Now RDI fund has come into picture. Is it a huge boost for you? What does the investment space, what does the capital raising space look like for you?
We are applying in that particular fund, so we know that it's a beautiful fund. 50% given by Government of India in form of CCD or debt. It's huge, huge, and the interest rate are like massive. क्या मतलब बहुत ही अच्छा fund है.
And with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching. More news and updates continue right here on CNBC TV 18.
Grabbing the headlines, but data is powering the revolution. At the heart of that transformation is NetApp, a $30 billion intelligent data infrastructure leader, helping enterprises unlock the value of their data across cloud and AI. After a landmark year driven by record financial performance and growing enterprise AI demand, CEO George Kurian believes data, not chips, will define the winners of the AI era.
When we last spoke, which was about 3 years ago, it was all about the cloud. And now it's all about AI. What do you make of this massive transformation and shift that's taking place?
I think it's built on the foundation of large-scale digital technology being available with an important couple of other ingredients. One is sophisticated computer models, and of course, the ability to harness the power of large amounts of data, which is where we come.
Your thesis on data being at the center of everything is proving right today.
Thank you. Yes. We've long held the view that in addition to talent and understanding your business or your clients deeply, data becomes the competitive moat of an industry. You know, everybody has access to the same chips, everybody has access to the same models, and the models themselves are largely trained on the same data. And so your ability as an organization to deeply understand your business, your clients and employees using your data becomes the competitive moat.
So that is the competitive moat, as you point out. But I want to understand from you, it's been what, a little over 10 years for you here at NetApp. So you've seen many cycles. What is specific to this particular wave that we are seeing, the AI wave that everybody wants to get on top of? What is different this time around?
I think it has the promise of a platform shift in a broad sense. Certain industries are already experiencing that, digitally intensive industries. I think for that to become a reality, the technology has to prove out its promise. I think, the organizations that use the technology need to have an understanding of how the technology works. It can't just be a black box.
Yeah.
And you need to be able to change the way people and businesses fundamentally operate. So lots of promise, but lots of work to do.
I started by saying that you've had a landmark year. How do you build on that? How do you top on that? Because you've had a record-breaking quarter in many ways.
I think it starts with strategic clarity, which is what can you do and be the best in the world at? And that gives you the clarity of understanding, the humility to rethink your ecosystem so that you can build complementary capabilities and serve your customers really well. I think the second is customer centricity. To be able to help clients, you also have to understand how to use the technology yourself. And then the third is culture. We have a belief that whenever there's a transformation, that you have to understand its relevance to your business.
Yeah.
And if it is relevant, then you want to lean into it and encourage adoption. And I think in that case, trust beats policy all day long. It's much easier to have a workforce that you can trust and that loves our company and wants to do right for the company. And it encourages use and adoption versus having a big policy manual of to-dos, what to do and what.
So there is no big policy manual of a long to-do list?
No.
No? And what has it done in terms of workforce and workflow for you inside NetApp?
I think we have two perspectives on that. The first is, we're trying to build an enduring institution. And I think at the fundamental heart of every institution and professional organizations is the idea of apprenticeship. And in this case, we actually really believe in bringing young talent to the company because they will be the future generations. And in some ways, what has been interesting is the mentorship in this case has been reversed. The new talent is much more facile with the technology than the more senior talent. And so it's really encouraging and interesting to see the new generations teaching the older ones how to use it. And so that's one view. It's sort of a long-term view of the talent pipeline and the opportunities there. And then the second is you need to be able to get people to think about the skills needed now that they have these powerful tools. So for example, it used to be in software development, the idea was that, the entry-level person would write code and then would have a more senior person teach them how to review code. Now you've got an agent writing the code for you, and as an entry-level employee, you have to be able to learn how to review the code. So you have to upskill people. And then once you do that, you can see enormous power. The third thing we have done is to really measure business outcomes rather than just usage. So, in software development, for example, rather than look at naive indicators like token use, we're actually seeing, hey, are people able to deliver better, higher quality code to the system? In customer support, we're measuring do our customers actually get the information they need better, faster, easier.
It's interesting that you talk about bringing young people in and how young people are a lot more agile with this technology particularly and understanding it and using it. But what does all of this now mean as far as the workforce is concerned from a jobs point of view? And I think that is what is causing a great degree of anxiety at this point in time. I mean, if you've looked at the graduating ceremonies and what's going on with tech CEOs and the kind of backlash that we're seeing at this point in time, how do you respond to that? What do you believe the workforce of the future is going to look like if we do have this hybrid model where digital labor and human labor will coexist?
I think there are broad implications, and I think it begins with having a deep understanding of the technology itself. Aristotle says the most dangerous thing is the illusion of knowledge.
Yes.
And today, I think broadly based, including the tech industry, we have an illusion of how this technology works and learns and understands itself. So we've got to be able to get a lot deeper in terms of truly understanding where it is useful and where it's not. I think the second is, as a member of the technology industry, we haven't always gotten it right. I think social media, remote working have been examples where the tech industry sort of highlighted the promise of something that had downstream consequences of, very negative consequences, right? Mental health and all of these other negative consequences of those technologies. And so we need to be more balanced in our view. And then I think thirdly, you've got to make sure that we cross the digital divide. This is where, particularly in India, there is an opportunity for India to lead the world, where I really believe the application of this technology to make available affordable healthcare or better food security or mitigate catastrophic risks from happening is perhaps more important than gloating about how powerful the technology is. And I think we have a responsibility to make sure that the next generation doesn't feel as much despair as they feel right now.
The other things that I think is now sort of becoming part of conversations is the fact that you need partners. You need to create an ecosystem. It cannot be one individual company or a few companies that are going to drive this and lead this, or it should not be left to a few companies to drive and lead this. How do you respond to that? And do you believe that will policy or regulation force the ecosystem, or is enlightened self-interest going to force this ecosystem to collaborate much more?
We've been in the data center business for a long time, and data centers are multi-vendor, and we've believed always that it's better to harness the power of collaboration and community to build a better outcome for clients. I think that's true across the globe. And I think that, it probably requires a combination of regulation to protect against some of the risks, but also enlightened self-interest. Platforms are better when more people contribute to the value of the platform than a single controlling individual.
So, speaking of partnerships, I mean, you've done a bunch of them through the course of this year, including with Google Cloud, Nutanix, and a whole bunch of other companies as well. What's exciting at this point in time? You've got a pretty solid pipeline of launches. You've launched many products as well. What's happening on the innovation engine that has you excited?
I think it's really to help our clients use their data and to be able to deliver amazing outcomes. We've been fortunate, for example, to work with the European Space Agency to map the universe, right? And I think that that work does not happen alone with us. It certainly starts with the knowledge and insight of our clients, but also the partnerships that we strike with other organizations to be able to deliver amazing breakthroughs. And I think that for us, the importance of partnerships are because it allows us to bring the world's best capabilities that we have, but also to work with other industry leaders. And the joint work brings a much better outcome.
Been very bullish on the Indian market, but how has India changed for NetApp since we last spoke, which was about 3 years ago?
In multiple ways. Certainly we've always believed in the talent in India. We have our largest development center, which is now close to 4,000 employees.
And you think that will continue to be the case? Because everyone's talking about, the agentification of the workforce, and that would probably lead to less hiring or maybe not so much offshore work. How do you respond to that?
We think India is a great place for talent, and we are increasing our employee population there. We have highly skilled employees, and so they will be a cornerstone of our research and development organization for many, many years to come.
Okay.
I think the second is we're working with the innovation ecosystem in India, both through our accelerator program, which has been very successful. It's one of the top 10 accelerator programs in the country, and we've seen both women-owned businesses as well as other innovative startups kind of learn and benefit from our experience. And so that's a contribution to the innovation ecosystem. Plus, we're working with NASSCOM around how to enhance digital literacy. And then certainly, we've been privileged to work with large public institutions as well as commercial institutions to help bring capabilities to the Indian population. I think that some of the large digital and mobile platforms, certainly many of the largest government agencies, and the large banks and financial services institutions.
So given the opportunity, where does India figure? I mean, outside of being an incubator of innovation as well as a talent hub for you, in terms of growth in the market, where does India stack up?
We see it as one of the fastest growing IT markets in the world. We are fortunate to be the #1 share player in our segment of that market, and we are bullish. We are expanding our investments there. We are working with the local ecosystem in addition to the global ecosystem. So we're excited to be in India.
You said you're expanding your investments. Is there a number that you can share with us in terms of what we can expect?
We've grown our investment in India across all of our functions, and we'll continue to grow that. Over the last several years, we have steadily grown and outpaced the overall pace of investment in the company.
One of the other factors that's weighing on decisions at this point in time is geopolitics. And I think, sovereignty and what that means as far as AI is concerned is gathering momentum. And I don't think there are easy answers. There is a complex problem. How do you look at that issue today? And what will NetApp do when it comes to issues like sovereignty? Do you see that as an opportunity for you?
Yeah, I think, first of all, we are hopeful that there is a uniform sort of commercial and regulatory framework for AI. We think that having a harmonious framework across the countries and across the globe makes it easier for everybody to build safer technologies while continue to bring innovation. And I think there's still work to be done there. With regard to, kind of the fundamentals of how we see the ability to foster sovereignty, I think there's certainly multiple elements to that. There's data residency, which is foundational. We have done that in so many organizations around the world, and part of the partnership with Google Distributed Cloud, for example, is to facilitate data residency without having some of the concerns about, kind of my data crossing national boundaries. The second is we have tools that allow organizations to be able to go beyond data residency to maintain data sovereignty, which is the ability to use the data alongside the innovations that are being available, global set of innovations, but to use the data in compliance with national mandates. And then over time, by contributing to the ecosystem in countries like India, we think that you can bring more technologies to the world. Today, if you think about the AI ecosystem, it's primarily led by 1 or 2 countries. And I think over time, for sovereignty to become possible, you need to be able to have more countries have, kind of supply chain independence for these technologies, and we're part of helping make that happen.
Supply chain independence is a great point, but speaking of countries benefiting and also creating their own competitive moat, what will India's competitive moat be in an AI era?
I think India's greatest contribution to the world in AI is actually to lead the world in the applications of AI. You have a young population, you have a large amount of data that can be harnessed because of the role the government can play in fostering that. You have innovative, entrepreneurial, digitally savvy innovators. And I think that my hope is that India leads the world in that, making it affordable, making responsible AI be able to reach a large population. And by doing so, you can teach the world.
Will that be enough? Because the question being asked is, if you're not playing across that